the tensions between US and European nations at the Davos. Harvard professor Kenneth Rogoff says he has never seen European leaders this upset in all the years that he has been coming to Davos. Euro-Asia Group founder Ian also said that Trump has two different modes of foreign policy. Indian IT CEOs are upbeat at Davos. HCL Tech's Vijay Kumar expects $1 billion opportunity thanks to artificial intelligence. CEO of Cognizant says that the next 3 years will see a big and bold bet on AI. RBI needs to do more on continuous liquidity, says Axis Bank's CEO Amitabh Chaudhary. Also believes the interest rate cut cycle is over. Says hiking deposit rates will not be enough to boost deposit growth. That's an exclusive. Hello, good morning. You've tuned into CNBC-TV18. You're watching Power Breakfast with me, Vinny Motiwala. While we have seen muted days coming in the last few trading sessions, even yesterday was nothing great for the Indian markets as well. What is the Asian market doing today, given we still have some more commentary that came in during the day yesterday from President Trump as well as post-market hours as well. Now, today, Asian markets have opened up a bit mixed. When you look at it, the Hang Seng is trading with mild bit of a gain today, 0.2% of gain right now for the Hang Seng. But Taiwan index, that's down 0.4% approximately. ASX 200, that's down with cuts of 0.6%. And Nikkei, that's the Japanese index, that's down 0.8%. Japanese bond yields, 40-year bond yields also have hit fresh highs. Now, obviously, that Trump as well as the EU tensions, that is continuing. So a bit of a mixed cue is what we are picking up today from the Asian markets. Now, look at the GIFT Nifty or Nifty Implied Open. What is that indicating? A very muted start for the Indian market. Right now, a slight bit of a positive bias is maybe something that we're keeping an eye out on in terms of the Indian markets. But that's the global market action that we have, as well as Asian markets, how they've opened up following that. How is all this going to be impacting our Indian markets in terms of important cues, the trade setup for today, stocks to watch out for? We'll talk about all of that with our team of research who's joining us right now. First up, let's go across to Vivek, who's telling us which are the important cues that we're keeping an eye out on. Today is the Nifty expiry as well, Vivek. Good morning.
Well, good morning. So many cues to keep an eye out for. But, when you're looking at overnight cues, remember, US markets were shut last night, which is why we're not taking any overnight cues into consideration. Yesterday, oil markets ended largely flat with marginal gains. Now, in terms of Indian markets, remember, yesterday is an extremely volatile trading session. The market was digesting significant heavyweight earnings, and on the back of that, you did see sharp moves either ways. Which were the key gainers yesterday on the back of good results? Telecom, CG Power, Indigo. On the other hand, key drags were ICICI Bank, RBL Bank, and remember, we had a very strong listing from one of Coal India's subsidiary, which is Bharat Coking Coal. In terms of events to watch out for today, quite a long list. World Economic Forum Day 2, result reactions for Lvls, LTI Mindtree, CEAT. Key results today, Persistent Systems, AU Small Finance Bank. Remember, IEX will remain in focus. The market hearing, or the hearing for, as far as the market coupling case, will continue at Aptil today. Restaurants Brands Asia, Q3 results, as well as the board meeting for fundraise is something that the street will keep an eye out for. Also remember, later on today, US Supreme Court, there is another date as far as the decision on whether or not Trump's tariffs, global tariffs, are legal or not will be made, and large block deals are expected in two Aditya Birla groups, both lifestyle brands as well as fashion and retail. And like you mentioned, GIFT Nifty Asian markets all indicating a subdued start for our markets today.
Okay, Vivek, thank you so much for that. But let's move on, talk about the important stocks that you should be keeping on your radar today. We have Upasana joining in with us for that. Good morning, Upasana.
Good morning, Vinny. First up, let me start with LTI Mindtree. Good quarter in line with estimates. CC revenue growth seen at 2.4% and EBIT margin at 16.1 versus 15.9. Next up is Havells India, largely in line set of numbers with our estimates. Revenue up 14%. Also, talking about the margin, it stood at 9.4% versus the estimates of 9.7. Mind you that the cables and wires and ECD saw good growth, but Lloyd Consumer saw muted performance. Tata Capital net profit up 20%, NII up 10%. Oberoi Realty also reported its numbers with a net profit up nearly about 0.7% and revenue up 6% on a one-year basis. Seat overall, a good set of numbers, net profit up 60%, revenue has seen an uptick of 26%. Margins saw a sharp up move from 10.3% to 13.5% on a one-year basis. Sai Silks also reported good set of numbers, net profit down 17.4%. But the revenue has seen an uptick of 8.3%. Margin stood at 17% versus 17.7% on a YoY basis. UPL will also be in focus as the company's arm, that is Advanta, files draft and red hearing prospectus for the SEBI for an IPO. So we'll be watching out for that as well. Ola Electric, Harish resigns as the CEO with effect from 19th of Jan, and the board appoints Deepak Rastogi as the CFO of the company with effect of Jan 28th. Now, according to our sources, Aditya Birla Lifestyle Brands will be in focus on the back of the block deal. The investor is likely to sell up to 3% stake in the company via block deal, and offer size is nearly about $43 million, and the floor price is seen around 106 per share. And lastly, coming to Aditya Birla Fashion and Retail, according to our sources, investor is likely to sell 3% stake in the company via block deal, and the offer size here is nearly about $32 million. So all in all, we'll be watching out for all these stocks in our today's trading session.
Thank you, Pasna. Thank you so much for that. But the final leg of update that we should keep an eye out on, that's the F&O space. And for that, we have Sudarshan as always. Good morning, Sudarshan. Anything exciting that we're expecting today, given that it's weekly expiry?
Good morning, Vinny. So yesterday we saw it was a volatile day of trade thanks to the earnings that we had seen from heavyweights like ICICI Bank, HDFC Bank and Reliance Industries. All these stocks dragged the market along with the major IT stock that was Wipro, which was top Nifty loser, fallen almost 8%. Coming to today, it's a weekly expiry for Nifty. And if you go by the indication that you're getting for put-call ratio from the options data as well as from GIFT Nifty, we are going to see a range bound of trade where Nifty would try to protect the recent low of 25,473. It's tough for Nifty to go below 25,500 on an immediate basis because now the range has become narrow from 25,500 to 25,800 to 25,900. As far as the flows are concerned, we have seen selling in both index futures and the stock futures by FIs. Longs exposure for FIs remain around 9%. On the short side, they remain heavily shorted and the exposure remains around 91%. Coming to the options data, two active options on the call side, 25,600 and 25,650. On the put side, the most active option was 25,500. That's the reason I'm telling you it's tough for Nifty to slip below 25,500. So support would be around 25,473. That's the recent low, and resistance would remain around 25,960 as far as the Nifty Bank is concerned, which remains on a very strong footing. And for that, support would be 59,555. That's the 20-day moving average, and resistance would be around the record high level of 60,437. Two stocks remain in the band. Usual stocks, SAIL and Samant Capital. Two stocks that I'll keep an eye on. Hindustan Zinc, it had put out a strong set of earnings, and after that, commentary also is strong. It has maintained the silver production of 680 tons, the target that it has given for FY26. And apart from that, keep an eye on LTI Mindtree, while the earnings were in line, but next 2 quarters expected to be a mild week. So that I'll keep an eye on both these names as well.
Okay, Sudarshan, thank you so much for that. But that's the latest update in terms of the F&O data that we have. Now, let's get you the key highlights from the World Economic Forum's annual summit underway in Davos. The RBI needs to do a lot more on ensuring that there is continuous liquidity. And this is the word coming in from Axis Bank's MD and CEO Amitabh Chaudhry. Speaking to Shireen Bani, as that there can't be a divergence that comes in between the credit and deposit growth. Listen in.
Last time we talked, obviously RBI has very openly stated that they will provide durable liquidity in the system, but I think they do need to do a little bit more. We have had cases where the liquidity has kind of almost gone away because RBI has intervened in the markets. So durable liquidity means constant, continuous liquidity, and the markets should be able to buy into it and act accordingly. That's one. Secondly, the credit growth has picked up, but let's also realize that government balances with RBI remain extremely high. They are at some of the highest we've seen in the recent past. So the deposit growth is still taking more time to come through. If you look at some of the numbers that have been published, they remain in the 10 to 12% range. People have started talking about credit growth of 15 to 17% for next year. Well, as I have said in the past, if credit growth is 15 to 17, deposits need to get there at some point in time. Both cannot diverge. Just hiking deposit rates for retail depositors necessarily does not make much of a difference because the wholesale deposits are priced at the market and the increment all the time. But I hear from the banking system that RBI is not pushing as much on LDR as before. You're also seeing that the public sector banks, which had much more headroom on LDR, have gradually been increasing their LDR ratios. There was a recent article about how we've hit a peak LDR. Given the nature of deposits, given the kind of balance sheet a lot of us have created, LDR might not be the only way to look at the liquidity in the system.
And moving on, Indian IT CEOs are upbeat at Davos. HCL Tech's MD and CEO tells CNBC-TV18 that he expects billion-dollar opportunities thanks to artificial intelligence. Also talks about the company and its positioning itself to benefit from AI-led demand and the growth opportunities ahead. Listen in.
We've been very proactively looking at how to transform our services without worrying about any potential deflation or cannibalization of existing revenue streams. But what's even more exciting is a lot of completely new opportunities. Like in the tech vertical, there is close to $1 trillion of capex. Now, every one of these big programs will need significant services in terms of planning out data centers, the professional services, the GPU infrastructure, and the managed services around that. I think that's what we call as AI factory. That's a brilliant, very big opportunity. It could very easily be $1 billion revenue stream for us in the coming years. And there are many such revenue streams that we've identified, and it's still early days.
And here's another exclusive from Davos. After stabilizing its operations over the past 3 years, Cognizant is shifting gears towards aggressive growth strategies with artificial intelligence and outcome-based pricing at the forefront. Now, CEO S. Ravi Kumar also talks to Shirin Ban about a potential secondary listing in India. Listen in.
I would say the first 3 years was about stabilization, and the next 3 years is actually going to be about bold bets. In the first 3 years, we climbed up the charts, and on relative scale, till the end of Q3, which we have publicly announced our earnings, we are on the upper quartile, top performance on relative scale. So I'm very happy with where we are, but looking forward to the next 3 years, which is going to be big bets and bold bets.
You did publicly state that you are looking at the possibility of a secondary listing or an IPO in India. Where have things progressed on that front? How close are we to an actual decision being taken?
So, Shireen, we are working with the regulators in India. The last time something like this happened was many, many years ago when Standard Chartered did this. Right now, we will be the first company who is attempting this, which means we have the burden of actually helping the regulator to work alongside us to get to the finishing line. So that's a journey we have to go through.
How close is the finishing line?
I mean, look, regulators in India are very receptive for new instruments. This is an American listed company which has the opportunity to list in India as a secondary listing. I mean, that's what Indian companies did in the 90s. They actually listed primary in India and then they went to the US.
Yes.
We think we have a pool of investors in India who are very keen to invest into tech services. Tech services is a proxy for AI. We also think there's a lot of mutual fund money which is being fed from the middle class of India, the vibrant middle class of India. We think we can capture that opportunity for Cognizant and get a new category of investors. It's going to be a journey to do this, but we'll give it a try.
And what are the questions the regulators are asking?
I mean, there are a variety of things because this is the first time we are doing it, but they are in a constant dialogue and we are iterating, and it's very constructive. So I'm very pleased with all the meetings we have done.
And do you think 2026 could be?
Hard to say. I mean, these are things which is very hard to say, but we're going to give it a try.
Okay.
Okay, on that note, we're going to slip into a very short break. After the break, we'll get you all the developments from the White House. Stay tuned in. Welcome back to Power Breakfast on CNBC TV18. Let's get the recent updates in terms of commentaries or updates coming in from the White House. We have US President Donald Trump, who has said that and has also made significant headlines at Davos. In a brief interview with NBC's News, Trump said that Europe should focus on war in Ukraine, not Greenland, and insisted that he would follow through with his tariff plans. Trump said that he would 100% hit European nations with tariff if a deal could not be made over Greenland. Also, in other commentary, Trump also wants a signing ceremony for his Board of Peace in Davos on Thursday, and it is unclear which countries will actually be signing this. The Board of Peace has had a bit of a rough start and a rough landing, as it has been criticized by Israel and questioned by Europe also as well. So that's the latest update that we have coming in. But in some more updates from Davos, top economists and thought leaders also weighed in on the tensions between the United States president and European nations at Davos. Harvard professor Kenneth Rogoff said that he has never seen European leaders this upset in all the years that he has been coming to Davos. Eurasia Group founder Ian also explained how Trump essentially alternates between two modes of foreign policy. Listen in.
Trump has two different modes of foreign policy. He's got the FAFO mode, fool around and find out, which you get if you're Venezuela and Ukraine. He's got the taco mode, Trump always chickens out, which you get if you're Russia or you're China. Right now, Trump believes that the Europeans are FAFO. And the Europeans need to convince Trump that they are actually taco. And that is going to require both military response and economic response that is strong, unified, and credible. We will see this week what we get.
I've been coming to Davos for 25 years now. I have never seen the Europeans so upset. I mean, when Putin invaded Ukraine, they were very upset. This is a whole nother level. He's invading Greenland, and oh, you know, there's 56,000 people. I mean, then he's going to take Switzerland. Then he's going to let Putin take the Baltics. Then he's going to let Putin take Poland. Then he's going to, you know, take Spain. I mean, it's just, you know, absolute frenzy. They're hysterical.
Okay, on that note, we're going to slip into a very short break. We'll get to cues in the world of commodities after the break. Stay tuned in. Welcome back to Power Breakfast on CNBC TV18. Now it's time to get to the latest update in the world of commodities, and we have Manisha Gupta who's joining in with us to give us those updates. Good morning, Manisha. Trump continues to throw his tantrums. We continue to see new updates, but what's the latest coming in terms of crude, metal space? What are we keeping an eye out on?
Yeah, well, I'll start with the crude oil prices because we seem to be holding gains onto this one. Well, as we've been reporting and talking about, the U.S. has threatened a 10% tariff on imports of 8 European countries from February 1st and can be increased to 25% by the month of June if there is no agreement. Well, the near-term supply risks from Iran have eased, but the markets are waiting for the IEA monthly report. That comes in tomorrow. That will tell you about the recent developments when it comes to demand and supply, and markets will take cues from that. Having said that, the dollar index is holding around 99. That is because the Europe holds nearly $10 trillion worth in U.S. bonds and equities. It also has significant public sector holdings in U.S. and that markets believe if the trade dispute intensifies, all of this perhaps could be leveraged and is the reason you've seen the dollar index gain up slightly there. Safe haven buying in gold and silver has just about continued. You have gold hitting record highs around $46.70 an ounce, and silver hit record highs at $94.50 in the overnight markets there. The street will also watch out for the U.S. GDP numbers that come in this week itself, and then the consumer sentiment numbers would also tell you on what the U.S. is going through. But most importantly, there is some profit taking that you have seen across base metals as a space. So whether it's copper, zinc, aluminum, tin, all of that has seen a sharp decline. This is after Shanghai has prohibited a section of high-frequency trading firms from entering the market, thinking that there is way too much volatility and the speculative money needs to dumb down. And that is the reason you are looking at profit taking across base metals.
Okay, Manisha, thank you so much for that. But with that, we're absolutely out of time on this edition of Power Breakfast. Nifty is indicating a very flat to muted start as of now, slight bit of a positive bias, but we'll leave you with the highlights of last night's event at Davos, the CNBC-TV18 Cognizant Davos Mixer, a confluence of the world's most influential voices.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Rima and Nigel. Guys, good morning.
Hi, morning.
Hi, good morning. U.S. markets shut yesterday, but there's still so much action and geopolitical, tensions right on top.
One successful listing, Nigel. Although I think the pipeline is huge, but I think we need. Generally, broadly speaking, for our market, I think we need one set of factors to abate a little bit. We need supply to abate a little bit.
Well, that's right.
And demand to increase a little bit.
On a day-to-day basis, coming to the pitch, and in fact, it's looking all wobbly. You don't know what Trump's doing. Plenty of selling as well out here. And I think that rupee needs to stabilize. I think that's another important mark because the FI selling just continues. A bit of a worry.
Well, I have a very interesting theory on the rupee, which we'll discuss later. Not right now, but I think basically why the government wants the rupee to be weak. I mean, usually it's about exports and how exports become more competitive. But I think, but that's for later. Let me just begin by telling you what you need to know as we begin this new session, right? So U.S. cash markets were shut. Futures is what we have indications from. And U.S. futures were down 1%, 1.25%, I mean, in that range. There was the Martin Luther King holiday, so cash indices did not trade. European equities were all lower. So DAX was down 1.3% by close. The CAC, which is the French market, was down almost 2% or so. And this is, of course, I mean, think about it. It's the it's U.S. usually in a fight, tiff, spat with other countries like China, etc. But here, you've got U.S. in a serious spat with European countries and that security umbrella of NATO at the risk of sort of, disintegrating. We had Ian Bremmer yesterday talking about it. We had Kenneth Rogoff of Harvard yesterday saying, well, in the last 25 years, he's been to Davos. He's never seen Europeans so upset. Scott Bessent, essentially, and this is important, he basically warned European countries against retaliatory tariffs. Remember, Trump is saying 10% from the 1st of Feb, 25% from June, and the tariffs stay till they're able to get control of Greenland. They're able to purchase Greenland. And European countries have been, there have been lots of reports that they'll put retaliatory tariffs on US imports into Europe. So Bessent saying, well, it'll be unwise. And he went on to say, we're not going to outsource our hemispheric security to anyone else. That is, I think it's simmering, and we don't know how this was going to pan out. Remember, President Trump is leading a very large delegation to Davos, the largest ever to Davos. They've got a USA house, as Shireen was showing us from there, and President Trump is expected to speak on the Davos stage on Wednesday. So basically, it'll be Thursday morning when we hear from him from there. Now, just two other things, right? Fed Chair Powell is going to, and this is also in a way historic, he's going to attend tomorrow Supreme Court hearing on Trump's attempt to fire Lisa Cook. It's symbolic, but Fed Chair Powell being in the courtroom in person, in solidarity, as one of his colleagues is being sort of, and this is, of course, related to, she was fired for cause, and the court is going to look at whether the cause makes sense and whether the president has got, ultimate authority to do this. So it's become a bit of a, Trump's attacks on the Fed is not new. He's done it in the first term. He's doing it now. What is new, of course, is that the Fed seems to be fighting back. And, of course, we had that, we had earlier Fed Chair Powell himself under attack, and he can sort of fighting back as well. So this is going to be interesting. Now, the other thing related tonight is going to be possible U.S. Supreme Court ruling on Trump's IEEPA-based tariffs, emergency tariffs. So 2 times it's not happened, and it's been a waiting game, but it may come up and the Supreme Court may rule, and then suddenly tomorrow becomes very different and, big. Of course, only if some of those tariffs are at least partially rolled back. In terms of other commodities, precious metals jumped to near record highs. Silver was up 6%. Gold prices were up very, very sharply, about 2% on gold as well coming through. If you can have the prices up. That's that. Bitcoin fell sharply to about $92,000. Almost 92, and then they kind of sort of, came up a little bit. So up right now, the last time I checked. Yesterday, it's been a bad situation, right? I mean, the market's broken through long-term moving averages. The one level that I've been highlighting is the 20-weekly average, and yesterday's close is below it. So the 20-weekly is now 25,684. And that's not a good sign, ultimately, for long-term watchers of the index. Now, the resistance is the closest is you can look at hourly averages, etc. But the 40 exponential moving average is that's the daily average, is perhaps the closest. 25,895 is that level. And the Nifty Bank, it almost got to the 20-day moving average and then bounced. So there is a bit of an intermarket divergence as well. Financials, especially PSU banks, etc., are not breaking down. But Nifty, of course, has broken down. So, but in a way, the silver lining is, if there is this divergence, I mean, it will get corrected one way or the other. Either the banks will fall or the Nifty is going to see a little bit of a recovery. So we'll see. But the Nifty Bank, the 20-day is 59,552. The day's low yesterday on that index was almost there, not quite. And then we saw a decent bounce and we ended about 1/3% lower. GIFT Nifty gives you a quick sense of where we're likely to start. It's absolutely unchanged, making up its mind as we speak with about 60 minutes to go for the pre-open. Nigel has walked across with the F&O positioning stats. Nigel, take it away.
Well, today is the weekly expiry as well for the Nifty, so it makes things even more volatile. Let's start off with the flows first. No surprises out there. The FIs they continue to sell. The DIs continue to buy. And the FI is selling at around 3,300 crores. It's not coming down from that level. And the Indian rupee on a daily basis, we're seeing some kind of weakness intraday. I think some stability is required first in the Indian rupee, and then hopefully we see some kind of a turnaround from the FIs. Moving to what the FIs did on the future space, they added short positions. Both on index futures, they added short positions. Even on stock futures, there were shorts that were added. So we've got shorts in the system. Percentage terms, 91% of the positions on index futures itself is on the short side. So they're aggressively net short. If you look at it in absolute terms, the clients, their long positioning has hit 1.43 lakh contracts. And I was just going by the chart, in the last 10 months or so, we haven't seen this sort of long build-up from the clients. And the FIs, as we've been telling you, their short positioning as well is closer to the upper end of the last few months in terms of the short positions. So that combination is something that normally you like. But, of late, the markets itself have got punctured and the structure has got punctured. Moving to the options data, the 25,600 call aggressive writing is what we saw there. Premiums down to around 50 rupees, while the 25,500 put. Now, this is interesting. Yesterday, it appeared there was writing at this level. The premium has come down to around 40 rupees or thereabouts. So those writers, they'll be looking to defend the lower levels. And a couple of technical indicators, they are moving towards the extreme end. So the RSI on the Nifty is around 37. Remember, at around 30 odd, it gets closer to the oversold level. So that's going to be important. And the PCR as well at around 0.77. At around 0.65 is when it gets to that oversold level. So both these two indicators are gradually moving towards that oversold level. So the structure on the Nifty, that's punctured. However, the 25,450 mark is extremely important. In the last 10 days or so, we have gone to that mark, 25,500, 25,450, in that vicinity a couple of times, and we have bounced from there. An adventurous trader would like to maybe go ahead and take a bit of a punt at around this 25,450, 25,500 mark, just because there's important support out there and because we have bounced off those levels. The Nifty Bank, that'll have to lead the way in case you have to see some kind of a fight back, because the 20 DMA, that's the first reference point, and at around 59,000 odd, you have the 50 DMA. So that's the important zone. In terms of stocks to track, well, Havells came out with the set of numbers, top line growth pretty good. The problem is in terms of margins, but industry sources are indicating that maybe there's a price hike as well that's gradually getting pushed through that hurt them in terms of margins in the last quarter. So maybe that's a stock to track. Came out with the set of numbers, management joining later today, one of the stocks that we'll be tracking today.
The only thing with Havells is it trades at 50 times forward multiple according to Jefferies. So that's 5% above the 10-year average, which is why some analysts have a hold call on Jefferies. But let's get back to the global stories. Lynn Alden, founder of Lynn Alden Investment Strategy, is now joining in. Thank you very much for joining in. Trump, Europe, Greenland continues to be top of mind. Europe sold off 1.5% overnight. Today, the U.S. markets will react. How do you expect this situation to play out? Do you see the tariffs on the 8 European countries going through on the back of Greenland? Will Europe retaliate? What, according to you, in the base case, might be the fate of Greenland?
Yeah, so I think there's a difference between what happens on the next day versus what happens over the coming weeks. We saw over the past year, whenever there were very big tariff escalations, there tended to be immediate term reactions, but then the market generally tried to see through it and assume that there's going to be some sort of de-escalation. It's possible they'll get caught out that time. Maybe there won't be a de-escalation, but I think that the multi-week kind of bias of the market is to try to look through that sort of thing. In addition, at the same time, the country is awaiting a Supreme Court decision on the legality of those tariffs, which is not really a Boolean outcome. There's a spectrum of outcomes there that could somewhat constrain the president's ability to do these kind of like unilateral, large-scale, long-term tariffs. Right now, if you look at betting markets, the market is betting that the Supreme Court is likely not going to rule in his favor. And so base case seems to be some sort of restriction on those. The administration's already said that, should that happen, they do plan to try whatever legal workarounds they can. So I don't think that, by any stretch, the tariffs are going to go away. But I think that there's a mix here that the market is saying, okay, there's some degree of de-escalation that might happen, combined with the Supreme Court just making it complicated and therefore slowing things down to some extent. So I think that gives the market some breathing room, even though I don't necessarily expect this to be a smooth week.
Got that. Lynn, the other one in the courts, not today but tomorrow, is reports that Fed Chair Powell plans to be present in the courtroom when the matter of Lisa Cook's firing comes up. So this is kind of sort of shaping up for the first time, I guess, ever, a proper fight between the Fed and the executive authority. So does that have any implications at all? Markets got pretty used to President Trump attacking and demanding lower interest rates, but they're not used to the Fed kind of sort of standing up and fighting.
Yeah, this is probably the biggest feud between the Fed and the executive branch since 1951, since the Treasury Fed Accord. The only time it came even somewhat closest was the 70s, but that didn't get formal like this one has. I do think that Chairman Powell will finish his term as chairman, despite some of the recent flare-ups. We've already seen a little bit of a de-escalation when Jerome Powell kind of came out with that rather strongly worded response. President Trump, rather than double down on social media, generally kind of distanced himself, saying he wasn't initially aware of that. There are reports that those in the administration were somewhat surprised by it. There's multiple camps in there. I think the Treasury Secretary is not in favor of a flare-up in that regard. So I do think that while this upcoming hearing is important, and there is a longer term kind of trend here of the Fed's independence being in question, my base case is the first half of this year we don't really see fireworks in that regard. But then as over time, as more members are added, as we get a new chairman, I do think we have to watch for signs of ongoing reduction in independence. I don't think I think it could potentially affect interest rates later this year. I think their balance sheet size, it's already in a gradually expanding mode. And I think that's going to continue pretty much regardless of the FOMC makeup in the quarters ahead.
Hi, Len. Good to see you, Ben. What about the equity markets? You have mentioned numerous times you like LATAM. And you've been positive on those markets like the Brazilian index. And if you look at that clutch of markets, actually, they've done well. Commodities have seen a melt up. Even smaller markets like a Chilean market, because of their exposure, the country's exposure to copper, has done very, very well. At current reckoning, post-India's underperformance, where do we fit in the pecking order?
Yeah, so over the past year, I've been pounding the table in Latin America, and they outperformed broadly last year. While I'm still bullish on Latin America, I still think there's room to run in the years ahead. I think we're in a multi-year, not a linear market, but I think we're in a multi-year bull market for many emerging markets. I do think that 2026 is potentially a better year for India. I am more bullish on Indian equities than I was last year. After that period of underperformance, I think the valuations are now more favoring of India. As you already point out in your program, there's some technical damage in Indian equity markets. So I would encourage traders to wait for whatever technical signals they prefer. But I would say that the fundamentals are getting more supportive. And so if a technical trigger should, kind of indicate that some degree of a bottom is in, I think there's better odds of good Indian equity performance this year than last year.
Risk reward in favor of India right now. Lynn, thank you very much for joining in. Let's also tell our viewers all the interactions that we've lined up on the show today. So first up, 8:35, the management of CEAT will join in to discuss the company's Q3 numbers. Very strong 60% jump in the company's profitability. 9 a.m., Renu Baid of IIFL Institutional Equities will put the spotlight on the capital goods sector. 9:20, JP Morgan, Sanjay Mukim will be a market master for the day. 9:30, the management of IRFC will join in to break down the quarter gone by. Following that, the management of PNB will be joining in at 9:40. We'll also be speaking to the management of Hindustan Zinc on the December quarter numbers. At 10 a.m., we'll get you another earnings conversation with Yes Bank's Prashant Kumar. And finally, towards the end of the show, Lata will discuss budget math with economist Sonal Verma of Nomura, Pranjal Bhandari of HSBC, and Upasana Bharadwaj of Kotak. And Voices from Davos, we bring you a conversation with HCL Tech CEO Vijay Kumar, Cognizant's Ravi Kumar. Stay tuned for that.
Time to slip into a short break. We've got a lot of stock-specific action to track for you. We get to that in just a bit. For the time being, I give you a sneak peek. LTI Mindtree, Havells India, Tata Capital, CEAT, UPL, Raymond Lifestyle, and Bajaj Electrical. They're all going to be on the back of positive news flow, while you have AB Lifestyle Brands, AB FRL, as well as Oberoi Realty that will be reacting to negative news flow. Take the break, come back, we get into further detail on all of these names.
Welcome back. You're watching Bazaar Morning Call. It's time now for CNBC TV18's list of top stocks for the day. To prep you up for this Tuesday morning, our entire research team is standing by and in the midst of a heavy earnings season. So let me kickstart this one with LTI Mindtree. LTI Mindtree numbers were largely in line with estimates, and it was a good quarter. The company's top line went up by 2.4%, similar to the growth rate that we had in the prior quarter. Margins expanded by 20 basis points to 16.1%. Profits were impacted on account of the one-off labor code impact, which is why profits went down 30%. But with respect to what the company said in the guidance, they said they aim to achieve near double-digit year-on-year revenue growth in Q4. In Q3, margins expanded, as I said, to 16.1%, but there is a wage hike impact which will kick in Q4 and Q1. The company is spreading it out over 2 quarters, so they will try and offset that on account of efficiencies. But overall, they said that they hope to end FY26 with better margins. All in all, a steady quarter by LTI Mindtree and in line with expectations. But what about Tata Capital? The Tata Capital. Gaurav now joins in to tell us how the numbers fared. Hi.
Whereas if you look at Tata Capital numbers, they were actually better than the street's expectation and also in line with their guidance, or in fact a bit better than the guidance. Because if you look at AUM growth, that came in at around 26% on a year-on-year basis. If you look at the guidance, they were guiding for 22 to 25%. In fact, for FY28, they are actually guiding to this growth to be 23 to 25%, and this will also include the motor finance. Other than that, if you look at the numbers, net interest income and PPOP both were up 10% on a year-on-year basis. Now profits that increased almost by 15%. It was a bit lower than their own guidance of more than 35% growth in terms of profitability, but they have stuck to this guidance for FY26, showing some kind of confidence on the increasing profit going ahead. Apart from that, the asset quality also remained very strong. In fact, the credit cost, which also includes the motor finance, which was a pain point for Tata Capital, now that has come down to 1.2%. Remember, the guidance was of 1.2% for FY26, and in fact, going ahead, they're expecting this credit cost to come below 1%. Other than that, if you look at ROAs as well, they are now at 2.1% versus their own guidance of 2 to 2.1%. So again, at the upper end of the guidance, and going ahead till FY28, they want to achieve ROAs of 2.5 to 2.7%. So all in all, the numbers are good. Overall, the outlook is good till FY28. And on the back of that, we will definitely watch out on this stock today.
Okay, all right, Gaurav, thanks very much for that. Well, Upasana is here with details on Havells India. Upasana, take it away. Morning.
Good morning. Well, in-line set of numbers as compared to our estimates, revenue and margin is largely in line, while there's a slight miss on the PAT due to an exceptional item of 45 crores. Now, if you look at the cables and wires, they have seen a strong growth of nearly about 44%. Now, overall revenue has seen a growth of 14% in line with estimates, which was led by the strong growth in cables and wires. Cables and wires revenue has grown about 33%, which was driven by volume expansion and even commodity price inflation. Now, if we look at the direct player, that is Polycab, it has shown a 46% growth here as compared to Havells, which stands at 33%. Now, coming to the margins, margins are broadly stable. The EBITDA margin has seen an uptick of 60 basis points at 9.4% versus the estimate of 9.7%. Now, as I mentioned earlier, the exceptional item of 45 crore was a one-off impact due to additional provision on account of new labor code, which impacted the profit, which is why the profit stands at 301 crore with an uptick of 6% on a YoY basis. Now, company says that the demand has remained modest during the quarter with a festive season uptick, but uneven consumption trends is what they are saying. Now, looking at the key positives is certainly the cable and wire demand and the revenue growth here, which has exemplified a strong volume and value growth. Also in ECD segment, the revenue has seen an uptick of 4% on the back of good demand for heating products. Now, looking at the key negatives, that is the company's lighting revenue was impacted down about 4% with the shift in the festive season this year. And also Lloyd remains in focus as the Lloyd performance continues to remain muted with the impact of a weak summer, and the losses have also widened in this segment. So all in all, going with a mild green, but the stock might slip into red on the back of the weakness seen in the Lloyd consumer.
Okay, all right. Thanks a lot for that, Upasana. Well, hopping across to Sonal. She's tracking Oberoi Realty. Morning, Sonal.
Good morning, Nigel. Well, Oberoi Realty reported numbers today, and if we look at their operational performance, their bookings were down 36% on a sequential basis. They were up 6% on a YY basis to come in at 836 crore rupees, but the volumes were disappointing too, down 28% sequentially and down 70% on a YY basis. The same quarter last year had some launches coming in from Thane, and that's why it does look lower, sharply lower on a YY basis. But the company says in 2026, they will continue to actively pursue attractive land opportunities, and they remain optimistic on the year ahead because of their launch pipeline and capital management as well. Additionally, they say it's the luxury segment which is drawing a lot of interest from buyers, and these are in established locations, largely from HNIs. So the commentary is positive, but their internals look quite weak.
Okay, all right, Sonal, thank you very much. Well, CEAT, the company we're going to be speaking with in just a bit. Let's get the numbers out of the way. Sudarshan, take it away.
Good morning, Prashant. So it was a good set of earnings for Q3 FY26 in the environment where there was an increase in the raw material cost both on a sequential basis as well as YOY, and that impacted gross margin as well as realization. But overall, the numbers look good. Revenue profit has increased by more than 60%. Revenue saw a jump of 26%. EBITDA too saw an increase of 66%. Margin has managed to hold on to the levels above 13%. It has come in at 13.5% versus 10.3% in the same period last year. And the demand growth company is saying it's mainly because of the increase or recovery in the international business and also the recent demand uptick that has been seen in the replacement segment that has helped both revenue as well as volume. So I'm going with green for CEAT.
Okay, well, as I said, so thanks very much. The management joins us on the third quarter numbers. Arnab Banerjee is going to be with us in about 10 minutes' time. Well, Vivek is here. Lots of block deals, AB Lifestyle, AB Fashion. Vivek, take it away.
Well, that's right. So we're expecting, recently large-size blocks in two Aditya Birla Group companies today. So as per our sources and as per the term sheet we managed to access last evening, the first one that you're looking at is Aditya Birla Lifestyle Brands Limited, an undisclosed institutional investor looking to sell up to 3% of the total equity. Total size of the block is around $43 million, close to 400 crores. The floor price for this particular block is at 106.1 rupees a share, a little over 8% discount to last close. This is a clean-out trade from this particular institutional equity investor. The other stock, of course, with Aditya Birla Fashion and Retail. Similarly, again, an institutional investor is looking to sell close to 3% of the total equity. Block size are slightly smaller, $32 million. Floor price at 65.7 rupees a share. Again, almost 8.5% discount to the last close. And it's once again a clean-up or a clean-out trade. So it'll be interesting to see, number one, who the seller is. We did try and look through the shareholding patterns. So most of the large earlier investors have exited. But it'll be interesting to see, number one, who's the seller, and also in the details that come out in the evening, who are the buyers or who participate in this particular block.
Thank you very much for that. Back to Sonal now on UPL.
Well, UPL will be on our radar because their subsidiary Advanta Enterprises has finally filed for a DRHP with SEBI, BSE and NSE. They say it will be an offer for sale of up to 3.6 crore shares, out of which UPL will be offering 2.8 crore shares in this offer. Now remember, Advanta is a subsidiary of UPL where UPL holds 64% stake. UPL Corporation, that one holds 14% stake, and Advanta is into the business of seed solutions for field crops, vegetable crops and oil seeds. This was something which the street was watching out for. Now remember, in terms of financials, Advanta did revenues of 5685 crore rupees in FY25 with profits of 921 crore rupees. Even the first half of FY26 has been strong with 3100 crores of revenues and 540 crore rupees in terms of profits. So this is the next trigger, but of course we'll need more details in terms of the valuations and other aspects, but UPL should be in focus on the back of this.
Okay, all right. Thanks a lot for that, Sonal. Well, let's wind this down then with Vinny on other stocks in the news. Hey, Vinny, morning.
Hi, good morning. So talking about Raymond Lifestyle first, positive news after they've appointed Satyaki Ghosh as the new Chief Executive Officer of the company. Ghosh is joining from the Aditya Birla Group. He was heading one of the divisions of fashion yarn business in Grasim Industries. He has over 25 years of experience in FMCG, textile, retail and consumer business. Do not forget, Raymond Lifestyle as a business, post its, demerger from Raymond, hasn't been doing that well. It's seen a fair share of ups and downs. So this new CEO expecting better strategy coming in for the company, and given his experience, hoping there will be some positive move here. Raymond Lifestyle also recently, do not forget, had onboarded Ishar Prasad as the CFO, and he will take charge from the upcoming board meeting as well. Next one, Bajaj Electricals, some positive news here as well. So green expected here after the company has entered into wires segment, which is a new business line for the company. This will be in their lighting solution segment. The growing demand in wire segment is the main reason that they have looked at entering this segment. It's a strategic decision that they've made. So green expected on both these names.
Bajaj Electrical is a stock down 40% in the last 1 year. So will this move boost the prospects? And also keep your eye on restaurants Brands Asia, because there is a board meeting today to consider a fundraise. And will we hear more on Vivek's story about Everstone's plans to sell their 11% stake? So that's a stock also you should keep on your radar. Thanks, guys, for running us through this list. Here's a quick recap then. Stocks with positive news flow are LTI Mindtree, Havells, Tata Capital, CEAT, UPL, Raymond Lifestyle and Bajaj Electrical. Stocks with negative news flow are Aditya Birla Lifestyle Brands, AB Fashion and Retail, and Oberoi Realty. Well, that's equities. What about commodities and currency? Manisha now joins in with a complete roundup. Manisha.
Well, thank you so much for that. I'll start with the crude oil prices first, where we're looking at prices almost holding their gains, especially with the U.S. and the friction that we've seen between U.S. and Europe for that matter, with Europe also now saying that they can come out with the anti-coercion measures there. Remember, it's nearly $10 trillion of bonds and treasuries that these European countries hold of U.S. And if the trade dispute intensifies, This perhaps could be leveraged, and that is what is making the markets jittery at this point in time. Safe haven buying has continued, so whether you look at gold still holding around that $46-70 an ounce mark, or it's about silver, we've seen $94.50 an ounce of an all-time high. It seems to be holding around 93.5 at this point in the Asian markets therein. There is a lot of data that is coming in from US this week as well. You have the GDP numbers coming in, and the consumer sentiment will tell you on where the markets will take a further direction from. What has seen a profit-taking, though, has been base metal prices. So whether it's about tin, which fell 7% overnight, or copper, aluminum, zinc, all of that has seen a decline. This comes in the back of Shanghai telling some high-frequency trading firms to abstain from the market, keep the volatility down and the speculation down as well, and that has led to some profit-taking across board.
Tin has been on Manisha's mind, right, Manisha?
It has been.
Talking about, well, I think we'll see you in office, Manisha. Thanks very much for joining us with an update on commodities. We'll take a quick commercial break. See it is the management we'll be speaking with on the third quarter numbers. Stay tuned, coming up. Okay, well, here's another exclusive from Davos, the World Economic Forum. After stabilizing its operations over the last 3 years, Cognizant is shifting gears towards aggressive growth strategies, AI and outcome-based pricing at the forefront. My colleague Shireen caught up with the CEO, S. Ravi Kumar, to talk about all of that, but of course also about a potential secondary listing, Cognizant here in India. Listen in.
I would say the first 3 years was about stabilization, and the next 3 years is actually going to be about bold bets. In the first 3 years, we climbed up the charts, and on relative scale, till the end of Q3, which we have publicly announced our earnings, we are on the upper quartile, top performance on relative scale. So I'm very happy with where we are, but looking forward to the next 3 years, which is going to be big bets and bold bets.
You did publicly state that you are looking at the possibility of a secondary listing or an IPO in India. Where have things progressed on that front? How close are we to an actual decision being taken?
So, Shireen, we are working with the regulators in India. You know, the last time something like this happened was many, many years ago when Standard Chartered did this. Right now, we will be the first company who is attempting this, which means we have the burden of actually helping the regulator to work alongside us to get to the finishing line. So that's a journey we have to go through.
How close is the finishing line?
I mean, look, you know, regulators in India are very receptive for new instruments. This is an American listed company which has the opportunity to list in India as a secondary listing. I mean, that's what Indian companies did in the 90s. They actually listed primary in India and then they went to the US.
Yes.
We think we have a pool of investors in India who are very keen to invest into tech services. Tech services is a proxy for AI. We also think there's a lot of mutual fund money which is being fed from the middle class of India, the vibrant middle class of India. We think we can capture that opportunity for Cognizant and get a new category of investors. It's going to be a journey to do this, but we'll give it a try.
And you know, what are the questions the regulators are asking?
I mean, there are a variety of things because this is the first time we are doing it, but they are in a constant dialogue and we are iterating, and it's very constructive. So I'm very pleased with all the meetings we have done.
And do you think 2026 could be?
Hard to say. I mean, these are things which is very hard to say, but we're going to give it a try.
Okay.
Okay, interesting. We'll keep an eye out on that. For the timing, let's turn our attention to the auto ancillary space because CEAT reported a healthy set of numbers in Q3. The margins hold on to levels around the 13%, while increased raw material costs, that's dented the gross margin a little bit. To discuss what happened in the past quarter and how are things shaping up, we're joined by Mr. Arnab Banerjee, the Managing Director and CEO at CEAT. Hi, Mr. Banerjee. Good morning. And good to see you in today and wishing you, your team, all the best for 2026. Well, Q3 appears like a good one in terms of growth. And as I'm looking at your mix, replacement is a large part of your business. So could you tell us the trends that we saw in the past quarter? Are they expected to continue? And if you could help us out with what is the volume growth you're targeting for this year and the next?
Well, past quarter has been good. I think after the GST revision in the month of September, initially we saw trade downstocking, but it's all come back. And there is a good sentiment in both OEM and replacement market in the domestic area. We have seen mid-teens to high teens kind of growth in replacement. And we have had a base effect of OEM. Our last year base was a little bit lower. So good growth in OEM as well. And we'll have to wait a while, maybe a couple of quarters to see if this kind of impetus continues. Because Q3 usually is a weak quarter for us because of the onset of winter in north and east. It has broken the trend because of these changes primarily. And that's why we have brought forward our investment plans in passenger car tires as well, as you know.
Right, let's talk a little bit more on that then. You're looking to add close to 35 lakh tires per annum. And that capacity is expected to come on stream in the first half of FY28. Break it down for us. What would that be in terms of the total capacity addition? And how do you fund it? I think you've earmarked close to around 1,300 crores. So the breakup between debt as well as internal accruals?
Well, yes, the capacity, we will add about 35 lakh tires through the year. And overall capacity after this addition will be about 60,000 tires per day. So you can multiply that by 350 days to get the annual capacity. And this will service primarily all segments, replacement, OE and IB. The expansion is coming up at Chennai, which is a brownfield expansion. So we don't expect too much of uncertainty there. It will be funded by a mix of debt and equity. Our ratios, as we see going forward, will be well within our internal control limits. The debt equity currently is at 0.6. Debt EBITDA is also around 1.5, 1.6. So we don't expect to worsen those equities too much, as we have been regularly incurring capex, if you have seen over the last few years. And so it will be the capex guidance for the next few years also will be similar as a percentage of sale.
All right, just one thing, sir. So you'll be at roughly around 2 crore capacity then. This is roughly around a 15 to 20% increase in your total capacity. That should be a fair estimate, right?
60,000 per day. Yes.
Yeah. All right.
Mr. Banerjee, good morning, sir. Prashant here. I had a slightly, top-down question, but I think it's important because, credit, and my starting point is credit growth. Credit growth was 16, 17, 18%, and it fallen as low as 8%. Now it's back at about 13, 14%, right? I mean, when you look at where this credit growth is going, autos is right up there. In terms of right, and this is instant injection of liquidity, So this is, credit growth is equal to sales, pretty much, right? 1-to-1. Are you getting that sense that this could be, I don't think expectations from auto companies that we speak to is of anything great, maybe better, etc. But is it possible as credit growth picks up and continues to move higher, driven by all these policy measures, this turns out to be a pretty, we see a meaningful upside surprise in terms of auto volumes. Is there any sense in your interactions with OEMs?
Yes, I think, there was a structural change in the four-wheeler auto sales where we see the emergence of SUV, when the first-time buyers going straight to the SUV, leading to value growth. But the volume growth was muted in terms of number of cars. Post the GST, that thing has changed because the small car volumes have come back. So that means larger number of tires, of course, but we'll have to wait and see whether the structural change towards consumer preference of higher vehicles, bigger vehicles, the SUVs is going to come back. But the overall numbers are definitely going to increase. How much? We will have to see for the next 2 quarters. Two-wheelers and farm are going to see a secular growth because we have seen the growth momentum coming back more from the smaller towns. So we believe that these are still, two-wheeler is an underpenetrated category still, and there is scope for growth in terms of number of vehicles there. And because of the credit growth, which you mentioned, we have seen a bounce back in the commercial vehicle segment as well, which is truck and bus. And this was kind of not growing in the first half, nor was passenger in terms of numbers. So these growths have come back to, yes, it has been bullish, but we'll have to see a couple of more quarters to see how much sustains.
Mr. Banerjee, time for just one question. So let me squeeze in 2 quick ones. One, what percentage of your overall revenues or volumes go to the US? I know it's small, but can you give us a number? And on the back of the punitive tariffs, what has been the volume in Q3? And what is the outlook on margins for Q4, given the way rubber prices have panned out and the currency depreciation?
So I'll answer the US question first. Less than 3% of our turnover goes to US. And as I had been maintaining in the past, for us, it's important to get a toehold in terms of creating the distribution and logistics infrastructure in US. So we had been absorbing the tariff impact to a certain extent and passing on by certain extent. That strategy continues over Q3 and also Q4. We have not seen any drop in sales turnover, therefore, to the US, though it remains small, and impact on bottom line is muted. We see this as a very big growth market, so we stay invested in US. So that's the US part. No impact on bottom line, but we are setting it up for growth in future. Overall margins, if you see, standalone margins have inched up from 13.7 to 14.1% in this quarter because of higher turnover and growth. We expect the raw material situation to be flattish in Q4, maybe slight inflation of max up to 1%. So mostly flattish, maybe slight inflation. That is the kind of situation. By end of February, we will see an uptick in volumes, the seasonal volumes, which kicks in for the period of March to June, the summer volumes. So we expect the margin, overall margin for the company to move in similar zone.
All right, very quickly, sir. Your net debt is around 2,930 crores. Does this number stabilize around this mark? Because you've got a capex as well that's lined up. And would it be fair, going by your commentary and the capex that you're adding, that you will be looking at growing at least at mid-teens for the next couple of years?
Value growth this year, I can say, will be close to that, because first 3 quarters, as per published results, you can see we have grown by mid-teens. So we want to continue that trend for this year. Next year, it's too difficult to predict, 2 years at once, but we are laying the foundation, as US is one of the growth measures. We are laying the foundation for domestic growth in terms of OE approvals, as well as replacement channel expansion, especially on the premium side, which is the SUV side. So we are planning for at least double-digit growth going forward.
Mr. Banerjee, we'll leave it there. Thank you very much for joining us. Good speaking with you. And thank you for being here. We'll take a quick break. We're back. Mayuresh Joshi is going to be with us, Director of Research at Mark Smith India, for some fundamental stock conversation. We'll address some of the other results apart from C8 with Mayuresh as well. Stay tuned. Okay, welcome back. And 15 minutes to go for the pre-open session to kick off. Mayuresh, Joshi is with us. Mayuresh, good morning. Just a pretty weak market, right? Breaking through some long-term averages on the Nifty yesterday. If you have a brief comment on the index itself, the Nifty, and there's a bit of a divergence. Bank Nifty has not even broken short-term moving averages. The Nifty, of course, is looking much worse. I guess because large stocks like Reliance, etc., have been very weak. So just a quick view if you have it, and then we'll move on to some results reactions.
Morning, Prashant. I think we've got a unique way of mapping this through distribution days as we see it in markets with India. And those distribution days are actually inching up over the past few days and weeks, which is a very inherent sign that the pressure for the market probably continues for a whole host of factors, primarily based in terms of how geopolitics is shaping up. And you're absolutely right. I think how the bank numbers have played out so far are probably emanating in terms of the bank Nifty probably doing well. Reliance was a decent set of numbers, yet I think the street probably reacted negatively yesterday. And therefore, I think we still believe that you probably should have a very sector and a stock-specific approach as you approach these markets.
Any results stand out to you from last evening? CEAT reported, Lvls, Hindustan Zinc, so many, right?
Absolutely, Prashant. So I think CEAT was a decent set, in my opinion. Lvls disappointed to a certain extent. And in fact, one of their comments in the press release, it might be an eye-opener for consumer durable plays generally in Q3. That statement was that the demand remains probably modest with very uneven consumption. Cooling products, small appliances have seen pressure. Channel inventory was normalizing. And therefore, I think as input costs are heading higher, specifically copper prices, as you see, aluminum prices, as you see it, it's a pass-through, no doubt, but I think it probably increases the end product prices, even post-GST rationalization, which probably makes it a little bit of a concern from an immediate short-term perspective. Hindustan Zinc expected numbers were expected to be good. And therefore, I think how prices probably move in the coming quarter as well will largely determine how numbers will play forth in Q4. But in my opinion, again, I think decent set by both CEAT as well as Zinc. Lvls largely disappointed.
Okay. Hi, Mayuresh. Good morning. Good to see you in. What about UPL? They're looking at unlocking some value, post the issue that they're likely to come out with. We're still waiting by in terms of valuations. But that's been one of the underperforming stocks, if I look at it over the last few years. Value is there, trades at a discount. But do you think you could gradually start getting positive on this name?
Morning, Nigel. Yes, and in fact, we've added that stock into our momentum portfolios. Our own sense is that outside the deal, if you probably look at the basic business construct that UPL operates out of, the expectations in terms of demand remaining steady should be a base case scenario. Obviously, I think expectations in terms of key input costs have largely remained benign, which probably makes us believe that margins, specifically on the operating front, should largely start holding out. And the key markets that they're now probably operating out of, that should show signs of resilience as we head into the next few quarters as well. So our own sense is that the basic EPS growth should start going up as we head into the next few quarters and exit FY27. That number might be far better than what we probably see in exit 25. So yeah, remain optimistic on this one.
Sun Pharma, Mayuresh, I mean, others have reported, we've also reported, and there's some news that they've made a non-binding offer of a very large $10 billion acquisition in the US, Mayuresh. Have you looked at the details in terms of what it gets them? Usually large acquisitions, people get very, very, very quickly. But basically, if they're able to pull this off, revenues double pretty much. Your thoughts?
No, you're right. And therefore, I think the whole scenario is the matrix that you built in as a base case and a bull case scenario. And therefore, from a bull case perspective, I think the numbers might look phenomenal. However, I think when you probably just have a constrained approach and look at the base case scenario and the existing business model, assuming that if this does not go through, I think they've got a few key molecules in place. A few of their molecules are going through phase 3 trials as we speak. And therefore, I think the monetization of these critical FTFs that Sun is expected to file and monetize thereafter might lead to significant amount of organic growth that they're driving themselves. Now, outside that, what probably happens in terms of the Organon Pharma acquisition might start adding up in terms of value as we head into the next few years, in terms of both synergies and new markets that probably open up, specifically in key areas and critical areas at that, where margins are relatively higher. That probably lays case for a bull case scenario. From a base case, I think they have plenty up their sleeve, but they've also got concerns related to FDA and what they probably do with that as well. So I think it's an if-but scenario at this point of time. On our watch list, but not necessarily added to our portfolios.
All right, Mayuresh, want to ask you about Interglobe Aviation. Not going to ask you about your experience if you traveled off late, but I want to ask you your view on the stock. You know, it's corrected a goodish bit from the top. There were a couple of penalties that came out, and yesterday, going by the stock price move, the street believes they're getting away easy with regard to this in the quantum of the penalties. What's your take? You know, it's going to be the leader. You know, the number 2 is far away from them. But post this correction, would you be positive?
I think the swing might be there, and you're absolutely right. I think the quantum of penalties that got levied on Indigo, I think far lesser than what the street probably believed or expected Indigo to probably get in terms of monetary penalties or otherwise from the regulator. And therefore, I think you probably saw a reaction onto the stock as we speak. However, from a structural perspective, I think when you probably look at the listed space outside Interglobe, I think SpiceJet has a basic fleet that you probably got. They're expecting to add 8 to 10 aircraft as we speak, as a read from media reports. But generally, I think for the industry as a whole, the kind of purchases that even Air India is making or Vistara is making, or even SpiceJet, I think those deliveries might probably get delayed. And therefore, I think as we speak, the existent dominance in the skies still remain with Indigo. Pricing, again, when you're probably heading into a peak season, how the regulator probably caps prices obviously becomes a risk concern. But ATF prices, which are 45% of the input cost for any airline, still remain benign, which gives them that added cushion in terms of the kind of numbers that they're probably posting. The expectations in terms of available seat kilometers and adding of new routes probably adds to that element. So there might be a momentum that might continue with this stock. We have not added this, or it's not part of our portfolios as we speak.
So many more things to discuss, Mayuresh, and hopefully we'll be able to do that. We'll thank you for now. Appreciate you coming on and sort of running us through your views on a bunch of names there. And hopefully, markets perhaps stabilize a little bit in the next couple of days. Well, let's talk about the big movers in terms of both price action and volumes yesterday. Hormuz is here with that list as always. Hormuz, take it away.
Good morning, Prashant. And earnings reactions, more importantly, earnings casualties were the ones that dotted yesterday's trading session. You can't not talk of Wipro, RBL Bank and IDBI Bank. All of them saw significant price action in yesterday's session. Wipro was down almost 8%, and delivery-based selling worth almost 1,600 to 1,700 crore in yesterday's session. You saw almost 7 crore shares traded on Wipro. The 20-day average is only 70 lakh shares. Even for RBL Bank, 2.5 crore shares were traded, almost 4 to 5x its 20-day average. And for IDBI Bank, the numbers were higher than its average volumes as well. Even on the delivery front, almost 50% of Wipro's trading volumes were marked for delivery. Same, almost a third of RBL Bank's volumes as well, close to 80 lakh shares. For IDBI Bank, almost 90 lakh shares were marked for delivery. So a delivery-based selling seen in all of these names in yesterday's trading session. An outperformer yesterday was Jindal SAW, is an earnings reaction as well. One of the top gainers on the Nifty 500, the biggest single-day gain since January of 2020. The stock before in the last 9 sessions has declined in 7 of them. So this was one of an outlying session yesterday. Volumes on Monday were the highest on record for the stock. Almost 12.5 crore shares were traded yesterday. The 20-day average is just 12.5 lakh shares. But out of those 12.5 lakh shares traded, 12.5 crore shares traded, only 79 lakh shares were marked for delivery. Here, the 20-day average is around about 6.5 lakh shares. And the stock, though, has been an underperformer, still down around 40% from its 52-week high. And the other outperformer in yesterday's session was JSW Infra. And after the management's guidance, it was only the second day of gains for the stock in the last 10 trading sessions. The biggest single-day gain since March of last year. Volumes were the highest highest since May of last year. Over 1 crore shares were traded yesterday, 20-day average of just 10 lakh shares. And out of those 1 crore shares traded, 25 lakh shares were marked for delivery, the 20-day average being around 6 lakh shares. The stock made a 52-week high of around 350 rupees, down around 22% still from those levels.
Take a break. Hormuz, thanks very much for that. We'll come back with the pre-open rates in about 5 minutes or so. Sudarshan Sukhani will be with us, and so is Mitesh Thakkar with trading ideas. Stay tuned. Coming up.
Welcome back. In a short while from now, in a couple of minutes, we'll get the pre-open rates. For the time being, let's welcome Sudarshan Sukhani, proprietor Technical Trends, as well as Mitesh Thakkar, President Retail Research at Bonanza Portfolio. Good morning, gentlemen. Good to see you all in. Well, the last few trading sessions have been weakish to say the least. The structure on the Nifty as well appears to be a little bit punctured. However, today's weekly expiry, and yesterday there was some fight just in the last 90 minutes or so, if I could call that a fight. Sudarshan, you go first. What's the trade on the index?
Yeah, good morning. The trade is to stay away from the index. There is no sign that the market is bottoming out. There is no sign that this is a buy on dips opportunity. The market is steadily, the Nifty is steadily moving down. It has to stop falling. That's the first step. So that will require a day or 2 days. So irrespective of what the markets do intraday, I think the best trade is not to watch the Nifty and to focus on stocks.
Yeah, absolutely. And Sudarshan, what would those stocks be on your radar today?
Well, it's a mix today. Fortunately, some buying ideas also, including Ashok Leyland, where a buy is possible with a stop under 185. National Aluminium, a buy is possible with a stop under 360. I have two intraday shorts, Bharat Forge, sell with a stop above 1440, and Mazanan Docks, sell with a stop above 2480.
Got that. Mitesh, good morning. What would your call be? Index first?
Yeah. So Prashant, on the index, I maintain that getting past 25,950 is the only way we can possibly negate this setup which is turning weak and gain some strength. Till that happens, I think sell and rallies is a good idea on the index, and I think on the downside, 400, 350, 330 is my preferred zone. So most likely we should test those levels in the next few sessions. And the better indices between all of them, I think, is Nifty 80, which has recently started gaining strength. So maybe you could focus on IT names. Once the Nifty IT manages to get past 39,500, 550, I'm expecting 41,000 plus levels there.
Okay. In terms of single stocks, Mitesh?
I have a mix of buys and sells. A buy on L&T Mindtree LTIM. That's a buy with a stop at 6355 for targets of 6530. Infosys is a buy with a stop at 1663 for targets of 1720. A sell on Bharat Forge with a stop at 1437 for targets of 1370. And a conditional sell on Aurobindo Pharma if it breaks the pivot of 1160, 1155 zone. Then sell with a stop at 1175 for targets of 1115.
What about the big boy, Mitesh? Reliance Industries. It was managing to defend those lower levels, and then yesterday it had a bit of a breakdown. Now it's important that it gets back above those technical levels. I think 1450 or thereabouts. What's your view on this name?
Well, I think, the bigger thing which happened was that 3 weeks back, the stock was on a verge of breaking into fresh all-time highs at around 1585, 1590 levels. And I was hoping that we'll get a weekly closing about that. That has been negated. I think on the medium-term charts, I think the stock is having very strong support around this 1360, 1350 zone. So maybe around those levels, you will see some kind of consolidation and then a reversal.
Yeah, that's a big one, isn't it? I mean, you need stability there for the index to start to maybe stabilize a little bit. The other, Mitesh, the other names, MRPL, Chennai Petro, HP, by the way, we'll probably get out. JP Morgan has downgraded their view on HPCL. And any thoughts on the other oil and gas companies?
Well, I think, what is honestly very interesting to me are the charts of Oil India and ONGC. So Oil India, had a big rally from 405 to about 465, has given a pullback to around 435 levels. I think this 428, 425 zone is very important support area. So if it can hold that, I think a retest of 465 could happen. Similarly, on ONGC, I'm waiting for a big breakout if there's a weekly closing about this 250 to 255 zones. This last week we had a move till about 251 and then the stock is retraced. But once it breaks 255, I think it could be a stock which would gain some good traction in the medium-term charts and a target of around 280 can be low.
Got that. Thanks very much, both of you, Mitesh and Sudarshan, for joining in more later. Appreciate it. Let's talk about the brokerage calls of the day. We're going to focus on Dixon and Godrej Consumer. So take it away.
So Investec has come out with a note on Dixon Technologies. It maintains buy call but has cut target price to 15,000 from 18,900 rupees per share. It says that stock has corrected 40% last 4 months due to certain uncertainties. And those uncertainties are first, delay in obtaining government approvals for Vivo and HKC's JVs. Second, slowdown in consumer demand, especially for mobile segment. And that's the reason it has slowed FY26-28 EBITDA estimates by 5 to 14%. And now stock is trading at 40 times FY28 estimated EPS versus 60 times that it was trading at 3 to 4 months ago. But in its estimates, it's building in company receiving approvals for Vivo and HKC JVs in next couple of months. And those approvals will provide comfort in both revenue growth and margin going forward in FY27-28. Next, Macquarie has written on Godrej Consumer. It has upgraded the stock to outperform and target is 1,400 rupees per share. It sees market share gains in high margin insecticide segment and pickup in soap margin. It expects steady pickup in Indonesia performance in FY27 and it has upgraded the stock because of increase in the EPS estimates in the range of 4 to 5%.
Thanks very much. So very interesting calls there. More coming up in just a bit. Thanks for now. Renu Baid is with us, Senior Vice President, Research at IIFL Institutional Equities. Renu, good morning. Great to have you back on the program here. Thanks for your time. Let's just dive straight in, right? CG Power first up. What's the view and what's the call here? Bit of a bounce yesterday after the data center order, etc. But generally, it's been tough. Last time we spoke, right? I think the one thing we perhaps did not address is this very sharp rise in the price of copper and how that is essentially going to impact margins across the board, not just for CG Power. So why don't you start there?
So for transformers of the grid equipment market, mostly which is catering to the government sector utilities, their price variation clauses are there. So inflation impact of copper CRGO is broadly captured in. Where it gets impacted is the short cycle industrial businesses where it is a function of demand supply dynamics and there is a lag in terms of taking price hike for LT Motors and other products in the market. So to that extent, companies with varied exposures will have different impact. On the grid equipment side or transformer companies like CG Power, power equipment should be broadly covered for the cost inflation element of the business. On the industrial, there will be a continued pinch on the margins front, even in this quarter as well, basis our expectations and forecast for 3Q26.
What kind of companies get impacted? Just as an example, illustration.
So if you look at the names of the industrial segment for CG Power, ABB, Siemens, will have impact on account of the inflation impact in copper. There is a lag in terms of passing on the price increases. Demand environment generally in the short cycle business has been relatively soft. So it becomes difficult to make the entire price transmission in one go. Similarly, companies on the pump side of the business will have similar impact. For most companies which are exposure to government sector contracts, especially the grid utilities, will be able to pass on the cost increases there.
Got that. Yeah, how are just CG as a business you cover the stock? Are valuations attractive now, Renu? What's the call?
Valuations, I think after the recent correction, definitely is in a value zone, we think, though not absolutely cheap, but given the growth drivers which are there in place. So CG itself is a cost leader when it comes to power equipment on the transformer side of the market. They have nearly doubled the capacity, plus a new greenfield plant for transformers is due for commissioning in October 26. And we have already seen order book accretion, seeing substantial growth to fill up capacities for these orders. And last order which they announced last weekend, the 900 crores orders from the US data center market, is more important for the company that it not just reinforces that the export focus is there, but entry into private sector customer, that too for the US market, which is a relatively difficult market for companies to enter from the domestic Indian space, has been to the credence of company. So to that extent, the incremental capacities which are coming up are targeted towards export market and domestic market, where it will be able to capture a higher share of the domestic business there. So we see this as quite positive for CG as entry in the US export market, and also with incremental capacities, we're confident that in the fourth quarter of the current year, they are already L1 on a couple of large orders for domestic private sector TBCB players, and order accretion for the power equipment business will remain fairly strong for them. Industrial is going through its own down cycle. It has bottomed out in our view, but growth would be subject to how the private sector investments or capex improves over the next couple of quarters. So there, both revenue growth as well as margins will continue to lag. And power segment, in our view, would be the key growth driver of the company, the way we have seen over the last 1.5 years.
You know, the wire and cable companies, I mean, I think this copper price is just passed through, right? Straight up.
Yeah.
But some of the other segments, like for Havells and others, get impacted as well, but I guess to a lesser degree.
Right. So if you look at the FMEG market, cables and wires, over the years, the market has matured enough in the housing wires to pass on the price increase in LME copper prices on a fortnightly basis, and even at times on a weekly basis where prices are very sharp increase. And there we have seen channel upstocking being very strong, both in the results for Polycab as well as Havells, which came in the last 2 days. For other FMEG products which are facing, say, consumer products, say fans, where inflation impact is there, lighting, switchgear, there the market itself has been fairly weak. Consumer offtake is weak. There is increased competition, and inventory is still elevated for all summer seasonal products. So be it room air conditioners or the fans ECD portfolio, there the price increases have been with a lag. So the impact on the profitability or margins of these companies, Havells, Crompton, would be very clearly visible. It will take time, probably a quarter or two, till we see demand uptake coming back, and then the price increases would be passed on.
I see. So on the other consumer products, perhaps the impact is a little larger, fans, etc., right? That's what you're saying.
Right. Plus, there is a table change impact, rating change, which has come with effect from Jan 26 for both fans as well as air conditioners. This implies almost anywhere between 5 to 7% price increase. In case of RAC, there was also GST rate cut reduction. So to that extent, the net impact for the consumers would be negated. But in case of fans, definitely price hikes of 5 to 7% would be visible through this calendar year to start with.
Renu, do you have coverage on Hitachi?
No.
Okay.
We don't have formal rating there.
Okay. GE, Vernova, etc. also no, right?
No. Yeah.
Okay. But any views you can offer otherwise? I mean, because we've seen sharp corrections here.
Corrections have been there in the space because generally if we see the grid equipment market had seen both the prices and margins had been very sharp uptick. Companies are in the phase of having cyclical high margins, price mismatches or the demand supply mismatches are very glaring. Companies are reporting almost 20-25% kind of EBITDA margin. In case of Hitachi, the order wins for HVDC have been very strong. So valuation somewhere for these companies had also increased very sharply, anywhere between 60% to 70% 1 year forward. And what we have seen is after the recent, where we had seen an instance that government approvals for TBA came through for reactor as a category. So that became more of a sanity check that sooner or later competition from, even if it's come from domestic Chinese OEMs, will be back in the market. And prices anyway ought to correct in the next 12 months. I see the increment capacity addition in the transformer space coming through. So to that extent, we think the price correction or the valuation correction for these names is fairly justified.
There was this other thing, which I think we've not really, but that's Jensen Huang of NVIDIA at that, in Vegas at that conference, the big conference, he kind of outlined, he introduced this new product where he said that, it could be, I mean, basically data centers can be completely liquid cooled. So a lot of the, equipment required, and I mean, it's not just these guys, but I guess a lot of other ancillary, but it'll take time to show up, right? I mean, there's lesser requirement of all of everything else if it's going to be completely liquid cooled. At least that's the claim which he made. But we yet to see, any impact of that on the Hitachi, GE, etc., globally listed as well. And I don't think we've had much impact. Perhaps we'll have to watch. Renu, you're also one of the few analysts who cover Netweb. So again, a stock which has fallen sharply from the highs, a bit of recovery now after the good numbers. What's the view here?
So here I would say Netweb is very well positioned for the national AI mission projects that have come through. They have nearly 2,100 crores plus of orders, of which last quarter they already executed 450 crores worth of projects, because of which we saw revenue growth all being pretty strong, 800 crores of revenue for the quarter. So here I think the company has positioned itself very well in terms of domestic manufacturing and giving local solutions for AI data centers as well as for hypercomputing solutions. And when it comes to some of the sovereign infrastructure, they are at the front to claim their share of business. We expect almost 50 to 60% wallet share for them of the 10,000 crore opportunity on this sovereign AI infrastructure over the next 3 years. And next 2 quarters, we will see that kind of jump in execution. And hopefully after budget, some of the other orders which are due for awarding will see acceleration. So at least for this company, we are fairly confident that they should be able to grow 40 to 50% revenues on the base business. And given the localization content that they have and relationship with global partners, both NVIDIA for GPUs as well as other OEM partners here, they are better placed in terms of managing some of these supply chain disruptions that we have seen, be it for the memory chips or for the other components on the electronics value chain. So here also the growth outlook and the earnings front is fairly strong. We expect nearly 90 rupee of EPS for the company in fiscal 28, which would be almost 2 times plus, 2.5 times from fiscal 26 projected earnings of 40 rupees.
2.5 times, 27 over 26 basically. Renu, you're saying?
28, we are forecasting about 90 rupee of earnings over 40 rupees in 26. Over 2 years,
2 years.
We are expecting more earnings, than 2 times.
Okay,
earnings to double in 2 years.
Got that. And I think we're now starting to look at FY28 estimates, right? I mean, in terms of valuations, etc. So that is that. Thanks very much, Renu. Appreciate you joining in. It's always a pleasure. And good speaking with you across a range of companies that you cover. We'll just get 9-10 calls out of the way. Sudarshan is back with us. Sudarshan, what do you have?
Ashok Leyland, buy Ashok Leyland with a stop under 185.
Ashok Leyland from Sudarshan. Mitesh, what do you have?
I'll go with the sell on Bharat Forge.
Sell on Bharat Forge. Got that. Well, just going back to the capital goods space, BHEL, right? Winnie's got more details. She's joining in. Winnie.
Hi, good afternoon. Good morning. I mean, BHEL, obviously, in terms of numbers, it was a okay, weak set of numbers that came in from the company. Now, on the back of that, we have brokerage notes that have come in. Kotak Institutional Equities has maintained the sell rating. They've cut the target price from 125 rupees to 120 rupees. They've cut that FY28 EPS target estimates by 15% as well. They're building a lower pace of execution, modest cuts on gross margin estimates as well. Now, Macquarie too is maintaining the underperform rating. Target price is 205. They said revenue was in line with their estimates. Execution uptick is something that they're seeing, but margins, that was below estimates. And order intake, that was a bit of a positive surprise that came in there. So they believe there is still some bit of an improvement one could expect in terms of revenue visibility.
All right, well, right on cue. Markets are opening. Vinny, thanks for that. 50 points lower on the Nifty, 25,535. So it's sideways. And it's about a 40-odd point cut. So 114 points lower on the Sensex. You've got mid-cap index down a quarter, small-cap index down about 0.25%. The Nifty Bank is down about 0.13. I mean, compared to the Nifty Bank, of course, has been much stronger. And it's not yet, for example, broken the 20-day moving average, whereas the Nifty is now at a very long-term support levels. It's actually broken some long-term support levels even. 25,550 on the Nifty is where we are at. So Nifty heat map gives you a sense of where things are landing at open. SBI, Kotak, Tata Motors Passenger Vehicle, and those are the names on the green side. Asian Paints, Shriram Finance, Apollo Hospitals are opening lower. It's more down than up, but it's more evenly balanced as opposed to what we had yesterday. So a little bit of recovery, but just, I mean, the first 1 minute, 25 points lower on the Nifty is what you have. I think keep an eye out on RIL, which is in the red, but I mean, the market needs that one to stop falling at least before it, turns around, because big weight and big say in the index. Yesterday got to almost about 1,400 and, a little bit of bounce, 10, 15 rupee bounce from the day's low is what you had yesterday. Rima.
IT once again is under pressure. Wipro's the top loser. This is after losing 8% yesterday. Wipro's down another 1%. Along with that, you've got Tech Mahindra, Infosys, HCL Tech also opening up with mild cuts. ICICI Bank is seeing some follow-on selling pressure. Yesterday, 2.5% lower. Today, it's lost another 0.5%. Asian Paints is now coming up as the top Nifty loser, so that's down nearly 1%. Shriram Finance is weak in trade. Apollo Hospitals is starting the day with some cuts. Interglobe Aviation is correcting some of yesterday's 4% gain. Bajaj Finance, weak in trade. But again, there is no Nifty stock with a loss more than 1%, barring something like an Asian Paints, which is also down just 1%. On the way up, it's SBI, Kotak Mahindra Bank, up and about. Hindalco, so a couple of metal stocks are having a good day. In fact, if you pull up the Nifty Metal Index, perhaps that's the one where we are still seeing some gains. The Nifty Metal Index has opened out with a gain of about 0.5%. Hindalco, JSW Steel, higher in trade. Tata Steel giving it company. On the automotive side, you've got an Eicher Motors, Tata Motors, Passenger Vehicles, M&M. So that's the other pocket of strength that's visible when you look at the frontline action. But again, the action is in the individual stocks.
Well, that's right. ABFRL, stock down close to around 7%. That block that take place out there. You have AB Lifestyle as well. That's down close to around 1% or thereabouts. BHEL, that's down close to around 1.5%. It's rather large volumes out there. And Oberoi Realty, that stock is getting a bit of a slam dunk. That's one of the top losers in today's trading session. Hindustan Zinc, we'll talk to the management in a few minutes from now. Remember, in fact, that one came out with a set of numbers. The numbers look pretty okay, a little bit better than what the sheet was anticipating. But the good news is that Q4 will be even better because pricing is higher, so they'll get a better benefit out there. Dalmia Bharat, we have been highlighting this, that cement demand has been improving and some of those price increases are gradually getting absorbed. So it explains why Dalmia Bharat as well is up close to around 2% and SAIL as well is up close to around 1%. Now, yes, there's been a big spike up in terms of steel prices, but the street is optimistic that there's more to go because still at current reckoning, prices are a little bit of a discount in comparison to the landed cost of imported steel. LTI Mindtree, that one's losing close to around 5%. Net, Nifty down, but not out. The Nifty Bank actually is doing a relative outperformance in the first few minutes. Prashant.
Absolutely. It's about 2:1 down, 2:1 in terms of declines to advances ratio. And the broader market, of course, has seen a fair bit of, it's taken a fair bit of beating, actually. Now, LTI Mindtree, I think we highlighted 5% lower, is the number 2 volume-led loser right now on the NSE. Shriram Finance is seeing a bit of a pullback. So one-way move. Before the deal, after the deal, I mean, you name it. 1.6 lower. It's got volumes in it. BHEL, we were just talking about that with Winnie, 1.5 odd lower. Oberoi Realty, we highlighted with numbers 5% down. Force Motor is down about 2%. 361, I think there was a downgrade from someone yesterday. 2.5 lower. 1140 or so on 361. Data Patterns is down about 2%. Sai Silks, that is Kalamandir, is down 6%. That's about 121 or so. Urban Company is down about 1.7. Poonawalla, Sobha, Shakti Pumps. Shakti Pumps is now under 700. Oh boy, I mean, it's a one-way kind of a move, and now, of course, it's from high was $1,000. Actually, the recent low was about 550. So from the recent lows, it's still higher. From the highs, of course, it's lost a fair bit. I started with silver this morning, and look at what's happening once again. Silver Bs 4%. We should have these at the bottom of the screen. All these silver ETFs, right? HDFC, SBI, everything up 4%, 5%. So populated really by what's happening in the on this one. Bharat Coking Coal, and Nigel has been telling us about this, 42, so 4% again. And it's actually, after Silver Bees, it's the number 2 volume-led gainer on the NSE. So huge volumes. It's I guess, it's also the, matter of the fact that it's a more biteable name, right, at 40, 42 rupees. So perhaps that participation is there. GMDC is up 4%. And I think I can spot the Vedanta, which is up about 1.5% as well. So enough and more, which is going on right now. Sanjay Mukim is with us, Head of India Equity Research at JP Morgan. Sanjay, good morning. Great to have you with us here. Thanks for joining us. At the turn of the year, especially towards the last week of 25 and first week of 26, I mean, general consensus was that 26 perhaps turns out to be a little better because, earnings perhaps will pick up. What's the earnings season been like so far? I know it's early, but we've got some bellwethers who've already reported. Does it look like we'll see a turn for the better, earnings-wise, Sanjay?
Good morning, great to be on. I think the good news is that the pace of earnings downgrades that we had seen around June last year has abated meaningfully. Earnings expectations for the market are relatively okay, at least for the FY26 season. I don't see you'll see any more downgrades. FY27, Nigel, you might see a little bit more cuts because I think expectations are still elevated. I think consensus is still somewhere around 16%. We think you'll probably end up more in the 12s or 13%. But the challenge, of course, is that it's not just the absolute that matters, it's the relative as well. Because when you're talking of, let's say, the low double-digit potential earnings growth for large caps in India, this comes in contrast with higher growth elsewhere in other sectors around the world in Asia. And you're looking at, or at least talking about, further potential currency weakness as well. So if you were to adjust the growth in dollar terms, then you'd find that in India, you would probably looking at mid to high single-digit dollar return on or dollar growth in earnings for the next 12 odd months. And this contrasts with at least expectations of higher earnings elsewhere. And which is why you see this tone of, oh, nothing's happening and things are slow. I mean, they're not really slow, they're okay. But it's just the contrast of growth elsewhere being much higher that causes this tone in India, I think.
So Sanjay, 2026 will be another year of India underperformance vis-a-vis the rest?
Well, the way we've pitched it is that, look, you'll get, at least in the first half of the year, material momentum in other parts of the world. There is possibly fiscal impulse both in the large economies of the US and in China. We're still upgrading our GDP numbers in these countries, for example. So at least in the near term, that phenomena is likely to continue. Second half of the year, and it's very difficult to take these long views now given the heightened uncertainty. Maybe if some of these excitements turn, that India may end up being a little bit of a safe haven. But at least in the near term, it looks like the momentum in economies elsewhere is probably going to be a bit stronger.
Okay. Hi, Sanjay. Nigel on this side, and good to see you. And as always, the call we had around, say, 3 months or so ago was that you were wanting to shift towards consumer discretionary and maybe rotate out a little bit out of capex. That's played out pretty well. At current reckoning, though, getting into a budget with hope that maybe, in fact, the government will do something, what's your current positioning? Will you still be tilting towards the consumer discretionary, or do you think post this recent correction and a couple of these capital good capex related names, it's time to have a relook out there?
Hi, good morning, Nigel. I think no. This is because, look, from a budgeting exercise perspective, we think that revenue collections are weak, and revenue collections will probably remain under pressure for government for a while. And this is, of course, part driven by the lack of inflation in the economy, and also because of the tax cuts that the government has, passed through recently. And I don't think that there is any impulse within policymakers to expand the deficit or think of an aggressive fiscal measure just yet, right? Why use that bullet given the heightened uncertainty everywhere? So that mathematically leaves you little room to accelerate the aggregate capex numbers. And therefore, I think that, yes, even though the sector has sort of been under pressure for a while, I don't think that there is anything that will help it turn around, at least from a public policy point of view, and nothing's clearly in the budget is likely. So on the other hand, the feedback we're getting on many of the consumer discretionary categories, top-down data is looking better. RBI consumer confidence data is improving. Nielsen data is getting better. So there is continued momentum on consumer, especially consumer discretionary, I suppose, not so much on the capex stocks.
Okay, all right, Sanjay, then do you think from here on it will be difficult for these companies to actually make a comeback? And I say that because 2026 could probably be the only budget that they could, look to spur this kind of capital expenditure. 2027, we have, a couple of big state elections, and then you're heading into another, election in 2029. So do you think for the next few years, actually, this consumer theme could actually playing out after the capital-related names had their day in the sun for the last 5-6 years on?
I think the answer, if it's limited to public expenditure, is relatively clear. There is little room for that to accelerate any time materially. And I would say for, let's say, FY28, etc., the bigger issue would be for government to accommodate the expenditure on the pay commission increases, right? You don't want to be overspending now. You want to be conservative today to create fiscal room to expand, to absorb that additional spending that is predictably coming, right? So the only way the government could increase expenditure is by expanding the deficit, which I think is very unlikely to happen in the near term. So what we could argue maybe is that non-government capex should maybe increase because the government's creating some room by cutting down on deficit. The crowding out effect is going down. We are more, or at least we think that translates more to a real estate momentum sustaining rather than for corporate capex numbers to start to surprise. So I would argue that yes, it's unlikely that public expenditure improves. And that may translate into slightly more sustained real estate spending.
Okay.
Sanjay, so basically it is just retail holding up demand on one side, right? And everybody else is on the other side. Across desks at JP Morgan and your other, your colleagues, etc., is some of that pressure easing off in terms of the supply? QIBs and, promoter stake sales. I mean, just when you look at the pipeline and anecdotally, is some of that easing off or not yet?
Prashant, if you were to add up the reported listings in the market and people who are working on and what constitutes the pipeline, it does look like fairly elevated even for this year. And remember, what happens is that many people don't even advertise their intention to sell stock. If stock is going up, you'll suddenly see an overnight block come in within decent size next day. So a lot of these things tend to be opportunistic as well. If the market does hold up, if the liquidity does hold up, I think that supply will be fairly large in 2026 as well. I don't see that easing up on itself. Yes, of course, if flow goes down, markets ease, then the supply itself will dissipate also.
So far, we've had quite a few geopolitical flashpoints just in the first fortnight of 2026, whether it's Venezuela, questions about Fed independence, Greenland, but markets globally have shrugged it off, saying that it's perhaps going to de-escalate. In your base case, is there a possibility that we see a deepish global correction, which again throws markets off track completely in 2026?
Well, I think that's a fair question because, look, what surprised all of us over the last 4 or 5 years is that you have seen a whole round of these uncertainty drivers globally. Yet equity walls have not only remained low, but they've actually fallen further. And the equity market simply saying that, look, I don't care about all of this. We don't know how to forecast or anticipate many of these issues. I focus on the earnings and earnings momentum, and we stay, let's say, comfortable in that zone. And this is not what I would have predicted 5 years ago. If you'd forecast the situation today, I would have argued that walls will be much higher than they are at the moment. Is there something that can now happen that changes that view from investors? I don't. It can, right? The whole trade war soon took people by surprise mid last year. Something as big as that, maybe a roll down of the whole AI sentiment, these things can matter. But frankly, given what we've already seen in the market not reacting, I don't know what else nudges it.
Oh, yeah, absolutely. At an index level, global volatility. And Rima, I thought you were going to ask that. You said, will global markets feel the pain? Misery loves company. I don't know. I think we've been suffering alone. But look at the market, right? It's gone. I mean, 100 points lower now. And sellers are back. So 25,484. And I just look at the contrast, the Nifty Bank here. Nifty Bank is down about 0.17. And here, I mean, it's all relative, of course, but this is a little bit of intermarket divergence we were highlighting. The bank's index is not breaking down. The Nifty, of course, has broken some of the longer-term averages as well. Sanjay, we'll leave it there for now. Thank you very much for coming on. Appreciate your time here on CNBC TV18. It's always a pleasure.
Pleasure being on. Thank you.
Okay, well, we've got earnings. We are on an earnings treadmill. Lots of numbers. IRFC, first up. Rima.
Indeed, and they've reported a good Q3. The company managed to achieve its full-year sanctions guidance of 60,000 crore rupees, and they managed to do that just in the first 9 months of this fiscal year. Manoj Kumar Dubey, Chairman and Managing Director of the company, will now join in, and what we'd like to discuss with him is that now what is the disbursement target for FY26, the outlook and trajectory on net interest margins, and the opportunities beyond Indian Railways. Mr. Dubey, thank you very much for joining in. Let me begin with the new guidance on sanctions. Now that you've managed to achieve your full year guidance, what can you end FY26 with in terms of sanctions and even on disbursements? Can you share a number?
So good morning, Rima. So we have come out with good numbers as expected. We embarked on our 2.0 journey, that is diversification journey. We started sometime in the March last year. And this 3 quarters have really been gratifying for the company for the fact that we could live up to the expectations and the kind of guidance and the target that we set for ourselves. As you mentioned, by the end of Q3, we have already crossed the mark that we set for ourselves in terms of sanction of assets. So obviously, anything which comes in Q4 is going to be more than what we had given the guidance. Giving a number, I mean, now that we are not thinking of giving any numbers, but rest be assured that since we are looking into B2B kind of system where our ticket size is not less than 5,000 crore for one of the assets. So going forward, if we are able to mop up 2-3 more assets in this Q4, the numbers may be going to be crossing 80,000 crore or something like that. So far as our disbursement is concerned, as you know, we started with zero pipeline in the beginning of the FY. So 30,000 crore target that we had given to ourselves was a very tall target. I'm happy that by the end of Q3, we have done already around 22,000 crore. So that target remains intact, that we believe that by the end of the Q4 and end of the FY, we'll be crossing the bridge of 30,000 crore that we had given to ourselves.
All right. Hi, sir. Good morning and good to see you in as always. What about the AUM? The AUM, I think, is at around 4.7 lakh crore.
As you know, AUM, as you know, this time we had a leap ahead and we ended up at 4.75 lakh crore, which is all-time high for the company. And as I've spoken in the past also, going forward, because in diversification mode, we are getting a very good response. And going forward, every quarter, we believe that now that we have shown a very handsome jump from 4.6 lakh crore to 4.75 lakh crore, this AUM will be showing quite a rise in every quarter going ahead.
Give us a number, sir. Where do you see this number going? And tell us a little bit more about the diversification strategy. As you said, it's being accepted well. So how does the mix look like going ahead?
Oh, yes. So the mix, as we have already discussed, in the diversification mode, we are looking more on the assets on the railway ecosystem. Yes, nearly 3 to 5% of my total assets will, by the end of the year, will be from diversified mode. And next 5 years, we have set a plan that our mix should be something like 60-40. So 60% should be my mix from the pure Indian Railway business, and 40% of my assets would come out from the railway ecosystem. We had a very good exposure to Gencos and Transcos in power value chain. We are not looking for any discom assets. Next to that is we mopped up quite a few number of disbursements in railway ecosystem with our siblings like DFCCIL and many SPVs of the railways. Apart from that, we are having a very close coordination and discussions with port assets as well as the metro railway assets. Maybe 26, 27 FY will be finding that apart from the big ticket assets in these areas, metros and urban transportation will be one of the mainstays where we'll be having a good forays. So overall, as you mentioned, and the guidance that we are giving to ourselves as well as to the interested investors, that going forward in next 5 years, we are looking forward to something around 30 to 40% of diversified kind of asset, where our margins will be 2 to 3x of what we get from the railways. So this 60-40 is something we are looking forward to, ensuring that everything is coming from the whole of government approach, government ecosystem, and we are very particular about looking for the assets who are fitting in our framework of zero NPA.
What will this mean for your net interest margins? Can you give us an indication of the NIM guidance for IRFC?
You see, Rima, already from 1.4 that we used to maintain last year, we are already in 1.5 overall. And going forward, I have been repeatedly saying that the new business on diversification mode, whatever we are getting, here the NIM is more than 2%, 2 to 2.5%. So if you add this to my static NIM of 1.4 that I get from the railway business, it is going to grow. This year, we should end up more than 1.5 for overall. And I believe that going forward, every year, we believe that 1.6, 1.7 and nearing to 2% when we have our nearly 40% of diversified asset in the portfolio will be there. So to give a indication to you, every year, this NIM is going to improve now for the fact that diversified business is going to stay in our kitty.
So when will you achieve 40%, that 60-40 diversification that you intend, which will help to get your NIMs to 2%? How long will it take?
Well, that target we have unveiled as 2030. So next 5 years, that is the target. And we are looking forward to, in fact, 20 potential customers in government ecosystem, each around 15,000 crore. So the roadmap for the company going ahead is that we should look forward to nearly 20 entities in the government ecosystem, having linkage with the railways, and around 15,000 crores should be their ticket size in 1 or 2 or 3 assets together. So going forward, if today I'm having a asset size of nearly 4.75 lakh crore, if you go on net basis, 2030 we are targeting that our mix should be 60-40 in this ratio.
I know you focus, sir, on reducing your dependence on Indian Railways, but can you tell us what is expected from the railway capex side? There is a union budget coming up. There is talk about a very large capex number. What have you heard, and what does this mean for IRFC? And will you require additional capital to meet that?
So you see, Rima, now that we are not on single client mode business, so we are not very, very jittery or anxious about what is coming in the railway budget or the union budget. Yes, we remain the sole financing arm for Indian Railways, and as and when they require any extra budgetary resources, we are there. What I understand from the discussion that is going on is extra budgetary resources going forward, we may not only be directly by the railways. There is a lot of PPP kind of thing that is government is thinking of, and if there is PPP projections also in the railway ecosystem, we will be there to pitch in and see to it that whatever is required for the concessionaire entering into a concession agreement for long term with the Indian Railways, we are their financing partners. So overall, yes, one thing is very clear that the appetite and requirement of capex for Indian Railways is not going to be less than 2.5 lakh crore for years together, maybe 5 to 10 years. Now, this 2.5 lakh plus crore of capex, whether it is being spent directly by Indian Railway through government budgetary support, or it will require extra budgetary support from our side, or there will be PPP element, that is to be seen after the budget is announced. But rest be assured, in the whole mix of the things, whatever capex requirement is there over and above the government budgetary support to the Indian Railways, it is IRFC which is going to pitch in up.
Okay, thank you very much for that, Mr. Dubey, for joining in. LTI Mindtree has taken a big knock today, 6% down. And this is despite the company reporting fairly decent numbers and in line with expectations. There is no miss when you look at LTIM's top line growth of 2.4%. The company's margins in Q3 improved to 16.1% versus 15.9%. And the company also said in the conference call that towards the end of Q4, they're hopeful to end with a near double-digit year-on-year revenue growth. The only thing is that in Q4 and Q1 of the next 2 quarters, there will be a margin impact, the wage hike impact on the company's margins, which the company will try and offset. But moving on now to PNB. Yesterday, the stock sold off, the bank sold off on the back of slightly disappointing NII growth and a compression seen in the NIMs. Ashok Chandra, MD and CEO of PNB, is now joining in to discuss their Q3 numbers. And we'd like to ask him if a deposit rate cut is likely to protect NIMs, if the loan book growth can sustain within the guided range, and if a 1% ROA is sustainable in the event of rate cuts. Thank you very much, sir, for joining in. First, let's talk about your NIMs. The street was hoping that the NIMs would be stable in Q3, but they declined further. What is the new guidance on NIMs for the full year? Where are you likely to end by Q4 FY26?
The NIM contraction which you are seeing, the impact is because of the 2 reasons. One is that 25 basis point cut which has happened in this particular month, December. And that has also put some impact on our overall NII and the NIM. Second, mindfully, we have not reduced the interest rate on deposits. This was a conscious decision of the management and the ALCO. And we were holding to the same deposit rate for the entire Q3. And since we were seeing the visibility in the good profit and the net profit, operating profit, so keeping in mind the dynamics and the depositors' interest in mind, we were holding to the same deposit rate now. But we have revisited in the Q4 and the very first month of this quarter. We have recalibrated our deposit rate in the various segments and around 20 to 30 basis point cut which we have done. And definitely, I think that will protect my NIM in this particular quarter.
Okay. So just a level, 2.6, is it for the full year? Should we look at 2.6?
It will be for full year, as of now also, we are at 2.73. And I'm expecting that definitely between 2.6 to 2.7 will be the year end. We will be closing at that level. So somewhere between this margin, between this level, we will be holding it to our NIM.
Okay, 2.6 to 2.7% to end the year with. So Q3 margins would be a trough. Yes. And would you look at a deposit rate cut to improve margins? What will drive this NIM improvement from Q3 to Q4?
One is that our some high cost deposit which we had mobilized in the last 1.5 years, I think 70% of that has already been recalibrated, and 21% we are expecting that will happen in this particular quarter. See what happens, the repricing has already happened, but the impact which we will see in subsequent quarters. So all those things and with the some 20 to 30 basis point cut which we have already done in the month of January, definitely there will be NIM positivity will be there, and we are expecting that from now onwards, definitely there will be positive sign in the NIM growth.
Okay, got that. What is the credit growth guidance? Are you still holding on to 11 to 12%? And what is the sanction pipeline now?
Yeah, in the beginning of this financial year, we had given the guidance of 11 to 12%. And as of now also for the full year, we are at 10.9%. And this particular quarter, it is almost around 11%. See, we have already 3.12 lakh crore corporate loan book sanction we have done in this financial year. Last year for 24-25 full year, our sanctioned corporate book was 2 lakh crore, which we have already surpassed. And in that 1 lakh crore disbursement is yet to happen. I'm expecting that some disbursement will happen in this quarter, and then going forward in 26-27, most of these disbursement will start happening. So we have a good pool of corporate loan book, and these are not the proposals in hand. These are all the sanctioned book. So going forward, I'm expecting that we will be closing the corporate loan book at 4 lakh crore in this financial year. So we have a good pipeline. What we are doing is that we are setting away some low yielding advances with some good proposals which are in pipeline. So that is the reason real impact in the corporate loan book is not reflecting. Our corporate loan book in this particular quarter is 8.9%. But I'm expecting that with the calibration which we are doing it, I think with that, we will be able to touch the double-digit growth in the corporate loan book.
Mr. Chandra, hi, good morning. Prashant here. In the morning we had the management of CET, and I was asking them about whether credit growth is really going to come back in a big way. Because at the end of the day, that is, sort of almost one-to-one kind of injection of liquidity, creating demand, right? We have fortnightly numbers. Is demand for credit? What's your own forecast, sir? Are we going to see an acceleration in terms of credit growth overall, as you see it? And which segments should we focus on? Where is this going? Is it going to home loans, autos as a segment? Where is it going?
See, overall, I can tell you with confidence that there is a vibration in the entire economy. And that number itself reflects if 8.2% is the GDP growth in the Q2, I think definitely that impact is going to come on the credit delivery. If I can talk about our growth in the various sectors, see if you can see our MSME growth. In Q2 also, it was more than 19%. And in this quarter also, we have shown a growth of 19%. And you know that MSME has the larger impact in the overall economy. So if that is growing at 19%, so it says how the economy is behaving now. Second aspect, if you can touch, is the retail loan. Retail loan is also in this particular quarter, excluding IBPC, we have grown at more than 18%. Housing is growing at more than 15%. Vehicle loan, there is a growth of 35% YOY. So you can see the impact of the GST in this particular quarter. And this is not the story for 1 or 2 quarters. It's going to happen in the entire year to come now. Even the agri sector, which used to be at 7 to 8% 1 or 2 years back, now that is growing at 11 to 12%. So entire retail, agri, MSME is growing in the double digit and more than 15-16%. Corporate loan book, which everybody was thinking that nothing is happening in the corporate side, if that is growing at 8.9% in this particular quarter, despite setting off some low-yielding advances, and if we have sanctioned 3,12,000 crore of corporate loan book, that speaks about the visibility and speaks about the resilience and the growth in the economy now.
Good point, sir, with regard to the corporate loan book as well coming back to life. Encouraging not just for your company, but for the economy on the whole. Got that. Let's talk about your ROAs. Holding around 1%, but some believe maybe it's driven partly by treasury gains. Maybe it's driven a little bit by recoveries. The point is that, going ahead, do you believe the ROA at around 1% is sustainable? Do you have enough levers in store? Please go ahead.
Yeah, I'm fully confident. And the ROA guidance in the very beginning of this year, we had given that we will be maintaining more than 1%, and we are holding to that level. See, in this particular quarter, you are right that one treasury gain that came by Canara HSBC, which we had diluted. But at the same time, 952 crore we got out of that. But mindfully, keeping that profitability in mind and the cushion for the ECL, we have kept 955 crore floating provision. I think everybody should see from that angle. See, this quarter, we have made a provision of 1,343 crore. Now that 1,343 crore is not for the NPS. 386 crore is only for the NPS. Remaining 955 crore is the floating provision, which we have kept it for migration, which is likely to happen in the ECL from 1st April 2027. And with this quarter addition of 955, we have the floating provision of 1,775 crore in the bank now. So you can imagine that likely impact which we have calculated for the ECL for entire transmission is around 10,000 crore for the entire 5 years. And we are already holding 1,775 crore in our kitty now. So not only for this particular quarter, but going forward for Q4 and 26-27 financial year, we are very confident that ROA will be holding more than 1%. No doubt about it.
Mr. Chandra, we'll leave it there, sir. Thank you very much for joining us. Good luck. Very confident and very positive sounding commentary coming from you. And we hope, next time we speak, some of those numbers, of course, hold strong and get stronger. and there is general overall credit acceleration as well. I mean, works for banks, but I mean, of course, critical for the economy as well. We'll take a break. We have the management of Hindustan Zinc joining in the third quarter numbers. Stay tuned, coming up.
Welcome back. This is Corporate Radar, and numbers are trickling in thick and fast. So let's get straight to our next management. Hindustan Zinc. We're joined by the CEO, Mr. Arun Mishra, who joins us on the show. Hi, Mr. Mishra. Always good to have you on the show, sir. Let's talk about the one that's been twinkling the most, silver prices. In the last 1 year, the silver estimate that we were talking about has gone from $35 to $45 to $50 an ounce. Now, Mr. Mishra, you've kept upscaling this guidance. Where do you think silver is headed from here?
So we are not at all now no longer talking about silver price, because beyond a point you cannot do a guesswork and make it a part of your plan. So we are now focusing more and more into how to increase our production of silver. As you can see, in Q3, we have produced 10% more silver compared to Q2. We are unleashing all improvement activities that we required for either producing ore with better grades of silver from our mines, or in the concentrator produce lead concentrate grade with higher ppm of silver. Look at our fumer operation. We have already added 8 tons additional silver through fumer, and we want to add further in Q4. At least double that quantity we'll be adding in Q4. And also look at more stable operation of our pyro plant, from where we get the basic input material for silver. So that is the main lookout now, how to increase more silver from the mining that we do. Otherwise, on the prices, we have given up. We won't calculate or bank too much on prices now.
Okay, focus on production, not on pricing. But you'll hedge some part of the silver, right, at lower prices. So as of now, how much is still pending?
So I think in around 60 tons or so, I will send you the actual number. Something around 72 tons we had hedged in the 9 months. And some amount of that will be left now.
Okay, so some part of that is still in the system, which will gradually get cleared out. But is there any fresh silver sales that have been hedged?
No, we have not.
Okay, all right. Well, let's get to the production side, since you're saying the focus is on production as well as, on the quality of the product. Silver production. The guidance looks like a very, very tall ask, sir. Your 9-month performance, is lagging actually. Are you confident of ending the year at around the 680 tons odd? Because as of 9 months, you're in the vicinity of around 451 tons.
So while the way to look at it, although we have produced 451 tons in the 9 months, but also look at about 21 tons of additional silver value we have recovered from the concentrate sale that we have done. And we want to sell some more concentrate in Q4. So while we keep producing from the smelter finished silver, also we'll recover silver value through concentrate sale. Two together should take us to our guidance number.
So you believe that you're going to be heading closer to 680 tons. But does the demand-supply gap for silver globally continue to exist? Because you've been talking about the deficit.
I think the deficit is there and the demand is continuously increasing. Whatever happens in the US policies, but the world is continuously seeing push for more and more renewable power, and which is pushing up the silver demand and hence the silver prices. I think the equation is not going to change in any short span of time. Only it may correct to the extent that people are overestimating the future prices. To that account, it can correct itself. Otherwise, I don't think basic factors of demand and supply equation is not going to change much in the coming days.
Okay, got it, Mr. Mishra. But if you could help us out now with a larger part of your business, but of late we're focusing more on silver. So let's talk about zinc. What's the outlook on zinc prices? And could you tell us, is there some more scope for improvement on the cost of production side, which has come down to multi-year lows?
We will do even better than that in Q4 surely on the cost front. But on the price front, overall zinc prices are stable and it will remain at that unless we find new zinc mines expansions happening. Now expansions, even if we or others do, it will take at least 2 to 3 years. So I don't think that the prices are going to vary much in the coming months.
Okay, all right. Mr. Mishra, you've announced phase 1 of the expansion, but the next phase is also awaited. Could you tell us when is that announcement likely?
So phase 1 already we have started working on the ground, and the phase 2 portion, I won't call it phase, it is the balance portion of the expansion of another 650 KT smelter and another 200 KT lead smelter plus some 600 to 700 tons of silver smelter. So all that are on the drawing board. We are finalizing with the designers. By I think a month or two, it should be announced.
We hope to touch base and at that time in the next month or two when you announce the incremental capex and the expansion. Now, given that you're going to be generating very, very cash flows, could you tell us what is the utilization of this money?
No, as far as we are concerned, we need about $4 to $5 billion for all our expansion programs, and we want to self-fund that. Unless, of course, the board decides for some strategic purpose. If that not be the case, we want to remain debt-free and utilize all our cash for our own expansion.
Okay, but don't you think it's an opportune time actually to go ahead, unlock value in Hindustan Zinc, maybe separate the silver business?
No, I think in the right places we are discussing, and I am sure when people see the reasons, that the decisions will be taken. Right now, I cannot comment on that, but yes, we have raised the topic.
Hoping for a breakthrough, sir. Last few quarters, you've been telling me the same thing. Finally, since you're on the board as well of Vedanta, what's the sense? Vedanta sells some more stake in Hindustan Zinc and, gets a little bit more money power with them?
No, I won't comment on that because that's for the Vedanta to decide. Today, as Hindustan Zinc CEO, I am not going to comment on that.
Got it, Mr. Mishra. Always a pleasure talking to you. Thanks a lot for joining in. Q3 was strong, and going by what you're saying, Q4, in all probability, will be even stronger. Stock holding more or less flattish. But we need to address the flashes on the bottom of your screen. Vivek is joining us to give us an update with regard to restaurant brands. Vivek, take it away.
Well, that's right. So on November 24th, our viewers will recall that CNBC-TV18 was the first to report that a family office of a large listed Indian pharma company was in the race and was leading the race to go ahead and acquire a majority controlling stake in restaurants Brands Asia. In fact, we had also reported that they were looking to completely buy out the PE partner Everstone Capital. What we understand from our sources today is that Ajanta Pharma is the pharma company, and one of the promoters, Ayush Agarwal, who has interest in the QSR space, the family office led by him, is leading the race, and we understand that they will buy out the entire stake of Everstone. In fact, we understand that this is going to be a three-part transaction process, and we understand that close to 3,300 crore worth of deal will actually happen. Now, what we understand is that in the first step, Ayush Agarwal's family office will look to infuse close to 1,500 crore via cash, and they will take equity in restaurant Brands Asia. And remember that there is a board meeting scheduled later today for a fundraising as far as RBA is concerned. We understand that step 2 of this particular deal will involve Ayush Agarwal picking up the entire 11.26% stake for close to a little over 450 crore from Everstone Capital. And we understand that since there will be a change as far as the controlling stake in RBA is concerned, we understand that there will also be an open offer, and we understand that this particular open offer will be done at a premium to the current market price. We've reached out to Everstone Capital, Restaurant Brands Asia, Ajanta Pharma, as well as Lennox Foodberg. Responses are awaited from all of the stakeholders involved in this particular transaction.
The Restaurant Brands Asia as a company, I think it listed in 2020, Vivek, and I'm just looking at it, right? I think it's never since then. 2020 was a positive year. After that, it's never had a positive year. It's essentially been just a one-way kind of decline through and through. 21, 22, 23, 24, 25. And of course, this year is starting a little better. The stock's up about 7% on the year so far. So Vivek, the family office putting money into restaurants, Brands Asia, and Everstone's 11% goes, and there's a 26% open offer, right? I mean, so finally, after all of this, they aim to own how much of the company?
So 26%, in case all of the shares gets tendered in the open offer, another 11% stake, of close to 450, that they're buying from Everstone Capital, 11% stake over there. And whatever, depending on the price of the deal, they're looking to infuse close to 1,500 crore worth of equity in RBI itself. So eventually they will have the controlling premium. And like you mentioned, a couple of reasons, for the underperformance. Number one has been SSLG growth fundamentally has been quite poor. And there has also been the overhang of consistent pairing of stake by Everstone Capital, which has also weighed in on the stock price. But today evening, we should get a lot more clarity. Hopefully, most of the details should be fleshed out and should be up on the exchanges.
Right. Thanks very much, Vivek, for that. So that is a big story. And Vivek, of course, following up in terms of the information he put out earlier, as he said, today evening is essentially the transaction announcement, as we understand. Well, I think we can move on to another bank, and a bank which has done very well. Yes Bank reported a robust operational performance in the third quarter. Net profits rose 55% on a year-on-year basis. Steady net interest income and improving asset quality. NIMs, by the way, went up some 10 basis points on a quarter-on-quarter basis as well. What's the outlook going forward? Prashant Kumar is Managing Director and CEO at Yes Bank. He's with us. Mr. Kumar, good morning. Great to have you with us here. Prashant this side. So actually, I'll come to the loan growth and in just a bit, but I just wanted to start with a NIM question, sir. Sharp improvement on a Q1Q basis, which immediately begets the question whether this is sustainable. There is a fair bit of competition for deposits. How will you manage an upward sort of trajectory for net interest margins, and what are targets going to be like here?
So first thing, Prashant, strategically, we were targeting a profitable loan growth. That is first part. Second, we have also taken deep corrective actions on the pricing on the deposit, especially on the saving bank. So our cost of deposit has also come down. And we also got the advantage because of our RIDF deposits are being now coming down. So I think it's a combination of chasing a profitable loan growth, a reduction in the cost of the deposit, and also getting the advantage because of the RIDF deposits coming down.
So where should one anticipate NIMs at? I mean, could you share with us a target, aspiration?
So we are not targeting, but definitely the current quarter would be tough in terms of recent reduction of 25 basis point would definitely bring down the yields on the loan side for the current quarter. And this quarter, there would be definitely a lot of, a fight for the deposit, and this is also the fourth quarter. I don't think we would be able to reduce the cost of deposit for the current quarter. So I think because of this, we would definitely try to retain our margins, and then in the quarter one onwards, the upward journey in terms of improvement on the margin would happen.
All right. Hi, Mr. Kumar. Good morning. Good to see you in. What about in terms of growth? Earlier, I think you all were gunning for close to double-digit growth. This quarter, I think it's been in mid-single digits. What's the outlook in terms of loan growth?
I think if we see the quarter two and quarter three, sequentially, we have been able to achieve a 3% growth. So I think we would be able to have the similar growth or maybe a slightly upwards, maybe towards 3.5% for the quarter four. So by and large, we would be in the position to reach around, say, 8% loan growth for the current financial year. But definitely next year would be a different thing because we are already made some changes in terms of how we are targeting the loan growth, profitable loan growth. We have reduced our cost of deposit. So some of the asset classes where we are not targeting as of now would be definitely part of our strategy for the next financial year.
All right. The ROA has been gradually improving. And you mentioned in the past that you believe that it will continue to improve from here on. Could you help us out with the target? When do you hit that 1% odd mark? And what are the levers you have in store?
I think 1% ROA is something we we were sharing like we would be exiting FY26 with a 1% ROA. But if you see the Q3 performance, and if you take out the impact of the gratuity, then we are already 1% ROA for Q3. So definitely the Q4 we would be exiting at 1% ROA. And as per our earlier strategy, I think FY27 would be a 1% ROA for the full year.
So just getting back to the point about loan growth, while you have guided for 8% this year, it's still less than 10% that you'd spoken about earlier. So what explains the miss versus earlier expectations, and what are the new portfolio additions that you will do to asset classes that will drive FY27 loan growth, and would that be in double digits?
Well, I think if you see in terms of retail side, especially the prime home loan and the new car loan, okay, the pricing is very, very competitive, and we don't think with this pricing it makes sense for us to grow on those asset classes. Sometimes just to chase a loan growth, we forget that not only there is a shrinkage of margin, but it would also bring your obligation for the priority sector, depending on what kind of loan growth you do. So I think we have done our maths around this. We would definitely not target these kind of asset classes where yields are so low and there would be obligation for the priority sector, which is also very, very costly affair for the entire banking industry. When we are talking about the next financial year, I think because we have been able to reduce our deposit cost and we would take further actions in the next financial year, I think we would be able to go forward in terms of like affordable car loans, the used car loans, and the business loan.
Sorry, Mr. Kumar, so the areas of focus is passenger vehicle loans and used cars, etc. That's what the focus is, where yields are better?
Yeah, where the yields are better, including the business loan and the personal loans also.
Okay, not the home loans and the other where yields are low and there's too much competition. What about on the gold loan side, sir, Mr. Kumar?
No, absolutely. Gold loan is a very attractive, I would be saying, asset class. Incidentally, we are not there, but definitely this is our part of the strategy. Only thing is like going for the gold loan, first you need to prepare yourself in terms of how you would operate, in terms of security, safety, and the operational part. But definitely this is part of our strategy going forward.
Yields are also attractive. So this is FY27, we will see this getting rolled out across branches?
Yeah, we will be planning for that.
All right. Talking about FY27, sir, what about your tenure as the head of the bank? I think it ends in April 2026. Any further update with regard to an extension? Leadership is something that the market as well will be looking forward to very, very closely. So what's the latest?
No, I think board is moving forward in terms of succession planning. And I think once there would be a clarity, we would be definitely share with all of you.
Okay. Well, I think, the bank's done very well under your leadership. As you said, ROA is almost 1% now. I really appreciate you joining us here on CNBC-TV18. Thank you very much. We'll take a quick commercial break here. Manisha joining in with commodities and focus on the other side. Stay tuned.
Cool.
Welcome back. Let's talk commodities now. Manisha is joining in. And what do you have your eye on? One commodity or everything's up and down?
Well, I'm looking at base metal prices. Even as the safe haven buying in precious metals has continued, it is the base metal prices which has finally come under some profit taking. Well, the dollar index for one is holding around 99. That has been putting pressure on prices. The other thing is this whole US and Europe conversation or the friction that we have seen come in really seems to be bothering this sector. So US has threatened tariff on 8 EU nations, 10% from 1st of Feb and 25% on June if the deal does not go through. EU, in the meanwhile, has threatened activating anti-coercion instrument therein. There also is a conversation that you could be looking at meetings coming in the next few days between these 8 European nations there. Europe now, remembers, holds nearly $10 trillion in sense of US bonds and equities. Europe also has a lot of public sector holdings within US in various areas. And if the trade dispute intensifies, whether or not the European Union will use these holdings to its leverage is what really seems to be bothering the markets right now. Having said that, it also is about a strong number of around 93 billion euros, which Europe faces in sense of levies worth of US goods. So these numbers are leading to not too much of buying now in case of base metal prices therein. Interestingly, it also has been about China growth expectations, which in recent days has been supporting metals, manufacturing, industrial goods. All of that data from China has come in on the positive side. The US, ex-US market tightness, because remember, the US was putting all of these tariffs. So before these tariffs came into place, a lot of metals from various geographies in the world had started going into US. So US was well supplied, but the rest of the world was looking at tightness. But all of that seems to be changing at this point in time. Markets do believe that this rally at these current levels is more speculative, more money-driven than fundamentals. One, the reasons for that is one, that the metal is rising on potential future demand. The current demand is not so strong to keep the prices where they are. Second point is that while the US inventories are well supplied, the ex-US inventories seem to be rising as well. And then US has decided not to tariff the critical minerals. So whether it's about silver, copper, other metals will not be tariffed. So even as there are no tariffs right now and there's enough metal available, the prices have continued to rise. So markets believe some profit taking is what you can perhaps look at in metals in coming few days there. Most interestingly is this point. Shanghai has now prohibited a section of high-frequency trading firms from entering the market, making it speculative and volatile. With these firms not allowed starting today, you're looking at volatility, volume, and the price rise, all of that kind of contained. So the tin prices, which hit an all-time highs, have come off by 10% from those highs. We also have seen aluminium Shanghai inventories gain up by 30% in the matter of last 3 months itself, taking the prices slightly on the weaker side. And there's an inventory increase on LME for copper and zinc as well, weighing onto those commodities there. We are looking at many of these metals actually open in the Asian markets, 0.5 to 1% on the lower side. So finally a day when you're looking at profit taking in base metals.
All right, Manisha, thank you very much for that. So some pullback, and we got a bit of a pullback in equities as well, 117 points. And as we kind of sort of take a break, I just want to highlight that the rupee has gone past 91 against the US dollar. We'll have a flash coming up in just a bit from now. I think this is the first time since 2017 that we are back at these kind of levels. Yeah, there you go. So dollar rupee 91, past 91 for the first time since December 17th. Okay, so more on this as we go along, but that's a 14 paise depreciation so far coming through. We'll take a quick commercial break here. We'll come back Indianomics with Lata. She'll talk about the budget math with economists Sonal Verma of Namura, Pranjal Bhandari of HSBC, and Upasna Bharadwaj of Kotak. Stay tuned.
Fly Emirates, fly better.
Welcome to the Mega Budget Match Show. Here's the CNBC-TV18 poll of what the budget numbers are likely to look like based on the estimates of several banks. The bottom line is economists are basing their estimates on the expectation that India's nominal GDP growth will be 10.1% in FY27 versus only 8.2% this year. Average, all these are. Higher nominal GDP usually means higher taxes. So the gross tax revenue is expected to grow by 9.3% versus only about 5.5% this year. Also, the corporate tax is expected to grow by around 11% versus only 9.4% this year. Income tax expected to grow by 13% versus 10.7% estimated for this year. As per our poll, the government will increase capital expenditure by 10%. Hence, the fiscal deficit is expected to come down only marginally from 4.4% in the current year to 4.3% next year. Again, average, there are some with 4.2. The government will also bring down its debt to GDP to 55.1 next year from 56.1 this year. Well, with this preliminaries, let me invite our star panel of economists. Joining me are Sonal Verma of Nomura, Pranjul Bhandari of HSBC, and Upasana Bharadwaj of Kotak Bank. All eminent economists. They only incidentally happen to be women, just as our finance minister is also incidentally happening to be a woman. Thank you very much, all of you. Sonal, let me start with you. The fiscal deficit has to come down only marginally next year compared to, 40 basis points and 60 basis points in previous years. Plus, the expectation is of a higher nominal GDP. So would you say there is a little more elbow room? Again, no tax cuts expected. So little more elbow room for the government to do something this year?
There is elbow room, Lata, but I think the bigger question is there a need in terms of counter-cyclical growth support? I think in the last 12 months from the fiscal side, we've already seen counter-cyclical measures in terms of the personal income tax cut, the GST cuts, the front-loaded capital expenditure, and the latter two basically to counter the higher US tariffs. So I think the economy is actually in a good place right now, having seen the impact of fiscal easing, plus of course the monetary policy easing. So I think in terms of whether stimulus is needed, I don't think there is actually a big need at this stage. What is more important right now is really to focus more on the medium term, the global backdrop in which India needs to grow. How do we make our supply chains more resilient? Do we expand the Make in India scheme? How do we boost domestic demand? I think these are the more medium-term pillars that need a bigger focus in this budget.
Oh, excellent. Suits us. We will have more policy discussions rather than minor mathematical squabbles, which we normally have during a budget. But Pranjul, how confident are you of this growth number? I got an average of 10.1 from all of you. Some of you are a little south of 10 and some a little north of 10.1. But does it look like we will have a comfortable real and deflator?
Yes, I think so, Lata. I think, having a 10% nominal GDP growth is quite possible in FY27, and you can also have slightly higher number. I would break down 10 in terms of 6.5 for real growth and 3.5 for the deflator. The state of the economy has been quite confounding. I can give you enough indicators which show things are looking good, like credit growth, it has picked up, or enough to show you that things are looking bad. For example, PMI, which has started to fall in the last couple of months. I think the truth is that the economy is in crossroads. 2025 was all about the informal sector coming back up and a consumption-driven growth. And I think 2026 is going to be the formal sector reappearing and moving a little more towards investment. And I think we are in this crossroads, and that's why we are getting all of these confusing mix of data. But I think the underlying growth is steady. I think the 6.5%, which also is my estimate of India's potential growth, is easily achievable at this point of time.
Very quickly, Pranjul, it's the corporate earnings that have been disappointing. The GDP number is only a number. You can't buy the GDP. You buy shares. And there you've got corporate earnings in single digits. Does that turn?
Yes, that is disappointing, but actually it's not surprising because if you look at the nominal GDP growth expectation for the December quarter, it's probably the lowest. We are expecting about 7 to 7.5%. So that also impacts corporate earnings, in terms of growth. And my sense is this is something that will correct in the next fiscal year, and we will start seeing the corporate earnings go up a little bit. Also, I want to say that generally corporate earnings do better if the growth is formal sector led. And last year was all about informal sector, and that's another reason why I think things will look a little better going ahead.
Okay. Well, at least informal sector is good from an equality standpoint. Upasana, let me just move away from the big numbers and ask for the one number that made a huge difference this year. Okay, Upasana, we'll come to Upasana in just a minute. The problem with the audio over there. Sonal, to come back to you on cost of capital. The fiscal deficit is, some of you placing it at 4.2 and some of you at 4.3, but the borrowing number is about, 17 trillion rupees gross borrowing. You take away 5.5 trillion, which is redemption, you still have an 11.5 borrowing, plus states borrowing, something like 13 trillion. So 17 plus 13 trillion, there is a 30 trillion rupee borrowing already. The bond yields are at 6.67, thereabouts. So is there going to be a pressure in terms of cost of capital? Never mind that the Reserve Bank has cut rates.
Yeah, I think, Lata, that is actually a challenge, I think, going forward. So on our estimates, the centre's gross borrowing, we are actually estimating it closer to 17.5 trillion INR. So about 12 trillion in terms of net borrowing, plus, including states, the gross borrowing numbers will be close to 30 trillion. So the supply is actually quite large. And from the demand side, I mean, we've seen demand from banks, pension, insurance, foreign portfolio investors, all being lower than expected. And it's really been the RBI's OMO that has sort of filled in the delta gap. So as we look ahead, I think some of these challenges will continue. I mean, we do think RBI will do some more OMO in FY27. There'll be some SLR demand that will pick up. The FPI side, there's no index inclusion imminent, so that sort of remains a question mark. So, I mean, you're right. The RBI can, try to do more liquidity through OMO and keep spreads narrow. But I think, towards the end of the rate cutting cycle and with, supply quite large and the global backdrop we are in where typically, markets and investors are focusing a bit more on the fiscal and the term premium expecting a significant moderation in long end yields, would be challenging. Nevertheless, Lata, I think at the end of the day, whatever actions have been done cumulatively in the last 12 months, transmission is happening, credit is picking up, and I think the economy is in the transition phase. So cost of capital may not fall much, but I think growth can hold up.
Okay. Yeah, there is, of course, because as we come to a lower debt to GDP and a lower fiscal deficit, the compulsion of getting included in the Bloomberg index mid-year next year becomes a very good possibility. It's only been postponed, not, cancelled. Upasana, apologies that we have to have you on phone, but, one of the things you have argued very strongly is about the RBI dividend. That was the clear magic this year. In spite of lower than expected tax, we got this massive 2.7 trillion from RBI. Does it get repeated?
Lata, if we see the dollar sales for this year have been significantly lower than what it was last year. So clearly, the kind of windfall that we got last year could not be necessarily the same, but it will not be very different from what we see from all various expectations. We are looking at a range of 2.5 to 3 lakh crores still. So more or less, we would be expecting a similar amount of dividend from RBI with a probable downside to an extent.
Okay. Then taxes better perform. And all of you are expecting it to perform. I want to start the policy questions now as to which sector and what kind of policies. Upasana, let me start that with you. Which sector should we bet on before the budget? The chorus seems to be defense.
Yes, absolutely, Lata. I think what has happened is that we have kind of hit a roadblock when it comes to incremental benefits coming from the railways. I still see benefit, but from the road segment. And I think at this point in time, when the geopolitical scenario is extremely volatile, this is the time to go ahead head on with increasing defense spending. We are looking at a reasonable growth on the defense spending side. It could be somewhere to the tune of 20-25% at least. And that should be something which we should definitely bet on.
Okay. Well, I have more questions on what the government will do with PLIs, what will it do for MSMEs, and what will it do for customs duties. A lot of reform and rationalization is expected there. Those questions to my guests after this short break.
Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel, and with me is Mangalam. Well, Mangalam, market's a little bit jittery, but we've got plenty of earnings to look at. So let's get straight to that.
Yes, we do have plenty of earnings to look at. You know, as we're looking at the market, though, from today's low, there has been a mild recovery, but still under a serious amount of pressure. One would have thought that maybe after yesterday's closing above that 100-day moving average, maybe the lows would be protected today. Let's see how we go about in the second half of trade, particularly given that it is also the weekly options expiry. One of the stocks which is under severe pressure right now, as our ticker team is alerting us, Ola Electric down about 6%, as the CFO of the company has resigned as well. But in a market like this, let's get some ideas for profit. We do have some coming in from our colleagues at Money Control Pro. Jitendra Gupta joins in with a stock that he's been tracking closely. Jitendra.
We like Mishra Dhatu Nigam, Midani, which is entering a phase where years of investments in capacity and capabilities enhancements are now beginning to pay. Midani manufactures special steel, super alloys and titanium alloys for the defense, space and atomic energy and aerospace applications. Midani has been continuously improving value addition through backward integration, the commissioning of its dedicated titanium melting shop and titanium plant with 250 to 300 tons of per month capacity that should improve control over semi-finished inputs. The product mix is also shifting towards higher value alloys such as aviation grade super alloys, nuclear application and space grade titanium products. Recent wins, of course, including 600 crore super alloys contract from Hindustan Aeronautics undermines this transition. Management is targeting a medium-term EBITDA margin of around 25%, which is supported by operating leverage as utilization improves from the current levels of 20 to 25% in some of its categories. Midani has an order book of close to rupees 2,500 crore, which provides strong revenue visibility. Export opportunities are also gradually opening up, with the company targeting 10 to 15% contribution over the next few years. At around 26 times its FY20 estimated earnings, the stock offers good value considering strong order book, capex-led growth, possibility of margin expansion, and of course, huge long-term opportunities.
Okay, all right. Thanks a lot for that. Well, let's move on to Havells. Reported a largely in set of numbers for the past quarter. We have with us Mr. Anil Rai Gupta, the chairman and managing director of the company. Hi, Mr. Gupta. Good morning and good to see you in. Well, we're going to be discussing a few talking points, but let's state that out for our viewers. The strong demand in the cables and wires business, will it continue? The outlook on Lloyd's growth trajectory, and what's the impact of a new entrant, a smaller one, but Bajaj foray into the wires business? Well, Mr. Gupta, let's address one problem, though. That's with regard to the raw material cost. Everyone's been talking about the melt up that we're seeing in metals. That's going to impact a business like yours, maybe temporarily. But how do you see that panning out? Do you think there'll be further pain on margins in the coming quarter? And more importantly, you will say that you'll take price hikes, but in turn, will that hurt demand?
I think absolutely, Nigel, you've hit the nail on the head. There are all these things will be there. The raw material price increases are unprecedented. Copper has increased 50% over the last 1 year, about 25% in the last 1 month. And I think such unprecedented cost increases, everybody is right now grappling with how to pass on this cost increase to the market. Cables and wires business, definitely it has to be passed on immediately because 70 to 80% of the material, raw material is copper and aluminum, and it is being transferred, being passed on. But yeah, in a very short period of time, it can impact margins, but over a period of time, the margins become normal. You rightly asked this question, can it hurt demand? Well, in the very short term, it will, because there has been extra stocking in the third quarter by the channel, which will normalize in the month of January. And hopefully, if it remains stable, then the normal demand should come back. But in this hyperinflationary situation, it can affect demand in the short term. As far as the other products are concerned, like switch gears and fans and all, obviously all these cost increases, including silver, affects the margins. But in the medium term, these cost increases will have to be passed on to the market to retain margins. Generally speaking, in brand and distribution-oriented businesses, the demand is not so price elastic, and hence it is prudent to actually pass on the consumer the benefit or the problem of the cost increases. But usually in the long period of time, it can affect demand. So right. I hope the world demand for these metals, does not continue to go up and affect the costs.
Well, that would be problematic for those who invested in the companies which are exposed to copper and aluminum. But be that as it may, that is margins, that is the market. Mr. Rayutta, I had to ask you about a couple of things. Once you said that it's a hyperinflationary environment, obviously it is not only just hyperinflationary, it's hyper-competitive as well, with a lot of players looking to eye that market. As and when they enter the space, the incumbents also wanting to protect their turf. At the same time, there is this US-India sort of international trade-related tension. Then you have another problem of full capacity utilization. So there is still some time for you to actually go ahead and, start the new plant. If you could give us some sense on all those parameters. One is on by when does the new C&W plant start operating? And as a result of which, how do you ramp production out there on competition? And at the same time, some new entrants out here.
Well, the sound of it looks like a perfect storm, but no, thankfully things are generally decent for us, good, because the capacity expansion in cables where we were short of capacity has been on. We have started getting the benefits of the capacity expansion done till now, and that capacity expansion is continuing in the coming year as well. A lot of our capex, even for the next year, will be on cables and wires. So we don't see capacity as a major constraint going forward. You mentioned about the tariff situation. Yes, we were looking at the US markets for developing our cables and wires business, which has been slowed down. But our business was not so much dependent on US till now, which you can say is positive. But I think going forward, we'll continue our efforts towards building, our demand in the US market. Hopefully, the tariff situation will normalize over a longer period of time. The final thing about, increased competition from new players, I think I always maintain that, cables and wires business has a lot of unorganized play as well as regional play. I think more and more organized players will come into the market. This will shift the demand from unorganized and regional play towards more organized players, which is a good thing. Yes, again, in the short term, they may try to gain market share through price, which can be a bit of a problem for the incumbent players. But I think over a longer period of time, this industry is dependent a lot on brand building, distribution, and product innovation.
Okay, all right. Ms. Gupta, before we let you go, I wanted to ask you about this opportunity you're seeing in the solar space. So as of now, as a percentage of your mix, how much is it? Where do you see it headed? And what are the opportunities you're looking at for your company?
I think right now it's a very small part of our mix. It is now becoming sizable because the growth is very fast in the solar business. Our investment in Goldie Solar start of this year gives us a very strong hold on the supply chain for the products. Our business focus will remain more on distribution-oriented business as well as commercial and industrial installations business. We are not into the utility play, but there also we see a very strong demand in the coming times. So in the next few years, 3 to 5 years, we see that it's becoming a larger part of our overall business, and it will become almost like a new business unit rather than just remaining in the others category.
So you would expect it to be at least 5 to 10% of your sales over the next 3 to 5 years?
Yes, could be.
All right. Just a final question before we let you go on Lloyds now this is, because you've in the conference call mentioned that you are looking at anywhere between 5 to 10% price hikes coming in to absorb the cost increases, rupee depreciation pressure, the BEE pressure as well. Will those 5 to 10% be enough? By when are you looking to initiate those price hikes? And what does that do to your profitability target or break-even target for Lloyds?
I think the price increases have already started because the BEE norms have changed start of this month. The raw material prices have jumped up sharply. So the price increases have already started. But the real thing will be known when the season actually hits. Right now, it's more of channel taking the product and finally eventually. So this demand for summer season starts around February in South and North in March. So we'll really know the impact of the price increases, and the real price increases to the consumer will actually happen in a couple of months from now.
All right, take that point. Always a pleasure speaking with you. Wish you good luck. You said it's a perfect storm, but not necessarily as bad over the medium to long term. Near term may look volatile. Take a short break, come back. On the other side, we focus on the primary markets. Third-party logistics company Shadowfax is near 2,000 crore rupee IPO opens for subscription. The management, Abhishek Bansal, joins us in the studio. Welcome back. You're watching us here on Chartbusters. The third-party logistics provider Shadowfax is near 1,900 crore IPO opens for subscription today. The company's raised about 856 crores from the anchor investors yesterday itself. Abhishek Bansal, who's the founder and chief executive officer of the company, joins us now in the studio. Abhishek, thank you for joining us in the studio. Good luck for the capital markets. It's a different beast. You'll have to answer a lot more questions about near-term, mid-term profitability, all the numbers, etc., as against what you are used to in the earlier avatar where you would speak to a lot of the private investors. Obviously, you know, before the IPO, the numbers look exceptionally great. I'm looking at your 3-year revenue CAGR. That's compounded at about 33%. And the first half, it's grown at 68% just before the IPO. So what's a sustainable run rate for the revenues to grow? And when does the operating leverage for margins kick in? When can we see, say, 5-10%?
So if you look at our revenues between FY23 and FY25, we have steadily grown at about 32.5% CAGR. This year, we have seen an exceptional growth of 68% in the first half. And thanks to a recovery in consumption, better digital penetration, market also being a lot more consolidated and less competitive as compared to the last few years, we have seen an exceptional growth, which will probably continue in the second half of the year as well. I think from a steady state basis, whatever we have done over the last few years in terms of growth is an easy assumption to make. That is something that will continue happening. While there's a market pace of growth, which we expect anywhere between 23 to 25% on a CAGR basis, we expect Shadowfax to continue going after market share expansion. We have gone from 8% market share in FY22 to about 23% market share in this financial year.
All right. Good to have you in the studio, Abhishek, and wishing you all the best with regard to the issue. And hopefully we chat more from here on. Just to probe you a little bit on that market share point, from 8 to 23%, you clearly did something very special. Could you tell us what that is? And do you have a target in mind with regard to this market share number, grabbing a higher chunk?
See, broadly, if you think about our strategy, it's been a two-pronged strategy. On the customer side, we have gone aggressive and built a lot of value-added services, did a lot of things differently, creating new age services like same-day delivery, store-to-customer omni-channel services, reverse logistics, which have been very, very unique and over there in each of these service lines, we have largely a sort of a 40% plus kind of a market share. Today, anywhere between 40 to 45% of our revenue comes from value-added services. So value-added services remain a very, very important component. And as you would understand, these are difficult to replicate. Customers also are willing to pay a premium, and it helps with our profitability.
But capabilities can be easily, copied, if not replicated. The ideas can come, right? And today you're doing same-day delivery. Tomorrow someone else does same-day delivery. So what was value-added today does not stay value-added throughout.
Absolutely. You picked up the right question over here. Innovation in this sector happens every quarter. We create
What is your edge
products.
today, as of now?
Our edge today is that we can innovate what the customer wants every quarter. The frequency at which we do these releases keep us apart. If you talk to our customers, one of the biggest feedback you will hear from them is we have an agile process. Okay, every quarter we are always looking out for doing different things, doing things differently, and that keeps our customers excited, that they know we are the first ones to come up with a new product, new requirement. Example, when quick commerce came in this country, we were the first company to modify our tech stack and ensure that we go after the quick commerce industry.
So, and quick commerce as a percentage of your mix, I think that's as well gone up. What is it at?
It's at 20% right now.
And you expect that to compound further?
So we expect, if you look moving forward, we expect while the business will grow at a healthy rate, quick commerce might grow slightly higher because of the fundamental size of the market and the amount of capital that is coming in. So it might marginally go up, but given there is a huge scope of market share expansion in e-commerce as well, we will continue gaining market share in that.
But your reliance on gig workers, we have to ask you that a regulatory risk, can that change your business model? Because can you give us a sense of what your earnings per hour of the gig workers is right now? And there is this big debate which is going on. Quick commerce itself is grappling with those.
Yeah. No, today our earning per hour can vary based on city, based on the effort people are putting in, but it can range anywhere between 110 to 120 rupees in the top 20 cities of the country, which is quite healthy per se. While there's a lot of debate going on and we welcome all those debates coming in, we believe the stance that the government of India has taken is actually quite a progressive one. It is quite on the right side, where there's a gig welfare fund being created. And if you have the right fund, if you have the right structure, it creates a lot of transparency into the sector. With also the minimum wage for gig workers going down, we believe a lot more people are going to enter this sector. And with a lot of transparency coming in, it is going to help people get a lot of confidence to basically come into the gig work, spend a few years over here before they figure out what do they permanently want to do in life.
All right, final question from my end before we let you go. Your operating cash flows have turned positive. Yep. Your profitability as well as something that the street is looking at. So you continue to generate positive cash flows. Could you assure the viewers out there, because in line with what the regulators are looking at, you're not going to get into trouble asking for a fixed number, but directionally and margin improvement as well, do you see from here?
So if you look at our numbers, in FY23, we were at 7% negative. Post that, we did a EBITDA break-even. Last year, we made a EBITDA of 2%. We did a net margin positive. This year, we have gone ahead one step later. We made free cash flow positive. There's a continuous trend that you will see, and it is not like a fluctuating trend in our numbers. It's a continuous trend of improvement. Every single quarter we have delivered in our numbers, and purely coming from operating leverage. As we grow from here, as we try utilizing our network better, we expect this number to only go upwards. While I cannot give you a pinpointed number per se, but directionally, it is fair to assume that the trajectory that you have seen in the last 12 quarters will continue happening for the next 4 or 5 years.
All right, we just need to ask those questions because directionally is important. We are playing, our part in terms of getting the investor to the company. So just asking all the questions out there because directionally is important.
And these are legitimately fair questions, right?
Yeah,
because, for people who are paying 7,000 crores in terms of market cap for a company like yours, last year, the first half of this year, your operating cash flow was about 140 crores in positive. You did 20 crores of PAT in the first half. So people will question growth and profitability as well. Just a final question from my end as well before we let you go. We saw that when Delivery, listed, thereafter, one of their large clients, Meesho, took all of their, logistics business in-house, and that was a big hit. Your top client accounts for nearly 49% of your revenue. Is there a risk?
So just to be correct over here on the factual side, they did not take all of it. They took some part of it as on the.
We have the numbers on that had an impact, right? Even
they had an impact. But what we foresee is there's a lot more stability now. I think whatever had to be done from their diversification, it was their strategic choice. Whatever diversification they had to do, probably we think it's behind us now. Markets look a lot more stable, and even when they were diversifying, we were growing at 32.5% CAGR last few years. This year we have grown at 68%. So there's a lot of stability now in the market, and probably we think that whatever diversification strategic choices customers had to make, it's behind us. The future looks a lot more stable, lot less competitive. There's consolidation in our sector that has happened earlier this year, and that gives us a great opportunity to gain market share.
What are your top 3 clients, and how much do they account for in your overall revenue?
Our top 10 customers account for about 74% of our business.
Well, good chat. Thanks a lot for giving us that clarification. We look forward to chatting up with you on the day of the listing. But wishing you all the best, you and your team. You'll have put in all the hard work. Now, in fact, welcome to the stock markets.
Thank you. Thank you for having me here. Thank you.
Right.
Time to slip into that break. Come back. We'll continue our focus on markets. We'll focus on a couple of stocks as well. Don't go anywhere.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
Welcome back. Well, the market's still under pressure as we speak. The Nifty is down 110 points, but the Aditya Birla Group stocks actually have recovered a goodish bit from the day's low. We had Aditya Birla Fashion and Retail. That was down close to 8%. That's cut its losses. And Aditya Birla Lifestyle is actually on the verge of moving into the green. So some kind of recovery in individual stocks. But there's a sharp spike that we're seeing in Bajaj Electricals. The company announced its foray into the wires business. Upasna joins us to help us out with a quick detailed analysis on that. Upasna?
Well, certainly. Well, the company said that it plans to enter the wires as a new business line under its currently owned lighting solution segments in the view of growing demand in the wiring industry. It has also said that the main aim of the company in this is the diversification of its business operations. The company says that it is planning to launch the products shortly, but it is currently assessing the cables and wires market. Now, if we look at the margins, the Bajaj Electricals lighting solution margin currently stands at 10% versus its peer group range that is nearly about 10 to 12%. Now, let us look at the wire segment and place focus there. Now, wire as compared to cables is low competition, and also if we see the scope of high margin exports is much high as compared to cables. Now, in cable and wire market, building wire segment forms nearly 28 to 30% of the total share, and housing wires focus players, which is a direct peer to the announcement made by Bajaj Electrical in the wire segment. So the direct peer here will be RR Kabel, Lvls and Finolex cables. Now, these companies within cable and wire portfolio have a higher share of wires as compared to the cables. Now, Motilal Oswal has estimated a revenue CAGR of nearly about 15% from FY25 to FY27. Now, coming to the commentary given by these wire-focused players, Havells high-margin house wires comprises nearly 60% of their total cable and wire revenue. RR Kabel, it says that the wires will see a good growth in Q4. And lastly, Finolex Cables, its electrical wire and cable contributes nearly 95% of the revenue. Now, if we look at the FY25 top 5 players, Polycab stands at 21%, KEI 11%, Havells at 8%, RR Kabel 7%, and Finolex Cables at 6%. So overall, we will certainly see how the competitive intensity pans out for these players.
Take that point to pass now. Thanks a lot for that. How the competitive intensity pans out for these players is something that we will be monitoring going forward. But we heard from the management of Havells as well. They said that in the near term, there could be some price disruptions, but over the longer period of time, distribution, brand and advertising along with product quality, something that would ensure that the larger players stay relevant still. Though the stock lower, as the management did point out on issues of margins in the very near term. Though, before we wrap up on this edition of Chartbusters, just look at United Spirits. That stocks moved into the green in an otherwise wobbly market. The company reports its numbers today, so that's the one that should come up for you. And alongside that, look at Restaurant Brands Asia as well. There is a likely deal today, as said by our colleague Vivek. The stock's off the highs of today's trading session, though we'll monitor all the developments out there. Take a short break, come back on the other side. Trading Hour comes up.
Good morning, you're with us here on Trading Hour. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Hormas Fatakia. Joining me as always, Ritu Singh and Mangalam Malu will be with us as well. It's a forgettable day for the markets so far. It's the weekly expiry for the Nifty contracts and the index has broken below its very key support level of 25,500. It's also intraday breached below that November 11 swing low of 25,449. It's currently trading just about at those levels. So lots of earnings reactions to track. Global markets continue to remain under pressure. Haven assets continue to make new highs. So all in all, it's turning out to be a bit of a wobbly start to this new week as we count down to the union budget as well. Morning, Ritu.
Morning, Hormaz. Almost 3.7 stocks declining for every one stock that is advancing. So, so market breadth firmly in favor of declines. That's where we stand. Bank Nifty, though, is able to support those levels of 59,500 on the downside. So maybe that's a glimmer of hope in this otherwise very, very red market. It's down 130 points on the Nifty, 370 points on the Sensex. Not looking so good there. But, in terms of indices, Realty is the pack that's really dragging the markets down today. IT, Auto, Pharma, all of them in the red except for FMCG, barely holding on in the green, and the media pack as well. So broader markets continue to show a lot of pressure, but it is individual stocks where investors are going to find pockets of opportunity. So Hormaz, it's over to you to put the spotlight on some of the top movers in the market today. What have you picked out for us today, Hormaz?
Earnings reactions are predominantly, and since you mentioned real estate, the index has completely been smashed since the start of the year. The stock's down almost 10 to 20% already in the first few weeks of the new year. The start off with Tips Music, though, is of the earnings came out yesterday. The stock is moving almost 9% higher in today's session. Biggest single day gain since June of 24. It's gained in 3 out of the last 4 trading sessions. Now, the combined volume of the last 2 sessions have been the highest in the last 3 months. So it's been gaining on strong volumes over the last couple of sessions. Today as well, we had close to 11 lakh shares that have been traded. The 20-day average is just under 40,000 shares. And the stock has moved above its 100-day moving average. The 200-day moving average on the upside comes up to around levels of 590. That's still some distance away. The stock had a bit of a forgettable year in 2025, was down around 30-odd%, but that came after 6 consecutive years of positive returns. A stock that is bucking the trend along with Tips Music today is Deepak Nitrite, and that is of course after the news flow that came in late last evening. 4.5% higher on the stock. It snapped a 7-day losing streak today. The stock in the last 10 sessions had gained only once going into today's trade. Today we have had close to 2.5 lakh shares being traded on Deepak Nitrite. The 20-day average comes up to around 41,000 shares, so significantly higher, almost 6x compared to its 20-day average. The stock, despite this move today, remains below its key moving averages. The 50 DMA on the upside, the first important level is at 1630, so still but some distance away there. And the stock has seen negative returns in the month of January every single year since 2022 and had declined around 30% last year as well. And one stock on the downside, that's an earnings reaction, is Oberoi Realty. Since you mentioned real estate stocks, the stock is down in 6 out of the last 7 trading sessions, 7% lower in today's session as well. This is the biggest single day fall since January of last year, and incidentally that fall also came on the 21st of January 2025. Volumes today are the highest in the last 3 months. They had 12 lakh shares that have been traded today. The 20-day average is just under 1 lakh shares. The stock remains below its key moving averages, and 4 out of the last 5 months of January's over the years has resulted in negative returns for Oberoi Realty as well. And that stock too was down around 30-odd% last year, coming on the back of 6 straight years of positive returns.
Hormaz giving us a reality check there of how the Realty pack is performing and on the other buzzers. Thanks very much, Hormaz, for putting that into perspective. But let's focus on the other space. Earnings heavy it has been, especially for the financials. And we have Indian Overseas Bank, which has reported a healthy set of earnings with its net interest income growing more than 18% and profits rising 56%, while its net interest margins also expanded quarter on quarter. To discuss the third quarter and the way forward as well, we're now joined by Ajay Kumar Srivastava, the Managing Director and CEO of Indian Overseas Bank. Mr. Srivastava, thanks very much for being here with us on CNBC-TV18. First up, Given your margins have improved sequentially and 3.32% is the level we can see, if you could give us a split, how much of your book is external benchmark linked and how much of your book is fixed, and how much of the rate cut impact have you taken this quarter and the deposit repricing that is expected going ahead?
Yes, so the composition of credit portfolio is like this: 51% is MCLR linked, 51% of the total credit portfolio, and around 43% is repo linked. And that is the ratio which at present the credit portfolio is there. And here I would like to add that we are the only bank where in Q2 and Q3, in both quarters, despite rate cut by RBI in the form of repo rate cut, our NIM has increased from June to December. If you see, the domestic NIM has increased by 25 bips from 3.17 to 3.42. Last quarter also, there is an increase of 7 bips. Domestic, I'm talking. And if you look at global NIM, then it has increased by 11 bips to 3.32%.
All right, Mr. Srivastava.
And on the deposit front, you wanted to know, the good thing I would like to share with you that since for last 2 years, almost entire industry is struggling with deposit growth. I have some good news to share with you. Deposit growth, savings, we have grown by 11.36% year on year. I think in last 2 years, this is the first time when SB growth, the SA part of CASA, that has grown in double digits, 11.36%, and retail term deposit, which is less than 3 crores, that has grown by almost 16%. So deposit growth is also happening, and credit growth, of course, it is exceeding still the pace as compared to deposit growth. But we have been able to manage the portfolio in such a way that the margins are protected, and not only protected, margins are healthy and improving.
Right. We take that point. On business itself, if I look at your overall loan growth, that was 20%. Retail grew about 40%, and agri as well saw strong growth. So where do you see this RAM settling as part of your overall strategy? And in retail as well, if you could give us a sense on what's driving this loan growth in retail?
I will start in a different way. I will say that the total credit portfolio of the bank, retail, agri, MSME, and corporate, it's around 24 to 26% of the total portfolio in all these 4 parameters. So retail growth, of course, it comes from housing loan primarily, a vehicle loan, a LAP, liquidant also, and a part of retail growth happens through jewel loan also.
Mr. Srivastava, just to come back to your deposit and CD ratio more specifically, you've got one of the highest CD ratios in the PSU pack, even though it is far lower than, I would say, some of your private banking peers. It's still in the 80s, but it's quite high. I mean, aren't you concerned on that front? And that, of course, to some extent has helped aid the performance. But, will this kind of credit growth be supported if your deposit doesn't keep pace?
It's not right to say that deposit CD ratio is the highest in the system. See, if you look at the domestic CD ratio, it is less than 82%, 81.81. But if you include the overseas centers also, where the concept of deposit is not as prevalent as in domestic market, then it is around 84 to 85% global CD ratio. But if you look at the CD ratio, mainly it is prevalent in domestic banking ecosystem, and it is still less than 82%. And the kind of deposit growth we are showing over last 1 year, I think credit growth is sustainable, and we will continue to grow at this pace.
Right. Just go back to the question on credit growth itself, Mr. Srivastava, because you did say that you saw some retail growth on the back of vehicle loans, home loans, LAP, and some general loans, etc. as well, which is about 26 to 28% of your portfolio. Wanted to understand retail, agri, how will that overall be as a part of your portfolio, the RAM portfolio as we call it, and even corporate, there the loan growth is in single digits. Is that a conscious strategy, or is it just because industry is not as receptive to loans right now?
Yeah, both ways. It's a conscious strategy over last more than 1 year, last 4 to 5 quarters. We are primarily focusing on RAM sector, retail, agri, and MSME. And in this RAM sector, we have been able to show consistent growth, more than double digits. quarter on quarter after year on year for so many quarters. And the total RAM portfolio of the bank is around 76 to 77%. That was a conscious call which we took last year, and we are still sticking to that. Coming to corporate, of course, corporate lending is happening, and many corporate loans which are short-term in nature, that gets repaid during the quarter and gets replenished by fresh sanction. The corporate, we have been able to maintain at the same level. We have not been very aggressive as far as corporate is concerned, and one of the primary reasons is that pricing issue. The price at which we are intending to lend and the price which corporates are looking at, there is huge deviation, I will say. And since it is not adding value to the bank's balance sheet, as a conscious, we have decided that we will not be very aggressive unless until we are getting value for money from corporate portfolio. And of course, RAM portfolio is growing very well. Almost 99% of the branches in the country, they can do RAM everywhere. And that is how the growth is continuing for last many quarters, I will say, last 2.5 years.
Okay.
And the same way we intend to grow in RAM.
All right, Mr. Srivastava, we've run out of time, not out of questions. We hope to have you back after your next quarter performance again. Thanks very much for your time here today. We have to slip into a short break, though. Up next, we're going to focus on more bank earnings and the markets. Stay tuned.
You want to talk business? Meet me in the On-Board Lounge.
Welcome back. 150 points lower on the index, now below that 25,450 mark. So continue to monitor the Nifty on the weekly expiry today. And of course, the real estate index that continues to remain the top sectoral loser in today's session. Tata Capital reported a good quarter, even with better guidance as well. Ritu spoke to Rajiv Sabharwal, the MD and CEO of the company, and began by asking him about his consolidated assets under management and the growth guidance stepping into the new year. Listen in.
If you look at our growth has been well spread across different segments of the business in which we are present in. We've given a guidance of 18 to 20% on the consolidated basis, and we would want to stay with that guidance. Whether we will be 18 or 20, time will tell. But as far as the first plans are concerned, we have shown very good growth, and we are hoping that this momentum will continue because January is looking promising, and we hope as we progress towards more deeper into the quarter, this growth will only accelerate.
All right. Motor finance AUM has been on that declining trend. Two parts here. First, where are you in terms of integration and portfolio cleanup there? And secondly, when does growth here meaningfully return? And what kind of growth rate is realistic for motor finance from FY27 onwards?
So if you look at our strategy as far as motor finance is concerned, our whole thought there was that we need to transform this business and make it profitable. We have done a few things there. One, we clearly now have diversified our portfolio to have all OEMs, whose vehicles we finance. We've increased the proportion of used commercial vehicle, which can help us in improving our yield and returns. Similarly, we have reduced the percentage of heavy commercial vehicles and increased the percentage of mid and small commercial vehicles. Similarly, we've embedded a lot more of technology into the system. We've tightened the credit policies, and that is what is helping us improve the ROAs. For example, in the quarter which just went by, we broke even, and we hope that going forward, ROAs will inch up. As far as growth of the book is concerned, since we were transforming, the growth was not there. The book was degrowing, but we believe that starting in the new year, we will get back to growth in that business too.
All right, get back to growth for motor finance starting FY27. Let's also talk about your margins, Mr. Sabharwal. A 25 basis point sequential improvement to 5.3%. Of course, there was lower cost thanks to the RBI rate cut and some yield expansion as well, which helped. But, as rate cuts flow through further, or if they don't, where do you expect NIMs to settle by the end of the year? And what does a sustainable, steady state NIM look like for Tata Capital in the medium term?
So if you look at margins, our whole strategy is one, that we will ensure that our rating remains the best, which we have, which allows us to get a cost of money at one of the lowest in the market, price at which we raise our liabilities. We've also diversified our liabilities so that we look at all opportunities such that we can get the money for the right tenor and at the right price. As far as margins are concerned, we believe that we have gained in the accounts. One, because of cost of funds coming down. Two, also because we had to raise here, and that liquidity also helped us. From our perspective, we also believe it's very important for us to pass on the benefits to customers to spur growth. So we've been also passing on the benefits of lower cost on fund to customers. However, we do gain because we have a large fixed rate book also. So there we do gain. So our margins have improved in Q3 over Q2. As we move into Q4, we believe there's an opportunity for margins to get better. However, it will also depend on what liquidity is there in the market. While RBI has brought down repo rates, but the rates in the market are a function of both the action on repo rates and also the available liquidity. RBI has been proactive there. If that continues, we believe there will be coming on further on cost of funds in the coming quarter.
All right. Speaking of credit demand, Mr. Sabharwal, there would have been some benefits from the festive season, the GST tailwinds. But as you move into the fourth quarter and the new financial year, are you seeing any signs of demand normalization, particularly when it comes to vehicle financing and across retail, SME and corporate? Which segments, to your mind, are best positioned to lead growth for the company in the next 12 to 18 months?
If you look at, post the GST cut, there was a spurt in certain segments, especially the vehicle segment saw a huge growth. That growth continues on both passenger vehicle and the commercial vehicle side. There is some amount of moderation which has happened on the two-wheel. We believe hopefully that will also pick up further. There's good demand on the tractors side too. All that is also helping us see more demand on the SME side because there is more demands coming in from the consumer side. Housing remains extremely strong, and hopefully all this is leading to corporates now putting in more investments and that will further increase the corporate demand in the future. If I look into the future, the larger growth for us will come from housing. That's been the largest segment for us. We are also seeing demand on the retail secured and unsecured and the SME side. And as a strategy, we've said that majority of our portfolio, like also retail and SME, including housing, form about 87% of our book. And this proportion is expected to remain in this range.
Okay. Mr. Sabharwal, specifically on unsecured retail, last quarter you had indicated that asset quality challenges were behind and you've now started to scale up disbursements in the last few quarters. Currently, that's about 10.4% of your AUM. Over the medium term, to what extent would you like to grow that book?
So retail unsecured forms about 10.4% of our book. We've seen credit costs improve on that portfolio for the last few quarters. We saw early indicators of the portfolio becoming better last 12 months, and that has given us confidence to now further resume growth in that space. We've seen strong growth in disbursements in Q3, and we hope this momentum will continue in the future too. Since disbursements are growing with some lag, we will see the benefit of that accruing on the book also, and the unsecured book also growing. Our thought process is that over the next couple of years, we would like to increase this percentage more closer to about 15%. But as a strategy, we will continue to watch. We want the portfolio quality to be good. In case we find any challenges, we will make the necessary corrections. But the way it looks like, and with all early indicators, that things are very good. And over the next few years, we would want to take this percentage up to about 15%.
Right, that's the management of Tata Capital. With that, we'll take a short break, come back on the other side. Market technicals with Somil Mehta of Mirae Asset Share Khan joins in for a view on the indices.
Welcome back. Market breadth continues to weaken. When we had started the show, the advanced decline ratio was close to 1:3, and now more than 4 stocks are declining for every 1 stock that is advancing, down 135 points on the index. Let's bring in Manglam Malu for the latest trends from the F&O space in the current market. Manglam?
Well, the market is lower. There's no two ways about it. And it's actually at the lower end of today's trading range so far. The frontline index, the Nifty Bank, as well as the Midcap index, which is down about 1.5%. But what's interesting is that the Nifty is holding on to some of the recent lows that we've seen lately, right? So if you look at, the low on Jan 12th, which was last Monday, thereafter we had the yesterday low. And today as well, the Nifty has been hovering around that 25,433 mark. That's where the low has been maintained. What's interesting is that the Nifty Bank, for the Nifty to maintain that, level currently, the Nifty Bank has to hold on to key levels, and that's the 20-day moving average and the 50-day moving average on the Nifty Bank, which is closer to that 59,555 mark on the 20-day moving average. And we have the 59,200 odd mark, which is the 100-day moving average for the Nifty Bank. So both these two levels are extremely crucial for one to track, and if the Nifty has to support or find support at these levels, these are important levels to track. As far as the market breadth is concerned, obviously 2,300 stocks in the red for about 545 stocks which are in the green. That does not paint a very pretty picture. The impact on earnings has been a lot harsher today than it has been in the very recent past. So case in point, something like an Oberoi Realty, the third quarter update not doing well for them. LTI Mindtree, the results itself, while they were in line, the outlook is weak. The stock had seen a run up. Havells as well, the results are in line, but the near term, when it comes to margins and competition, not particularly good. So the street is finding safe haven. What is the safe haven? It is the consumer stocks. We have HUL, Britannia, Godrej Consumer, all of them doing well. Though there are some silver linings. The good part is that, at lower levels, we are seeing purchase. So the Nifty's found some support. The Nifty Bank is still above the 20-day moving average. And the put-call ratio, as it moves towards the extreme, today's low was 0.62, has now moved back to around 0.71. So there is some sense of balance which has come by. Just for today's expiry, the street believes that this range that we've made for ourselves will continue. 25,400 at the lower level and 25,500 at the upper level. Why do I say that? Because straddle writers are very active. Straddle is a call and a put together. The 25,450 put and a call, they have a combined premium of almost 70 rupees. So, 70 points on either side of 25,450 is where, the range the option writers expect for the market to be. And if you want to broaden that as well, 25,500 call writers, fairly active, premium of 30 rupees. And at the lower level, the 25,400 put writers, they come up for you as well. They too have a premium for almost 17 to 18 rupees. So around 25,380 to about 25,520 is the broader range that the street is working with, if it's not 25,400 and 25,500.
Manglam, ever thought of buying a kg of silver?
3 lakh rupees? No, not at all.
3,17,000 was the flash on the screen just a few minutes ago. And silver, that is one thing that's not down for sure, even if the markets are continuing to make new highs, both in the global markets as well as on the Indian MCX as well. There you can see almost 3,18,000 now for silver MCX, and on the international markets around $95 an ounce. Somil Mehta of Mira Asset Share Khan joins in now for a quick chart check. Somil will get your views on silver as well, but for now the index is broken below 25,500. Do you see that fall now extending towards the lower end of the range, go down to 25,250, 300 levels? Your call on the index and your stock recommendations for the morning as well.
Good morning to everyone. Absolutely negative on the markets at this point of time. Markets are trading below 25,500, very crucial levels. Absolutely creating low top, low bottom formation on the daily charts as well as weekly charts. From last week, I think last week, Nifty closed below 25,700, which was the swing low on the weekly charts, which was very crucial. So that is one weakest point at this point of time, that markets have started making low tops, low bottom on the weekly charts. The next point is we are trading below 20 and 40 daily moving average for Nifty. And now an upward sloping trend line has broken on the downside. So all of this indicates that there is a lot of weakness here. And the first target for me is 25,320, which is the previous, now the next swing low, and 200 daily exponential moving average, which would be my target eventually. That is 25,160. So that would be my target in Nifty. However, Bank Nifty has been holding on about 20 and 40 daily moving average. Now I'm expecting Bank Nifty to crack from here till at least, I think, 58,870, which is the previous swing low, and still remain in a range. Bank Nifty still would remain in a range. I'm not expecting too much of a weakness, but yes, 58,870 would be my target in Bank Nifty on the downside. So overall, yes, sell on rise should be the strategy. My view would be negative in short term, medium term, both. The two stocks which I'm looking to sell here is, first one is Mazgao Dock, trading below 2040 daily moving average, 200 daily moving average. A small consolidation has broken on the downside, so the stop loss would be 2460 and the target would be 2175. The second stock which I'm selling is KEI. KEI has also broken a small triangle pattern on the downside on the daily charts, trading below 20 and 40 daily moving average, creating lower top, slow bottom. So the stop loss would be 4320 and target would be 4015.
All right, KEI Industries is your stock. Saumil, thanks a lot for joining in. Sell on rise is the call in the frontline index. We'll take a short break, come back, focus on more markets, bond markets actually, in particular. Manisha Gupta joins in. Well, the Nifty is gaining a little bit. We have the ICICI Bank stock, which has moved to the high point of trade. We're also seeing some traction in names like Dr. Reddy's, which has now moved into the green, a recovery of almost 1.5% from the lows. And we've seen the market move, a little more from today's low of around 35 points from there. So today's low, 25,433. And the Nifty Bank's the one which is doing a fair amount of heavy lifting, which is down just 0.25% as against the frontline indices, which are lower by 0.5%. Good time to focus on the bond market action. Manisha Gupta, as always, joins in with Bond Street. Manisha.
On Bond Street, we're talking about bond offers with minimum investment of rupees 10,000. So I have 3 on this list. Make a quick note of that. The first one on my list is Indal Money Limited. This is a 9.75% coupon. Maturity date for this one is October 30th, 2027. Yield to maturity shows at 11.15%. And the ratings is from Infomerics at A-. The second one on my list is Navi Finserv Limited. This is a 10.6% coupon. The maturity date for this one is 21st May 2027. The yield to maturity is 11%, and the ratings comes in from India Ratings at A. The other interesting one, and the last one on the list for this one, is Adani Enterprises. The coupon is at 8.75%. Maturity for Adani Enterprises is May 12th, 2029. Yield to maturity stands at 8.7%, and ICRA has given a AA- for this one. I also have a couple on my list with bond offers with state guarantees. The issuer's name here is Kerala Infrastructure Investment Fund Board. The coupon is 9.67%, and maturity date for this one is 8th of August 2030, with yield to maturity standing at 9.3%. You could also invest in Andhra Pradesh Investment Fund Board. 9.15% is the coupon here, with maturity date at 30th November 2028, and yield to maturity stands at a good 9%. Telangana, within the state guarantors, Telangana State Industrial Infra Corp also is the last one on my list. This is a 9.35% coupon, maturity date standing at December 31st, 2029, and yield to maturity onto this one is at around 8.9% as well.
All right, Manisha, thanks very much for bringing us that update. Now we'll focus on Bajaj Electricals. The company has announced its entry into the wires business, expanding their portfolio under their lighting solution segment. The stock is up almost 4.5% as we speak. Let's go across to my colleague Upasna for more on what's keeping the investors excited. Upasna?
Well, certainly the stock remains in focus as company plans to enter wire segment under its lighting and solution segment in view of growing demand in the wire industry is what the company has said. Now, it aims to diversify its business operation for sustainable growth going forward is what the company has said. Now, company has also mentioned that it is planning to launch the product shortly and is currently assessing the cables and wires market. Now, if we look at the margins, the Bajaj Electricals lighting solution margin stands at 10% versus the peer range of 10 to 12%. Now, let us look at the key players placing focus in the wire segment only. Now, wires sees a lower competition as compared to cables, and also there's higher scope for high margin exports. In cables and wires market, building wire segment forms nearly 28 to 30% of the total share, and housing wire focused players, which will be the direct peers for Bajaj Electricals on the back of this foray, will be RR Kabel, Havells and Finolex cables. Now, Motilal Oswal estimates revenue CAGR of nearly about 15% from FY25 to FY27. Now, Havells has said that its high-margin house wires comprises nearly 60% of its total cables and wires revenue. RR Kabel says that by end of FY26, the wires to cables ratio will stand at 65 to 35, which currently stands at 70 to 30, and wires will see a good growth in Q4. So certainly wires is the new theme, and now let us see how the competition pans out with the entry of Bajaj Electricals going forward.
Indeed, another new player in the wires segment after the entry of a lot of these conglomerates as well last year. Upasna, thank you for that update. Slightly off the highs of the day is Bajaj Electrical still holding on to a gain of around 5% odd. What's not holding on to gains or is at the lows of the day is LTI Mindtree after its results. Rima is joining in with a breakdown of why the stock is lower despite what seems to be a pretty decent quarter. Rima.
Indeed. So the headline numbers are in line with expectations, but we can think of a couple of reasons which explains the fall in the stock. One, the valuations. Valuations today are at 30 times forward multiple, and this is more expensive than even a Coforge or an HCL Tech. Secondly, the stock had outperformed. I was taking a look from the April lows. LTI Mindtree is up 50%, while the Nifty IT index from the April lows is up less than 20%. So in the last 9 months, there has been a substantial run-up in this stock. But as you said, right, headline numbers are in line with expectations, but some analysts are pointing out to the mix, the internals in the numbers, they don't look that strong. For instance, the core growth driver for many of these IT companies, right, the core verticals are BFSI, high-tech. But this time, BFSI has not done well. In fact, BFSI growth rate has been moderating for the company. High-tech has seen negative growth rates now for 3 consecutive quarters. What drove growth for the company was largely manufacturing. About 3/4 of the revenue growth came in from manufacturing. And the other one is healthcare, which is basically the India PAN deal that gets classified there. So that seems to have driven growth. Also, margins, the company's done a good job. They held on to margin 16.1%. But in the next 2 quarters, there will be that wage hike impact on the back of margins. But largely, I think it's more to do with, valuations, the run-up since April lows of about 50-odd%, and the fact that some internals, like the top clients, the mix, the portfolio mix, is not as encouraging as the headline numbers seem to suggest. Back to you.
All right, Reema, thanks very much for taking us through that. We have to slip into a short break. Don't go anywhere. We're back with more on the markets in just a bit.
Fly Emirates, fly better.
Welcome back. The Nifty moving towards 25,470 mark right now. Dr. Reddy's has picked some serious pace. It's actually now up 2.5% from the lows. HUL too continues to do well over the last couple of trading sessions. The brokerages were saying maybe that FMCG staples are likely to come back into investors' ken, largely because of one, for a serious amount of value derating that has taken place, and at the same time now there are consumption, there are some triggers for consumption as well. But let's go across to Shireen Bhanu joining us live from Davos. It's Trump making headlines all the way. Shireen, as always.
Good morning and thanks very much once again for joining us here in Davos for our live coverage from the World Economic Forum's annual meeting. The headlines are breaking courtesy President Trump. The news cycle is hot. My coffee not so much because it is freezing cold here in Davos. It is very early in the morning as we kickstart the day. But as I promised, this is a Trump Davos and it is turning out to be exactly that. What we have seen President Trump say just a few moments ago is that he is going to do two important things. One, he is going to be meeting with European leaders on the issue of Greenland, and perhaps even more. He's had a call with the NATO General Secretary. Post that call, Trump says that there is an agreement to sit across the table and discuss, but he's not backing down from his ambition to take Greenland. He's made it clear that the U.S. needs Greenland, not just for its own security, but for the world's security. So that is very clear. President Trump making that reiteration here ahead of his arrival. He will, of course, arrive in Davos tomorrow, which is Wednesday. There is going to be a reception with business leaders. And the second important thing that President Trump is going to do, and in a way, this is perhaps the most significant, most relevant World Economic Forum meeting in years that I've been attending. The second most important thing that President Trump is going to do here is get people to sign up for his Charter Board of Peace, which is essentially the plan that they had put forward for Gaza. That has run into controversy because while it has people like the former Prime Minister Tony Blair, British Prime Minister Tony Blair, Ajay Banga of the World Bank, and of course many other officials of the US government as part of it, there are concerns around membership fee. There are concerns about who is going to be on that board. Interesting that President Trump has in fact invited President Putin to be part of the Board of Peace. Prime Minister Modi, of course, has also been given an invite by President Trump. So far, what we have seen, and that's another headline that's breaking here this morning, President Trump going after France because President Macron and France has been quite clear about the fact that they don't intend to, at this point in time, join the Board of Peace because of the concerns that they have. And that has led President Trump to speak of tariffs on French wine and champagne. That is what the headlines are suggesting at this point in time. So the tariff threat continues to loom large. So two important developments that have taken place. One, there is going to be a meeting with European leaders here that President Trump will have on the issues pertaining to, of course, Greenland. Remember, so far we've seen a pretty united response coming in from Europe, European leaders standing up and saying that this is unacceptable. In fact, Keir Starmer separately held a press conference in the UK and also did make it clear that while they may not necessarily be part of the retaliatory tariff proposal that EU leaders are contemplating, but they do stand in solidarity with the EU on the issue of Greenland. So that's going to be important to watch out for. All the action on that front will start on Wednesday. And of course, Thursday, President Trump continues to be here. 10:30 a.m. is when that Board of Peace Charter is expected to be inked here in Davos. Well, outside of that, some of the other headlines coming in here continue to be around artificial intelligence and what AI is likely to do as far as global growth is concerned. And that is, of course, something that we've heard many of our Indian tech CEOs as well as global CEOs that we've been speaking to speak of. Many people that we had, including some of the largest asset managers in the world, Jenny Johnson of Franklin Templeton, still seem pretty sanguine as far as growth prospects are concerned. And most people do believe at this point in time that talk around an asset bubble, perhaps not legitimate or warranted, because if you take a look at the Mag 7, the belief is that the price to earnings ratios are still good. And also the fact that there is a fundamental shift towards AI. So that's the consensus view so far in Davos. Of course, the other big developments that we are going to watch, and there is no clarity yet on whether there will be a Supreme Court ruling on tariffs on the 20th, which is today. The expectation is that there could be a ruling, but we're not sure yet. We still don't have a confirmation on that because the court doesn't tell you whether on what matter they intend to rule. So it is going to be interesting to see. But, Kenneth Rogoff put his money on Kevin Hassett as the next Fed chief. Will it be Hassett or will it be Kevin Walsh? Well, those are some of the other questions that are up for discussion and conversation here. Today is going to also be the launch of the India Pavilion. You'll have Ashwini Vaishnav. In fact, we're walking closer to the India Pavilion. And you will see Ashwini Vaishnaw, Prahlad Joshi, and some of the other government functionaries inaugurating the India Pavilion today. There is, of course, going to be the big CNBC-TV18 India Impact Summit curtain raiser with the IT Minister Ashwini Vaishnaw, Salil Parekh of Infosys, K. Krithivasan of TCS, and Rishad Premji of Wipro, and in attendance a lot of other Indian CEOs and global CEOs. So that's also slated to take place later this evening. We're just about to cross DP World, and remember yesterday there was a bilateral in Delhi, a very short, quick bilateral between the UAE and Prime Minister Modi, and as part of that, DP World is one of the companies that is expected to set up in GIFT City. And GIFT City's CEO Sanjay Kaul was with us here in Davos yesterday, and he talked about the fact that GCCs will be the big theme for the GIFT City this year. Here we are. This is the India Pavilion right next to where we are, and this is where in just a short while from now the inauguration will take place at the India Pavilion in the presence of the IT Minister Ashwini Vaishnaw and of course Prahlad Joshi and some of the other government functionaries who are here. This is, as I pointed out, this is the venue for all states excluding Andhra Pradesh. So right here you have Maharashtra, Telangana, Assam, which is making its debut here in Davos. You've got Kerala, you've got Madhya Pradesh, again, a newbie in Davos, all here in the India Pavilion. Andhra Pradesh is, of course, at the Belvedere, and they have a bunch of bilaterals slated to take place later today. It's still not sunrise here in Davos, but as you can see, things start pretty early. This is a village which is converted into the epicenter of global action through the course of this week every year. There's about 3,000 people here for the entirety of this week. About 850 global CEOs and about 400 government functionaries from around the world. According to the World Economic Forum, this is the largest representation of government leaders that the World Economic Forum has seen. And of course, we've got that big representation from the US with President Trump being accompanied by senior government secretaries Howard Lutnick, Chris Wright, Scott Bessent, Jameson Greer, the USTR. They're all going to be here with President Trump when he arrives in Davos tomorrow. That's Wednesday. So we'll keep bringing you all the action here, but two big developments that I wanted to point out. One, of course, is the Board of Peace Charter. That is now going to be signed here in Davos, and of course, that crucial meeting between President Trump and EU leaders on the fate, the future of Greenland. I'm going to toss it back to you for now and keep coming back with more updates. Stay tuned to CNBC-TV18. This is your Davos headquarters.
Shireen, thank you for that. We'll let you have your sip of coffee, which would have frozen by now, considering that long walk. But keep you updated on all of the developments from Davos in just as the day goes by. Well, the Nifty is back at that January 12 low, which was 25,474. So it's moved slightly above those levels. So it's seen a bit of a 50-point recovery now from the lows of the day for the index. We are heading into the second half of what is this weekly expiry session. As Mangalam was pointing out, HUL and Dr. Reddy's are some of those names that are leading that recovery on the index, as is ICICI Bank. So the Nifty Bank has been that one factor that has kept the index, has capped the index downside for a better part of the start of the year. But the Nifty Bank holding on to levels of 59,500, moving back to levels of 59,800 now, has almost moved into positive territory as we speak. So it is the Nifty Bank that is sparking this recovery, or ever so slight recovery, that you're seeing on the index as of now. But there are other names that are not doing well. Just pull up Ola Electric before we move on. 10th day of losses now for the stock, 6.5% lower. It's back towards those all-time lows of 30 rupees that the stock had fallen to. But another M&A activity brewing in the pharma space. Sources suggest that another one may be in the offing. One more Indian company scouting for M&A opportunities. Vivek is joining in with more details on this. Vivek.
Well, no, absolutely right. Yesterday we heard about how
Sun Pharma may be looking to take a large-sized bite as far as the US healthcare space is concerned. And today what we are gathering from our sources that another Indian-listed company, Zydus Life Sciences, is in talks to acquire a US biopharma firm by the name of Ardelyx. What we understand is that Zydus may look to acquire complete controlling stake in Ardelyx or buy key top molecules of that particular company. We also understand that Zydus may fund this particular acquisition by raising funds via the QIP route, and it will be important to remind our viewers that the Zydus Life board actually approved a fundraise of up to 5,000 crore rupees via the QIP route. For information, Ardelyx is a NASDAQ-listed company. It has a market capitalization a little above $1.5 billion. We reached out to both Zydus Life Sciences as well as Ardelyx, and responses from both of the companies are awaited. Just to give some perspective to our viewers, Zydus in the Q2 conference call had told analysts that one of the reasons for the fundraise that the company had taken an enabling resolution for was to deleverage the balance sheet and also to potentially scout for opportunities, especially in the US specialty business. And one of the areas that they were looking at acquiring stake was in the gastroenterology, and that was something that they'd seen as a starting point. Now, along with that, they also mentioned that they're evaluating if they can build some capability in that particular space through a strategic acquisition. Some of the key details about Ardelyx is that they have two commercial approved products in the USA. Both of these projects are quite large. One of them is called Ipsarela. This is a prescription drug for adults with irritable bowel syndrome, and this is one of the largest drugs. In fact, Ardelyx had given a press release day first day saying that they look to achieve $410 to $430 million in revenues in 2026 just from this particular drug. Important development, and it'll be interesting to see whether Zydus can go ahead and fund this particular acquisition. It's a slightly large acquisition given the fact that the total market cap of the company currently is $1.6 billion, and Zydus may need to shell out a little bit more to get controlling stake.
Take that point, Vivek. Thanks a lot for that. The street is worried a little about the size of the acquisition. The stocks move lower from the highs of today's trading session, though them going ahead and acquiring this along with growing this company is something that we will be monitoring very closely, and what it does to the return ratios of the combined entity as well. Axis Bank from the lows has seen a formidable recovery, actually is currently moved back into the green, and that's reduced the Nifty Bank deficit to just 98 points, sub 100 points on the Nifty Bank, and whether that leads the Nifty higher or not is something that we'll leave the team of Halftime Report to take note of. Hormaz, me, Ritu, thank you for watching Trading Hour. Halftime Report comes up next.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
Midcaps dip as Trump politicking weighs on global markets. Realty, IT and capital goods are the big drags, while utilities see some green.
LTI Mindtree takes a knock after a hefty 590 crore labour code charge hits Q3 profit. The IT major, however, remains upbeat on growth in Q4 and expects to close the year with better margins.
Axis Bank MD and CEO Amitabh Chaudhary says getting deposits in India will be hard-grind, and while credit growth is seen picking up, there can't be a divergence between credit and deposit growth.
HCL Tech MD and CEO Vijay Kumar sees AI at an inflection point with physical AI as a $1 trillion opportunity. Cognizant CEO Ravi Kumar sees applying AI to operations as the future, even as he preps to list the company in India.
Hello, good afternoon. You've tuned into Halftime Report coming live from the CNBC-TV18 Motilal Oswal studios. I'm with Vinny Motiwala, with me my colleague Sonal Bhutra as well as Ekta Batra. Good afternoon, ladies. A day that we're seeing a bit more of a fall, a bit more of a correction. Even from yesterday, we're seeing a further fall coming in. And as of now, like you can see, the Nifty 25,450, around that mark is what the Nifty is trading at. Broader end of the market, that's seeing a bit more of a pressure as well. Look at the Nifty Midcap, that's down almost 1.3% in the trading session as we speak. Small cap too down 1.6% in the trading session, while advance decline ratio today clearly in the favor of declines versus advances in the day today. So a bit more of a red on the screens today.
Well, yes, absolutely. At this point in time, it's a tough day which is coming through for the markets. And as you can see, we have a lot of earning reactions which are really dominating sentiment in today's trade. So, for example, we have BHEL, which is down for the second day in a row. That stock is down around 3-odd%. LTI Mindtree, which is now at the low point of the day, down 7.5-odd%. And Oberoi Realty, which has seen volumes and bookings decline on a year-on-year basis this time. So, Oberoi Realty, too, down around 7-odd% post its numbers. So it's a market which is dominated really in terms of earnings. We do have a lot of numbers to watch out for in trade today as well. We have AU Small Finance Bank, J&K Bank, ITC Hotels, Persistent Systems, United Spirits, all of these stocks which will possibly determine the mood and the sentiment for the markets as well.
Oh, yes, absolutely. That continues to be on our radar, right? All the sectoral indices in the red today. We do have the Bank Nifty, which has recovered a tad bit. That saw some recovery in the Nifty as well, but that again got sold into. So we'll be discussing that, the market fundamentals, technicals, and get some corporate conversations on the show as well. But let's talk about what do we have on the show today. In our What's Trending segment, we put the spotlight on Nifty and whether the 25,000 level is likely soon with Rahul Sharma of JM Financial Services. We'll also have the management of Himadri Specialty Chemicals for their Q3 earnings. And a little later, we'll connect with Tips Music for their Q3 earnings. Okay, all right. So with that, let's move on. Big moves in the broader market. So let's go across to Vivek to take us through the stocks that are moving around in trade. Vivek.
Well, thank you so much for that. Advance decline ratio, as you just mentioned, quite weak. So broad end of the market, most of the names or most of the sectors under quite a bit of pressure. But select stocks on the back of news flow and earnings are seeing some buying activity. First on the list, Hindustan Zinc. Strong management commentary. Good Q3 on the back of that high by almost 4%. Deepak Nitrite, one of the top gainers as far as the NSE 500 index is concerned. Good volumes today as well. That particular stock up by almost 4%. Bajaj Electricals, after a while, some positive news flow coming in. The company says that it's looking to enter the wire segment higher by over 4%. And Tips Industry, clearly an outlier as far as the broad end of the market is concerned. They've gone ahead and revised their PAT guidance upwards. Street clearly likes that higher by over 7%. On the other hand, quite a few laggards as well. LTI Mindtree, now despite an essentially inline Q3, high valuations is something that the street doesn't like, down by over 7%. The entire realty pack continues to languish under pressure. Oberoi Realty, a slightly weak Q3, but along with it, most of the other realty names are under significant pressure. The OMCs, a couple of newspaper reports as well as JP Morgan today has highlighted that the government may look to raise additional funds via an excise duty. The back of that, most of these names under a bit of pressure as well. IEX under a bit of pressure ahead of the Aptel hearing that will take place today afternoon. And both of the Aditya Birla Group stocks that saw block deals today post the block deal under a bit of pressure.
Okay, all right, Vivek, absolutely. A lot of stocks which are buzzing in trade today, and that's a whole list of stocks that you need to keep on your radar. But let's move to let's focus on what's trending. Today, the spotlight is on the markets. The Nifty remains under pressure, breaching last week's low, and the market breadth is favoring the declines at this point in time, with the Midcap index below its 100-day moving average. All sectors are in the red. Volatility is at a near 2-month high, and earning reactions are sharp, like we've been pointing out. LTI, Mindtree, Lvls, Oberoi, all of these stocks are in focus in today's trading session. To discuss this on our What's Trending segment, we have with us Rahul Sharma, who's the Director and Head Technical and Derivatives at JM Financial Services, joining in. Rahul, hi. Thank you very much for joining in. You're going to be discussing the technicals of the market and going to be taking a lot of the viewer queries that we have flooding in on Halftime Report as well. Rahul, thank you very much for taking the time out. Just wanted to start with your call on the Nifty, considering that we've breached 25,500 for the second time in just around 6 to 7 trading sessions. What does that mean technically? Where do we go from here?
Yeah, firstly, we're glad it's half time, considering the kind of volatility we've had intraday. Now, like you said, this is the second time we are breaching the 25,500 mark, which puts us into a place where a newer low could be established in this week itself. Technically, we are looking at the 25,200 level, which is where the 200-day EMA for the Nifty is. Essentially, a bounce back is something that can be expected from those levels, but that is for some other day. As of now, the trend seems to be down. The only two shining stars in this kind of a dull scenario is PSU banks and metals to a great extent. Apart from this, the market is lacking leadership, and whether it be it defensives, whether it be it IT or a stock like Reliance, all seems to be bearing the brunt of selling pressure.
Hi, Rahul. Good afternoon. Yes, like you mentioned, PSU banks and metals seems like that's the one only trending in 2026 so far. They are the top sectoral gainers, while on the flip side, real estates, that's seeing clear pressure as well. So any thoughts on Nifty Realty that you could put in as well?
Yeah, so yes, Realty has been under immense selling pressure in the last 10 odd trading sessions. If we speak of the Realty index, it is oversold on the charts, but the thing is, markets can remain oversold for a prolonged period of time. And one thing that could lift the sentiment up for the real estate index is a positive surprise on the quarterly numbers. I assume DLF will announce its numbers today, and if it could set an example that could lift the sentiment. Otherwise, technically speaking, even DLF for that matter is heavily oversold. RSI around below the 25 mark, and at the same time, if you look at the components of the Realty index, none of them are sort of showing any signs of a reversal as of now. So my sense is this is one sector where the weakness has been immense, and this is in spite of the multiple rate cuts that we've had last year. So clearly this sector is struggling, and essentially, unless and until the market gives us a relief rally, I think it's best to sort of, wait it out and let the current correction play itself completely out.
So you expect further 3 to 4% correction in Nifty Realty from here on, Rahul?
Yeah, seems like so. If you talk of a support for the Realty index, it is placed in the vicinity of 780, which is around 3 to 4% more from the current levels. As of now, it is a falling knife, and as of now, there are no real signs of a bounce back seen, and even on the hourly charts, forget the daily charts. So my sense is, in case there are some traders who traded this on the short side, the best thing to do is keep trading stop losses and ride the wave. And for investors, I think maybe the results could bring in some bit of more clarity. And once some consolidation takes place, one can look to add up in this sector.
So Rahul, for most of these realty companies, the quarterly update or the quarterly bookings, that gives an indication of what the results would look like already, right? The table will come up for our viewers. Most of them have seen an increase, but the growth rate has slowed down. Oberoi Realty has seen a decline. Signature Global has spoken about demand concerns. So this is the scenario that we're working with. So we'll actually get a particular viewer query on real estate because a lot of these stocks are at a 52-week low now. Ramesh Jain is writing to us from Mumbai. He holds 40 shares of Prestige Estates at 481 rupees a share, sitting on decent gains here. Wants to know the short-term outlook on the stock. Rahul, what do you make of this? Considering that you're saying it is a falling knife in terms of sectors right now, and the viewer is sitting with good gains on this name.
Yeah, so the thing is, in a broadly negative market, even good news gets discounted and markets don't react to them. Now, speaking of particularly of Prestige, the stock has given a fresh breakdown in today's session, and below 1450, the bias remains bearish in this. I think the next meaningful support for the stock can be expected anywhere in the vicinity of 1380, 1360, which is another 70-80 points from here. So from a trading perspective, clearly the bias is down and we could see another round of sell-off in the same. But from an investment perspective, since he is sitting on good profit and it's a long-term holding, I would suggest to wait it out and possibly wait another quarter and see if we can get a better price. But as of now, in the very short term, the trend is clearly down.
Okay, well, Rahul, you join us at a time when the US futures are also extending their losses. We have the Dow futures, which are down around 400. So it's not only India and earnings which are dominating in terms of sentiment, but what is taking place, obviously, globally, which is fueled by geopolitics at this point. So in that context, we have gold and silver, which are trending and have been going from strength to strength. How would you approach the entire metal space? How would you approach stocks such as Hindustan Zinc, which have already given tremendous returns?
Yeah, so, it's like, enjoy the party till it lasts. At the end of the day, at these prices, especially silver, it's like passing the parcel. We all know that the music will stop someday. But until and unless it stops, nobody wants to miss out on the fun. So speaking of specific stocks like Hindustan Zinc, which benefit a lot from increase in the silver prices, well, today we've seen a fresh breakout on the daily charts. It had been consolidating since December, since the last 2 weeks now. And the current setup takes it possibly in the vicinity of 725, 750 on the upside. So that is where we see the immediate upside for Hindustan Zinc. And as far as I think the other, best performing sector of this stock of this sector is concerned, which is Hindustan Copper, this has been subdued since a few days now. Probably this could be the next one. So look to accumulate in the copper in the vicinity of 500 to 545. It's currently at 543 odd. I think this could be that second stock in the lineup, which has been strong for the entire last 6-month period, could continue to impress from here as well. So right now it's more of a trading bet than an investing bet. But yes, the momentum seems to be favoring these two names.
Rahul, we have one more query that's come in on Vari Energies. Now, obviously, Vari Energies in focus today as well. There's some order that has come in for the company. But Soumya from Kolkata is writing to us saying she's holding 3 shares of Vari Energies. This is at a price of 2,735 rupees. Wants to know the short-term outlook. Should she continue to hold this? What would your view be on Vari Energies?
Yeah, so technically, this is forming a bearish pull and flag pattern on the daily charts. The next breakdown of which is placed at 2,500. Below 2,500, the floodgates could open for a 2,300 kind of a target on the downside. So, the advice would be to have a very strict stop loss at 2,500. And now, if this view doesn't work out and there is a bounce back seen, there could be a stiff resistance in the area of 2,800, 2,850. So, any bounce back can be looked upon as an exit opportunity in the same.
Okay. All right. Thank you so much, Rahul, for joining us with your insights on the technical levels to watch out for the markets, individual sectors and names as well. With that, we'll slip into a short break. As we do that, the countdown for Budget 2026 is underway. The most influential voices decode and analyze the impact and policy decisions from the Finance Minister. We bring you a power-packed lineup throughout January and on the day of the budget as well. Helios Capital Samir Arora for all things market, followed by JP Morgan Sajid Chinoy to discuss the macro signals. We also get you insightful analysis from industry veterans and Dinesh Kanabar and Ashok Wadhwa for the tax rhetoric.
Fly Emirates, fly better.
Welcome back. You're still tuned into Halftime Report. Himadri Specialty Chemicals is the first management on the show. The company reported a good set of Q3 earnings with the 9-month profit crossing FY25 growth. We have with us Mr. Anurag Chaudhary, the CMD of Himadri Specialty Chemicals, to discuss the three key focal points. First, the revenue potential from announced capex. The second is, will these new projects be margin accretive? And the third one, the exports as a percentage of the overall opportunity. Mr. Chaudhary, good afternoon. Thank you so much for joining in. It's been a while since we spoke on air, and since then you have announced a lot of capex across segments, across chemistries as well. So if you can briefly tell us what is the kind of capex you'll be putting in, what is the asset turnover potential in terms of revenues from them, and will they all improve your margins once they commence?
So, good afternoon, Sonal. Nice to be back on CNB after many years. So, Himadri has outlined a significant growth plan from here for the next 5 years. So we have announced doubling our capacity for specialty carbon black from 60,000 tons to 130,000 tons, which has in the last quarter commenced trial production. In the current quarter, it will start commercial production. With this, will become the single largest site in the world for specialty carbon black. We have announced another capex for significant high value-added product anthraquinone and carbazole with a capex of 120 crores. We have announced capex for lithium iron phosphate for 1125 crores for 40,000 metric ton capacity, which will start production in Q3 FY27.
Okay.
Along with this, we have acquired Birla Tyres 2 years back. We have started commercial production from 29th of May 2025.
Yes.
And there also we have around 1,100 crores of capex lined up.
So, Mr. Chaudhary,
all in all, around 2,400 crores of capex, which is already announced, and another 2,000 crores of capex will be announced in due course of time.
Okay. Mr. Chaudhary, if you could just detail how exactly are you funding this capex and any kind of fundraising on the cards for the company?
So in all the capex program, it will be funded through internal accrual. If you look at our balance sheet, last year we have a cash of 381 crores. Current year, already in the 9 months, we did a EBITDA of around 700 plus crores. Plus, we have our warrant conversion, which brings in another 290, 300 odd crores. So we have sufficient cash. Plus, the cash accrual, which will happen over the next 2-3 years, is sufficient to meet our requirement for the capex.
Mr. Chaudhary, you outlined all these capex plans. Some of them have commenced, some of them are going to be commencing now. What does it mean for your revenue? If you could highlight some of that as well. The one which started, like you mentioned, the carbon black capacity, which started in Q3 FY26. What are the synergies that we'll start seeing in terms of incremental revenue or even the Birla Tyre capex that you made there as well? I think we've snapped the line with them, but interesting capex plan, a lot of them that they've announced over the last few years as well. I think Mr. Chaudhary is back with us right now.
Yes.
Mr. Chaudhary, so I was asking you, what will all this capex mean in terms of your revenue potential? Next couple of years, how do we see the revenue moving?
So if you talk in terms of revenue, overall revenue impact will be around 7,000 crores. Coming in from all these 3-4 capex over a period of next 4 years. And if you look at our capital allocation, Himadri current ROC is around 34-35%. So regarding your question for investment being accretive, we have in principle decided will not invest in any project where the ROC is less than 30%.
Okay. All right. Mr. Chaudhary, how big will exports be an opportunity in this 7,000 crore target that you have? Asking because of the scenario that we are in currently, right? So much happening geopolitically. Do you think that could also be a risk? Any other risk that could be there for that 7,000 crore target?
No, see, as far as the geopolitical situation is concerned, definitely it's a matter of concern for everyone. But you know what advantage Himadri has is when we interact with our customers. So it's not a commodity that we are selling. We are selling specialty products in our entire portfolio of products. So we engage with the customers, work with them, work on the research and development level, and keep on improving the product as per the requirement, today's requirement and future requirement of the customers. So even in a difficult situation, the customers remain with us. So
and what is the export percentage? And what is the export percentage?
Currently, it's around 26%. We expect it to go to around 35-40% in next 4 years' time.
All right. Mr. Chaudhary, just want to narrow down in terms of the numbers that you've reported, because your 9-month profit has in fact crossed your FY25 profit, which you've reported. So just give us a sense in terms of what the momentum might look like in terms of margins as well as profitability, what your exit rate would be, say, for FY26, and what are you projecting for FY27?
See, we don't give any projections on a year-to-year basis. But if you look back, 2025, I gave a projection that we will double our profitability of FY24 in next 3 years. That means 411 crores of profitability will double to 800 plus by FY27. But good thing is that in 2 years' time, we are already nearing to that.
Okay,
now, I want to make a,
go ahead.
Give a guideline for future that 2025 we achieved a PAT of 548 crores. Again, in next 3 years, but that is FY28, we'll double this profitability. So we are looking at 1100 crore of PAT by FY28.
Okay. All right. So by FY28, you should be at around 1100 crores in terms of profit. Currently, your margins are trending between 19 to 20%. You want to give us a guidance on that as well? Where do you see it by FY28?
So margin in absolute terms is better the way to look at Himadri rather than the percentage of top line. So if you ask me today, we are at 16,000 plus margin. I think means from my side, it will consolidate and remain strong for the time to come.
Okay, all right, Mr. Chaudhary, always a pleasure speaking with you. We'll speak to you very soon again when one of these further capacities commence and we end the year FY26 as well. So that's a strong performance coming in from Himadri and outlining their future growth as well. 7,000 crore of revenues in the next 4 years from the current capex that the company has announced. The stock is at the day's low. The market's also generally not doing so well as we speak. Time for a break now. When we come back, we'll speak about all the trends in the F&O market. Stay tuned for that.
Welcome back. Well, looking definitely like a tough day for the markets. We have the Nifty at around 25,438. So we're down around 0.6%. We have the mid-caps, which are clearly underperforming today. So we have the mid-cap index, which is down around 1.6%. The advanced decline ratio is not seeing any kind of improvement. So we have around 1,000 stocks advancing to over 3,100 stocks declining. As you can see that the market breadth gap is so wide that it's unlikely to narrow too much, at least in the foreseeable future. The Bank Nifty, not as bad. So we have the Bank Nifty, which is just about lower by around 0.3% at this point in time. Just a clutch of stocks which are managing to hold up in the green within the Nifty space, just about 6 stocks from 50 stocks. So Dr. Reddy's is your top gain on the Nifty. In fact, it comes out with its numbers tomorrow. So that stock is holding up with a gain of 1.5%. Kotak Mahindra Bank, HDFC, ICICI Bank, a couple of these banks are managing to hold up. gap along with State Bank of India. HUL is the other stock which is just about managing to see some amount of green, up around 0.5% currently for HUL. So those are a couple of the winners or the stocks which are largely resilient in today's trading session. But it's a tough day. We have the Dow futures which are down around 600 points as we speak. We have Mangalam joining in to give us more statistics in terms of what's taking place in the futures and options desk. Mangalam, over to you.
Well, the Nifty Bank is outperforming, even though there is some pressure on the Nifty as well as the other frontline indices. The important part, however, is that, the market's maintaining some of the lows. If you look at the last few trading sessions, Jan 12th, the last Monday, we saw the Nifty is low at around, 25,470 thereabouts. Yesterday's low was 20 points above that, and today's low 20 points below that. So between 25,430 to 25,490 is where important supports are, and that's where the market's meandering as well in today's trading session. The market breadth has a mind of its own, though. We still have 2,300 stocks which are in the red, for about 500-600 which are in the green. So portfolios are definitely bleeding this morning. And the important part, however, is that the Nifty Bank is holding on to key levels. For the Nifty to hold on to these lows, the Nifty Bank, which is outperforming, is holding on to its 20-day moving average as well as the 50-day moving average. So both those levels, important supports for that index. And we are seeing some support come by for the Nifty Bank via a lot of these private sector banks as well. But the only thing that we have to look at now from here on is, the stocks which are underperforming basis results or Q3 updates or management commentary. So we have the likes of Lvls lower because of management commentary around margins, LTI Mindtree inline results but weakish outlook, and we have Oberoi Realty as well. The bad third quarter update has that stock lower by almost 7.5–8%. So those stocks are getting punished, and there is some safe haven buying in the markets. What is safe haven? It is currently the FMCG and pharmaceutical pack. So these stocks are mild outperformers today. For the frontline index, the option writers believe that maybe a range will play out today at the lower level. 25,400 will be a support, 25,500 will be a resistance. Why do I say that? Because if you look at the 25,450 straddle, which is a 25,450 call and the 25,450 put together, combined premium for around 55–60 rupees, telling you that that's what the street is working with. The put call ratio too is fairly at the lower end of the range, though it's recovered from the lows at around 0.71. The options data does indicate that the range bound trade around 25,400 at the lower level to 25,500 at the upper level will continue.
Okay. All right. Thank you so much for joining us with those F&O stats, Mangalam. That continues to be on our radar. What's happening on the futures and options side as well. But time for a break. On the other side, we'll get in Manisha Gupta, who will join in with Amit Goyal of Pace 360 in our commodity segment. Stay tuned for that.
Welcome back. Joining us now is Amit Goyal. He's co-founder and chief global strategist at Pace 360. Amit, hi. Thank you so much for joining in. And while we've been talking about that correction, which is very long overdue now in the markets, the silver prices just about continue to read even higher. I was reading some reports that silver prices could go to 2.5 lakhs, but there have been reports suggesting 5 lakh rupees a kg within this year itself. How are you looking at these current levels? And would you say there is some resistance now that we are seeing just ahead of that 3-digit mark?
Hi, Manisha. Thanks for having me on. So my understanding is that silver is now close to its end game of this massive historical rally that started in April of 25, but actually came into motion from June of 2025. So it's been absolutely a stunning rally. And now I do believe that we are probably close to the end game. And my timeline is that between now and first half of February, there is a very high likelihood that the top is going to be in place. And I agree with you that there are a lot of resistances which it would now run into. So, for example, $98, $99, and then I think 103 is a possible projected top. And those resistances are also coming from gold-silver ratio, which has just made a new low of 49.35 yesterday. And gold-silver ratio is now massively, it has come down from a level of 108 in April. So my sense is that the resistance is going to come from gold-silver ratio as well as from the absolute prices of silver.
So, Amit, well, I just want to run you through a few things as well. Goldman Sachs report that came in yesterday says that there was a rally which was well supported because of silver's inclusion into critical mineral lists. So was the case with copper as well. And then the dollar was declining. The geopolitical tensions have been well baked in as well. But now what we're looking at is absolutely speculative money allocations. We've seen Shanghai Exchange actually tell the machine guys or the high frequency traders, as we call them, to keep out of the market and not add to speculation and volatility therein. So do you see all of these steps actually come in and help?
I think they would try to sort of slow down the momentum, because I think whether it is the exchanges or the regulators, they are kind of uncomfortable with what's been going on in silver. So whether it is COMEX increasing the margins, then of course MCX increasing the margins, and now those restrictions coming from Shanghai, it just shows that the regulators in the exchanges are a little uncomfortable with the meteoric rise and the extent and the speed with which it has happened. And they are worried that, if this were to reverse course, then what could be the ramifications for speculators, traders, and even the exchanges? So I think all that is happening, but this is a historical bull run, Manisha. And when a historical bull run is sort of unfolding, often the actions of the exchanges and the regulators, they fail to stem the tide. And I would not be surprised if these guys fail to stem the tide. But of course, they would sort of slow down the process a little. And my sense is that a historical top is going to be in place between now and mid-February, irrespective of what further actions the exchanges and the regulators might take.
And what's your sense on where would we see a correction or a support come in then?
So my sense is that my projected top is 103, 104, Manisha. And I must point out at this stage that the MCX level is right now trading at a 6 to 7% premium over the COMEX price. So in a way, MCX is building a premium which some people are justifying as a possible tariff hike by India in the February budget. But I'm not so sure, because if I look at gold is just trading at about a 0.5% premium to its parity, while silver is trading at a 5 to 6% premium. And it is very difficult to make a logical case that the duties on silver are going to be hiked more than gold, because gold import is a much larger figure for the country. And plus, it would be a little regressive to hike the duties on silver because of its use in the high tech and the electronic industry. So my sense is that a correction could begin once the targets are reached, and that target could be anywhere between 98 to 103 on COMEX. And I think the first correction could be something like a 20% kind of correction, which I know sounds crazy, but then who would have thought in December, just a month back, that silver is going to go up by 50%? It was even then at its all-time high, and it has come up by 50% in just the last 1 month.
Absolutely.
So the rally has been crazy, and so probably are going to be the corrections.
Oh yes, in last 1 month, 50% of gains in silver. And Ekta, let me tell you, in last 1 month, from 2 lakh rupees to 3 lakh rupees of a price has come in 1 month.
Absolutely, a huge jump there. But we're talking about record highs for silver and gold, but a record low possibly for the rupee. Just watch out for that. 91.03 is where it's at. On an intraday basis, the rupee had depreciated to around 91.04. The record low was 91.077, which was hit on 16th of December. So we're probably, there is a little bit of an appreciation, as you can see, on an intraday basis, but the overall trend seems to be that the rupee is now moving to possibly breach that record low that it had hit in December. Precariously poised, just like you can see for the markets, which are also at the low point of the day. Take a short break, but up next we'll connect with a company which is managing to buck the trend. We have Tips Music, which will be joining in to discuss their Q3 numbers as well as the profit guidance, which has been upped.
Welcome back to Halftime Report on CNBC-TV18. Now let's put the spotlight on the next management for the day. We have Tips Music that reported a good set of numbers in Q3 FY26. Profit guidance revised up to 25% for FY26 from earlier 20%. Kumar Torani, who is the MD at Tips Music, is joining us now to discuss 3 important points that we want to talk about. First is the FY26 outlook and the guidance revision that has come in for profits. partnership with B4U and the acquisition, what will it mean in terms of revenues and content lineup for FY26, FY27, especially what are we keeping an eye out on? Ms. Turani, good afternoon. Thank you so much for joining in. Sir, let's start by talking about that guidance which you'll have up for profits, right? PAT came in at 16% YOY right now, while in terms of guidance, you have upped it to 25% for the end of the year. 9 months is the 16% growth I'm talking about. What is making you so confident of this 25% that you are talking about that you will achieve in FY26? And also in terms of revenue, you managed to see a growth this time of around 21% in Q3. Where do you see that headed with this B4U partnership that you have?
I think we already achieved that 16% you are talking about. I think top line is the revenue. So revenue we have kept at 20%. But if you see the PAT we have hiked our target to 20 to 25%, which we can see. Actually, I think it will be more than 25%. But at present, we are giving assurance for 25%.
Okay. What is this assurance based on, sir? You know, you're saying that you can even exceed 25%. So what would that exceed be? For example, can you give us a range? Would it be 25 to 30%? Do you have any kind of visibility? And what is it? What is the key driver?
Yeah, see, till last year, we always suggested that we will have a top line of 30% and bottom line of 30%. But this year, because of so many apps that OTT apps got, they stopped functioning. So that's why we have to come a little bit down. So we told our investors and everyone that this year we will have a 20%. But as our repertoire, whatever we have done from 88 till now, is really doing well. And so that is performing. My repertoire, music repertoire is performing very well. So we achieved 20% on top line. And earlier, as said, 20% will be a PAT. But now what we see, 25%, we can assure that 25% will happen. But even 30% can happen. So how this quarter is performing, we are depending on that. We are really working hard to achieve those numbers.
No wonder, because of which the stock is doing very well in an otherwise weak market. Mr. Turani, you have spoken about your partnership with B4U TV. Can you give us a sense of what does it mean in terms of revenue margins going forward? Will you be doing some capex for this? Also asking you whether it could turn into something more stake heavy, because your industry has seen a lot. Universal Music acquiring stake in XL, Saregama acquiring stake in Bhansali Productions. Will you also get into something like this, buy stake in any production house?
We are already into deal with our own company, Tips Films, where they produce films, and at the arm's length, we have arrangement with them to acquire all the music from them. Since beginning, we are doing that. So these, whatever now you are hearing, we are doing this since ages. So that should, you can trust our investors, trusting our vision. That's the best thing. And we continue to do this, and we are getting a good quality content from them. So that is already happening with us.
But if you could just detail the cash on books, Mr. Turani, and if you would be interested in any kind of M&A, you know, in order to sort of grow the verticals.
At present, we don't have any plan, but in case there is a proper right deal, maybe we can think of. And we have enough cash to manage our business. And as you know, we will give entire dividend of last year's profit, 100% dividend we give this year. This year we have given 1300% dividend, 1 rupee share and 13 rupees dividend per share. Around 166 crores we have given as a dividend.
Sure. Mr. Turani, just wanted to understand your strategy for YouTube Shorts as well, right? Because I believe there's overall in terms of your total views, that's seen a bit of a negative, fall right now. Why is that so? And YouTube Shorts, what's your strategy? How do you see that forming a part of your revenue?
See these short apps, short content apps, they are paying us a lump sum kind of a deal we have with them. But next year, our deals are coming for a renewal. So maybe we will sit with them and we convince them to now go for a profit sharing basis. The way we do a normal business with YouTube or Spotify. So if that happens, I think it will be very good for business. And they are also planning, these companies, they are also planning to do that kind of a deal instead of lump sum deals. So
Okay.
that's coming up next year. And as far as this downfall in some views or this happens quarter on quarter, that's not a big deal for us.
All right. Mr. Tarani, quickly, we are short on time. If you can tell us, content costs have fallen as a percentage of revenue. Will this trend continue? Because this is something which could aid margins.
Actually, this year, we supposed to release one big movie, but that got postponed to the next year. That's why our content cost became low, around 18%. It will come. Otherwise, our normal target is 25 to 28% we want to spend on a new content. And I think it's enough because the quality content, if you see the quality content, what we are getting is very low. So we are just sticking to 25 to 28%, and I think we achieve that next year.
Okay, all right, Mr. Tarani, we'll be looking forward to that delayed movie, definitely. Thanks very much for joining in and speaking with us. So that's tips managing to hold up in what is a very weak market at this point in time. The Nifty down around 160 odd points. Take a short break, get you more on stocks and markets on the other side. Welcome back. We'll just want to point out that Dr. Reddy's is the one which is managing to hold up with a gain of around 2% at this point in time. It does come out with its numbers tomorrow. So ahead of that, there is maybe some amount of optimism on Dr. Reddy's. It'll really kick off the pharmaceutical space in terms of the Q3 numbers. For Dr. Reddy's in particular, the street will be watching out for commentary with regards to semaglutide and their launch in the Canadian markets. Remember that as of now, no company has received approval, but it is expected expected to be a big opportunity for Dr. Reddy's, which has, however, faced some amount of roadblocks. But nonetheless, it's a weekday for the markets, and that's all the time that we have on the show. Stay tuned. Business Lunch will come up next.
Midcaps dip as Trump politicking weighs on global markets. Realty, IT and capital goods are the big drags, while utilities see some green.
LTI Mindtree takes a knock after a hefty 590 crore rupee labor code charge hits Q3 profit. The IT major, however, remains upbeat on growth in Q4 and expects to close the year with better margins.
Axis Bank MD and CEO Amitabh Chaudhary says getting deposits in India will be a hard grind, and while credit growth is seen picking up, there can't be a divergence between credit and deposit growth.
HCL Tech MD and CEO C. Vijay Kumar sees AI at an inflection point with physical AI as a $1 trillion opportunity. Cognizant CEO Ravi Kumar sees applying AI to operations as the future, even as he preps to list the company in India.
Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Hormaz Fatakia. With me as always, Arundhati Ramanan. Arundhati, good afternoon.
Good afternoon, Hormaz. The markets today, it's red across the screen, right? Nifty and Sensex down about 0.5%, but the Midcap seeing a bigger fall than that, 1.5% in the red today.
It's not a pretty picture if you are a bull particularly, because there were two important levels for the index to defend today. The first one was 25,500, which it failed to do so at the start of the trading session. The other one was the Jan 12th low of 25,473, which is from where the index had reversed after remarks from the US Ambassador to India, Sergio Gore. And we are now below those levels. In fact, we made an intraday low of 25,405 in today's trading session. So 25,400 now becomes an important level to watch on the downside. Earnings reactions coming in on your screens. The first result of the day flashing at the bottom of your screen from Tata Tele Maharashtra. Of course, not a big name to talk about, but there are a lot of other important results that you will have to keep track of in today's trading session. Just before I go to Arundhati, the Nifty Bank is the one that has been doing the heavy lifting for the bulls, at least for a better part of this year. And that recovery that you saw sometime before noon has also been very swiftly sold into, Arundhati.
Absolutely. And as you pointed out, earnings has been the key to watch, right? If you take a look at the sectors as well, we've got that Realty index, which is not doing well. It's the top loser, about 3.5% in the red. And Oberoi Realty, which came out with a weak set of earnings, saw its bookings down. There was a sharp fall in that stock. And if you take a look, it's 7.5% in the red. And that sort of hit all the other Realty stocks also. If you take a look, Prestige Estate, Soba, all of them down over 5% as we speak. Now, LTI Mindtree's numbers were largely in line, but mixed internals and concerns related to the next 2 quarters led to a big fall in that stock, also down about 6.5%. Wipro, Tech Mahindra, all of them are the other losers on the IT index, down over 2%. But if you take a look at some stock-specific action, we've seen that IEX is about nearly 4% in the red, ahead of the market coupling case, which is in Aptel, and that will be heard later today. And we've got Hindustan Zinc, which is the only one probably in the green, about 4% higher, tracking strong earnings and a continued up move in silver prices, but largely markets in the red. But the European Union and India could conclude talks over a free trade agreement as soon as next week. Parikshit Luthra is here with all of that action. Parikshit?
EU Council President Antonio Costa and EU Commission President Ursula von der Leyen will be the chief guests at the Republic Day this year. The major highlight of this visit would be the India-EU FTA. Sources say EU-India are likely to announce the conclusion of FTA talks by January 27. But this doesn't mean that the FTA will come into effect immediately. The conclusion of talks will be followed by finalization of the legal text of the FTA. EU Commission will sign the FTA with India after being authorized by the EU Council. The agreement will be approved by the EU after consent from the European Parliament and the decision from the EU Council. Sources say the EU will work towards signing and completing this entire exercise and ratifying the FTA by 2026. CNBC-TV18 has learned that EU has been amenable to India's demand for greater market access for Indian labor-intensive exports, and both EU and India's red lines on agriculture and dairy have been completely respected in the FTA talks. Market access for European automobiles has always been a major issue. We learned that automobile exports from EU to India will be subject to a tariff reduction quota. The FTA to fix a tariff reduction quota for cars as per fuels and engine capacity, and tariffs on cars will come down in phases. However, discussions on tariff rates and quotas for automobiles is still on. When it comes to wines and spirits, the EU industry, we are told, is set to get better market access in India. We also learned from sources that EU will not compromise on the carbon border adjustment mechanism, but will support Indian companies in their decarbonization efforts. EU has to maintain a level playing field, according to sources, and the CBAM has actually encouraged countries to develop their own carbon credit systems. Now, this is a stand that has been taken by EU officials in talks. After the conclusion of FTA, the EU will begin a major outreach exercise to accelerate trade between the two regions. EU and India will also sign an MOU on facilitation of mobility of professionals during the high-level state visit.
Parikshit, thank you very much for that update. All eyes on that India-EU FTA. Take a short break. More news and updates on the other side.
Fly Emirates, fly better.
Well, the bulls are now fighting to defend that 25,400 mark on the downside. We're heading to the final couple of hours of the weekly expiry for the Nifty contracts, and the Nifty now heading 160 points lower as we speak. There are a couple of stocks that are not doing well though in today's session. Of course, Arundhati spoke about the Nifty Realty Index. That index is now down for the 10th day in a row. Is the Nifty Realty, and 3 stocks from that are also at 52-week lows. Godrej Properties is one of them. Lodha is another name, and Prestige Estates as well, down at 52-week lows, so 4% lower for the real estate index. What is also at 52-week lows, or what is also at a new low and down for the 10th day running, is Ola Electric, and that continues to extend its losses in today's session. Let's go across to Davos for our continued coverage from the World Economic Forum. Shireen Bhan in conversation with Anish Shah, the Group MD and CEO of Mahindra & Mahindra.
Welcome to our continuing coverage here from Davos 2026. I'm Shireen Bhan, and as I've been telling you, the headlines are hot. President Trump is keeping Davos active. This is now going to be the epicenter over the next 48 hours of everything that President Trump intends to do. As I pointed out at the start, a meeting with EU leaders on Greenland. Trump not backing down at all, saying Greenland is the U.S.'s territory and the U.S. must take claim to it. It's needed for the U.S. security ambition, but also for the world's security ambition as well. And secondly, of course, that Board of Peace Charter, that signing will take place here in Davos on Thursday. President Trump, of course, arrives tomorrow with a large entourage of secretaries. Outside of what Trump does or doesn't do, the focus also is on India. The India Pavilion is going to be inaugurated in just a short while from now with the IT Minister Ashwini Vaishnav and, of course, Prahlad Joshi and many others in attendance to talk about the outlook for 2026, where India finds its place in the global pecking order. With us is Anish Shah of the Mahindra Group. Anish, always a pleasure. Many thanks for joining us here on CNBC-TV18. It's great to have you back in Davos. I know you've already had a bunch of meetings and many more to come, but what are the themes that you're picking up on? What are the conversations that your investors are having with you, your clients are having with you based on today?
Shireen, pleasure being here with you, and always great being back in Davos. The theme I've picked up so far is resilience. And we've gone through a year with many challenges, and across the world, the sense I've got from our conversations is a higher degree of optimism than I would have expected, and a very high level of resilience in terms of companies looking at doing what is in their control and tackling issues as they come up, and that augurs well for us.
Well, you know, speaking of resilience, we, of course, have a big event coming up back home in India, the budget. What's the expectation, Anish? What is industry going into this budget hoping for? Because many of the big ticket items, GST cuts have happened. That was not a budget item. Income tax cuts happened in the previous budget. Many other measures have been taken. So what's the hope, the ask that industry is going into this budget with?
The ask we have is stay on track. The budgets over the last few years have been very good. They were focused on infrastructure build, on capex, on longer term structural changes, as well as on fiscal discipline, and that is good for India. So continuing on that same path is positive. As you said, we have seen a lot of positives in terms of reforms, in terms of GST, etc., and that is playing out very well for the economy. So we're seeing the economy in very good shape right now. We're seeing a very high level of demand. Our plants are full. While we've quadrupled capacity in the auto business, we still cannot meet the demand that is out there, and we're putting in more capacity as well. So on balance, we're very positive on India and the Indian economy.
Well, you know, you said it's hard to meet demand at this point in time, even though you've added capacity. So let me bring up the point about fiscal discipline as well as capital allocation, both themes that you've been very focused on. What can we expect now for 2026, both in terms of capital deployment as well as where you intend to prioritize your investments?
So we are also staying on track.
I thought so.
We have not just been disciplined, but we also have been bold in many actions we've taken across our companies. And as you saw at Investor Day and the roundtable you conducted with our leaders, all our leaders are talking about multiples of growth, not percentages of growth. And that has come from doing less, focusing on what we are good at, and doing that very well. And that's exactly what we will continue to do as we go forward. We are not going to be shy of investing. We have been investing in many of our businesses that are now growing. You heard Vinod Sahai talk about aerostructures growing literally in 12 to 15 times this decade. You heard Amit Sinha talk about life spaces growing many, many multiples again. And all our leaders today are looking at significant growth that essentially complements our large businesses. So our auto team has done remarkably well. The products that you've seen and the consumer responses we've got have been just amazing. The farm team continues to deliver well, aided by very strong sentiment in rural. So the farm industry has grown, but we continue to grow market share from a high level. Our Mahindra Finance business is on a very good track, has gone through a stabilization phase, come out of it. We're now pivoting to growth there. Tech Mahindra is on a good track as well. So as we said at that point, our businesses are firing on all cylinders. So for us, it is stay on track and continue to deliver growth.
You know, since you're talking about cylinders, let me ask you about what's likely to happen as far as the EV ICE mix is concerned for the auto business going forward. You just had a bunch of launches and, in your words, done very well for you. What can we expect over the next few years in terms of the changes in your portfolio between ICE and EV?
We will continue to see EV grow. EV today is about 7% or so of our sales, and we expect that to grow to 20%, then 30%. the key is going to be around infrastructure. And this is where government policy of focusing on EVs has helped tremendously because that is starting to result in infrastructure growth. The product is a wonderful product from everything our customers tell us. And it's really a wow. Even compared to any of the ICE vehicles, EV vehicles are lots of fun to drive. And that will result in a lot more sales for EV. Charging at home and office is sufficient for any city driving because real life range is 500 kilometers. Our customers need to charge once a week.
Yeah.
Charging on highways is not as easy right now. It's there, but that needs to get much better. As that does, we will see EV taking off.
With all the subsidies in place, the push being made by the centre as well as many state governments, as well as, of course, companies like yours, it's still, as you pointed out, 7% of sales for you. So this ambition of 20 and 30%, does it seem far-fetched today?
It's not. And I think with the path that we are on, we feel that we should be able to get there. And we just need to ensure we stay the course from a policy standpoint as well, because building charging infrastructure will take a little bit of time, and we need to allow for that time for that infrastructure.
It's also been a year, as you pointed out, where many of your businesses have seen significant investments, but are now targeting significant growth plans. So what can we expect realistically? Are we likely to see any listings from the Mahindra Group in 2026 or perhaps, in the near term?
Not in 26, but in 27, we will look at listing our last mile mobility business, which is electric three-wheelers.
Okay.
A business also that has done phenomenally well. A space where we were literally a non-player in three-wheelers. And we were the leader in electric. Today have a 40 to 45% market share, depending on what month of quarter you look at it. Number one in that space. EV penetration in that space has gone up dramatically. So we are at about 35% EV penetration overall. Some cities are at 50, 60, 70% as well. And the large metros are at 5%. So as you get charging infrastructure in large metros, that will take off. So we've got a great business in an industry that is a very strong industry.
So IPOing the last mile mobility business in 2027, what's the rationale for that? What do you use the funds for?
For further growth of that business and for going international.
Okay.
Because we've got a great set of products. And that's something that we should be able to...
So how aggressively are you going to tap the international markets, the export markets for the three-wheeler business?
As you know, we've always done things in phases and ensure that every phase is done well. So at this point, it is a very sharp focus on the domestic market. It is a highly competitive market, and our business has done very well with that competition. And we will start looking at global plans, pick certain countries, and look at becoming large players in those countries.
Well, there's a lot of interest in India. We've already seen a lot of deals being done, specifically in the financial sector in 2025, and many outside of that as well. Anything on the anvil in terms of partnerships or investments into any of your group companies?
We are always open to that, where our partners can bring value beyond just capital. And there again, we've had some marquee investors come into many of our businesses, and that has helped us with the expertise that they have brought. We typically don't go out seeking funds from anyone, but we have some very good partners that we discuss potential partnerships with, and as that fructifies, you'll be the first to know.
Well, we look forward to hearing more from you on that, Anish. But before I let you go, we talked about many of the opportunities, and you said resilience clearly seems to be the theme, in spite of all the volatility and uncertainty of the headlines that we are faced with. So the key risks that you would be watchful of, and how do you intend to mitigate those risks as we move forward?
Realistically, the key risk today is what we don't know. Because everything we know, we've got a plan for. And that's what we've seen through the past year. Rare earths came up from literally nowhere. Right? We had no clue that something that goes into permanent magnets, that goes into motors for a vehicle, is what we should be concerned about. And therefore, our teams today are just prepared for eventualities. We have got a supply chain that has gone from just in time to just in case. But given the world where it is today, there will be challenges that come up, and we just have to have the mindset to be ready to face the challenges. And
Any interest in the government's PLI scheme for rare earths?
For us, we are going to be a big consumer of rare earths with our vehicles, and it's not an area that is core for us from an investment standpoint, but we have mentioned to potential folks who are interested that we can always come in with a small investment, but more importantly, give the assurance that we will take the supply. Because,
so who are you talking to for that?
There are a few folks who are interested in that. I'm not sure
Indian
of the level of interest. More companies outside who have the capabilities to build this. And as they want to come in, we are open to partner because this is something India needs. And this is something where manufacturers have to be ready to pay a slightly higher price than is available globally as well to have certainty of supply chain. So we are stepping in there to say, we will pay a slightly higher price to ensure the certainty of supply chain. And that's beneficial for us and that's beneficial for the country.
So the capex number for the year?
We have talked about a 26,000 crore capex for a 3-year period. We are still exactly on that same number.
And the one thing that you believe Indian manufacturing needs at this point in time?
To be bolder, to have more research and development that goes into making higher quality products, much greater focus on quality and creating world-class products, and preparing ourselves to be the manufacturing hub of the world. Will
M&A be a path to both R&D as well as export markets for you?
We've got a fantastic team for R&D. We've got 4,000 engineers at our Mahindra Research Valley, so we don't need M&A for that. We have great pride in our team, and they've done an amazing job.
But are you looking at M&A to look at new geographies, new categories, new markets?
Not really.
No?
Not really. Our businesses are growing at a very rapid pace. Where we need to do it like SML, and we find the right fit, we will. So there will be some areas where, as things come up, we're not averse to looking at them. But it's in line with the growth plans we have, and in line with where the businesses can play and can win.
Well, this is a Trump Davos, Anish, as I pointed out, and you're going to be at the reception that the World Economic Forum is hosting for President Trump as he meets business leaders. What's the expectation?
The basic expectation is for me to at least understand a little more of what's happening around the world. I must admit that not all of it is fully understood as yet. And hopefully we get to a path of more stability from a geopolitical standpoint.
Well, Anish, always a pleasure. Many thanks for joining us here in Davos on CNBC-TV18. Always a pleasure and appreciate your time. That's Anish Shah giving us a picture of what the outlook is for the year ahead for the Mahindra Group. Stay on track. That's the message to investors, to the markets, and of course to the Mahindra Group internally as well. They will continue to bet on the businesses that they are invested in. And the one new headline coming in from Anish is a listing of the last mile mobility business in 2027. We are going to take a break here on CNBC TV18, but the conversations will continue. Don't go anywhere. We're back in a moment with more.
Welcome back. You're still with us on Business Lunch. And as you can see above us, it's red across the screen for the markets. The Nifty at 25,420, very close to the low point of the day. Sensex also losing about 0.5%. But it's the mid-caps that are lagging. That index is down 1.8% in trade. But the Bank Nifty doing slightly better than the blue chips, about 0.3% in the red. But with that, it is a wrap on this edition of Business Lunch. From Hermaz and me, goodbye and many thanks for watching. Midcap Radar coming up next.
Good afternoon. Welcome to Midcap Radar live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always is Vivek Iyer. A confluence of reasons for the underperformance. We are seeing what's happening geopolitically, a lot of earnings reaction and rupee at a record low as well. So across the board, it's a big sea of red.
That's right. Good afternoon, Sonal. And like you mentioned, confluence of factors. The Dow futures indicating a sharp gap down, and Asian markets too under quite a bit of pressure. But a lot lined up on the show, an important corporate conversation as well. So let's start off with the top headlines. Midcaps dip as Trump political weighs on global markets. Realty, IT and capital goods are the big drags, while utilities see some green.
LTI Mindtree takes a knock after a hefty 590 crore labour code charge hits Q3 profit. The IT major, however, remains upbeat on growth in Q4 and expects to close the year with better margins.
Oberoi Realty slips over 7% in trade after the company reports a weak Q3 with its bookings falling 36% sequentially. Lvls also falls in trade post its Q3 results. The management says short-term demand might hurt on high raw material prices.
And shares of Hindustan Zinc and Tips Music trade with gains on the back of strong results. Hinzinc's Arun Mishra says the next phase of expansion will start in 1 to 2 months, while the management of Tips expects FY26 profit growth over 25% versus 20% that they had indicated earlier. Okay, all right. Those are the top headlines that we are tracking. Nifty is currently at the day's low as we speak, very close to breaking that 25,400 mark as well. So that will be a very crucial level to watch out for. For the mid-caps, it's a 2% cut, a big difference in the advanced and declining stocks. On the BSE, the ratio is 1:5. So watch out for that one. But let's get in Shrikant Chauhan of Kotak Securities for a technical check on the markets. Shrikant, what are the levels suggesting now? Will we break 25,400 easily and continue to stay below those levels, or there is some recovery on the cards?
Good afternoon, Sunil. Good afternoon, Vivek and everyone. So for Nifty, we are of the view that with a very short-term perspective, markets are highly oversold. If we consider the put-call ratio for the month, then it is around 0.62 and India's VIX is around 12.3. So the combination is clearly suggesting us that in the near term, we may see rebound in the market. But with a view of next at least 4 or 5 days, we may see the market to remain within the range of 25,200 and 25,700 on the higher side. But with a very short-term perspective, I am of the view that market should rebound from current levels.
Understood that, Shrikant. And, you're saying, calling for a bit of a rebound. How will you play that? Will you play that via the index, or do you have any individual stocks that you believe can lead this particular rebound?
No, I think for index also, it looks like quite promising to take bait with a stop loss of just 100 points. We can keep a stop loss at 25,300 for creating any long position on index at current levels with a target of 25,600, 25,700 on the higher side. But for stocks, we need to be more watchful and more focused on metal stocks. In that specifically, we like Vedanta, Hindustan Zinc, but they are far, far away from their current recent support levels. So at current levels, we like Tata Steel, which is down from the levels of 191, 192 to almost 185, 186. At this level, it's a buy with a stop loss close to 182 on the downside. Again, we can expect 190, 192 on the higher side. So Tata Steel looks quite promising at current levels. The other stock on which we are bullish is Bharat Electronics. And there also we are seeing some sideways sort of activity. But relatively, the stock is doing much better in the same basket, or even if we consider the basket of Nifty 50. So Bharat Electronics also at current levels around 412, 413 looks a very strong candidate to buy with a target of 435.
Thank you so much for joining us as always, Shrikant. But let's talk about the big mid-cap movers in trade today. Gaurav is here at the big wall. This is a special segment, Mid-Cap Movers. Gaurav.
Well, yes, if you look at the mid-cap index, it is currently under pressure. And even in this pressure, we have seen some of the stocks who are actually gaining in trade. So first, let's talk about Aarti Surfactants. Now, the stock is actually hitting its upper circuit. And the reason being that if you look at profit, that has increased almost by 3 folds. Other than that, we have got Tips Music, good set of number. And at the same time, management also increased their guidance. Other than that, Deepak Nitrate, if you look at the volumes for this stock, they are actually higher. And at the same time, it also ended its losing streak. Bajaj Electric also is a stock which is actually gaining in trade, and the reason being that the company is now foraying into a wire segment. And lastly, let's also not forget about Jindal Saw. We are seeing actually good set of numbers, and at the same time in terms of volume and the gains which the stock is seeing right now. Other than that, we've got some of the stocks who will report their third quarter's numbers, and on back of that we are seeing some kind of negative reaction in the likes of AU Small Finance Bank, DCM Shriram and India Mart. All of these stocks are currently under pressure, down more than 1.5%. Lastly, let's also not forget about the stocks which are currently facing more pressure. First is Bharat Rasayan. If you look at volumes, we are seeing some kind of pressure building up in terms of volumes for this stock. Oberoi Realty, Ola Electric. For Oberoi Realty, we saw the numbers came in for bookings, which declined almost by 36% on a sequential basis. Ola Electric, we saw a news on CFO reappointment. So the previous CFO resigned, and at the same time, they have also appointed new CFO, but at the same time, we are seeing some kind of pressure in this stock. And lastly, let's also not forget about KI Industries. Some volume built decline is what we are seeing. Other than that, some stocks which are currently at their 52-week low level. We have got Godrej Properties, Patanjali Foods, IRCTC, Page Industries and Jubilant Foods. Now, all of these stocks are currently under pressure. So all in all, mid-cap segment is under pressure right now, but there are some stocks which are gaining in trade today.
Okay, thank you so much, Gaurav, for joining in. By the way, Nifty has breached that 25,400 mark for the first time since November, so some more selling pressure is coming by. And one of the segments which is not doing well, Gaurav spoke about Godrej Properties. So the real estate pack down 22% from its 52-week high level this year. So far, that index is down 9%. Today, it's down around 4% as we speak now. So the last time we looked at it, was down 2.5%. Now that index is down 4%. And overall, we are seeing Brigade Enterprises, Godrej Properties, Lodha Developers, all these stocks at a 52-week lower level. We did get quarterly updates from a lot of them. Largely they were not so bad, but the growth rate has slowed down. Sobha saw growth of 12%, Lodha 25%, Keystone saw 3% decline, Puravankara saw 17% growth, Signature Global was lower by 17% this time, 27%. We did have Prestige Estates with a growth of 39%. Oberoi Realty did see a growth of 6%, but sequentially it was a decline, and Godrej Properties was also up 55% on a YY basis. But what is really ailing the street? Now, the first time it came by was when Signature Global said that it will not be able to meet its guidance in terms of bookings, and also that demand is slightly slower in the region that they operate in, which is NCR. We spoke to Prestige Estates. They said, no, demand is not a problem at all. They are a small player in NCR region. But it did indicate that if the pricing is a problem, there could be demand concerns in the industry overall. So everyone has to price their product really well. Oberoi Realty, where we are seeing a big reaction in terms of earnings today, down almost 7.5% as we speak because of a sequential decline, big sequential decline. They indicate 2026, they will continue to actively pursue attractive land opportunities. They remain optimistic on the year ahead with the new launches that they have in place and capital allocation policies as well. Even Keystone denied the fact that they are not seeing any slowdown in any of the segments that they are operating in. So largely the commentary has been positive, but the fear that there could be a possible decline in numbers going forward or growth patterns going forward is something which is worrying the street, especially when one of the listed players indicated there's a demand slowdown. We are seeing a ripple effect everywhere, and that's what we are seeing in markets today as well. In fact, now if we talk about Nifty Realty, which is at the day's low, Nifty also is at the day's low, and market breadth is firmly in favor of declines. So we'll be tracking all those market moves.
That's right. Not too much positive news flow coming in, especially when you're looking at the markets, the broader end of the markets, seeing even more pain. But we'll now slip into a short break. Up next, we will connect with the management of LTI Mindtree to discuss their Q3 numbers. Stay tuned.
Welcome back. You're still tuned into Midcap Radar. Well, while we're talking about the broader markets and what's happening on the Nifty level, let's take a look at what's happening with oil marketing companies. Budget is near and there are rumors, or at least there are talks in the analyst circle of a possible excise duty hike on petrol and diesel. JP Morgan has put out a note where they say that OMC stocks are up around 22 to 30% in last 1 year versus Nifty growth of around 10%. This is on the back of strong EPS upgrades, and we've seen a lot of notes come by positively on OMCs as well. Further upgrades depend on clarity on potential excise duty increases. So that is something that Street will be watching out for. OMC FY27 numbers will see a downside if there is a hike of ₹2 per litre on in terms of excise duty on both petrol and diesel, and earnings could see an upside revision if that doesn't happen. So all the fundamentals in terms of EPS revision now depend on whether or not there'll be an excise duty hike or not. So further hike is also dependent on whether crude prices stay at current levels and what happens with the rupee as well. OMC rally, according to JP Morgan, can take a breather if there is no clarity on excise duty hike. But of course, we can see excise duty hike out of the budget as well, because it has happened earlier, out of budget. So maybe around the new fiscal is the time when there could be an announcement of excise duty sometime in April. Revenue collection of the government has been below budget, and hence the government could raise additional funds via excise duty. That's the big headline that JP Morgan is trying to highlight. And they have downgraded HPCL to a neutral because that has the biggest contribution coming in from the marketing segment. Overweight retains on BPCL and IOCL, but this is the biggest point that Street will be watching out for. Not possible to see earnings upgrade till the time there is some clarity here.
That's right. And remember, later this you'll also see the earnings coming in for, and the GRM trajectory is something that the Street will look out for. Well, one particular stock that we could pull up is UPL. Remember, UPL earlier today highlighted that one of the subsidiaries, Advanta, is looking to go in for an IPO. Post that, however, there has been a sell on the news that the company has reported that particular stock has fallen to the day's low, down over 8%. The metal pack too now seeing a bit of profit booking emerge. Sale down over 2%. Within the mid-cap IT space, KPIT Technology is one particular name that's seeing quite a bit of selling pressure. But LTI Mindtree, remember, reported an inline set of Q3 earnings with the profit impacted by the new labor code. But the Street seems to be concerned on the high valuations. To discuss the Q3 results of the company and the outlook going forward, our colleague Rima caught up with Venu Lambu, CEO of the company, and began by asking him on the outlook for Q4 and the setup for FY27. Let's listen in.
It's been a great quarter for us. We delivered 3 consecutive quarters of 2% plus quarter-on-quarter growth. I think at the end of Q2, I did come and speak about our plans of coming nearer to the double-digit growth in the second half of the year. I think we are on the journey. Q3 gave us 6.1% year-on-year growth on the US dollar terms. As we go into the US, into the Q4, I'm reasonably confident of, coming, as close to the double-digit as we can. On that, and so the whole plan is to continue the growth momentum, and the pipeline is still strong. The AI traction is increasing for us. We have reimagined the capabilities, so all those things are going to aid us to continue the growth momentum for us.
Digit in FY27 also, Venu?
Absolutely. Look, I think we are working on a 5-year strategy, which I'll share more details by mid-March or end of March. As part of that plan, we're very ambitious growth plans. So, I do expect, if we can continue our, all the growth momentum and all the New Horizons program that we have launched, I find no reasons why we can't continue the same traction as we go into the FY27. Look, it's been, nearly 1 year for me when I joined back LTI Mindtree. This weekend, it'll be 1 year when I joined back as the CEO designate. I think, the first interviews I did, one of the things that I mentioned was how do we bring the growth, mindset and continued growth mindset in the organization. And I'm glad to say that all our transformation initiatives has produced tangible outcomes. And, and the market is what it is. We need to find areas of growth and be focused on that and deliver the value to our customers, and the growth will follow us.
We'll get to the details about the 5-year strategy in March when you outline it, but give us the end goal of it. By the end of 5 years, what would you want LTI Mindtree to have achieved in terms of top line and margins?
Look, I think, top line, definitely we would love to see to double our revenue. That's absolutely clear. I think it was already a stated aspiration when I joined, back in this company. So we're working on towards that plan, and margin also to improve from where we are today. So I'll share more specific details on that part in March, but directionally, how can we double our revenue, increase our margins, increase the value to all our stakeholders, and most importantly, be the AI-centric organization so that we can provide solutions for both in the AI infusion services and the AI native services to our customers.
Venu, one criticism of the quarter is that the growth was a bit lopsided. So BFSI, high-tech didn't do well. High-tech, in fact, has been declining now for the third consecutive quarter on a year-on-year basis. BFSI growth rate is moderated, while growth was led by manufacturing, which is seen as pass-through, and healthcare, the India deal, etc. So break up the internals for this quarter for LTI Mindtree, and when do we expect BFSI high-tech, which is majority of your revenues, to bounce back?
Sure. Look, I think probably that's not the right summary, I would say, because, we want to work towards a very balanced portfolio, and that's a journey we are in. With regard to the tech, if you recall, there was a productivity benefit that was passed same time last year. Hence, you see a year-on-year decline because we're going through the post-productivity phase. But what is most important, or the leading indicator in the business, is that are we growing sequentially, right? And in the tech vertical, we grow sequentially. We were flat this quarter. And it's a beginning of the growth journey for the tech vertical. So all the productivity journey that we had with some of our big clients in the tech vertical is behind us. So it's a positive trajectory from here on the tech side. And on the BFSI side, look, I think we're in a very, very uniquely positioned to grab the opportunity in the BFS space. I mean, we are the prime supplier for some of the top 7 global banks in the world. And each of these banks are going through its own AI, productivity journey strategy, and we are partnering with them to deliver that. So there may be a short headwinds with 1 or 2 clients for a quarter, but after that, I sort of suspect that probably will bottom out in BFS in Q4 and get onto a big growth trajectory from Q1 onwards. So it's a very short-term headwinds, not a structural headwind, if I may say. So in summary, we want to get into the balanced portfolio so that we don't have 1 or 2 accounts driving the growth strategy. We want to grow across all our accounts. The second is that the tech is, in the journey of growth. We're back to flat, sequential flat growth, which is the first step towards it. The third is that, we signed up with some of the big global banks as a prime supplier. So the headroom for growth is significant once we navigate the short-term, a quarter headwind in 1 or 2 clients with regard to the AI productivity that, we need to walk through them.
One word answer, 9-month margins are 15.5%. Where do you end the year?
Oh, it'll definitely be higher than last year. For the full year margin, it'll definitely be higher than last year.
By how much?
Well, I don't want to talk about specific numbers because we're still working through that, but I can assure you that it'll be higher than the last year.
Well, that was the management of LTI Mindtree guiding for high margins going forward, but clearly the high valuations is something that is weighed in on the stock. Well, we'll now slip into a short break. We'll get you more on the markets and stock-specific action on the other side. Stay tuned.
Welcome back. Earnings are coming in thick and fast. Nugent Software is the stock on our radar, down 8% as we speak. It's a sharp fall. The company reported numbers a while back. Net profits down 23%. The revenue is absolutely flat actually. EBIT is up 3% on a quarter-on-quarter basis. But do remember there is an impact of the costs coming in from the new labor laws. So that's one of the reasons why the profits have fallen YOY and on a quarter-on-quarter basis, and a sharp fall on the stock as well, down 9% as we speak. So we are seeing bigger reactions on earnings, even if there's a slight miss on the bottom line and on the margins as well. So that's about Nugent Software, but let's stay with the IT sector. Here's an exclusive from Davos. After stabilizing its operations over the past 3 years, Cognizant is shifting gears towards aggressive growth strategies with artificial intelligence and outcome-based pricing at the forefront. CEO S. Ravi Kumar also talks to Shireen Bhan about a potential secondary listing in India.
I would say the first 3 years was about stabilization, and the next 3 years is actually going to be about bold bets. In the first 3 years, we climbed up the charts, and on relative scale, till the end of Q3, which we have publicly announced our earnings, we are on the upper quartile, top performance on relative scale. So I'm very happy with where we are, but looking forward to the next 3 years, which is going to be big bets and bold bets.
You did publicly state that you are looking at the possibility of a secondary listing or an IPO in India. Where have things progressed on that front? How close are we to an actual decision being taken?
So, Shireen, we are working with the regulators in India. The last time something like this happened was many, many years ago when Standard Chartered did this. Right now, we will be the first company who is attempting this, which means we have the burden of actually helping the regulator to work alongside us to get to the finishing line. So that's a journey we have to go through.
How close is the finishing line?
I mean, look, regulators in India are very receptive for new instruments. This is an American listed company which has the opportunity to list in India as a secondary listing. I mean, that's what Indian companies did in the 90s. They actually listed primary in India and then they went to the US.
Yes.
We think we have a pool of investors in India who are very keen to invest into tech services. Tech services is a proxy for AI. We also think there's a lot of mutual fund money which is being fed from the middle class of India, the vibrant middle class of India. We think we can capture that opportunity for Cognizant and get a new category of investors. It's going to be a journey to do this, but we'll give it a try.
And what are the questions the regulators are asking?
I mean, there are a variety of things because this is the first time we are doing it, but they are in a constant dialogue and we are iterating, and it's very constructive. So I'm very pleased with all the meetings we have done.
And do you think 2026 could be?
Hard to say. I mean, these are things which is very hard to say, but we're going to give it a try.
Okay.
Well, that was the management of Cognizant at Davos with our managing editor Shireen Bhan. With that, it's all the time we have on this edition of Midcap Radar. MF Corner when we return.
afternoon. You're tuned into MF Corner on CNBC-TV18. I'm Vinny Motiwala. With me is my colleague Sonal Butra as always. Sonal, good afternoon to you. And we have so much that happens in the industry. I think that's what we're going to be focusing on today, though.
Exactly that. And we have a special guest to do that with us today and talk about the mutual fund industry, the trends that we are seeing. The guest today that we have on the show is Mr. Venkat Chalasni, who's the Chief Executive Officer at AMFI, the Association of Mutual Fund Industry. And we are going to be speaking about the industry trends, the outlook, distributors, and a lot more, how more concentration or how more distribution can happen for mutual fund products at a lower level. Thank you so much for joining us today, Mr. Chalasni. And there's so much to talk about with you. We did get the AMFI data as well recently. And from that, we did see some data come by. On that, I wanted to understand more about what B30 cities are doing now. That is one space where AMFI also is looking at increasing distribution. Right now, what's the contribution to the total AUM? The last known number was just about 15 to 18%. What are the plans to increase this proportion?
Yeah, good afternoon, Sonal. Thank you for having me on the show. You have taken a very important point as we speak now. The B30 cities contribute around 15.35 lakh crores out of the total AUM of 80 lakh crores. And that brings the percentage to around 16 to 17%. But having said that, we need to do a comparison. Let me put two data points for you to look at the B30 city contribution. One, the amount that we're talking about is coming from the individuals, while the total AUM that we talk about, 80.3 lakh crores that is there, it is both from individuals and non-individuals. So it's always good to have a better comparison between the B30 individuals versus T30 individuals, where if you take that as a percentage, as we speak now, the percentage comes out to something like 28%. It is one important data point. The second data point that I would like to also mention here is that if you look at the SIP contributions, you would have seen, I'm sure you would have tracked the data as on December, we had a record SIP inflows, which is around 31,000 crores. Out of this, 40% of this SIP contribution is coming again from B30 cities. So we have seen an improvement in the contributions that are being made from the B30 cities when compared to the previous period. But having said that, we are, as you rightly mentioned, there is an effort being made both by the regulators and by AMFI to ensure that the number of investors increase in the B30 cities. The first and foremost, from the regulator side, you would have seen that they have given the incentive structure. They have said that any new investor that is going to come from B30 cities, either in the form of investment in the form of lump sum or in the form of SIP, they would be given, the distributor will be given a compensation to the extent of 1% over and above the usual commission they get, but of course subject to a maximum of 2,000 rupees. This is an incentive structure that they have provided. The second important thing that we are trying to do is we are trying to increase the feet on the street. You know, the number of distributors are very less when compared to the other industry, if you're comparing with the insurance and others. Our number of the feet on the street is very less. So we have trying to increase the numbers. One, you would have seen recently we have entered into a tie-up with the Department of Post, where they have an extensive network, almost around 450,000 employees are there. We entered into an MOU with them. We are trying to train them, then make them write the NISM test, give the product training, give the platform training, and ensure that the number of the people who are going to market for these mutual fund products across Tier 2 cities and Tier 3 cities go up. So this is the second important thing that we have done. The third, of course, you are aware, I mean, the usual mutual funds AI, the media campaign that we do in order to increase the awareness. But more importantly, we are focusing now by adopting states. We have adopted 4 states, wherein we have entered into tie-up with some marquee institutions like IIM Visakhapatnam, IIM Bodh Gaya, IIM Shillong, and XIMB in Bhubaneswar, where they are going to train the trainers, and then they train the students, bring investor awareness over there. And indirectly, while we make the people understand, get the financial literacy, they in turn will take their informed calls and invest into various other schemes.
Right. Okay. Sir, while you've spoken about all these factors or points that you have taken into action over a period of time, B30 cities increasing as well, how do you view the rise of fintech apps offering, SIPs and mutual fund platforms as well? What is that, and how does that also fit into the role of increasing this penetration?
Fintechs are helping us. They are a very important integral part of our entire ecosystem. They are the ones, you want to do your KYC, onboarding of a customer. They make life so easy when we want to onboard a customer. Second important thing is, once you onboard them, then they would like to have an informed decision. You, the Gen Z, the youngsters, would like to see on the screen which one is giving a better returns, which schemes are good, which is good for my goals which I set up for myself. So they are providing enough information on a click of a mouse. So onboarding is made easy, getting information is becoming easier, and once you have an informed decision, investing, that is made also easier by making a click of a mouse. So these fintechs are helping us in increasing the penetration for the informed investors.
Taking this point forward, because you said it's making investing easy, that also means that people are going ahead and investing on their own. So that means direct plans now account for roughly 45% of the industry AUM. Is it something which is worrying you? Because investors in this case are not going for expert advice anymore. They are thinking DIY investing is the way to go. Is this okay, or is this something that you think is a worrisome sign?
No, Sunal, you have a very valid point. See, but again, when you talked about 45%, Sunal, there's the important thing that we need to look at is there are two types of investors that I have. The same point that I talked about when you asked me about B30. You have individual and non-individual. There again, I need to break up and see, because the non-individual, it is the corporates who are investing, they don't need any distributors. So if I remove them, then this 45% that you're talking about will become a smaller percentage with the overall AUM that we're looking at. But having said that, today, as we speak now, I have 5.8 crore investors. And you would have seen the recent survey which has been made by SEBI, which again talks about that 63% are aware of the securities. In that, again, they talked about mutual funds, where 53% are aware. But the number of households that are investing into the mutual fund space is around 6.7 or 7%. So there is a wide gap between the people who are aware and people who are investing. And therefore, the pie is big. I need both hybrid model, both the digitalization, the do-it-yourself customers, where Gen Z who are informed investors who do it. At the same time, there are millions of investors who need hand-holding and where distributors play a vital role. So it's going to be a hybrid model. It's not either or, has to be both.
Not either or, but it has to be both. But sir, we are reaching closer to that 100 lakh crore AUM, What are the factors maybe that could lead to the growth from here on? And could we expect this figure in the first half of calendar year 26?
No, we are also looking towards that. But one thing that I would like to bring to your kind notice and to our satisfaction is a SIP. The consistent contribution to the SIP, there is a constant growth there. It demonstrates the discipline of the investors. They are not looking at short-term volatility in the market. That's point number one. Point number two, the growth story of the country is intact. Even today, we have seen IMF coming out with a report talking about the growth story they have increased the growth GDP of the country. So the growth story is intact. And the markets, I hope that the markets will continue to do a favor, and there will be an attraction of FIs to come back. With all these factors, the disciplined investments, the growth story of the country, and the FIs coming back into this particular space. And there are a good number of tailwinds. Of course, there are a couple of headwinds that are always there, but good number of tailwinds are there. All these are going to support the market, and the number that you said is very likely to come in the first half of this current calendar year.
That will be a big milestone for the Indian mutual fund industry as well, right? And this is at a time when we are talking about more distribution going in, more participation coming in across the investor value chain. Very interesting insights, but we have to get into a quick commercial break. When we come back, we'll also focus on the mutual fund industry's key expectations from the upcoming budget. There's a lot to talk about more, so stay tuned for that conversation.
Fly Emirates, fly better.
Welcome back to MF Corner on CNBC TV18. We still have with us Venkat Chalasni, Chief Executive at Amphi, as well as now joining us is Rajshri Sabnavis, Senior Advisor, Tax Regulator and Consulting Ecosystems at Grant Thornton Advisors. And now we're going to be discussing the expectations that one should have, or the mutual fund industry has, from the budget this time. Rajshri, good afternoon, and let me start this conversation with you. Now, equity mutual funds are one of the most tax-efficient long-term products for retail investors. In this budget, what specific tax stability guarantees are you expecting from the government this time?
Thank you. Good afternoon. And I think one of the major asks would be to bring the debt mutual funds on par with the equity funds as well, because that's been a long-standing ask, at least for the past more than a year now, especially where if government is looking to strengthen the bond market, I think it will be good if they could take a relook of that. So either they increase the basic exemption from 125 to 2 lakh, which is available for listed securities, or at least look at reintroducing the indexation benefit.
That I think I would like to go to Mr. Chalasni for that, because, you know, since the time the debt taxation overall has been introduced, the general idea for this space has changed drastically. Have you made those representations to the government regarding bringing back the older taxation, or at least make some changes which makes this particular asset class more attractive?
Yes, Kunal, the most important thing, again, I agree with my friend who has just spoken. If you look at the way in which the markets have developed from 2019 onwards, the equity market space has grown phenomenally. But in respect of the fixed income, it remains static at the same level that it was there. What it was in 2019, we have the same level today. That's because this particular space has not become attractive from the point of the taxation, from the benefit of the taxes. See, and second important thing is today, the corporate bond market, there is a need for liquidity in the corporate bond market. And there is also need to make the retailization of the corporate bonds and enable the investors to diversify, not just into various other asset classes, and one of the most important asset class being the fixed income. So taking all these factors into consideration, we have again made a request for giving the long-term capital gains in respect of this fixed income. 2, we've also brought out the indexation benefit, which was there earlier. We requested that it has to be restored now. It enables, as I said earlier, it enables the markets to develop in the corporate bond space. Otherwise, it is totally focused towards an equity space as we speak now.
Absolutely, you know, that is some important points that you have made there as well, sir. You know, Rajshri, should long-term SIP investors actually get higher tax incentives than lump sum investors, maybe to encourage more of a disciplined investing, where we as a country want to increase the focus of everyone on investing, increase mutual fund industry growth as well, penetration there? Do you think this is something that is required?
See, I mean, as an investor, if we were to ask, then I would ask for everything, right? Like I would say my entire income bucket should be tax-free. So it'll be hard to make a distinction between an SIP and, you know, extending a benefit only for an SIP mode of investment vis-a-vis a lump sum investment. I would, in fact, you know, move the needle a little bit and say that as an investor, you know, when we look at, so the ask would be, instead of looking at SIP versus lump sum, let's look at if an investor is probably liquidating one particular fund and moving that money into another mutual fund, you know, all under the same AMC umbrella. Why not look at exempting that? So today there is a capital gains tax payable, but maybe that's something you may want to relook at, because what it does is it maintains the money still remains within the mutual fund setup itself. So I would, rather than the SIP versus lump sum, I would actually look at neutralizing this movement from, or what we say is swapping from one fund to another. Absolutely. All the same AMC umbrella, asset class, basically.
Absolutely, and that has been a talking point for a long time. If the money is moving from mutual fund to the other mutual fund, it's the same asset class, why do you have to pay capital gains tax for just switching your units from one particular asset class to the other, or one scheme to the other for that matter? Mr. Chalasani, what's your take on this? As Rajshri mentioned, you can't really differentiate between SIP versus lump sum. At the end of the day, the investors putting in money, they'll get returns. If not this, what are the other ways to incentivize an investor to put in money into equities or ensure that at least the returns are not taxed heavily?
Agree with this particular view. In fact, we are agnostic to the way in which you're investing. It has to be scheme specific tax incentives rather than amount that is being invested. So that it has to be tenor based incentive and scheme based incentive rather than looking at the amount, number of times that is being invested, whether it is in the form of lump sum or SIP. So I'm fully with that view. And second important thing is we have made a similar pitch asking about that whenever these switches are being made, the long-term cash should not attract long-term capital gains, because for the simple reason that the entire amount that is going to be reinvested, they will have to pay the tax for whatever gains that have been made. In fact, in any case, they're going to pay at the end of the tenor. So that again, that request has been made along with our various other requests that are put forth in this particular budget.
Rajshri, there was an ask that came in to get a debt-linked incentive saving scheme, right? Like the equity one. Can we safely say that may not come, since we are talking about now the new tax regime having lower rates? What are your thoughts here?
So again, here I would say that the government has taken a step forward in terms of making it a little bit more simpler from a tax regime standpoint, right? So moving to the new tax system, i.e. do away with all exemptions, let's do away with all litigations, let's do away with disagreements, difference of opinion, etc. So if we were to stick on that path, I would say rather than introducing a debt-linked saving scheme or a deduction for that, why not look at making mutual fund contribution, bring that on par with national pension scheme? So today there is a benefit that is available to every taxpayer for any contribution that goes towards the NPS. Can we widen that net to include even the mutual funds contributions as well? So I would rather, again, move the needle to and point it more towards this aspect.
Take that point, Rajshri. Mr. Chalasani, we are very short on time, almost just like a minute left. Can you quickly tell us if you agree with it, or the debt-linked savings scheme is still a priority?
We did request, as I said, one of the important aspects that as we speak now is to develop the corporate bond market, is to develop the fixed income market. There is total concentration on one particular segment, so we need to ensure that it expands. So DLSS is one of the points that we did request. At the same time, we also had made a request saying that people who are going to invest into infrastructure bonds, if a scheme mutual fund is going to invest into these infrastructure bonds, again, the concession or tax benefit should be given. That's something that, again, we are looking for.
Okay. Thank you so much, Mr. Chalasani and Rajshri, for joining us today and taking us through your budget expectations and for the mutual fund industry overview as well. With that, we'll do one thing. We'll take your leave on this edition of MF Corner, but stay tuned for more market action closing bell to take you through the last hour of trade.
Welcome to our special coverage here from Davos 2026. I'm Shireen Bhan. As I've been pointing out, this year we have the largest representation of Indian states here in Davos pitching the India story. But perhaps the first Indian state and the first Indian chief minister who made a pitch here to investors in Davos way back in the day was Chandra Babu Naidu and the state of Andhra Pradesh. And of course, they are Davos regulars. Joining me now for a conversation here in Davos on what the future for the state holds, the deals that have already been done, but more importantly, the conversations that are open and are hot. Joining me is Nara Lokesh. Nara, many thanks for joining us and great to have you back with us here in Davos. You know, you did do a lot of deals, not in Davos last year, but outside of Davos, but on the back of conversations that may have happened here in Davos. So I know Davos is not about deals for you, as you say, but it's about conversations. So which conversations are looking likely that they will lead to deals?
Thank you very much for having us here. It's always good to be back. No, Andhra Pradesh views Davos twofold. One is we're here to learn, we're here to understand what are the sectors that are hot, how things are going to roll out, where are investments flowing into. And last year we started a lot of conversations across various sectors here, and you've seen announcements, groundbreaking, and so on and so forth already. So a lot of conversations have started. You'll hear good news in the next 90 days.
In the next 90 days, that's a specific time frame.
Absolutely. In Andhra Pradesh, we are all about speed of doing business. So for us, 90 days is good.
What should we expect in the next 90 days across which sectors?
Across.
Because you have many economies that you're focusing on, from the maritime economy to, of course, the digital economy.
No, we have close to 22 clusters. So ranging from aqua, cement, renewable energy, all the way up to quantum. So we're looking at investments across all these sectors, across 22 clusters. So that's something that makes it exciting. And Andhra Pradesh is very cluster dependent. So we're very clear that all the companies of a certain sector should be in one cluster so that they can stand the test of time and make economies of scale meaningful. So that's been our focus. So you'll hear good news soon.
Okay, good news and a sizable investment amount as well, just as we saw with Google.
See, Andhra Pradesh just came out of the partnership summit. We worked with CI. There have been great announcements. We're now busy grounding all these announcements. And it's an ongoing fight, right? I mean, when states compete, India wins. And it's really exciting time for India, where now we have close to 10 states here in Davos. And all of us are competing in different sectors. So it's very exciting.
Well, when states win, India wins. That's a nice way of putting it. But, specifically as far as your ambition on AI, your ambition on creating a quantum valley, etc. What can we expect now in terms of next steps, in terms of the next stage of announcements on each one of these?
No, I think, one is the high-tech industry, right? Yes, quantum, India's first 153 qubit quantum computer is going to land in Andhra Pradesh.
I believe this month.
This month, yes. And a lot of work around it is already gone in. We're working on the use cases for it, right? And that's been a lot of work already going in. Apart from that, we're also looking at sectors like even glass. How can we build a glass city, a space city, a drone city? So if you've seen, Skyroot has made a big announcement in terms of building a center now in Andhra Pradesh. So that's where, these 22 sectors are very, very important for us, very focused in terms of delivering. And a lot can happen over a cup of hot chocolate. So that's what we
How many cups of hot chocolate have you had?
So a lot can happen, and we've done it in the past. The entire conversation with Cognizant started here in Davos. Started with 8,000 employees committed, and now it's up to 25,000.
Did the conversation with TCS happen here in Davos as well?
Yes, in Davos, and really exciting in terms of new
How many more takers for that land policy and the IT policy that you've got in place?
The lift policy is very exciting. I think it's a very unique competitive advantage that we have built, where other states are unable to compete with us. It's open to Fortune 500 companies, and that's why I said in the next 90 days you'll hear a lot more announcements where companies are going to leverage on the lift policy.
On the lift policy specifically. So any more out-of-the-box ideas like the one that you announced where you're virtually giving away land for a rupee?
Well, that's just one part of it, right? So land is an important component, but it is one component. As a state, we believe in a very tight integration in our clusters. So a vertical and horizontal integration. Now, what I mean by verticals? What does it take to make an end product? Who are all the players in it? So I want the entire Rolodex. I'm building that entire ecosystem done. That's the vertical. The horizontal is where, again, my ministry, Human Resource Development, plays a very important role. Is the talent pool there? Is it ready from day one? Are the testing facilities there? Are the certification facilities there? Is there the innovation ecosystem in that sector there? That's where this tight integration is something that Andhra Pradesh is offering. We already manufacture 50% of India's air conditioners. And with the 3 deals we have done, we'll be at 70%. So we have to do like this, a very tight integration across sectors.
So which clusters? You just...
Well, those are conversations from Davos, and we'll keep getting to it. For now, we've got a market to trade, 1 hour to go, and it's been another very weak session for our markets. Lower for the second consecutive session. No level is sacrosanct. Today, the Nifty is breached 25,400 mark on the way down. It's a good 200-point decline seen on the Nifty. For the Sensex, it's nearly a 600-point fall. And the problem is the broader markets and the way it's collapsing now. We've got the Midcap index down close to about 1,400 points. The Nifty small cap index will also come up for you on your screen. It's also down nearly 2.5%, and that advanced decline ratio at 1:7. No sectoral index is currently in the green. It's a broad-based sell-off that we have at our hands right now. And the Dow futures will be reacting for the first time to the escalation seen with respect to tariffs in Greenland, annexure, etc. Europe was down 1.5%. We'll get the early rates in Europe. But the Dow futures is still down close to about 500 points.
Equity markets is not the place to be, it appears, Rima, in terms of investment. Just take a look at gold and silver. They're making fresh highs yet again. I don't know who's buying silver at these prices, even gold for that matter. But one way up, and the only way to play it, I think, from a listed space is Hindustan Zinc, which tells you why. That's one of the few stocks that are trading in the green. But exciting 60 minutes coming up. We'll get you a lot of market opinion. And keep in mind, we have the weekly expiry as well to play out. So let's see whether or not, at least in the near term, that can provide some kind of support, or in fact, we see a bigger breakdown in the last 60 minutes. That said, let's welcome Mitesh Thakkar onto the show. Mitesh, you have been sounding a little bit skittish. We're trading below that 25,400. The problem is there's no kind of intraday big 50-60 point bounce as well. Your view?
There's no audio. I can't hear you.
We can you hear us now? Am I audible? Nope, not audible. All right, so we'll wait by. Go back to Mitesh as we get that fixed. A couple of stocks, though, in the last few minutes that have tried to bat for the bulls. Steel companies, they're cutting their losses. You have JSW Steel that was down 2%. Now it's down close to 1%. Some measly recovery is what we are seeing. The big boy is HDFC Bank. Because that's trading in the green, that's where we're down only 200 points. If that was down in line with the market, we would have been down far more. And from the broader markets, Hindustan Zinc, that's the one that's flying away. Beautiful move on that particular name, currently at the high point of the day. Mitesh Thakkar is back with us. Mitesh, I was asking you, what's the trade on the index? I think the 25,400 mark is what you were looking at. Now we're around those levels, but there's no kind of intraday bounce that we have seen so far. Would you be brave enough to go ahead and buy the Nifty at current levels? Or do you think you'd rather go in closer to around the 200 EMA, which is close to around 300 points away from here?
Good afternoon. So I think, this is a very important support zone, this 25,400 to about 25,330. And we've kind of come off about 30 points off the low. So let's see, we still haven't, as you rightly said, we still haven't got a signal of a proper reversal or a proper bounce back. But given the fact that this range is not violated on the downside, I think that could happen later in the day. Let's not forget today is also expiry day. So the last 40-45 minutes could be slightly different than what we have seen. But for the timing, since there's no sign of a bounce back, I have a sell call on Ashok Leyland. Sell with a stop at about 185 for targets of around 171. And Aurobindo Pharma is the sell as well. Keep a stop at about 1161.5. Look for targets of 1110.
Anything on the Nifty Bank? The Nifty Bank is also attempting a bit of a recovery. And as we speak, I think it's managed to claw above the 20-day moving average. So the Nifty's Bank now closer to 59,600. The 20-day moving average is 59,550. So it's trying to just, put its head above that level. Mitesh, is that... because even ICICI Bank has managed to get back into the green, Kotak Mahindra Bank, HDFC Bank, Nigel spoke about. Anything?
If somebody has to take, and since again, there is no sign of a reversal, is it? It's just bouncing back from support. I think between the two indices, if somebody has to take a trade, I think the Nifty Bank is more appealing. Just keep a stop below today's low, which is roughly about 110 points lower from here. And a long can be taken, and on the upside around 60,000 is where traders can look at taking some profits.
Okay, all right, got that. Mitesh, you want to give us a few more stocks?
Yeah, I gave Ashok Leyland and Aurobindo. I think that's about it.
Got it. All right. Thanks a lot, Mitesh, for that. Well, let's give you a quick recap then in terms of what's going on in the F&O market. The Nifty is at a 3-month low, and we're clearly the structure on the Nifty is very, very weak. And once, we broke that 25,500 odd mark, we've seen a bit of a slide. Now, the important point is the 20 DMA. That comes in at around 25,100. That's the last support level you have in terms of technical levels, which is going to be a very, very important level, and you don't want that to breach. Otherwise, you're in for a deeper correction. The Nifty, well, that's moved down, but the Nifty Bank, that's the one that at least is defending the 20 DMA as well as the 50 DMA. The 50 DMA is closer to around the 59,100 odd mark, and the 20 DMA is at around 59,500. So at least for now, it's defending that band. The PCR, that's come to the lower end of the range. And we've seen in the past at the lower end of the range. 0.62 is when we have normally seen a bit of a bounce. For today, we need to get through the expiry as well. But normally 0.6, 0.62 is when you at least get a relief rally. It may not be a bigger bounce, but some kind of relief rally. For today's session, the call writers are having a blast. Take a look at the 25,400 call. The premium is down close to around 92%. Last I checked was only around 15 rupees. So massive writing is what we're seeing out there. The bulls believe 25,500, that level is now becoming the new resistance mark. On the downside, the 25,350 put, if you bought it yesterday, you bought it at around 7 rupees approximately. Today, in fact, it's moved up a little bit. Currently, it's more or less flattish because now the time value of money is eroding the premium out there. Around an hour or so ago, it was at around 16 rupees. Individual stocks are unfocused. You just look at a couple of these reactions today, and that's telling you the mood of the market. Havells, the numbers weren't so bad. You could have easily said that the numbers are pretty okay. But the stock is down. There's massive shorting that we're seeing on that one. UPL, you were waiting some kind of value unlocking out there. And you said, well, the company should do well today. Stock is down 7%. Massive unwinding of long positions is what you're seeing. But thank God for a couple of stocks. HDFC Bank, that's seeing some fresh buying. That's holding one end up. And Dalmia Bharat as well. I was just reading a note coming in from Nomura. They are talking about, East outperforming from here on. And in an otherwise weak market, Dalmia Bharat is one of those stocks that are actually doing well. A few sessions ago on Bazaar, we were discussing that cement could be the sector to look at just in the near term because it's a domestic play. There are signs that pricing is improving a little bit and demand has been very strong. So that's one of the few stocks. Net, weak-looking screen. We're playing out weekly expiry today. That 200 DMA, very, very important on the downside.
Indeed, that's at 25,100 approximately. But let's go across to Shireen now, who's in conversation with the TCS MD and CEO, K. Krithivasan, at the World Economic Forum in Davos.
Welcome back. You're watching our coverage here from Davos 2026. I'm Shireen Bhan, and a company that has the ambition of becoming the world's largest AI services tech company, TCS. That's the message that it is signaling to the world here in Davos. Joining us now to talk about that ambition and its plans going forward is the man in charge, K. Krithivasan. Krithi, always a pleasure. Many thanks for joining us here in a very cold Davos. But, let me start by asking you, Krithi, and the question everyone's asking is that, is there a shift that's now taking place internally to speed up your ambition, but more importantly, your aggression? And I'll back this on 2 data points. The 700 million acquisition that you did, as well as the deal that you did with TPG. Is that an indication? Is that a sign of your animal spirits coming to life?
Definitely, Shireen. First of all, good morning or good evening to all your viewers. It's definitely what we, like you said, about 4 or 5 months ago, we looked at what should be our destiny in this. We said we have to be the world's largest AI-led services company. And then we have to back it up with certain actions. And we defined 5 pillars towards that. One obviously is how do we transform ourselves internally, how do we transform the services, how do we transform what we do for our customers. And the 5th pillar is how do we broaden our scope in the overall ecosystem. So that's where our interest in both building capability at speed and scale through mergers and acquisitions, and also expanding the play with the AI data center, by which we are able to provide end-to-end capability to our customers. That's what we call infrastructure to intelligence. To our customers, we can service them across all layers of AI. Okay, we have offerings to them in front if they want infrastructure, if they want hardware design, if they want model as a service, if they want agentic AI capability or experience, right? So we can provide end-to-end. So that's the underlying philosophy through which we are approaching it, and that's what you are saying, some of the initial actions that we have taken.
You know, so this ambition of positioning yourself as the world's largest AI tech services company, I mean, who is currently the largest and who do you displace to become the world's largest? I mean, what does this mean exactly?
See, that's the reason. I don't know who is the largest, but everybody is at it and everybody is trying to be a pioneer. But we believe that setting a goalpost and vision for us will drive us every day, and more importantly, if you look at compared to year before, last year there was still a lot of people wondering where is AI going, is it delivering real business benefit, and this year there's a very
No, but I'm just trying to understand, when you talk about the world's largest, what is the metric? I mean, you know, it's clearly not going to be people, revenue, I mean, what are we talking about?
This is the question. See, we define 5 pillars. Within 5 pillars, there are a number of sub-activities or sub-tasks we have defined for ourselves. So we'll keep measuring at each one of them for our internal purpose. But first time last quarter, we also declared what is our AI revenue.
Yeah.
Okay, so we continue to measure our AI revenue, how it grows. So all of them put together, like number of people, revenue, the partnerships we have, how are the analysts positioning us in this game, or it will be a composite metric.
You know, there's a debate on whether or not companies should actually report AI revenue, since everybody now says everything is AI. So whether it makes any sense to give a separate AI revenue line or not, people like Accenture not doing it anymore.
See, there are 2 dimensions. Everything is AI. For us also, it's true, like whether we do application development or whether we do business process outsourcing, there is an element of AI involved. But there's also element of AI involved, like if I'm reimagining the claims processing of my customer, insurance claim processing, how am I reimagining it using AI? Okay. There are things that cannot be done without AI. So there are things, for instance, we are doing a large migration from a mainframe to modern technology. Such things cannot be done without AI. So we have defined specific guardrail on what we would call as AI revenue, and we will stay disciplined, and we are going to be reporting that revenue. And of course, we are also training. Last quarter, we conducted a hackathon that involved about close to 300,000 associates over a 4-week period. All of them were immersed, they gave ideas, and then they built one of the largest in the world. So there are multiple things happening, and every one of them will take us towards the direction of being the world's largest.
You know, let's understand also what this means in terms of new bets, because as you pointed out, whether it was the acquisition, $700 million acquisition that you did, or the deal that you did with TPG, what can we expect on both those fronts? More deals like that likely for you?
Definitely, we are looking at where are the areas where we want to build capabilities, as I said, at speed. And with that, we have lined up a number of opportunities we are looking at. As they materialize, you will hear, but it's not that I'm going to be announcing 10 of them next quarter or anything, but we are looking at number of opportunities, but definitely we are more acquisitive than before.
More acquisitive than before, so how much could inorganic growth then provide a bump up as far as...
We are not looking at sharing, like we are not, as I said, looking at inorganic growth as a revenue driver. Inorganic growth, as I said, is the ability to build the capability at speed and scale. But the revenue driver will be the synergy that we build. How are we able to leverage the larger TCS ecosystem and use the capability that we acquire to deliver benefits to our customer? We are not acquiring to increase our revenue.
Okay, not acquiring to increase your revenue, but let's talk a little bit about associates, because you've seen a fairly significant headcount reduction of 30,000 that you've already announced. Now, what are we given to understand your workforce could potentially look like going forward as you accelerate your ambition for growth?
Again, we've been reiterating this. AI is not taking away the jobs at this time. We are continuing to find, in fact, we look at what we are doing in the market. As much as you see our headcount reduced. By previous quarter it went down, I think, by 20 and now by 10. But otherwise we have been hiring a lot in the market. And we also announced in the market that we want to have a future ready workforce. We provide all the ability and the support for our associates to learn and become proficient in these new technologies. There are few associates where we find like they may not be fit or ready for the future that we are charting for ourselves. We are providing them all the support and they are releasing some of them. But otherwise we continue to hire from the colleges, we continue to hire from the market, we are not stopping hiring. So as I said, at this time we are not looking at AI shrinking our workforce at all.
What is the average revenue per employee today? And on the back of all the AI productivity gains, what do you anticipate that to be?
See, Sharon, we have not been publishing the revenue per employee, but you can calculate, like we've been giving all the numbers. And it will increase slowly. It's not a big increase, but it will show an increase over a period of time.
Well, what about growth? You know, all of this is ambitious. It's a plan that you have for the future. But in the near term, Kriti, growth has been a challenge. You have, of course, been lagging behind your peers as well. When do you see the mojo returning in the near term?
See, we are taking all the steps. We are very confident and we are not losing market share. We are winning enough in the market. There have been, so last year we had situation, that is FY26, we had situation in one or two verticals. We had announced that we had a one-off issue. And there were some verticals, overall the vertical sentiments have been low. But overall we are very confident and comfortable with the situation we are in, the kind of order book we have, the kind of deals that we are winning in the market, we are comfortable.
So let me end by asking you, in this pivot that you're making, where do you believe you find yourself today? And at the end of this calendar year or of the financial year, next financial year, where do you believe you will be positioned in terms of outcomes that you can share with us?
I don't want to put an outcome at this time, but as I said, we have definitely made a significant progress towards our journey to be the world's largest AI-led services company.
Okay.
That will be visible for you.
That will be visible a year down the line.
Absolutely.
That you're committing to.
Yes.
Okay.
Absolutely.
Kriti, always a pleasure. Many thanks for joining us here in Davos on CNBC-TV18, and we look forward to hearing more from you as you unveil more of your plans on this effort going forward. Thanks very much for your time.
Take care. Bye-bye.
Good to see you. Well, with that, it is time for us to take a quick break. The conversations will continue. Don't go anywhere. Back in a moment with plenty more. Stay tuned.
Welcome back. We're below 25,350, now extending the fall to a 250-point cut. Remember, this is also the Nifty weekly expiry. 40 minutes to go to wrap up what's been a very tough trading session. Jigar Misri, co-founder Buoyant Capital, is now joining in. Jigar, it's been 12 trading sessions so far since the start of the year, and we've been in the red for 8 of them. And this was the year when we were supposed to reverse some of last year's underperformance led by earnings momentum. What has happened? If you could just, lay out the setup for the markets from here.
Right. Good afternoon, Rima. So I think, there are two-pronged problems to this. One is sort of what's happening with the trade and related issues. And secondly, what we reckon is the central engine of India's growth coming under some bit of scrutiny. On the trade and related issues, on the face of it, it looks like a livable problem. You export an equivalent of 2% of GDP worth to the US. And if you assume half of that gets taken out for 6 months, a 50 basis points impact is not that material on GDP. However, what it does to the rupee is something that needs to be looked at, because we are now running a serious current account deficit at a time when FIs are selling and FDI is almost net zero. Right? So BOP is negative as well, and it's a vicious sort of circle we seem to have entered in. FIs will not enter unless the rupee and the overvaluation is taken care of, and rupee won't be taken care of until we have a trade deal, and therefore it's gone into a circular spiral, which needs some jolting out. In absence of that, or while we wait for that, the central engine of India's growth was the fact that center plus state plus PSU capex was growing at a very fast step, incrementally. And I think we've spoken about this at length over the last year, is that we are finding states are doing a lot more social spending compared to the capital spending that they used to do. And the central government, for the first time since COVID, is finding itself short of revenue to continue doing capex. So we are expecting the capital spending bill for this fiscal year as well getting slashed. If the central engine of growth, which was pulling up India's GDP higher, is slowing down, then you're seeing the impact of that in the quarterly numbers as well. It takes transition for an economy to go from capex to consumption, and we are not there yet. So I think if you combine both those events and then overlay flows on top of it, apparently FIs have sold, promoters have sold, companies have raised money, and the singular buyer is equities, which is singular buyer, is retail through mutual funds and retail direct. Now, traditionally, you would have seen, SIP slow down after a year of underperformance, but this time around, even that is not happening. Otherwise, it would have been a much faster burn compared to the slow burn that we seem to be witnessing. So I think if the market sort of comes to a level where valuations become attractive, and we don't think we are there yet, especially in the small cap piece, I think it's sort of something that we'll continue to expect for the next few months as well.
Jigar, give us a few basic details. As you said, economics are not turning in favor of us. In fact, with the rupee weakening, it's putting us into a bigger problem. And also, we did have a good run, and now we're paused for breath. The question is, how low can we go from here? First, on the headline index, you're clearly telling us that in the broader markets, there is signs of frothiness. For y'all, how much cash are you sitting on? And how much do you think the headline index can correct? Because I think a month or so ago, everyone was talking about at least the headline index holding its own. And now we've corrected close to around 1,000 points from the recent top.
Right, Nigel. So while that's not very visible, but more than 60% of micro caps have fallen more than 25% from their highs. More than 20% small caps have fallen 25% from the 52-week highs, even in the previous case. So there is some amount of froth that has been cleaned out. But as I said, if you are going to see a situation where, the flows are holding the ball up, and if flows become challenging, then you will start questioning almost everything. To the second part of your question, as a fund, Nigel, we don't believe in owning a lot of cash. We prefer to lower the portfolio beta through our aggressive and defensive stances. We have been defensive for a while now, as you would have gathered over the last year that we have been having the conversations. We are still not there yet in terms of dialing the risk up, in our opinion. So it's a wait and watch even for us at the moment.
Some numbers you said for small caps, valuations need to correct a lot more. Can you break that up, sector by sector? What are the growth prospects? Where are the valuations looking high, especially in the small and mid-cap universe?
Rima, so see, just before I answer your question, let me give you one more statistic. In that, see, more than 81% of the demat accounts operational today have come in post-COVID. Now, obviously, it's not a seamless one-way move up, but they have seen between 25 and 32% growth CAGR returns in Nifty. They've seen between 40 and 52% CAGR returns in small caps, right? And that was the expectation with which a lot of this money came in. And obviously, you could show them a lot of data that 5 or a 10-year rolling return on large cap or small cap index is around 13%. But unless people sort of experience it themselves, it's not going to come to a reality check for many of us. So that transition away from a 30% expectation to a 15% expectation will take its volatility along the way. And I think that's what we are experiencing today. To your question on where do we see the growth and value emerging, again, if you're positioning the portfolio to deliver sort of 15-17% returns, then a lot of sectors become very interesting. Now, we calculate that about 6 lakh crores, or roughly 1.7% of GDP, has moved in the hands of people away from the government coffers, state and center combined. That money is slowly getting sort of deposited into the bank. You're seeing the latest data for deposits grow. And clearly, that is one place where almost all the sort of ducks are falling in row. So deposit growth is happening. It looks like we have already seen our last rate cuts, and if not, maybe one more. So NIM compression is behind. Asset quality is largely okay. And essentially, all the cycles are working okay. So financials is one sector which I think clearly stands out. Over the last 12 months or so, besides this, we have increased allocations to consumer discretionary at first, increasingly staples as well. And outside of this theme, I think pharmaceuticals continue to be our largest picks.
Jigar, what happened to the first love? Metals? What's the view out there, Jigar? You have seen many cycles like these. But this seems to be, quite a run that it's had. Talk about the index under pressure. And metals is normally high beta. But it's in a world of its own. There's plenty of excitement. I don't know when's the last time you saw Hindustan Zinc rally like this. Obviously, there's a float factor there. But Vedanta, even on bad days, we're not seeing the stock collapse. Telling you that the street believes this metal cycle still has more legs to run.
Absolutely, Nigel. So one part of the story here clearly is the supply shocks we are likely witnessing. Copper complex is the first to give way, and we take Q as that being the barometer. But besides this, as we discussed, I think was it last month when we said that this is not just a play on the demand supply of individual commodities, as much as it's also a play on where people think dollar is going. Now, given that the Fed had printed almost 8 trillion worth of dollars since the GFC was not enough, they're using power across media, across spectrums in a way where increasingly this is getting yes, there's only one alternative, but we might as well explore others. So every country is trying to de-dollarize in its own way. If you are India, you'll do it through, say, gold and silver. If you're China, you'll do it through commodities. And there is also a factor where any limited supply commodity, when designated in a fiat currency, most notably the US dollar, will be inflationary over the time to come. Now, these are sectors which a wide gamut of people didn't like to own, and therefore there was always under ownership getting into that rally. But I think, that's a place that we have had significant exposure, and we continue to like a few of those names, Nigel.
Thank you. We leave the conversation here for now. The Nifty is hurtling lower now, 260 points down. Jay Bala of cashthechaos.com is now joining in. Jay, now it's more than 1,000-point rally from our all-time high levels of 26,373. More than 1,000 points. Just in the near term, in the broader term, over the medium term, you've given us the key markers on the way up, on the way down. But just in the near term, with this kind of a momentum on the way down, stocks are falling with very large volumes. Where are we headed?
Hi, Rima. And like I pointed out last week, the markets have a good possibility of going lower back to the August low of about 24,400, or maybe even slightly below that. So this is not something to be worried, in my opinion. We are still bullish on over the medium term. Once that decline is complete, I'm anticipating the market to resume its bullish uptrend. But so we have to stomach a little bit of headwinds in the short term, and this turbulence is par for the course from a technical perspective. As far as interim supports go, it's about 25,100. That's the important level for me. So because there are multiple possibilities for the markets in the short term, and none of it has an edge over the other. So if markets don't hold 25,100, then what I think is the base case, which is markets going back to the August low of 24,400 or slightly below it, I think that's going to play out. If 25,100 holds and the market can reverse from that, there is an alternate scenario that plays out that says that this dip is an even shallower dip than what I anticipated.
Okay, all right. Hi, Jay. We're no stopping the Nifty. I think this has an expiry-related factor that's playing out here. The 25,300 is gone decisively now. I think we have gone down to around 25,280. Jay, that said, the Nifty Bank, that was doing quite well. But in today's trading session, it's just marginally breached that 20 DMA. What's the view on this one? Because it's been outperforming. And I think it's still, only 1% away from the recent high that we saw. So can this bat for the bulls?
Yeah, it does look like that for the moment, Nigel. As long as the index can hold above 57,629, I think it's in a much better place than the broader markets, and so that's an important support level for me. But there are alternate scenarios that once 57,629, if it were to get breached, I think the markets would still be coming back to its major trend. But it may not be the banks that may be leading the markets. It could be autos and some other sector. So, but I don't think at the moment there is threat of this market dropping below 57,629. So watch 57,629 as an important support.
Okay, but just one quick question, Jay. For the time being, we were worried about the Indian markets and we were underperforming. What's the risk that the mother market corrects itself? The US markets, they've got used to any kind of dip gets bought into over there. But is there a risk in the US markets, NASDAQ, S&P, or do you think that the mother market continues to hold its own?
There's a greater possibility that the US markets continue to hold. Watch the December 17th low on all the big indices, NASDAQ, Dow Jones, and the S&P. As long as the indices stay above the December 17th low, the markets aren't in a risk of going much lower. But even if that were to break, there are two alternate possibilities at the moment. Either the markets are going to fresh record highs straight away and holds the December 17th low, or it goes back to revisits the November low as the Nifty revisits the August lows, and then all start resuming higher post that. So for the US markets, December 17th low is an important level. I don't recall it exactly for the S&P or the Dow Jones. But I think that will hold, in my opinion, the probability of US markets going high, making fresh all-time highs sooner than later is more probable. But yeah, it's just a slight edge though.
Just to put India's underperformance in context, since the start of 2026, and it's only been 20 days, in trading days probably 12, the Korean markets are up 15-16%. The Taiwanese markets are up 10%. The Japanese markets are up more than 5%. But India is down 3.5%. And in dollar terms, if you look at the rupee rupee depreciation, it would be a much larger fall and underperformance versus the emerging markets. Last year's trend of 2025 of India's underperformance has continued, at least in the start of 2025. Jay, but are you getting a sense of some sort of capitulation seen in the broader markets, in the mid-cap index going by the 1,400-point fall, and any stocks that you can identify where you are seeing a lot of momentum or they've broken some of the key support levels?
See, Rima, at this point, it's a bit difficult to play the market on the short side or the long side. But I have one short pick for the day. But be very, very measured in your approach here. I have a short call on Bank of Baroda. Bank of Baroda with a stop loss of 314. I'm anticipating it to drop to 276. See, once the Nifty were to break 2,500, possibilities that we are straddling, two possibilities. One of them will become more obvious. So once 2,500 breaks, we can get more aggressive on the short side, but that's only for the short term. So even the taking short position at this moment is a bit of a dicey call. But this is the clear call that I have for the moment. But again, it's not without risk. Nothing is without risk. But I anticipate things to get clearer when the markets either holds 2,500 or breaks 2,500.
Okay, all right, Jay, thanks a lot for joining in and giving us that view on the index. So maybe some downside in the near term. That 25,100 extremely important as per what Jay says. Otherwise, there's a possibility we go down to around 24,400. Slip into a short break, come back. As always, our technical experts will be back with us. Nowhere to hide. Markets continue to get a bit of a pounding now at the low point of the day. Midesh Thakkar is back with us. Midesh, you have some individual trading calls?
Yeah. So STBT on Concor, which is Container Corporation, the stop at 504, target of around 490. And I'll still give one long call, BTST on Dalmia Bharat Cements. That's still trading well with a 2% gain. So take a stop at about 2185, look for targets of 2225.
Okay, got that, Midesh. Let's take the discussion forward with regard to Dalmia Bharat then. Nuvama, well, they expect the Eastern cement market to outperform in FY27, which will be driven by a sharp pricing recovery after a steep correction that we've seen. They go on to point that over the past week, key cement players in the East India, they have begun pushing price increases as non-trade prices have already moved up and trade prices are expected to firm up further, which is supported by strong demand. It's important to note that actually the eastern region saw the sharpest knock on a quarterly basis. Pricing was down by roughly around 15 to around 16%, though part of the decline was because of the GST cut that we saw. And we did see demand as well was not very, very great. So East got the hardest hit in terms of pricing. And now Nuvama believes there's a good case that we see a recovery. Nuvama believes that the cycle now appears to be turning, particularly for the eastern players. Dealers, they are anticipating a 20 to 40 rupee price hike over the next few weeks across select eastern states. At the same time, demand as well, they point out, is showing early signs of recovery with, while regional realizations remain at cyclical lows, they're also saying that this calls for a strong rebound. Nuvama, Nomura, they expect a meaningful price recovery in the first quarter of FY27, with the East leading the upcycle. As a result, the companies with higher exposure to East region, well, they are best positioned to benefit. In particular, Dalmia Bharat as well as Nuvama, both of them stand out. That's why they've upped their target price in both these two names. And in fact, on Nuvoco, they had a sell rating earlier, a reduced rating. Now they have a buy rating. Those target prices as well come up for you. So, Rima, at least a couple of brokerages are positive on select spaces. From the cement space, Nomura has come out with this note, and they're positive on the eastern players that otherwise were lagging.
But right now, I think the specter of tariff tensions escalating are hurting global markets, and it's risk-off across the board. Pull up the European markets, we've got the early rates and 1.5% down on the CAC, DAX and the FTSE. And this follows Monday's trading session when, again, the frontline European indices were lower by approximately 1% or sometimes in excess of that. So Europe continues to see follow-on selling pressure. Dow futures, the last time I checked, was down close to about 500 points. Remember, Trump has threatened to slap an additional 200% tariff on French wine and champagne after France's president reportedly was unwilling to join the Board of Peace on Gaza. So just this rhetoric is hurting and causing a risk-off across global markets right now. For the Nifty, now 25,250 has also breached. Just in the last 30 minutes, we've seen 100 points, incremental 100 points being taken off the Nifty. But SRF numbers are flashing for you on your screen. At the bottom line, there looks to be a beat, 432 crore of a profit number, higher than expectations of 382 crore. So looks like a beat of 10 crore. But the market mood is such that SRF is still down 1%. We'll wait for the internals. Dr. Reddy's also on our radar, reports numbers tomorrow. Ekta joins in to tell us what's expected.
Well, for Dr. Reddy's this quarter, it is expected to be a slow quarter this time round. So the revenue is expected to be flat. We can expect a margin and profit decline this time. Now, the reason for that is mainly the US business, because the Revlimid generic cliff will actually take place. So we are seeing a lot more competition come through for the cancer drug. And hence, you are seeing, depleted earnings from that, which would impact the US business on a high base. Also, we do have the pricing pressure along with the product mix in the US, which could be unfavorable for Dr. Reddy's. So there are estimates which are even predicting as much as over a 15-20% decline in the US business this quarter. That will result in terms of margin pressure that we could see for Dr. Reddy's. Separately, for the India business, expect around 10 to 12% growth this time. What would be crucial for Dr. Reddy's would be the commentary this time. So, for example, semaglutide, the launch in Canada, would be is very anticipated for Dr. Reddy's. So the street will watch out for any important commentary coming in with regards to that, as well as the US pipeline.
Thank you very much for that. Back to market technicals. Rohit Srivastava, founder India Charts and Strike Money, is now with us. Rohit, 1.5% down. It's more than 1,000 points lower on the Sensex. What's your read of the fall today?
I think we are seeing global alignment to the downside. We are in very, very early stages of what might end up being a major or significant trend reversal in global equities. It's been a good ride, but I think it's gone away from what looked like only about trade to becoming a geopolitical problem. And geopolitics don't really resolve in a day or two, which means we have multi-month uncertainty now ahead of us. In short, it's not a good time to be in equities. You should create as much cash as you can. And that is what we are recommending to all our clients.
You're saying global equities itself, which have been resilient up until now through all of the bad news, every opportunity was used as a buy on dip approach, despite all the negative news on tariffs. You're saying that's reversing? Global markets are going to sell off? And how deep could the correction be?
Yes, I think global markets are getting ready. They're already selling off. I mean, we are seeing it in Europe. US was closed yesterday, so we didn't get the follow through from what is an ending structure. We'll probably see that today looking at the futures. you should prepare for a 10, 15, 20% kind of downside in global equities. It's better to prepare for that and then think about it later. Sometimes people will come in and question, oh, will it be so much or will it be that much? I think what that approach does is it doesn't help you to prepare. So I would say prepare for the worst and then let's hope it doesn't get that bad.
Okay, all right. Hi, Rohit. Good. I mean, good to see you and hear your view as well. Sounding rather somber. But do you expect a couple of indices at least? In our markets, the metal index has done quite well. PSU indices are doing well. What if someone has positions out there? Would you say, take your money off the table, this market's going down, and then there'll really be no place to hide. So if you're making money, take some money even of these sectors that actually have been outperforming.
PSUs have been very selective outperformers. The PSU index didn't make an all-time high. The only index that did was banking. The best performing sectors of the year were banking, metals, and autos. Metals is still holding on because, when we do long-term cycle analysis for these markets, essentially bond markets are the first that roll over, equities follow, and then commodities are last. So which is why we're probably seeing the commodity side of the market still holding on. You're also seeing a weak dollar today, so that is not really signaling you the risk of kind of pattern that you would see, which you're seeing in equities, but you're not seeing it in the dollar. Typically, if you had all world equities falling, you would have seen the dollar going up. So that's still supporting the commodity side of the trade. But like I said, equities go first, commodities are last. This pattern has been seen in most, previous major market peaks as well. So the commodity stocks might hold on a little longer, but they will not be a place to hide permanently. Once the markets, clearly once you've seen the downtrend take hold, you will see commodity, the metals market also roll over. So that's a risk to keep in mind.
Are you completely out of all your equity positions, or have you built short positions right now? And are you rotating into, say, precious metals?
So precious metals were the trade of last year. I've been trying to call a top on the PMs, but I think that will happen only when the dollar spikes. So essentially, I think there'll be a lag in the metal space. In equities, we've recommended 30 to 50% cash to clients, but personally, I'm 100% out of the market. And yeah, we have started recommending shorts as well.
Do you see the dollar index actually move up? Because that's been the saving grace, right? All of last year it was weak, which was good for most emerging markets. We underperformed even in that sort of a scenario. But do you see a risk that the dollar index, after correcting from 110 to around 98, now it's a possibility that it spurts up?
Yeah, that situation has developed. We haven't seen it yet, but when we look at the positioning in the CFTC futures market, the net non-commercial short positions are close to the highest that we have seen in probably at least 10 years. And that's been the typical setup of all the reversals we've seen in the dollar index in the past. So the positioning is there. In fact, it's interesting if you note what we call in technicals, we call this an intermarket divergence. It's classic Dow theory. When one market which is aligned with another doesn't confirm. So for example, we think that when the dollar falls, then commodity prices and gold and silver are supposed to go up. So the opposite of that is that if you're seeing new highs in gold and silver, are they supported by lower dollar prices? Now, we actually saw the bottom in the dollar index on 18th of September. We haven't seen a lower low in the dollar index since then. So in other words, the last quarter's gains in commodities and metals or precious metals have come without a lower low in the dollar. That is a major intermarket divergence, which is signaling that something will eventually turn in all of these markets. So it may be taking time, but the divergence is already there. So yes, I think the dollar index will turn and create that risk off that will be impacting markets and especially other asset classes apart from equities, which are already weakening. You'll see that. The only case to think about here is whether this will be a near-term dollar spike, which ends up being only a knee-jerk reaction, or can it become something bigger than that? Those are the two scenarios to consider.
Okay, just one more point. What about Brent crude? That's been very well behaved, which is good from an India perspective. There's a possibility that turns as well?
Probably not, because it is part of the commodity complex. Unfortunately, has not participated in the commodity cycle on the way up. And if the commodity cycle turns down on the dollar, then the case for rising oil may not exist unless the geopolitics creates that scenario. So while that scenario may not exist on a pure demand, supply and dollar basis, if the geopolitical situation worsens to getting closer to wars or other acquisitions around the world, then definitely oil could end up, moving to the upside, because that's what it does in those moments.
Okay, all right. Just Rohit, request you to stay with us. We need to look at the Nifty. The Nifty, forget about 25,400, 25,300. In this last 60 minutes itself, we have broken down decisively. And now I think we need to change that header. We are below the 25,200 mark because individual stocks, well, they have seen a big slide. A few of them should come up for you on the screen. I think Max Healthcare, that was in the green. That's again moved into the red. So I think as of now, there's just two stocks that are mildly in the green, HDFC Bank and Tata Consumer. But otherwise, intense selling pressure, Rima. The weekly expiry factor is playing out. And the breadth of the market that was as bad as 5 stocks declining to 1 stock that's advancing. Now you have close to around 7 stocks that are declining for 1 stock that's advancing.
In the morning, we were looking at, 25,500. Will it be retested once again on the way down? And at that point, 200-day moving average of 25,100 was seen as the support all the way down, 400 points lower. And now looks like, going by the fall in the last 1 hour, we could just test that 200-day moving average in today's trading session. 9 minutes to go. I think this is one trading session. The bulls will be happy to say, thank God, it's coming to an end. Do stay on, Rohit. We need to slip into a very short break. But as we do that, let's also get our viewers some of the opinion that we got earlier in the day. Rahul Sharma of JM Financial Services and Sanjay Mukin.
This is the second time we are breaching the 25,500 mark, which puts us into a place where a newer low could be established in this week itself. Technically, we are looking at the 25,200 level, which is where the 200-day EMA for the Nifty is. Essentially, a bounce back is something that can be expected from those levels, but that is for some other day. As of now, the trend seems to be down. The only two shining stars in this kind of a dull scenario is PSU banks and metals to a great extent. Apart from this, the market is lacking leadership, and whether it be it defensives, whether it be it IT or a stock like Reliance, all seems to be bearing the brunt of selling pressure.
It's not just the absolute that matters, it's the relative as well. Because when you're talking of, let's say, the low double-digit potential earnings growth for large caps in India, this comes in contrast with higher growth elsewhere in other sectors around the world in Asia. And you're looking at, or at least talking about, further potential currency weakness as well. So if you were to adjust the growth in dollar terms, then you'd find that in India, you would probably looking at mid to high single-digit dollar return on or dollar growth in earnings for the next 12 odd months. And this contrasts with at least expectations of higher earnings elsewhere. And which is why you see this tone of, oh, nothing's happening and things are slow. I mean, they're not really slow, they're okay. But it's just the contrast of growth elsewhere being much higher that causes this tone in India, I think.
Welcome back. Screen is looking very, very scary as we speak. The Nifty has breached that 25,200 mark, while the Nifty Bank, which was holding on to the 20-day MA, that as well has got breached in today's trading session. And no stock, actually, from the Nifty is, able to hold its own. Rohit, sometimes, there are these various ratios that you look at, some of those technical levels as well. You would have spotted a few. We keep highlighting the FI net shots that goes on getting built down. You have the PCR that's holding at around 0.6 odd. For the time being, all of these factors just ignored. Anything that you have observed?
So let me give you a lowdown on the FI positioning. I've used it forever to be a contrarian on the market, which means every time that they've been short, it's helped us in catching various bottoms in the market. But in the first week of January, something happened, or let's say over the last few weeks, something happened that was very, very different. So I'll just highlight it for people who've not understood it. And this is not the first time. It just happened at a smaller scale in COVID. So what happened in COVID is when the markets were, rushing up and down between 12,500 and 11,000 odd, where it made that last beat rally after the 25% tax cuts and, into Jan of 2020 COVID. That's the first time when FIs did not cut their short positions significantly. I mean, they didn't go long. And the moment the market rolled over in February, they were back to being short. In the first week of March, they had the highest short position ever at that point of time. So while we could have looked at that and said, well, the market will go up, we of course had COVID. And what kept them from adding to that short position was SEBI coming in and saying no more short positions. Okay, so that was around the 12th or 13th of March 2020. But essentially, that ended up being a directional trade. So while we mostly take a contrary view to the FI positioning, COVID was a directional trade where they were short into the event. At the start of this year, there's something similar has happened. While they've been, short for quite a while, every time they had a position closer to 1,80,000, 2 lakh short, contract short, the market bounced back in September, in November, December. But at the start of Jan, we've actually sold off on a short positioning. And at that point, it starts to look directional. It starts to look exactly like it did in COVID, where the market's falling and you have a short position which is getting added up. So it was pointing to some event that may be ahead of us. We just didn't know what it was because we don't know anything about COVID now. That's behind us. But this weekend has, of course, given us the event, right? This geopolitical news around Greenland, while it might sound like a small thing, I think it's probably ends up being the biggest geopolitical factor for the rest of the year, or I don't know how long, because it sort of destabilizes the whole world in the way that it was in the past. So it's a big uncertainty for markets to deal with, and I think it explains the directional short that they're holding and adding to on the way down. So that's a big difference in the way the data is right now. So we can't look at it and see that it's going to bounce back because they're short.
Got it. All right. Thanks, Rohit, for joining in and giving us that view. May not play out like the way it's played out in the past. So let's wind things down. Nifty goes home with a 350 point cut. 25,200 because of the last 2 minutes recovery. We managed to, the final tick is above that, and the averages as well will actually be above that. But otherwise, an extremely weak trading session. 47 stocks from the Nifty itself end in the red, while you have various stocks, that are down 4 to around, 3.5 to 4% in today's trading session. Adani Enterprises, you had Bajaj Finance, Jio Financial, Eternal. All of them went home with cuts. From the broader markets as well, plenty of stocks sold off. UPL was down 8%. Realty was down close to 7%. LTI Mindtree as well did react on the downside. Now, some of these stocks, another day they would not get hit so hard. But that told you the mood of the market. And that's why these stocks got absolutely pummeled. Couple of places to hide. Hindustan Zinc, numbers were pretty okay. Q4 will be even better. Valuation's not cheap. But the street believes that silver could do well. And that's why that stock was up. And Dalmia Bharat as well, Nomura came out of the north. They believe East India will do well. It has high exposure out there, so that stock went home with some gains. The bears were on top on this weekly expiry. The bulls, will be wondering whether or not that 200 DMA can hold out. On that note, we'll wrap up on this edition of Closing Bell. You don't go anywhere. The team of Markets Forward is waiting by.
Markets closed lower for the second straight session with the benchmark hitting a 4-month low. BSE listed companies raised over 10 lakh crore rupees in market capitalization. Market breadth favors declines. Nifty falls below the 25,200 mark.
LTI Mindtree takes a knock after a hefty 590 crore rupee labour code charge that weighs in on the third quarter profit. The IT major, however, remains upbeat on growth in Q4 and expects to close the year with improved margins.
Realty stocks under pressure, marking their worst start to a year in almost a decade. The Nifty Realty Index is down over 24% from its 52-week high, despite mixed Q3 bookings.
Hello and welcome to Markets Forward, your go-to show where we aim to get you all the key data points to absorb for tomorrow's trading session, as well as the key highlights of the trading day that just went by. I'm Vivek Iyer, and with me is my colleague Sonal Bhutra. Good afternoon, Sonal. A very grim-looking screen. The Nifty has slipped below the 25,400 mark. The mid-cap and small-cap index down over 2%. The small-cap index, in fact, with cuts of over 2.5%, and individual stocks, bearing the brunt of the selling pressure. A name like an UPL, despite positive news flow, a name like LTI Mindtree, decent Q3 with good guidance for Q4. All of these stocks seeing significant selling pressure in today's trading session.
A lot of reasons that we are grappling with. Of course, what's happening geopolitically, that is something which is impacting the markets. We do have some earnings which have seen disappointments. There is fear of demand concerns in the realty space. So a lot of it is weighing on the markets. We'll discuss a lot of these sectors and stock-specific action and some management commentary through the course of the show. But let's tell you the lineup of what we have in store for you today. We start with top movers and shakers of the day with Hormuz. We get your deep dive into why stocks like LTI Mindtree, Bajaj Electricals, Hindustan Zinc move today. Last but not the least, we delve into the key market events to watch out for tomorrow's trading session as well. And now that we are talking about the big movers, the advanced decline ratio absolutely in favor of declines by the end of this trading session. Let's go across to Hormuz Fatakia, who's joining us now from the big wall with the top movers and shakers of the day. Hormuz.
10 lakh crore gone in a single session today. If only we could say it was a good afternoon indeed for the markets. It clearly wasn't. But the index now, there are a lot of movers, the earnings reactions in today's session. And take a look at the extremes at which the earnings have been reacting. Nugent Software numbers came out just a couple of hours ago. The stock ended 15% lower. Oberoi Realty, another 8% shaved off. LTI Mindtree, Lvls, of course, the management warning of some near-term demand impact, declining 7%. A sector that has continued to sulk all along has been the real estate segment, and it's been the third worst start to the year for the realty index in the last decade. Then Sobha down 8, Lodha down 6, Godrej Properties, Prestige Estates, all of them seeing losses, then steep losses at that, and most of these names are down anywhere between 10 to 20% on a year-to-date basis already in the first 12 to 13 sessions of the year. There are some newsmakers, as Vivek was highlighting, UPL, were positive news flow, but clear buy the rumor, sell the news phenomenon playing out for the stock, 8% lower today. Ola Electric, a 10th straight day of losses for the stock today, back towards those all-time lows. KEI Industries, the Bajaj Electricals foray playing out on the other listed wires and cables peers, and Deepak Nitrite, one among the very few names that bucked the trend in today's trading session. Among stocks that ended at a 52-week low in today's session, look at Aditya Birla Real Estate, not part of the Realty Index, but no different from any of its other peers, 7.5% gone in today's session. Tejas Networks continues its underperformance, was the worst performer on the small cap index last year. It's carrying on from where it left off. Zee Entertainment now sub 100 rupees, in fact sub 90 rupees as well now, 5% lower today at a multi-year low, and Aegis Vopak too shaving off around 4% in today's session. And Deepak Nitrite was one name that bucked the trend. Some of the others that did so in today's session, Jindal SAW extending its gains from yesterday. Hindustan Zinc 3% higher considering the silver rally. Tips music after its results, and Bazaar Style Retail will be awaiting the outcome of the board meeting later in the day. Another 3.5% gained today. Some names that bucked the trend, but overall it was a sea of red on the last street.
Well, thank you so much, Hormaz, for joining us and managing to find a few specks of green in an otherwise very, very red market. Well, one particular stock that declined nearly 6% today was LTI Mindtree. This was after the company reported a mixed set of numbers for the third quarter. The profitability was impacted by a one-time labor code charge, while revenues came largely in line with the estimates. Rima now joins in with more details on what's weighing in on the stock.
Indeed, so the headline numbers are in line with expectations, but we can think of a couple of reasons which explains the fall in the stock. One, the valuations. Valuations today are at 30 times forward multiple, and this is more expensive than even a Coforge or an HCL Tech. Secondly, the stock had outperformed. I was taking a look from the April lows. LTI Mindtree is up 50%, while the Nifty IT index from the April lows is up less than 20%. So in the last 9 months, there has been a substantial run-up in this stock. But as you said, right, headline numbers are in line with expectations, but some analysts are pointing out to the mix, the internals in the numbers, they don't look that strong. For instance, the core growth driver for many of these IT companies, right, the core verticals are BFSI, high tech. But this time, BFSI has not done well. In fact, BFSI growth rate has been moderating for the company. High tech has seen negative growth rates now for 3 consecutive quarters. What drove growth for the company was largely manufacturing. About 3/4 of the revenue growth came in from manufacturing. And the other one is healthcare, which is basically the India PAN deal that gets classified there. So that seems to have driven growth. Also margins, the company's done a good job. They held on to margin 16.1%. But in the next 2 quarters, there will be that wage hike impact on the back of margins. But largely, I think it's more to do with valuations, the run-up since April lows of about 50-odd%, and the fact that some internals, like the top clients, the mix, the portfolio mix, is not as encouraging as the headline numbers seem to suggest. Back to you.
All right. Thank you so much for explaining that to us, Rima. Let's now go across to our guest, Jay Bala, CMT at cashthechaos.com, and Sudeep Bandyopadhyay, Group Chairman, Intra-day Capital. You want to take it ahead?
Well, good afternoon, Jay, as well as Sudeep. Jay, first up, we've seen a complete breakdown as far as, some of the charts are concerned, especially as far as the Nifty. We are looking at the Nifty with over a 200-point cut. Where do you see the bottom at current levels, and do you see a near-term bounce?
Hi, Vivek. We are very close to an important support at 25,100. And I've been pointing out for the last 2-3 weeks that the market has got potential to drop back to the August lows, about 24,400. But 25,100, that's an important interim support, because there is an alternate possibility that, this is a short-term correction, shallower than what I'm anticipating. So if 25,100 holds and there's to be a reversal, then we can, switch to the alternate case that we are seeing a much shallower correction than what I'm anticipating. But until that happens, I would still count the probability the markets are going closer to the August low or slightly below it.
Okay, all right.
That's about 24,400 on it.
Okay, take that point. Sudeep, what's your take on some of the earnings that came by, especially on LTI Mindtree, because that's what Rima just spoke about. Anything that stood out for you during the day? And do you think some of these weak earnings are seeing more exaggerated reactions than what it should get?
Well, definitely. LTI Mindtree, I don't see too much of a problem. There was a one-time charge, which is why the PAT numbers were a little down. But on the top line and most of the other internals, there were not too much of a problem. I think the problem was the valuation, and that's the reason we did see some amount of sell-off. It is quoting at a multiple which is significantly higher than most of its peers, and that's probably why there was a bit of a profit booking, or whichever way you look at it, selling coming after the numbers came out. But otherwise, I don't see much of a problem. As far as the overall, the numbers are concerned, I think the IT numbers, by and large, have been better than what was the, general expectations. Shade better, I would say, not too much of an outperformance, but shade better than what was being expected. So, that's a bit of a ray of hope. BFSI numbers, whatever have come, are by and large in line. Leave aside, some of the provisions which were taken by ICICI and HDFC based on RBI's insistence. But otherwise, I think the numbers are in line and slightly better than expectations. I expect the outperformance in BFSI to continue. I also expect, some of the larger PSU banks to definitely come up with very good set of numbers. I will be very keenly watching the cement numbers. There is expectation that Eastern India being there are shortage of cement, and some of the companies which have got good presence in Eastern India as far as cement is concerned will outperform the peers. Let's wait and watch how these numbers pan out.
Absolutely, Sudeep. So cement is one particular space in the materials and mining space that we will keep an eye out on. Well, one of the few stocks that managed to do well in the session today was Bajaj Electricals. The stock surged after the company announced its foray into the wire segment. It plans to enter the space as a business line under its lighting solutions portfolio, a move driven by rising consumer demand. Upasna joins in now with more details.
Well, certainly this stock continued to remain in focus today as the company announces that it plans to enter wire segment as a new business line under its lighting solution segment in the view of growing demand in the wires industry is what the company has indicated. It aims to diversify company's business operation for sustainable growth is what they've said. And it has also mentioned that the company is planning to launch the product shortly and is currently assessing the cables and wires market. Now, looking at the margins, Bajaj Electrical lighting solution segment margin stands at 10% versus the cables and wires peer average, which ranges in the range of 10 to 12%. Now, let us look at the key players that are in the wire segment. Now, if we compare wire as compared to the cable, wire sees a lower competition and also has a scope for high margin exports as compared to the cables. Now, in cable and wire market, building wire segment constitutes nearly 28 to 30% of the total share, and housing wire focused players will be, which are likely the direct players for Bajaj Electricals, would be RR Kabel, Havells and Finolex cables. Now, Motilal Oswal has estimated a revenue CAGR of nearly about 15% from FY25 to FY27. Now, Havells has said that the high margin in-house wire comprises nearly 60% of the total cable and wire revenue, and RR Kabel says that the wire will see a good growth in Q4 going forward. So all in all, let us see how the competition pans out with the entry of Bajaj Electrical as well in the cable and wire space.
Well, thank you so much. Well, thank you so much, Upasna, for joining us and giving us the details as far as Bajaj Electrical's foray into the wires and cable space is concerned. Remember, we've seen quite a few conglomerates enter this particular space. But earlier today, a CNBC-TV18 exclusive that we put out, remember, yesterday we heard about Sun Pharma and its planned foray into the US specialty space. Today we understand from our sources that Zydus Life Sciences could soon follow suit. In fact, we understand that the company is in advanced stage of talks to acquire US biopharma firm Ardelyx. We understand that Zydus may acquire Ardelyx control or buy key molecules from them. Some of the molecules are blockbuster drugs. In fact, we understand that Zydus may soon raise funds via the QIP route in order to go ahead and part fund this particular acquisition. And to remind our viewers, on November 6th, Zydus Life board had gone ahead and approved a 5,000 crore QIP. Now, remember, Ardelyx is a listed company in the US. It's a NASDAQ-listed entity, market capitalization of close to $1.6 billion. We reached out to Zydus Life Sciences. Zydus Life Sciences refused to comment on market speculation. We are still awaiting a response from Ardelyx. Now, in the Q2 con call, Zydus Life Sciences had actually mentioned that one of the objectives for the QIP would be to go ahead and deleverage the balance sheet. And they also said that they will potentially look at opportunities in order to go ahead and bolster their US specialty business. Interesting development, and Ardelyx, remember, has two commercial products in the USA, a prescription drugs for adults with irritable bowel syndrome, and Zydus had specifically mentioned gastroenterology as one particular segment they would be looking to go ahead and boost their product portfolio in.
Okay, all right. So take that point. Zydus will be on our radar. Let's get back Jay Bal and Sudeep Bandopadhyay for their take on these two names that we just spoke about. Jay, first up to you, how does Bajaj Electricals and Zydus look from a technical angle? If these two stocks are not showing good trends, anything else that you would suggest for our viewers?
Yeah, see, both Bajaj Electricals is on a very steep downtrend, so it's not. I don't think whatever spike up it's seen today, that's not a reversal for me. So I would still wait out. In fact, for most of the stocks, we have to sit out for the correction to play out. I'm anticipating the markets to drop back to the August lows. And post that, we can see a very good recovery, a resumption of the bull trend that we saw for the markets from April to July. That will resume, but the markets needs to go a little bit lower. When it comes to sliders, the trend is a bit unclear and choppy, but the long-term trend is quite bullish. So either it goes back to the April lows and holds that, or it slightly breaks below that. But the medium to long-term trend is quite bullish for the stock, but the short-term can get a bit turbulent and choppy, so avoid for the moment.
Okay, all right. Sudeep, we'll come to you in just a bit. We also want to understand your take on the realty space because that one has seen a big fall. It's down around 24% from its 52-week high. Today, that was the top loser, the realty index, that is down 5% in trade today. And across the board, we are seeing severe pressure. In fact, the stocks like Godrej Properties, we did have Brigade Enterprises, Lodha, all these stocks were at a 52-week low and some more additions to that list by the end of the trading sessions as well. But if we look at their quarterly performance, it hasn't been so bad. Barring some of them which spoke about demand concerns, we did see Soba seeing growth of 12%, Lodha seeing growth of 25%. Keystone, yes, that did see a decline of around 3%, but even Puravankara saw a growth of around 17% this time around. That's not a decline. That's a growth that the company has seen. Other than that, if we talk about Signature Global, that was the one which saw a big decline, 27% on a YOY basis. The other names have also come up for you on the screen. Now, let's talk about the commentary. This big fall started when Signature Global spoke about demand concerns and the fact that they will not be able to meet their guidance. Prestige said that there is no demand concern as such. They are a small player in NCR, but their project is doing well. But they did indicate that pricing could be an issue for a lot of projects. If the pricing is higher, there will be demand issues that the sector will face. Oberoi Realty, they saw a big decline in their sales this time around, but they indicated that they will continue to actively pursue land opportunities. They remain optimistic on the year ahead. There is strong developmental pipeline, capital management as well. Keystone Realtors said that they did not see any slowdown in any of the residential real estate segment. So commentary has been positive and negative, but despite that, we've seen a big fall in the realty index overall. Sudeep, come in on this because we have seen a sharper fall. Do you think there could be more concerns here? What's ailing the sector so much despite the commentary being positive and the fact that the demand concerns are very specific to some micro markets?
So now, globally, this works differently, but in India, real estate also moves on similar trajectory with the financial markets. Now, if the financial markets are under pressure, obviously we will find some pressure, going out to the real estate sector as well. And part of the reason is that we have been seeing, the FIIs selling and market remaining under pressure for a considerable period of time. So obviously the murky real estate deals at a very elevated prices, which was the norm, till a few months back, are coming under pressure. And it's a fact that the high-priced real estate transactions will be under some kind of pressure if this kind of market trend, capital market trend continues beyond a point of time. So one has to be careful because all these real estate players have been focusing on luxury, super luxury segments to a great extent. And I would, probably dare to add here that somewhere the mid-market and the lower end of the market has been grossly neglected by most of the players. And, that's probably the reason why there is a bit of a worry at this stage about the future. I mean, there is absolutely no problem in this quarter's performance or maybe even one or two more quarters. But going forward, what's going to happen to these players who are solely or predominantly focused on the higher end of the market? When the higher end slows down, they don't have adequate supply in the mid and lower end of the market.
Well, thank you so much, Sudeep. Very detailed views over there. Jay, let me bring you in as well in this particular conversation. Within the realty pack, significant price damage across most of the players. Would you at this point of time do any bottom fishing, and which stock looks relatively strongest?
Yeah, you have to be very, very selective out here, but the medium-term trend for the realty sector is quite bullish. But the realty index is likely to break below the April low, but it's going to be a brief break. But the strongest within the sector is going to be Prestige Estates for me. And Prestige Estates will comfortably hold above the April low. It could, in the short term, it could fall somewhere close to about 1380 to 1350, and then possibly hold very, very comfortably above the April lows. So the strongest stock within the space for me is Prestige Estates.
The highest sales in the sector, 9-month sale more than FY25 sales as well. And technically, as Jay is pointing out, it is looking strong in the Realty pack. Thank you, Jay and Sudeep, for your time today, joining us on the show with your insights on specific sectors and stocks as well. With that, it's time for a short break. When we come back, we'll get you the top corporate voices along with the key market events to watch out for on the other side. Welcome back. You're still tuned into Markets Forward. Let's take a look at some corporate voices of the day. Tata Capital's management is confident of sustaining its growth momentum into FY27, with January already shaping up as a strong month. The company has maintained guidance of 18 to 20% consolidated AUM growth and expects the motor finance business to return to growth in FY27 and also plans to increase the share of retail unsecured loans from 10.4% of the AUM to about 15% of the book.
Himadri Chemicals has announced a 2,400 crore rupees capex plan and is evaluating an additional 2,000 crore rupees of investment going forward. The company CMD told CNBC-TV18 that the expansion will be funded through internal accruals. He added that the investment pipeline is expected to generate revenues of around 7,000 crore rupees over the next 4 years.
And Havel says that solar business is expected to contribute around 5 to 10% of sales in the coming years, with capex largely focused on the cable segment. On demand, Havel says near-term consumption could be impacted by elevated raw material prices, but expects demand to normalize if input costs remain stable in coming months.
And before we wrap, we bring you the key market events to watch out for tomorrow's trading session. Upasana Bhatt is standing by the wall with the key events to focus for tomorrow's session.
Well, first up, let us look at the global economic cues. US API crude oil, pending home sales, and even IEA monthly report will be out. UK inflation data for the month of December will be out tomorrow, and back home, that is in India, M3 money supply is the data we'll be closely watching out for. Now, let us look at the key stocks that will be on our radar on the back of corporate action. 5paisa Capital will be in focus on the back of fundraising. Punjab and Sindh Bank fundraise of about 3,000 crore via QIP is what the board will approve tomorrow, is what we'll be watching out for. Now, let us look at some of the key important results tomorrow. Counters like Dr. Reddy's, HPCL, KEI Industries, PNB Housing Finance, Supreme Industries, Tata Communication, UTI AMC and Vari Energies, all these counters will be reporting their Q3 FY26 results tomorrow. Amagi Media Lab is set for its IPO listing tomorrow, so we'll be keeping a track of that as well. Now, World Economic Forum annual meeting in Davos is happening from Jan 19th till 23rd, and we'll be keeping a track of all the important event and interviews that as well. Now, the most important is the Trump will be giving its Davos speech and addressing World Economic Forum tomorrow evening. So that is one of the key important highlights for tomorrow's day. So all in all, looks like quite a power-packed day tomorrow.
Okay, all right. Thank you so much, Upasana, for joining in. Those are some events to track. But with that, it's a wrap on this edition of Markets Forward. We'll be back with more news and updates on the other side.
Hello and welcome to Business 360. I'm Arundhati Ramnan and here are the headlines that we're tracking for you this evening. Friction at Davos as President Trump doubles down on annexing Greenland despite opposition from European allies. Trump agrees to meet key stakeholders at Davos but does not specify who he will meet. Trump threatens 200% tariff on French wines after a snub from President Macron on the proposed Gaza Board of Peace. Trump wants European allies to sign up for the Gaza board at Davos, but EU leaders remain wary after Trump invites President Putin to be a part of the Gaza board. Trump's tariff threats to Europe rattle global market. Stocks decline across Asia and Europe. U.S. Treasury yields spike, a sell-off in Japanese bonds due to snap elections and fiscal fears sour sentiment even further. Nifty hits a 3-month low after posting the biggest single-day fall in 10 months. 10 lakh crore rupees in investor wealth wiped out. All sectoral indices end in the red. Rupee weakens to move towards its record low against the dollar. Indian and European Union likely to seal a free trade agreement next week. Sources say red lines on agriculture and dairy have been respected. European automobile exports will attract lower tariffs. Both sides expect to ratify the deal by the end of 2026. TCS aims to become the world's largest AI services company, says CEO Kriti Vasan. Eyes inorganic growth to ramp up capabilities. Insists revenue growth is not the sole motive. That's an exclusive. Mahindra Group CEO Anish Shah plans to list the group's electric three-wheeler business in 2027. Tells CNBC-TV18 in Davos that their EV portfolio should gradually rise to 20 to 30% of its volumes from the current 7%. Nitin Naban formally takes charge as BJP's national president at the party headquarters. Prime Minister Modi and senior ministers present at the ceremony. At 45 years, Naban is the youngest person to head the BJP. Let's cut across to Davos, where Shireen Bhan is in conversation with JSW Group's Parth Jindal.
Welcome back. Our conversations continue here at Davos 2026. Joining me now is somebody who gave us a headline here in Davos, promised to get a deal done and followed through on it. Parth Jindal, many thanks for joining us here. You did say that you will give it all that you have to get AkzoNobel, and that deal has finally been done in 2025. So congratulations once again on that. What's the headline that you're going to leave me with this time around?
No, I think last year, it was a very important deal. And actually from Davos, I had gone to Amsterdam to meet with Greg, who's the global CEO of AkzoNobel, and introduced myself. And I'm very happy that we could conclude that deal. It actually just closed in December.
Yeah.
And now we are the 4th largest player in the paint space in India, with a very clear mandate to come into the top 3 and then the top 2. So it's very exciting. Yeah, but a lot going on at the group. So
yes, there is plenty going on at the group. But since we started by talking about paints, let's double down on the paints business. And you said that the aspiration is to break into top 3 and then eventually top 2. And perhaps I don't know. You didn't even talk about number 1. But what could be the next milestone as part of this plan? A merger, maybe 2 or 3 years on?
yeah, absolutely. I think today JSW Paints is a private entity, and that is the acquiring entity that acquired a majority stake in AkzoNobel. So the first step will be to unlock all the synergies between the two companies. Obviously, both companies have a decorative business where AkzoNobel, we own the Dulux brand in India, which is extremely powerful and strong. And then there's the JSW Paints brand, which we have developed over the last 5 years. Dulux is very strong in the premium and luxury segment of the market, and JSW is very strong in the mass segment of the market. So we want to unlock those synergies, go-to-market strategy, synergies on the procurement side, on the logistics side. And then on the industrial coatings business, together the JSW and Akzo franchise will become number 2 in the country, with a very strong presence across coil coating, vehicle refinish, marine protective coatings. And there we have a very clear plan to become number one, because 70% of industrial coatings is applied on steel. And given that we are the largest steel producers in India, we have a right to win in that space. So I think the first step is really to unlock the synergies. And I think in 2 to 3 years' time, we would like to merge JSW Paints into the listed entity. And then, yeah, hopefully by then we will be in the top 3, and then we can aim for bigger things.
Well, you know, what are going to be some of the levers that you intend to exercise to be able to break into the top 3? And also from an integration point of view, you know, what will be the next sort of steps on that front?
Yeah, so if you look at the business today, by the end of fiscal 26, JSW Paints and AkzoNobel combined, we would be a 7,000 crore business, with the decorative business being about 3,800 crores and the industrial business being about 3,200 crores. Now, the next step for us is obviously to double down on the industrial business as well as on the decorative business. So on the decorative business, if you look at it, AkzoNobel has about 20,000 retailers across India that sell Dulux, and JSW Paints has about 9,000. And there's very little overlap between the two. So the first step would be to offer JSW products to the AkzoNobel dealers and to offer Dulux products to the JSW dealers. With that, we think we can increase our counter share across each of these 29,000 counters, while also adding new counters. With this, we think we can significantly increase our market share, which combined is about 7%. Next year, we would be targeting to at least get to 10% in the decorative side of it. The back-end synergies are very powerful, because today AkzoNobel services some of their southern Indian markets from their plants in the west. JSW services the entire country from one plant in the south. But now with the combined footprint of 6 manufacturing locations, the logistics cost can come down significantly. The go down cost, the last mile cost will be shared between the two companies, giving us a lot of synergies. So with that, we expect margins to improve, and that money that we can unlock is what we could actually pump back into advertising and sales promotion, because Dulux has been underinvested for a very long time. On top of that, the 2.9% royalty that AkzoNobel India was paying to the AkzoNobel Global for the decorative business goes away.
Right.
That again gives us more ammunition to spend more on branding and advertising.
Well, on the cement side of the business as well, and you did see that listing go through also in 2025, you know, demand, has it started to pick up at this point in time?
Yeah, so demand was extremely slow till November. The industry was seeing very low single digit growth, about 3 to 4% till November end. But December has seen a real uptick in demand. We saw first time demand coming back to around 8-9% year-on-year growth, and January continues to be extremely strong. So I think it was more weather related because of the prolonged monsoon, because of some parts of the country having significant heat waves and now significant cold waves. I think demand took a hit, but now it looks like demand has come back. And with that, I hope that the industry gets back some pricing power, because prices have seriously eroded since the GST reduction. When the Prime Minister announced a reduction from 28% to 18%. The prices have actually corrected much more than 10%. It's actually gone down nearly 17%. So we hope that the prices recover. And normally the construction season is from December to June, which is normally when the demand is very strong, and hopefully that shows up in the numbers as well.
Well, there's been a fair amount of consolidation in the cement space as well. There are many players that are still up for grabs or in the market on the block. Is that an area that you're going to be looking at?
Cement is I think we are a relatively small player in cement. We have a very ambitious organic roadmap to go from 20 million tons to 40 million tons and then to 60 million tons. Our first greenfield expansion in the north of India in Rajasthan will be commissioning in this quarter. With that, we would become a pan-India cement player. And then we want to continue on the organic journey, because the competition is fierce. They are very, very strong balance sheets there. And I don't think they're going to let any of the good assets go to a player like JSW. And they would be, fighting amongst each other for those kind of assets. Amongst the assets that are available, there are very few that have scale or are in a good market. The assets which are available are not of interest really to us, and even if they were, I think we would not be able to compete with the larger players.
So given the fact that you're dealing with large players, also with large players who have large balance sheets, what's then the plan for growth as far as the cement business is concerned? Your shareholders would also be interested to know, because the stock is down 20% from its listing price.
Yeah, I think for us, the synergies with the rest of the group give us a very significant cost advantage. So the waste product that comes out of the steel making process, slag, is our basic raw material. The fly ash that comes out of all the power plants is also our basic raw material. We leverage the JSW infrastructure, port and transport facilities to lower our logistics costs. And with that, we're in the top quartile on the cost side. And obviously the JSW brand is very well known. It's even getting more well known every day. And with the JSW car, I think the brand will absolutely go to the next level. And I think that results in a superior price as well in the market. And we would be able to compete very closely with Ultratech or Ambuja or some of the larger brands in cement. And that's how we've been able to grow this business. So I think for us, the focus is very clear, build capacity at lower than replacement cost, go to good geographies. If you look at our footprint, we've primarily been in the south and in the west. South has always been oversupplied. Now we're going to the more lucrative markets of the north and then to central. With that, hopefully our EBITDA per ton would be one of the best, if not the best in the industry. That's the aim.
So what's the next milestone as far as cement business is concerned?
So commissioning Rajasthan, with that we would get to 25 million tons. We are also expanding our footprint in the UAE. We're adding a third clinker line as well as a grinding unit there. We have also starting the work for the central India operations in Madhya Pradesh. So the plan is by FY29 to get to 40 million tons. So that would be the big milestone for the company, and then grow from there.
Well, let's talk about the car, which you just brought up. So 2026, is that going to be the year that we see the JSW car roll out?
Yeah, absolutely. I can confirm that the JSW car will be launching this calendar year. We are aiming to launch it just before Diwali to catch the festive season. The factory construction in Shambhaji Nagar is well underway. It's a large investment, 14,000 crore investment. Actually, the MOU for which was signed last year by my father, our chairman, with the Honorable Chief Minister of Maharashtra. And yeah, the project is completely on track. And the first car is already identified, designed for India. Localization works are underway. And by hopefully by August, the production will begin. And by September, we should be available in the country.
Okay, so let's talk a little bit more about this and give me a glimpse of what this car is going to look like. Localization you spoke about. So how much of this car is actually going to be assembled here in India as opposed to made in India?
Yeah, actually, so the like I said, the factory is under construction. The main part of the factory, which is the paint shop and the general assembly line, the general assembly line will be ready by the month of June, and the paint shop will be ready by the month of October. So in the initial period, we will be bringing the parts from the home rooms and be assembling it in
home rooms being where?
In China. And it's a global Chinese company, and we will be bringing the parts from there and assembling the car in Shambhaji Nagar and delivering it. From the month of October onwards, the car will be 80% localized, other than the cell, for which none of the Indian auto companies today have the technology. Everything else, from the battery pack to the steel for the BIW parts, the motor, the seats, the glass, the tires, everything else will be localized. So from October onwards, we'll have an 80% local car, and we are in advanced discussions even now to get the cell technology so that we could localize the cell as well. Our idea is that we would like to be 100% local producer in India with global technology partnerships with companies.
And what's the price point that you're going to play in? And you talked about competition. This is an increasingly competitive space. I mean, you've got the likes of Tesla in India struggling to sell.
Yeah, absolutely. I think if you look at our experience has been very positive. We acquired MG in India last year, and this year The Windsor, which is the first car that the JSW Group brought into the country, is the fastest selling EV in the country. For the last 16 months, we've been breaking record after record. And it shows that EVs in India, for them to work, you need to be at the right price point. If you look at the data, India sells about 4.5 million cars in 2025. Out of the 4.5 million, the maximum amount of cars, more than 3.5 million, was sold sub 15 lakh rupees. So it's very clear that you got to be in the 15 lakh rupee ballpark if you want to achieve scale. So our aim is to play in that 15 to 30 lakh rupee price point.
Okay.
The first car that we're launching is actually a very big muscle car. We want to establish the brand, establish the powertrain, establish the technology, because we're bringing it in a plug-in hybrid format, which we believe is the right intermittent technology for India till charging infrastructure gets developed in the country. So that's going to be at a slightly higher price point to establish the JSW brand. And then the next car we're going to bring in is going to be in the month of January 27, which is going to be in that 15 to 20 lakh rupee price point.
Do you have names for these two already?
So they're global platforms. They're globally available. We've just tweaked the design a little bit for India. But we have to change the name, so there's a lot of discussion going on the naming right now. We will announce that soon.
Okay, so Diwali, that's the first launch from JSW, the car that we will see hitting Indian roads, and 27 will be the second one. But Parth, thank you so much for joining us. We wish you the very best of luck and look forward to seeing more of you and hearing more from you as you get closer to these launches, and of course both on the cements and the paint side of the business. Appreciate your time here in Davos 2026.
Thank you so much.
Well, with that, it is time for us to take a break, but don't go anywhere. Plenty of headlines coming in, as you just heard there from Parth Jindal, taking us through their launch plans for the JSW car, Diwali, and then the second one in 27. There's a lot more coming up. Don't go anywhere. We're back in a minute on CNBC TV 18. Welcome back. The conversations continue here in Davos 2026 as we try and understand what the world is going to look like in 2026 and beyond. Joining us now to talk about the global economic order, the changes that we are seeing to trade, to the impact of tariffs, and of course what we could expect at the end of Davos 2026 with President Trump making many announcements that could in fact impact the NATO alliance, that could impact the future of Europe. Joining us on the program is Ishar Prasad of the Cornell University. Many thanks, Mr. Prasad, for joining us here. The Doom Loop, that's your new book. How appropriate a title is that? So, you know, what do you make of the many developments that have shaped 2025 and what that tells us about what the world is going to look like in 26?
I think what we are seeing here in Davos is a moment when there seems to be a crumbling of the traditional world order as we knew it, where there was a well-defined alliance of the Western countries, the liberal market-oriented democracies. It was seen as standing in counterpoint to China and other socialist economies. But what we are seeing is a fragmentation of the world order driven by a variety of forces that I think are feeding off each other in a negative way. So in the Doom Loop, I talk about the interaction between domestic politics, economics, and geopolitics, and all of these could work together in a very positive way. So if you think about globalization, for instance, it was supposed to make people in all countries and generally the entire world much more prosperous and thereby bring countries together. And the idea was that globalization, because it would be a positive sum game where everybody could benefit from trade, for instance, would be a counterbalance to the zero-sum game of geopolitics, where one country can gain influence only if another country loses influence. But what has happened right now is that even globalization has become seen as a zero-sum game or even a negative-sum game, where one country gains, other country has to lose. And that means that this balancing force is gone. So the zero-sum game of geopolitics now becomes much more dangerous because there are no offsetting forces. So the concept of the Doom Loop now is that these forces are feeding off each other in a way that generates instability rather than stability. And I think what we are seeing here in Davos is a prime example of that, with Donald Trump likely to make a speech that suggests a splintering of the Western alliance. So it creates a lot of fragmentation in the world in all of these dimensions: political, economic, and geopolitical.
You know, so on the back of what you've just said, the many changes that you have spoken of and alluded to, we're now talking about structural changes. This is not a cyclical downturn. What you suggest is a structural change that could have implications and an impact over the next few decades.
That's right. If you think about the way civilization has progressed, there have been times when there's been a shift in one direction and then a correction. Even the United States has gone through these periodic corrections where it lurches to one extreme and then lurches to another extreme. But what is very important is there was a self-correcting mechanism in place. The same was true on the global stage as well. But going back to the US, if you think about what created the self-correcting mechanisms, it was really the institutions such as the democratic process, the rule of law, the free press, and all of those institutions are really being whittled away right now, if not really being destroyed. The same is true at the international level. The institutions that were seen as maintaining the rules of the game are now being seen as less legitimate. They're being seen as less legitimate by the advanced economies which set them up, but also by the emerging market countries, China, India, and others, that feel that those institutions are not serving those interests well. So we are seeing a breaking apart of the rules of the game. So I think it's going to be much harder to put these things back together and for the corrective mechanisms to work. So the way you phrase the question is exactly right, that we are not in the middle of a cyclical change. I think something more fundamental in terms of reshaping the world economic order is in progress.
So, you know, how do you believe this reshaping is going to take place? What will this reshaping lead us to? At this point in time, what we're seeing are tactical changes. For instance, with the US taking the position that it's taken, you've suddenly seen Europe rediscover or reset or attempt to reset its ties with China. As you look at this reshaping of the economic order, you know, what do you see? More blocs emerging? Do you see more bilateral relations emerging? How is this likely to play out?
One possibility which we saw in the last few years already is more fragmentation. If you think about global trade, you know, the benefits are so large that I don't think we're going to retreat from global trade. But certainly, rather than trading with all the countries of the world, we see trade falling along geopolitical lines. That is, countries that are geopolitical allies build stronger trade and financial relationships with each other. Now, that means that you're denying countries the benefits of much freer, much broader trade, but countries feel that this is one way for them to reduce exposure to geopolitical and other risks. But there is a problem with this fragmentation. It might serve countries well in the short run, but now you have geopolitical and economic lines falling along the same ways, and economics or trade, which used to be a bridge between geopolitical divides, is gone. So it means even more instability, and that I think is very worrying. But overall, I think we're not going to see trade disappear. Now, regional blocks are certainly going to form because, again, countries are trying to figure out how best to generate the benefits of trade. But we're also in a very particular moment right now, which I think is worth considering. Certainly, there are two great powers right now, the US and China, that are sort of well matched militarily, economically, financially, and so on. It would be a compelling proposition when the US is trying to impose tariffs on practically every other country for the rest of the world to say, let us reduce our trade with the US, let us trade more with each other. But there is a problem. The second largest economy in the world, China, is now facing significant domestic problems, and the way they are generating growth is through exports. And when the second largest economy in the world is not pulling the world along, but is in fact counting on the rest of the world to absorb its exports, that creates a problem. So for all the countries stuck in the middle, it's countries like India, but also even the advanced economies like Japan, Germany, the United Kingdom, all of these countries are not doing very well economically. They need exports, and they're terrified about being swamped by cheap Chinese goods landing on their shores. So they're really caught in the middle. So the notion of the US being isolated, which would be in normal times a logical proposition, is unlikely to play out.
It is unlikely to play out, and you talked about China and that trade surplus that we've seen coming in from China at a record all-time high, and that is, of course, going to be a challenge for the rest of the world, as you point out. But here in Davos, while there's a lot of conversation around trade and tariffs, there's also the hope around AI and what it's likely to do as far as global growth and the global economy is concerned. How does that figure in the new order, in the doom loop?
That's a very important element of the book. In fact, I should tell you that when I started the book, I wanted to tell actually a much more positive story about how we might be going from one equilibrium, which was largely unipolar after the fall of the Soviet Union, to a multipolar or bipolar world. And as an economist, one thinks that a world where economic power is more evenly distributed should be one that has more balance, efficiency, stability, and so on. And technology was one of the forces that I thought would lead to this new equilibrium because it generates more prosperity. In thinking about this force, so I came to a very different conclusion. I talk in particular in the book about three specific technologies: AI, digital currency, social media. All of these could generate positive gains, but in fact what we are seeing is that they are leading to a much greater concentration of economic and financial power within countries, but also across countries. And moreover, if you think about small disruptive nations like North Korea, for instance, or even larger ones like Russia, they can use these tools very effectively to foment a lot of instability around the world. So while technology is certainly generating a lot of gains in terms of productivity, output, and so on, I think under the surface it's actually generating even more instability within and between countries.
So since we're talking about technology and the implications of what this technology could lead us to in terms of productivity gains, what it's also seeing companies do in the short term is spend significant amounts of money in the infrastructure build out, which has actually been the tailwind for growth, specifically for markets like the US. How do you see that playing out in the short term and the impact of this massive infrastructure build out that we're seeing today?
Now, certainly AI is going to have a very big impact across the board, and there have been many conversations I've already participated in at Davos about how companies are in fact undertaking very significant investments in AI. But two interesting things have come out of the discussion so far. If one thinks about the bottom line, the bottom line impact seems to be much more muted than one might have expected, given how transformative we all think this technology is going to be. And the second problem, of course, is what the implications are for employment. When we think about advanced countries, there was an entrepreneur from India who was talking about similar issues about how they were going to set up a new plant which would have far fewer workers but would produce the same amount of output using AI and other technological innovations. So technological innovations are certainly very good in terms of productivity, in terms of output growth, in terms of employment growth, which is a challenge not just in India but around the world. That is going to be a serious issue. There have also been some discussions with leaders from African countries. Many African countries right now are actually growing quite well. But even in those countries, employment growth is really lagging. And that is a significant problem because, again, going back to the concepts of the doom loop, you can do well on the economic front, but if you don't generate employment growth, you don't generate household income growth, then you end up with a very negative feedback loop with domestic politics affecting economics as well.
So where do we find hope? Is there any hope in the doom loop at all?
I had to leave my readers with some hope, so I do talk in the end about how difficult it is going to be to get out of the doom loop. It's not going to be easy because, as we just discussed, these are structural forces that are playing out. But ultimately, it's going to take a combination of three things, very engaged citizens, where we think not just about our short-term, narrow national interests, but think about how shared prosperity is the answer. Leaders, community leaders, business leaders, national leaders who can help us see beyond our short-term prejudices. And then we need rebuilding of institutions, national institutions, including the rule of law, the independence of the press and so on, but also international institutions. And one way to think about this is that all these institutions are crumbling, but it's also an opportunity to rebuild institutions or perhaps build new institutions that are much more effective, much more legitimate. None of this is going to be easy, but I think understanding the forces that got us here, which is what the doom loop is about, I think is very important as a first step.
Well, thank you very, very much for joining us here on CNBC-TV18 and giving us a glimpse into what the doom loop is about and what we should prepare ourselves for, the many forces that are at play. Look forward to reading more about the book and the book itself. But thank you so much for joining us here in Davos on CNBC-TV18.
It's been a real pleasure and I enjoyed the conversation.
Thank you very much, Professor Prasad. We will take a break here, but the conversations continue on CNBC-TV18. Don't go anywhere. We're back with you after a very short break. Welcome back. The conversations continue here at Davos 2026. We're trying to get you a picture of what the world could look like in the year ahead, what could be the factors, the forces that shape investment decisions. Joining us now to help make sense of that is Filippo Gori of JP Morgan. Filippo, many thanks for joining us here. It's too cold. My brain is frozen now. Thanks for joining us on CNBC-TV18. Well, you've done 11 countries before you got to Davos. What's the mood at this point in time?
Shireen, first of all, thank you very much for having me. It's a pleasure to be here. Yes, so I've been traveling across Europe, the continental Europe and the Middle East over the past 2.5 weeks with a group of colleagues to gather momentum at the beginning of the year, to show our clients that we are there and our employees too, and to kind of re-stress our European credentials. We have been in this part of the world for a long time, and we wanted to stress that. So the mood was actually quite positive, both in Europe and in the Middle East. Different reasons, different cycles. Europe is kind of moved on from the tariffs, and most clients are just ready to continue to get on with their lives, invest and do what they have to do for their companies. In the Middle East, you are facing more of strategic rethinking of the role of the Middle East in the broader political and geopolitical environment across the world. And there are enormous investments taking place in that region, and therefore there is a degree of enthusiasm, a degree of sense of pride for what the Middle East is achieving that is definitely palpable. And there is global interest for the Middle East as well as for India, obviously, that you can perceive. Then you arrive here in Davos, and clearly everything will happen in the next few days.
Next 48 hours,
Yes.
once President Trump arrives.
Yes, so there is definitely a high degree of expectation for what can come from this week over here.
But let's talk a little bit about India and Asia in specific as well, and how that sort of is placed at this point in time from a fund flows perspective.
So India, as you will have seen, has done exceptionally well over the last 15 years or so, for as long as I've been, when I lived in Asia Pacific, and for as long as I've been involved. It has transformed itself. And if you look at some of the flows or some of the important changes that have taken place, have really reshaped the country, even in a global, from a global investor standpoint. If you think about last year, Asia Pacific had IPO flows that were up around almost 75%, or up to $90 billion, if I remember correctly. India represented 25% of those flows. And there was definitely a degree of excitement around the equity market in India. And India right now is having enormous tailwinds, whether it is domestic consumption, India generated by the India for India manufacturing, whether there is a high degree of export, India for the rest of the world, the whole infrastructure reforms, and India remains the office country of the world, the services economy of the world. As JP Morgan, we have over 60,000 employees in the country, and we are really proud of what they contribute firm-wide, and the quality of the talent is and remains outstanding.
But Filippo, in the short term, do you see, on account of the significant depreciation in the rupee, etc., further sort of pull back from FIIs as they look at India? Because that's been the story through 2025.
I think the story is, you will not believe me, but the depreciation of the rupee has always been a little bit of a story. I remember other interviews 10 years ago when I was being asked about that. So that story has always been a little bit there, but notwithstanding that, the interest, the flows, they remain there. Ultimately, if you are a global investor and you are looking at Asia Pacific, if you exclude Japan and Australia, if you are looking at developing economies, you look at China and India. They are the two largest markets, and therefore there is always going to be interest.
Well, IPOs, and you spoke about the India IPO market, which was burning hot in 2025. What's the expectation as we look forward?
I think the IPO market, in general, I would say for 2026, will remain important and will grow possibly. we are coming from years where the global IPO volumes have been really depressed.
Yes.
And there is a sense that the backlog that is there has built up to a level that needs to find a way to go to the market, and therefore we strongly believe that 2026 will be a strong IPO year globally, and therefore
including in the US?
Especially in the US. The US, we were more optimistic in 2025 around the US. Then a couple of things took place. One, April Liberation Day, you had a slowdown. And then what happened was there was in October the government shut down. The government shutdown meant that many of the IPOs that were on the pipeline were not approved on time. They missed the window, and therefore they are coming into 2026. So yes, we are optimistic about the US and optimistic around the rest of the world, in India too. And our team, investment banking team in the country, which is the number one in terms of market share, is heavily prepared for it.
Well, the AI theme and how that's playing out as far as the equity markets are concerned, we could perhaps see, from an IPO perspective, 2026, see the IPOs of some of these large AI companies. But how are you reading into what we're seeing as far as this AI theme and how it's playing out in the markets?
So AI is definitely one of the most important topics that every investor around the world wants to talk about. On one side, they look at the opportunity set that AI is bringing in terms of increasing productivity, the way you can reshape your companies, the way you can access markets that might not have been there, and so on and so forth. And then there is also the flip side of the same coin, which is, are valuations too high? The questions they get asked. The increase in productivity that might lead to job losses. How will that impact society, and so on and so forth? And then there is the broader question mark around AI monetization. The US or the Western world has a monetization strategy, for instance, that is different from the Chinese models. Which of the two might be the ultimate game winner is questions that people ask around the world. But there is definitely enormous interest for everything AI right now.
Bubble? No bubble? Yet to bubble?
I would not use the word bubble. I would just use that there is an enormous degree of interest given the productivity opportunities that might come along.
M&A in 2026?
The pipeline right now is the strongest that we've ever seen as far as we have records. 2025 was...
What's driving that, you think?
A variety of things. One, I would say the fact that financing remains relatively economic. The credit spreads are at the lowest. You have a relatively good visibility of where rates are going to be in the US and in Europe for the foreseeable future. And therefore, people want to take the opportunity right now to do transactions that might otherwise, in the past, might not have been possible. You will have seen in the fourth quarter of last year, the return of the large mega deals. Think about Electronic Arts, think about Warner Bros, Netflix, and so on and so forth. So that is spurring a sense that things things that might not have been possible before are possible. There is definitely a deregulation agenda in the United States that is helping some of those conversations. And in general, there is a pipeline coming. People want to take the opportunity to monetize or to access capital markets or do things right now, given this broader financial backdrop, let me put it this way. And therefore, already in 2025, M&A was up substantially, and the pipeline in 2026 is the strongest that we have record for.
No, that's interesting. That's a important headline that you're leaving us with. So finally, let me ask you, the three things that you're going to be watching out for and what you believe could shape investment decisions in 2026.
So there are three topics in my mind. One is geopolitics. Those winds have been blowing in one direction and at times in a different direction now for quite a long time. And I think overall investors and corporates have become I don't want to say numbed, but they are they get on with their lives. But there would always be a spike up, and that could slow down some of the activity. There are inflation concerns. There is a lingering inflation there in the US economy. There is a sense that we might be at some point coming to the end of this fantastic credit cycle which we have witnessed for the past 15 years or so. So there are some considerations around that, and people are watching that carefully. And then third is AI. AI can play in many different ways, and so the people are rationalizing that too.
Well, Filippo, it's been a pleasure speaking with you. We look forward to seeing you in India. Thanks very much for joining us here in Davos to give us a quick read of what your conversations with your clients as well as other investors are telling you about what we should expect in 2026. That's the view there from JP Morgan. We are going to take a break and come back with more conversations. Stay tuned to CNBC TV 18. We're back in a moment with plenty more.
the dreaded European working group that.
We've seen a lot of working groups over the decades.
We've seen a lot of working groups.
It's hard to make decisions in Europe. It is, and sometimes.
Well, Joe, 4 years into the Ukraine war, they're still buying Ukraine energy. They are buying refined products from India made from Russian oil. So 4 years in, the Europeans are still financing the war against themselves.
All right, let's talk about.
But Joe, what I do want to say is, same thing that I said after Liberation Day on April 2nd. Everyone, take a deep breath. Do not escalate. Do not escalate. And President Trump has a strategy here. Hear him out, and then everything will be fine.
When I hear people say the U.S. is in dire straits, there's chaos, et cetera, et cetera. I just list about 5 or 6 things. Okay, stock market, new highs almost every week. I don't know about today because there's a lot of tumult around what we were just talking about. GDP, multi-year highs. Unemployment, basically we're at full employment. Inflation 2.7%, you could, depending on what you talk about, go down from as high as 9%. Southern border is secure. Trade deals all around the world. Trillions of dollars of investment flowing here. I was asked, where's the rub? Why so sad?
Again, I think the President's had an incredible year. He's done peace deals, trade deals, and tax deals. We have the one big, beautiful bill done on July 4th. On the corporate side, full expensing for equipment, for factories, for farm structures, for working Americans, no tax on tips, no tax on overtime, no tax on Social Security, deductibility of American-made cars. We're going to see record tax refunds. I'm also the IRS commissioner. I can tell you we're going to see record tax refunds coming out in the 4th quarter for working Americans. We've had a CapEx boom, up 12%. History will tell you CapEx boom always follows an employment boom. I'm not sure. We are the envy of the world. We have higher nominal growth than China.
Let's talk about the nominal growth. Are numbers that, when you say them, it's hard to even grasp it. So 8% is possible at this point.
Well,
that's what it was in the last quarter. I think if you had
it was 7 or 8%, and we are moving along at a great pace. And again, the president's economic agenda was a 3-legged stool: trade, tax, and deregulation. You know what's really kicking in now, Joe, is the dereg.
That takes the longest.
That takes the longest, but we're seeing it. We're seeing it. Treasury and the financial regulators, safe and sound deregulation in the banking system, getting more lending into the regulated banking system. Oliver Wyman believes that we've created $2.5 trillion of lending capacity that can go. I have made a big push on Main Street with small banks, community banks, because they power Main Street. And I think Wall Street can do well, Main Street can do well, and I think we're about to see it in spades for 2026.
When you said that in this term for the president that you could get, I guess, debt to deficit, or
deficit to GDP.
Deficit to GDP down to 3%. We were at 7%, were we not?
We were for calendar year 2024. We were at 6.9. Calendar year 2025, 5.4. 5.4. So that's a combination of controlling spending and the higher revenues, substantial portion of that from tariff income.
And 3% is still possible by the end of
well, at this pace, we may be there before the end of that.
Let's switch to the Fed because we've had a lot of comments recently. You don't know when the announcement's going to be made, or what's there's things happening today, I guess, at the Supreme Court regarding the Fed. Jay Powell's planning to visit to watch the proceedings with Lisa Cook.
Well, couple of things, Joe. My guess is that the president will reach a decision maybe as soon as next week. We've had substantial conversations about this. We've run a process that started in September. 11 very strong candidates. We're now down to 4 candidates. The president has personally met with all of them, and it's going to be his decision. In terms of the Supreme Court hearing, I believe, I'm not sure whether it's today or tomorrow, Jay Powell has announced he's going to attend, and Joe, I got to tell you, I actually think that's a mistake, because if you're trying not to politicize the Fed, for the Fed chair to be sitting there trying to put his thumb on the scale is a real mistake.
And there's a lot to talk about, obviously, with Jay Powell. There's this great economy that you were just talking about. So obviously the Fed has managed rates to the extent that it allowed us to get to where we are right now, notwithstanding what we saw a couple of years ago when maybe the Fed was too slow in the face of that inflation, the post-pandemic inflation. But there are other things that you've pointed to. Jay Powell is not just the chairman that sets interest rates. He runs this huge behemoth of an organization, unelected, that is a huge part of Americans, of their lives in this country. And you're CEO and COO of that organization, and that's where you have some issues.
Look, I think that the Fed's monetary policy independence is very important. I think that a lot of the issues around the independence are being created by the other things that are happening. So, let's look. Under Chair Powell's watch, we will have seen between 4 to 6 governors and presidents have to resign for ethical issues. That's out of 19, Joe. If that happened at a Wall Street firm, CEO would be out.
And we found out in hindsight most of the time. They left, not sure why. It's not transparent.
And it's not transparent. And again, the independence does not mean lack of accountability. The Fed has a special obligation to the American people because it influences their lives, but they are unelected. They are not subject to appropriations. They have magic money. They print their own money. This big cost overrun for the Fed building, they'll just print more. They'll just print more money. So I don't think there's anything wrong with some accountability. And look, just to be clear, the Federal Reserve is now losing $100 billion a year. $100 billion a year because of mistimed asset purchases. I think that was a big mistake.
How does this resolve itself? I know that this isn't your purview necessarily.
Hello and welcome to CNBC-TV18's continuing coverage here from the World Economic Forum's annual summit in Davos. We've been bringing you headliners and newsmakers. It is our privilege to have with us on the program today in our Davos studio a man who has seen the way that the markets have shaped for the last 40 years. He is, of course, also a big believer in the India story. Joining us now, live and exclusive in Davos, Stephen Schwarzman of Blackstone. Stephen, what a great pleasure to have you join us on the program. It's wonderful to have you speak with us here. What's the big takeaway from Davos so far?
Well, Davos is just starting. Started last night, so you're catching me around noon in Davos. And most people aren't questioning the global economy and how it's doing. They're more interested in geopolitical stuff that's going on, whether it's Iran or Venezuela or Greenland or other types of things that keep happening with real rapidity. So no one has any answers to any of those things.
And more questions.
Right, more questions than answers. And like many things, time gives you the answers. But surprisingly, most of those issues haven't had a huge impact on markets at this point.
Mm-hmm. You talked about time, and I want to understand from you 40 years of doing this at Blackstone and building out Blackstone, 21 years in India. Many people compare what we are seeing today in the world. In fact, Boge Brende, the president of the World Economic Forum, believes that this goes back almost to 1945, the geoeconomics and the geopolitical fragmentation that we're seeing. Why do you think the markets are not reacting to the volatility in the headlines?
I think the markets aren't reacting because, one, there's some economic things that are going on that that appear to be overwhelming, actually, some of those geopolitical issues. And the geopolitical issues themselves aren't resolved. So it's not quite 1945. But on the economic side, the advent of artificial intelligence and its future impact and changes has created, you know, it's not really a euphoria. It's a solid economic growth in the United States, which is a you know, world's biggest economy by far. We grew in the last quarter 4.3%. Now, by Indian standards, that's not much. But on the other hand, you know, we've got a GDP per capita probably around $70,000, yes. And India has $3,000. So it's easier for India to have a bigger percentage growth. But for us to be growing 4% plus, you know, that's almost never happened in decades. And it's the impact of massive expenditures by what's called the hyperscalers. They're just big companies that are all in the data and you know, social media and other types of you know, activities, spending at unprecedented rates. And probably 3/4 of the growth in the United States is from the building of data centers. And now there's going to be a big boom in electricity because the U.S. is really short electricity. And for the data centers to keep being built, you need the electricity, and that's creating even more in the way of economic growth. Now, that doesn't totally explain why European markets are up, but in the U.S., something magical is happening with technology and what people think is going to happen in the future.
Well, in your words, if you believe that something magical is in fact happening on the back of technology in the US, what would you be long on in light of this?
Well, in point of fact, we have a point of view.
Yeah.
And Blackstone is the largest builder of data centers in the world. And we're also the largest owner of data centers. And we're a huge investor in the modernization and growth of the electric grid. So, for example, unlike India, we've had no growth in electricity in 20 years. And we're going to start running short. And we're going to go into a world where most people think you'll have 5 to 6% growth. Now, by Indian standards, that's not that much. But if for 20 years you haven't grown at all, that increase is a very substantial increase. And the whole electric grid is going to need massive expansion, 50% type expansion at a minimum. Some people think much higher. And so as investors, being in these two areas with increased concentration has turned out to be a simply wonderful outcome.
Well, yeah, I would imagine so, and we continue to see billions of dollars being poured into the build-out on the AI infrastructure side. But, you know, you said once recently that you believe that we're in a super cycle of fundraising. Do you believe that will continue to be the case in 2026? Well,
in terms of fundraising, it was a little tougher in the private equity area over the last few years when interest rates went up quite high in the West because of inflation after the pandemic. And that sort of trapped people who had bought deals near the top Then interest rates went up, and all of a sudden, you couldn't sell things, and it was not a good time. But interest rates are coming down. You know, in the United States, they've already come down in Europe, and that's going to start the cycle again. But other parts of what we do at Blackstone, credit, for example, private credit, we now have $500 billion just in private credit, and our firm is increasingly close to $1.3 trillion. That's with a T.
Yes, we get that. That's with a T, 1.3 trillion, yes.
You know, I remember when we started with no assets. So this is actually pretty remarkable because, you know, we have some of these large businesses, you know, growing at 20% a year. Now, those are Indian numbers. You know, those are very nicely profitable businesses for us. And so we're moving into the cycle now because finance is somewhat cyclical, where the kinds of businesses we're in, whether they're real estate, we're the largest commercial owner in India of real estate. That kind of business is coming back. Private equity fundamentals are changing positively, and the private credit is already doing really well. So it's a very good time for us. You know, I think just separately that our India business is our #1 business in the world in terms of rates of return for the investments that we make. Now, somebody's always got to be #1, but it's nice that I'm on an India show.
Yes, absolutely. And India is #1. That's good to hear and good to know.
Right. So we're doing a new fund. I can't say how big it's going to be because our lawyers will beat me up. But it's having very strong reception because our investment results in India are so good. So in a way, we're a bit like ambassadors for India in the developed world.
Well, India's lucky to have an ambassador like you, Stephen Schwartzman. But what's the ambition then for India and the new themes that you believe you would like to back? You talked about real estate, and that's, of course, been the big one for Blackstone in India. India's also building out data centers as it moves down the AI highway. What will be some of the new themes that you would possibly bet on in India?
Well, we're going to continue buying companies, and we switch in different areas. We've become very big in hospitals, for example, and we have probably around 40 companies that we owned in India. And I think we're the largest foreign direct investor in India. And so we'll continue adding companies at an accelerated rate because we'll have the monies to do that. In real estate, there's always exciting things to do as data centers are developing. There have been a series of announcements, as you know, of what people hope to do. We're one of those hope to do people also. You know, we've already been building some. Whenever you operate with a country that's on the right track, there are always new opportunities that you didn't see. We did something in the money management business there. That's done really well. Something in the housing business, that continues to do well. So, you know, India has a very stable political structure now, and it's doing the right types of things. You know, so we're finding an increasing number of things to do.
Not just you hope to do, but you intend to do.
Well, we've been doing them now quite well. You don't get to be as consequential as we are in India, without doing a lot of things.
Well, we look forward to you doing more things in India and hope India continues to be #1 when it comes to returns for Blackstone. But it's been an absolute pleasure. Thank you so much for joining us here on CNBC TV18, and we look forward to seeing you back in India as well.
Well, I love going to India, and we also have an amazing team of people in India, all Indians.
Yes.
Actually.
Well, we look forward to seeing you with your team in India. Stephen Schwartzman, thanks very much for joining us here in Davos. Well, you heard it from Stephen Schwartzman. India continues to be a theme that Blackstone will bet on, invest in. Lots of new sectors emerging there. Of course, they hope to do data centers in India, but a lot more conversation coming up for you here in Davos. Right after this short break, we're back with you in a minute. Our conversations continue here at Davos 2026, and there is a lot of focus not just on AI but also industrial automation. Who better to talk to us about what's happening in that space and what we could expect over the next few years than Gwenaëlle Huet at Schneider Electric, the CEO of the automotive automation business. Gwenaëlle, thanks so much for joining us here on CNBC TV18. So let me start by asking you about that. What's going on today and what should we be prepared for as far as automation is concerned?
Well, industrial automation across the world is having a turning point because lots of discussion around competitiveness of the industry across the world, but also sustainability is still top of the agenda. And finally, digitalization. Everyone is talking about AI, how this is applicable to industry.
Well, so are we seeing people now saying that, look, we want to spend more and move on to this next phase as far as automation is concerned?
Well, even more, they want to have concrete use cases. They want to understand how this creates value for their companies. Believe it, yesterday at Schneider, we've been awarded by the World Economic Forum on the Global Lighthouse for our industries, especially in China, but also in France, for having the cutting edge on AI first, but also on sustainability. So it is good showcase that in industry, in plants, we can deliver value in terms of emission reduction, in terms of cost saving, but in terms of also skills for workers in the plants.
What about India? And your plans for India?
I can tell you, we're working quite a bit with water industry in India in order to develop digitalization of the wastewater within India. So in particular in Delhi, but not only in other geographies, but also the steel sector because of hydrogen deployment, which is part of your government focus. And we've been developing some technologies to accompany those green steel development across India.
Yes, green steel is going to be a big issue because India is also being tariffed on account of European measures. But as you look at the many competing priorities that CEOs are dealing with today, is this now a hard sell or is it an easy sell to make?
Well, I can tell, AI is bringing competitiveness, good money, right? At the end of the day, sustainability, it's good business too. We have to reconcile all those different objectives. Sustainability, digitalization, electrification, all goes hand in hand in order to reduce the cost of the product that we sell for customers, right? So that's a bit of the angles that some of our customers are taking. It's not one against each other, how to create added value thanks to all those different pillars.
So which are the key growth markets for you today and what do you anticipate growth rates to be?
I have to respond that India is part of it, right? And especially because you know that we have more than 28,000 people in India. Manufacturing plants, R&D centers, but also developing for our customers in India. And this is really important to be very much local. That's our model, the hub model, to be local for local. And that's where we see a lot of expansion. India is a fantastic country, very good investment. As you were saying, green steel is one of the area, but not only, there are other sectors like hyperscalers investing into India, but also in the water segment, infrastructure overall, big investment. And this is where we need to electrify. This is where we need to digitize.
So what is that going to mean in terms of capacity expansion? Are you looking at adding more capacity in India to cater to the demand? Are you also looking at using India to innovate for the world?
That's what already we are doing. We are developing this hub, technology from energy management, but industrial automation. We are shaping what can be the overall trends in terms of R&D. So this is really important because this is nascent. We really want to have like investment in terms of R&D, but also scaling that across the world. So that's what's already happening.
28,000 people already, and do you see that number growing significantly over the next few years?
We need to have this partnership with customers and governments in order to grow. That's our aim, right?
So what's the message that you're sending out to folks here in Davos as you speak to them and try and get them to move up the value chain on industrial automation?
I think the core is that technology is an enabler. Technology is already available. When you look at technology, it's just something that we need to scale, we need to educate, we need to make sure that people leverage on the technology. But it's already there. Just one example. In the industry, only 5% of the industry is electrified on the heating side, only 5%. And technology is there to electrify by 60%. So it's not a question about availability of the technology. It's about know-how, it's about training, skilling, and making it scalable.
Well, if anybody can do it, I'm sure you can, Gunel. But thank you very much for joining us here in Davos and speaking to us on CNBC-TV18 about the future of industrial automation and what Schneider is doing on that front. Always a pleasure. Appreciate your time. We are going to take a break here and be right back with you. The conversations will continue. The sun is starting to beam here in Davos, and we'll bring you a lot more right after this short break. Welcome back. We continue our conversations here from the World Economic Forum's annual meeting in Davos. I'm Shireen Bhan. The focus here on CNBC-TV18 has really been to bring you global leaders, to give you a perspective of how they see 2026 and beyond, not just from the point of view of the global economy, but also more importantly, from the perspective of India. Joining us now is a man who has a pulse check on both the global economy as well as their plans for India. Benoit Bazet, the Chairman and CEO of Saint-Gobain. Many, many thanks for joining us on CNBC-TV18. Appreciate your time. Let me start by asking you about what you make of the global economy and how that's likely to play out for your company in the next 12 months.
Saint-Gobain, as a strategy, is the worldwide leader in light and sustainable construction. We have big trends everywhere. Urbanization in emerging economies, in India, fast growth, and also a housing crisis that we need to solve in Europe and in the US. So everywhere we have big needs for housing, but also commercial buildings and infrastructure. So overall, mega trends are there. On top of that, you have, of course, the climate adaptation, the climate change, the resilience of buildings and infrastructure. So it's all about the solution of Saint-Gobain, the strategy of Saint-Gobain that we implement locally. We are organized by country. So our leader in India covers all the lines of Saint-Gobain. It's very powerful because in the deglobalized world of today, you need to be flexible, you need to be agile, and you need to be deeply local. This is the governance of Saint-Gobain with a lot of megatrends that support our growth strategy.
Well, you know, you talked about India, and I'll get to that in just a bit, but the megatrends that you speak of that will be supportive of growth in an uncertain climate, what would you point those out to be?
Well, it's basically the needs of people in the buildings. We spend 90% of our time within buildings, at home, at work, in a school, in a hospital. So we need to pay more attention to buildings. Sustainable construction, it is just better buildings. So this is the way we deal with that within Saint-Gobain. You could have a storm in the US, you need to replace your roof with a better roof shingle. You need to work on energy efficiency in Europe. And you need to cope with population growth in fast developing countries like in Asia, like in the Middle East. So for us, the number one criteria of growth is the population growth. You take a country like Egypt, 27 new cities will be built in the next 30 years. We are there on the ground with an Egyptian CEO ready to develop all this.
Well, you know, speaking about your local strategy, let's address the India market and how that's playing out for you, and more importantly, what your future plans are for India, given the fact that it's an economy growing at over 7%.
India has been a fantastic journey for Saint-Gobain for more than 3 decades. You know that we are number one in every single of our product line. The strategy of Saint-Gobain is all around the building envelope, you know, the glazing, the ceilings, the partition, the floor, providing air quality, thermal performance, good well-being, productivity on the job site, including on infrastructure. So we have 82 plants in India, close to 2 billion euros. We have been basically doubling our size in sales every 5 years, times 4 in the last 10 years. And we keep investing not only on CapEx with new plants, but also on acquisitions. We bought Fosroc last year, which is the leader on what we call construction chemicals. It's all good for infrastructure. The Bangalore Metro is done with our waterproofing solutions. We have a lot of admixtures to decarbonize concrete. So we are investing a lot in India, CapEx, acquisitions, and also R&D. Innovation is at the center of Saint-Gobain strategy. We have more than 400 researchers in Chennai. So we are working on all those fronts, including sustainability. I'm very proud that Saint-Gobain participated in 70%, 70, of the sustainable buildings in India. All these being managed by fantastic teams out of India. Our India manager has been there more than 30 years within the group. So I think we provide a fantastic journey also to attract the best talents. We have been nominated again the best top employer in India. So that's a fantastic journey. And I'm very confident about the next 10 years. It will be the decade of India. Why is that? Because in India you have the scale, you have the growth of the population, and you have also the transformation of construction. What means new cities, what means new airports. I think you are going to build more than 300 airports in the next decade. Highways, so infrastructure, housing, aspiration from the middle class to have good quality housing. So a lot of transformation, growth, and scale. So all boxes are checked with a fantastic growth and good profitability in India because our teams are very, very strong and capable.
Well, as you said that if you believe that this is going to be India's decade, what is that going to mean in terms of incremental capex for you? You said that the business has been doubling in India every 5 years. So will things accelerate even further?
It will continue to accelerate, and we think big. When we buy a piece of land in India, we think about all the capex we can put for the next 10 years. We just bought last year a big land southeast of Chennai on top of already the world-class complex that we have in Chennai. So yes, we think big in terms of acquisitions, capex, accelerating on that, and also talents, because you need to prepare the talents for the future, and this is the way we make sure that we have the best teams in India. Of course, the brand reputation of Saint-Gobain in India, it's second to none. It's a very, very strong brand reputation. So all this is good investment for the future of Saint-Gobain in India and for the future of the country.
So acquisitions, you did say that is going to continue to be part of the India growth strategy for you. You talked about the one that you just did. Anything in specific, any areas in specific that you would be focused on?
Well, it's all the building envelope and infrastructure projects. For instance, we bought last year Menkol. It's a company dedicated to high-performance waterproofing. 4 years ago, we bought some insulation, stone wool, glass wool, to improve the efficiency on energy from housing to industry. One interesting point of India for us in the last 2-3 years that we are going to use India to export more. For instance, we built, as we speak, capabilities to export to Southeast Asia, to export to Australia. So not only it is a lot of production for the domestic market, but more recently, we have seen India as a very good base to export. Without saying that, of course, we have our own IT teams. We have close to 2,000 very capable talents to provide on the global scale the manufacturing 4.0, all the new digital solutions for Saint-Gobain around the planet. So it's a true leadership that we have also in this space in India.
So what is the value of how much you're exporting out of India today, and what could that number look like by 2030?
Today it's around 5%, but I'm quite confident it could be 10-15% in the next 5 years, because we are building the capabilities, we are qualifying the products, for instance, for Vietnam, for Australia, so I'm sure it will grow. And our current leader, he has been the CFO of the group for 6 years. First time in 360 years of Saint-Gobain that we had a non-French CFO. He did fantastically well. The prior leader retired after 45 years of bringing Saint-Gobain to this level in India. So we have these capacities in India, and I'm sure that we have the aspiration together to more than double in the next 5 years. For me, it's a super strong sign of confidence for Saint-Gobain in India. It's truly in the top 5 countries of Saint-Gobain worldwide. India is in the top 5 in terms of profit, and of course, super high, number 1 in terms of growth. Last year, we grew 10% of volumes last year in India. So it's even more than the GDP growth you mentioned of 7. Yeah. We outpaced the market by 3 points last year, which is the sign of the strength we have in India.
Well, strong growth for Saint-Gobain in India, top 5 markets for the company globally, and the top market from a growth point of view last year, and you hope to build on that and hope to accelerate the pace of growth in India on the opportunities that you intend to bet on. Organically as well as inorganically. Benoit Wazin, many thanks for joining us here on CNBC TV18. Appreciate your time here in Davos. The global CEO and chairman of Saint-Gobain on their India plans, very bullish on growth and the economy. From Davos, we'll take a quick break, but we'll be right back with you. Stay tuned. We're back in a moment.
Many thanks to you.
Thank you. Hello and welcome to our special coverage here from Davos 2026. I'm Shireen Bhan. We've been bringing you global newsmakers, headliners, business leaders to talk us through what 2026 looks like, what will be the trends that will shape the global economy, what will shape India's growth as well. Joining us now is someone who has a pulse check on global growth as well as a very keen eye on India. Michael Maybach, the global CEO of Mastercard, here with us in our Davos studios. Michael, always a pleasure. Thanks so much for joining us here in Davos.
Good morning, Shireen. Thank you for having me on a very chilly morning.
On a very chilly morning indeed. But what about the investment climate and the investment temperature? Michael, is it as chilly or is it heating up?
Hey, the investment climate is a lot less chilly. So we see a lot of investments across the digital economy from leveraging AI for better experiences, powering the digital economy. We see a lot of investment around cybersecurity in the space. So I think AI lowering the barriers to bring better experiences to people is just taking hold, and we're at the beginning of a whole new dawn around the digital economy. So exciting, very exciting.
I'll talk about the excitement on the digital economy in just a second, but let's talk about the real economy. And let me start by asking you about the trends that you're seeing in the US specifically. The tariffs have had an impact. Of course, not as severe as was expected, but what is the retail consumer telling you? What is the data telling you at this point in time?
When you take a look back at 2025, we're in a unique position as Mastercard. There's a lot of data, so we have a good pulse on the overall economy and particularly on the consumer. So you think with tariffs and people adjusting and companies adjusting, the overall economy adjusting, you should have felt more of an impact. But it was a pretty strong year, 3.2% on the GDP side overall for the globe, and the US fared very well in that. And you ask the question, why is that? So why is it adjusting? So first of all, we have seen a lot of the learnings from COVID. Supply chains are a lot more resilient, and there was a lot more focus on localizing supply chains, and that has helped in this instance. The private sector is very good adjusting when they know what's happening. So in the initial, first half of the year, that wasn't so clear, but it was pretty clear that what the private sector had to do in the second half of the year, and the consumer adjusted as well. So if you're uncertain as the consumer, but you happen to be, in the digital economy, you have a lot of tools that allow you to find out what's the best deal for me. If I don't quite know where prices are going, but I'm going to shop around. I can see what is my loyalty program offering me, where do I get the best deal. I might have my preferences out there, I get better advertising. All these things come together, the consumer adjusted. Consumers were also shopping early in the holiday season this year. They said, okay, I need more time to find out what I'm going to spend money. So they were very prudent, very savvy, and very intentional. And we don't see that changing in 2026. So the outlook is very positive, considerably positive, let's put it that way. So we feel it's going to be a year of continued expansion. You also saw that generally there was trade alignment happening. You saw, when I think about where global trade flows go between Asia and the US, there was a little less in the second half of the year, particularly with China, so that just kind of balanced out in a way, but it all has settled. And some of the more secular trends is continuous investment in AI and in technology that is propping up the overall economy. And you do see this continues strong household balance sheet. So all that together is a pretty positive outlook for this year.
So the outlook continues to be positive. But you talked about cross-border volumes, and that is a high-margin business for you on account of this economic confrontation and geopolitical risks and uncertainty. How much of a concern do you have on that side of the business?
So when we look at cross-border spending that's going on, you see cross-border spending in terms of travel. 2025 was a strong year on travel, and we don't see that changing. Just look at how full it is here in Davos. So people continue to travel despite headlines, and that's a fact. When you think about non-travel related cross-border spend, after COVID, non-travel related e-commerce really picked up, and those preferences have never changed. So this is a very strong business for us and for other players in the ecosystem. So people look around the world and see in the digital economy, the world is my oyster, I want to buy this, and it just happens to be available elsewhere, and consumers do that today. So we don't see that changing.
You don't see that changing either. Let's talk a little bit about what's happening in terms of payment trends, stable coins, and that's something that Mastercard has also moved to and integrated into your system. What should we expect? What will be the trends that will shape 2026?
Yeah. If you look at the headlines from a trend perspective, so stable coins, digital assets is certainly one of them. The whole space of agentic commerce is another one. And then more fundamentally cutting across both of them is generally the need to secure the digital economy. So those are three big trends that are at play. Just spend a little bit of time on each of them. Stablecoins, very interesting from our perspective. So here's a technology that facilitates quick and easy payments, programmable payments between businesses and between people. So as a payment powerhouse, the operating system of the digital economy, as I like to describe ourselves, of course we have to offer that. It's built in our network. Our network is ready to settle in stable coins everywhere around the world. And we see demand rising. Think about it in the context, for example, of cross-border payments. So those are today oftentimes payments that have to be pre-funded. With stable coins is instant settlement. You don't have to do that any longer. From a capital perspective, it's a lot more efficient. For consumers or businesses, it's most likely going to be a little bit cheaper because the money arrives faster. So a lot of advantages there in that use case and many other use cases out there. We're excited about digital assets from that perspective. Agentic. So the world of agentic AI in the world of payments manifests itself, for example, from a user experience. If you decide you're going to go on your favorite chatbot and you ask your chatbot, I have to do this trip and I'm needing the following things, and it gives you a list of 10 items that you need for this, let's call it camping trip. In today's world, you might go on your favorite search engine and then hit different websites to buy what has been recommended to you. In the world of agentic commerce, you could just check out on your chatbot. And how do you do that in the world of payments? The chatbot needs to be registered. Is it a real chatbot? Is it verified? What happens if something goes wrong? So all the things you take for granted when you pay with Mastercard today. So we have built that into the agentic commerce experience. And that is bound to take off because consumers like this kind of experience.
How large is it today for you, agentic
It's
commerce?
early days. It is early days. So it will be, I think, in the space of consumer payments, it will pick up first because consumers, particularly younger consumers, like to try these experiences out. It will be a good experience. But just think about the world of intercompany kind of trade flows, procurement, for example, when in a company something has to be bought from one of your vendors, and agents do this autonomously going forward. And the payment is enabled, so some sort of resource needs to be bought for the company. All of this starts to become highly automated, powered by an agentic commerce experience where the payment ecosystem and the corporate ecosystem just click into each other. Exciting times. Again, early days. I think consumers are a little ahead. But this will follow, and I think we're going to see it grow very significantly.
So what kind of investments are we talking about? You have, of course, been investing in AI, also, cybersecurity, about $11 billion over the last few years has been spent on that. But
I think this was the number when we last spoke. It's much more now.
I would imagine so. So
exactly.
what can we expect in terms of future investments now?
Yeah, so for us, we invest in emerging technology. We have to because we provide those choices to our customers, and if agentic commerce is the latest thing, or stable coins, we have to have it. So we are investing. But across the board, the investment in cybersecurity is really needed, and that's a topic that's not talked about enough. So with this ever-growing digital economy and our more digital lives by the day, keeping that digital economy safe is important. It's important. Particularly when you look at that AI is not only serving good purposes, but also it's serving the fraudsters and the scammers and the hackers. So we have to arm up. It's a bit of an arms race out there, and the industry overall is doing a good job, and we're taking a leading position here in investing and ensure that the 160 billion transactions run through our network every year are actually safe.
Well, speaking of potential risks and challenges, President Trump has made an announcement as far as an interest cap is concerned on credit cards, and I know that you don't set the rates, banks do, but the unintended consequences of a move like this, which is intended to actually make things a lot more affordable for the consumer, but what are the unintended consequences of it?
Yeah, it's an important conversation around affordability for citizens in the United States and other countries around the world. So there was a call by the president for an interest rate cap. The industry, particularly banks, have engaged on that and highlighted the importance of the affordability conversation, but it's also highlighted one has to think through what are the consequences on the availability of credit. Now, we don't set rates, as you said, but we believe in the power of the private sector finding the right balance to ensure that credit is available where it is really needed. Imagine you need a bridge from your paycheck to the washing machine and it is broken down. How do you do that? So if you don't have credit available at short notice, then that might be problematic. So those are all things to thought through. I think this is early days in that conversation. But it's an active conversation, and we'll see where it goes.
I want to talk about India. And Michael, you are a regular visitor to India. And of course, Mastercard has significant operations in India. And I know that you see India as an innovation hub for Mastercard, not just for India, but to innovate for the world. What's the latest on India?
Yeah, so there's always the latest for India. Earlier we were talking about payment trends. And if you think about how these payment trends play out in India, so yes, by many standards, the largest digital economy in the world. We talked about this many times before with the India tech stack pulling more people in. So if you think about the cybersecurity trend, for example, that is really needed. So is the Indian economy, India as a country, focused on cybersecurity? Absolutely. So big praise there, in fact. So we have an MOU with CERT-In, your national cybersecurity agency, to ensure that across the board the ecosystem is secured. So, innovations like biometric passkeys, where you look at any kind of your device and use your biometric identity that's linked to your identity database that you have built in the country, is just a major, kind of leg up versus many other countries on that. So we're excited about that. We talked about agentic commerce, so there's already conversations on where that could go. When I think about digital assets, that's an earlier conversation in India, but I always find there's this hunger to use latest technology, bring it in a scalable and safe way, and that's always what we welcome, and we feel welcome at the table. So more to do. We've continued to invest in our footprint in India to deliver more innovation out of India for India, but also out of India for the world, so we do both. So we have now 9,000 people, so about a third of our employees based out of India. We just opened an office in Hyderabad, which is now our 6th presence. So it makes my trips to India even longer because I'm trying to go all over places and see our colleagues.
So are you setting up an AI garage for Mastercard in India?
That's been said a long time ago, actually. It's in Gurgaon, and some of the brightest minds in AI are working for us there, thinking about what the next experiences could look like.
So let me end by asking you, we talked about trends for the digital economy that you're going to be focused on in 2026, but outside of the digital economy, what are you going to be watching out for? What are the red lights on your dashboard that are blinking at this point in time?
Right. So, post-COVID, there was a supply chain conversations. How can I make my country, my economy more resilient? So we've seen more focus on self-sufficiency in many countries, and that's a good trend. So for us as a company, we reflect that in stronger country partnerships, as in India, to have more present. But I think something to keep in mind is, and it could be a red light, it's probably a yellow light right now. It brings me right back to cybersecurity, because the hackers, the scammers, don't care about borders. They don't care about what's happening in a country. These are global trends and global threat actors that are at work. So I think as a global community, and this is why coming together here and talking about cybersecurity is so important, we got to secure across the board. So threat sharing, playbooks that cut across are really important. So I'll keep that in focus, and we'll have more of these conversations over the coming days here in Davos. A very important topic, cybersecurity.
Yes, it is a very important topic, and perhaps a topic that will generate a lot of discussion and debate in the meetings that you have. But Michael, always a pleasure. Many thanks for joining us here in our studio in Davos. We look forward to seeing you in India on your next trip there.
I'll see you in India, Shireen. Thank you for having me.
Thanks for being here. With that, it is time for us to take a break, but our conversations will continue. We're live from Davos 2026 from the World Economic Forum's annual summit. We're back in a moment with more. Welcome back. Our continuing coverage from Davos 2026 is on here on CNBC-TV18. Joining us now to talk to us about the road ahead for his business is Neeraj Kabar of Apollo Tyres. Neeraj, always a pleasure. Many thanks for joining us here. So 2026 bodes well for you. You know, on the back of GST cuts, the auto sector in India has certainly got a bump up. What's demand looking like?
Well, I'm pretty bullish. As you know, I'm always optimistic. Demand is looking at a double-digit figure. Apollo is doing very well in both the commercial segment and in the passenger vehicle segment. Also, we went to two-wheelers for now the past 3 years. So we're gaining market share. I think India, also on the OE side, they're very positive. GST has really helped us, specifically the consumers, to have more money in their pockets, thereby spending more money on tires. And it's also a safety issue because people were still holding back to change their tires. Now they have free money to change their tires, so safety becomes another important part given road accidents increasing in India. So I'm pretty bullish for 26. Both CV segment and car segment, I see a double-digit growth.
But Europe, a different story?
Europe is a very, very challenging story. As we all know, and even in Davos, everyone's talking about how Europe is going to come out of this mess. Yeah, it is a very difficult story. We are keeping up with the pace of the market, but it's only growing by 1 or 2%. because we are a very niche player. We sell in the high segment of the market. We are selling more on the UUHP sizes, which are 17-inch and up. Profit remains a challenge because there's hardly any growth, but we're still above the water. We are doing better than the market, but it still is a very tight situation.
With any indication of a revival?
I don't see any indication as yet, no. We are seeing a lot of inflow of Chinese tires coming in. That's another problem. So the budget brands are growing in Europe and the higher brands are coming down. So the middle segment and the lower segment is growing because tires are coming for cheap.
You know, you talked about the Chinese threat, and how big of an issue is that? How big of a concern is that for you at this point in time?
Well, for India it's fine. We have tariffs to block Chinese tires coming in, but in Europe, yes, it is a challenging time. So we're trying to see how we can cut our costs in order to try and beat them with better technology. So we're investing a lot in R&D and in building the brand to try and see how we can compete with the Chinese brands in Europe.
Raw material costs, you know, your peer has spoken about raw material costs going up. What is it looking like for you?
Well, right now I think it's stabilized. It had gone up, but in the coming 2 quarters I see it at the current levels. Maybe it go up by 1 or 2%, but nothing drastic.
Okay, so what could be the levers that you then look to drive growth for you forward with the uncertainty in Europe continuing?
Well, first coming to India, as you know, we sponsor the India national cricket team. So that is in a big way.
Worried?
No, not worried at all. I think we're doing very good.
Given the past history, no?
No. I told some of the journalists before that I'm not one of those. The company is built since 1976. In fact, this is our 50th year. In November was the first tire that came out in 1976. So the company is built with very strong foundations, set of 20,000 people, families that we have to look after. So we are here to stay. That's all I want to tell you. So yeah, to build the brand, we've invested in the cricket team, and that's a huge pride for us. It's not only Apollo investing in Apollo is invested in the country's pride, which gets the nation together. Hopeful that they win the T20 World Cup. I hope they're listening to me. But no, yeah, so that in itself since October has given us a huge benefit in the rural markets for passenger car and two-wheeler. So because we are out there, it's very difficult to get your brand recognition in the really rural markets. And today in India, everyone watches cricket. And so we've seen expansion, we've seen distribution increase in India, especially in those markets where we are gaining market share. Coming to Europe, I think Europe, the challenge is going to be how we can do cost savings on our overheads, which we've already started, how we can come down on A&P spends, on our advertising and publicity. So looking at an overall cost structure, we will also benefit, as we announced earlier this year, that we are shutting down our plant in the Netherlands. So that's a huge cost base that's coming out. Okay, and most of the production is going to be moved to the Hungary and to India. So you're looking at a low cost base coming into a higher profit pool. So margins will increase, definitely. It's a matter of time. We've already announced it. Hopefully by June or by July end, we'll be done with the Netherlands factory. So I see that cost structure coming down, and then becoming again competitive in Europe is the next driver for us.
So what should shareholders look forward to? You talked about the divestiture of the Netherlands plant and how that could provide or aid margins going forward. What should shareholders look forward to?
Well, we're in it in a positive run, I would say. I see India and Europe growing with healthy margins. And yes, that's what the investors should look at.
Well, we wish you the very best of luck, Neeraj. As always, thanks very much for joining us here in Davos, and good luck with the business and good luck with the Indian cricket team.
Good luck to all of us.
Absolutely. Well, with that, it is time for us to take a break here, but the conversations will continue. More newsmakers coming right up on CNBC-TV18. Welcome back. Our coverage continues here at Davos 2026. I'm Shireen Bhan. The tariff uncertainty, the geo-economic and geopolitical volatility, all of that is having an impact on investor sentiment. CEOs are anxious and they're feeling anxious about the state of the world, and it is likely to have an impact on how they decide where to invest and when to invest. Joining us now to talk about PwC's annual CEO survey, but more importantly to also talk us through the trends that could shape 2026 on the back of the conversations that they're having, is the global CEO of PwC as well as the head of their India business, Mohammed and Sanjeev. Always a pleasure. Many thanks for joining us here on CNBC-TV18. Appreciate you joining us. Let's start with the PwC CEO survey. So feeling anxious, that's the headline, isn't it?
Yes, indeed. Sharon, first of all, thank you for having us. It's always a pleasure to be here with you. But anxiety is real. And, the results of the CEO survey are confirming the anxiety level that we have on multiple dimensions. The first one is around growth. We find out that only 30% of the global CEOs are thinking that they have a trajectory to grow their business in 2026. Only 30% of them.
And that's a 5-year low, I believe.
That's a 5-year low. And, it's lower than last year, obviously. And, it's very interesting to see. Even though they have less confidence in their ability to grow their business, they actually have confidence about the global economy, which led us to believe that there is a challenge around business, but also the leadership acumen that is required to run businesses today in the midst of that uncertainty that we are dealing with. The second big finding that we also have is around all this capital that is being invested today on artificial intelligence. Not all CEOs are seeing the benefits of artificial intelligence when it comes to the top line of the business on the revenue side, but also on the bottom line. It's only 12% of the CEOs that we interviewed that said that they're seeing the benefits both on the top line and the bottom line of the businesses.
So the ROI question still not settled, far from being settled.
Far from being settled, because about 56% of them are saying that they're not seeing yet the ROI of AI investment. Now, we have our own beliefs about what should be done when it comes to artificial intelligence, but the results are telling us that more to do on the artificial intelligence front, but also a lot of questions around what is the leadership of the future in this environment that is changing very, very fast, every day, on the technology front and on the geopolitical front, both at the same time.
Well, I'll talk about the leadership challenge in just a second, but Sanjeev, let's talk about India, because that is perhaps one of the bright spots that the world is focused on, and especially here in Davos. That is something that we are hearing from CEOs that we speak to, and that's showing up in the survey as well.
Yeah, exactly. I mean, while Indian CEOs are not so sanguine about global growth, again, a 5-year low of 45%, they are much more sanguine about the growth in India, 77%. Again, lower than last few years, but still very high quantum. And I think that's got to do with the fact that, not only is India the highest growing economy, 2025 India has been fairly resilient. There have been a bunch of reforms that the government of India came up with, including, the labor reforms, which we have been talking about at GST rationalization, et cetera, a bunch of FTAs signed. The FTA with EU somewhere nearby.
Likely to be closed on the 27th of this month, yeah.
So not very far away. And I think just gives Indians the confidence that they ought to be investing in India, being part of the global value chains as much as possible, boosting productivity, and also scaling their businesses, which they possibly have done in a bit of a sandbox environment so far.
Yeah, India, Mohammed, and the survey says that it is the confidence in India as an investment destination has gone up significantly over the previous survey. What are you hearing from people that you speak to on the kinds of investments that they would like to do in India, the sectors that they would like to invest in? What's changed?
Actually, first of all, we have to acknowledge that it's a great thing that just happened. Because now India is actually number 2, right? Yeah. At par with the UK and Germany when it comes to investment destination. The US still remains the number 1 destination for capital investment. But when it comes to India today, with the talent pool that you have in India, the size of the population and the growth trajectory of the country, we are seeing more and more companies globally that are looking to invest in India, not only in the services sector, but also in the manufacturing sector. That's the next wave of growth that we're also seeing in India. And of course, India is now part of this wave of investment in artificial intelligence, not in the large language models, but in the data centers and the computing power that's required to generate all the benefits of artificial intelligence.
Yes, that infrastructure build-out is just about starting to happen. But when you talk to clients about foreign direct investment, flows, at this point in time, do you think 2026 is going to see more stronger flows into markets like India?
Yes, we actually believe that independent of all the geopolitical tensions that we are seeing today, and artificial intelligence is here to stay. Now, many CEOs are saying that they're not seeing the benefits, but they're not stopping though when it comes to investment in artificial intelligence. So we believe that investments are going to continue to go into India based on the stability of the country, but also the opportunity that you have in the countries. Not only on the supply side, which is the people that you have, the ability to have on the manufacturing footprint, the services economy, but also on the demand side because of the size of the population that you have today.
What are U.S. CEOs saying today? And of course, a lot of it is going to be dictated by what President Trump decides to say or do. But outside of that, while the U.S. continues to be the #1 investment destination, what are U.S. CEOs telling you today?
Today, we are hearing from U.S. CEO that the fundamentals of companies around the world, as honestly, when you ask me the question about the U.S., especially in the U.S., the fundamentals of companies are good, independent of all the discussion that we have around artificial intelligence and geopolitical. So what we're hearing from CEOs, they will continue to invest. Capital will continue to be deployed because the opportunities still exist. Now, we all understand with many of the CEOs around the world that they will have to have optionality of being able to be agile in the allocation of capital. But nobody is stopping. That is something that is very different from last year. There's an acknowledgement that investments have to continue because more opportunities will lie in the future. Challenges, but opportunities at the same time.
Well, speaking of challenges, one of course the challenges the world is faced with in light of the tariffs is this business of once again reworking supply chains, reshoring to the US, which is something that President Trump is asking across industries to do. What is all of that going to mean in the near term as far as investment decisions are concerned?
First, it attracts investment. Flow of capital is moving around the world. But as you know, it's not just about the US. The same conversations are happening around the world, whether it's Europe and Asia, US and Asia, etc. So this is a conversation that is global when it comes to reshoring and figuring out where capital needs to be deployed. As I mentioned earlier, Germany and the UK are also the second destinations when it comes to capital allocation. So we are seeing movement of capital today based on opportunities. Tariffs are indeed having an impact on the design of supply chains today, but people are working it. Okay, there are short-term impacts that we're having, but eventually people know where to invest the money based on having the right supply chain that they need to have. But they're also going after the big opportunities. I would tell you a lot of the CEOs that we talk to, they focus on growth, and they're going where the growth is going to be.
Well, yes, and global growth estimated at 3.2%, so steady, pretty much where we've seen it. But, Sanjeev, let's also talk about the asks from the India side. I mean, you mentioned many of the changes that have already happened. We've got a budget coming up. What are global CEOs saying in terms of what else they would like to see India put on the table?
See, one of the things which continues to be a challenge is, in terms of factor cost, is the cost of logistics. I think we have done well. But still we're about 8%, a little over 8%. I think that still makes us a bit uncompetitive, I think the other piece really is about clustered development. I think that's been an ask of the industry as well, that can we do clustered development as, for instance, we have seen in the eastern neighbor and so on and so forth. I think that's one of the other things. And one other thing is really about development of our urban infrastructure. I mean, we talk about, the labor code has come in, but we talk about more and more women coming into the workforce. That does require urban infrastructure development so that it is integrated at some level. And I think that's something which possibly needs some more effort. The focus on healthcare and education, which is there. And I would say one more thing, which I keep discussing, at least in India, maybe a bit of a rehaul of our education system so that our STEM graduates are really relevant for the disruptions that are coming through today. So they're still at cutting edge, as they have been over the years. So a bit of a rehaul of our education system so that the pride that we have in our STEM students continues. And I think that's an area of investment as well.
Well, what about PwC's plans for India, doubling down on the business there?
Absolutely, and Sanjeev knows. He's the one actually leading the way for us in India, and absolutely. And again, for us, we look at India as two parts of India. Access to talent, critical. You just mentioned the education system, but you have one of the largest talent pool in the world, with the STEM graduates that you have. And when you think about the demand on new business model, etc., we are doubling down on getting people in India. But the second part, India is also important for us because a lot of the multinationals that we work with outside of India want to access the Indian market. And you also have giants in India, large corporations that are not only working in India to increase their footprint in India, but also they're trying to go outside of India. So, India is absolutely a focus for us at PwC.
The leadership challenge that you spoke of, the leaders of tomorrow, what will they look like?
The leaders of tomorrow are leaders that can learn fast. Learn not only about technology, but what's happening geopolitically, so they can understand how to run their businesses with agility in this new age of uncertainty, where instability is now the norm. The leaders of tomorrow are the ones that can do scenario planning, but continue to execute on the strategy with this agility when they learn something in the market that is changing. The leaders of tomorrow are the ones that do not stop. They're the ones that learn and continue to execute the strategy.
Well, we hope that we continue to see leaders having to learn. They have no choice, by the way, in the environment that we're in. And agility, of course, will continue to be the name of the game. Always a pleasure. Many thanks for joining us here in Davos. Thanks very much for taking us through the highlights of the PwC annual CEO survey, but more importantly, what the world looks like in 2026 and what will be the trends that will shape it going forward. We'll take a break. There's a lot more coming up. Don't go anywhere. Back in a moment with more conversations. As I've been pointing out, this year we have the largest representation of Indian states here in Davos pitching the India story. But perhaps the first Indian state and the first Indian chief minister who made a pitch here to investors in Davos way back in the day was Chandrababu Naidu and the state of Andhra Pradesh. And of course, they are Davos regulars. Joining me now for a conversation here in Davos on what the future for the state holds, the deals that have already been done, but more importantly, the conversations that are open and are hot. Joining me is Nara Lokesh. Nara, many thanks for joining us and great to have you back with us here in Davos. You did do a lot of deals, not in Davos last year, but outside of Davos, but on the back of conversations that may have happened here in Davos. So I know Davos is not about deals for you, as you say, but it's about conversations. So which conversations are looking likely that they will lead to deals?
Thank you very much for having us here. It's always good to be back. No, Andhra Pradesh views Davos twofold. One is we're here to learn, we're here to understand what are the sectors that are hot, how things are going to roll out, where are investments flowing into. And last year we started a lot of conversations across various sectors here, and you've seen announcements, groundbreaking, and so on and so forth already. So a lot of conversations have started. You'll hear good news in the next 90 days.
In the next 90 days, that's a specific time frame.
Absolutely. In Andhra Pradesh, we are all about speed of doing business. So for us, 90 days is good.
What should we expect in the next 90 days across which sectors?
Across.
Because you have many economies that you're focusing on, from the maritime economy to, of course, the digital economy.
We have close to 22 clusters. So ranging from aqua, cement, renewable energy, all the way up to quantum. So we're looking at investments across all these sectors, across 22 clusters. So that's something that makes it exciting. And Andhra Pradesh is very cluster dependent. So we're very clear that all the companies of a certain sector should be in one cluster so that they can stand the test of time and make economies of scale meaningful. So that's been our focus. So you'll hear good news soon.
Okay, good news and a sizable investment amount as well, just as we saw with Google.
See, Andhra Pradesh just came out of the Partnership Summit. We worked with CI, there have been great announcements. We're now busy grounding all these announcements. And it's an ongoing fight, right? I mean, when states compete, India wins. And it's really exciting time for India, where now we have close to 10 states here in Davos. And all of us are competing in different sectors. So it's very exciting.
Well, when states win, India wins. That's a nice way of putting it. But, specifically as far as your ambition on AI, your ambition on creating a quantum valley, etc. What can we expect now in terms of next steps, in terms of the next stage of announcements on each one of these?
No, I think, one is the high-tech industry, right? Yes, quantum, India's first 153 qubit quantum computer is going to land in Andhra Pradesh.
I believe this month.
This month, yes. And a lot of work around it is already gone in. We're working on the use cases for it, right? And that's been a lot of work already going in. Apart from that, we're also looking at sectors like even glass. How can we build a glass city, a space city, a drone city? So if you've seen, Skyroot has made a big announcement in terms of building a center now in Andhra Pradesh. So that's where, these 22 sectors are very, very important for us, very focused in terms of delivering. And a lot can happen over a cup of hot chocolate. So that's what we have.
How many cups of hot chocolate have you had?
So a lot can happen, and we've done it in the past. The entire conversation with Cognizant started here in Davos. Started with 8,000 employees committed, and now it's up to 25,000.
Did the conversation with TCS happen here in Davos as well?
Yes, in Davos, and really exciting in terms of
how many more takers for that land policy and the IT policy that you've got in place?
The lift policy is very exciting. I think it's a very unique competitive advantage that we have built, where other states are unable to compete with us. It's open to Fortune 500 companies, and that's why I said in the next 90 days you'll hear a lot more announcements where companies are going to leverage on the lift policy.
On the lift policy specifically. So any more out-of-the-box ideas like the one that you announced where you're virtually giving away land for a rupee?
Well, that's just one part of it, right? So land is an important component, but it is one component. As a state, we believe in a very tight integration in our clusters. So a vertical and horizontal integration. Now, what I mean by verticals, right? What does it take to make an end product? Who are all the players in it? So I want the entire Rolodex. I'm building that entire ecosystem done. That's the vertical. The horizontal is where, again, my ministry, human resource development, plays a very important role. Is the talent pool there? Is it ready from day one? Are the testing facilities there? Are the certification facilities there? Is there the innovation ecosystem in that sector there? That's where this tight integration is something that Andhra Pradesh is offering. We already manufacture 50% of India's air conditioners. And with the 3 deals we have done, we'll be at 70%. So we have to do like this, a very tight integration across sectors.
So which clusters, you just gave us an example of what you've been able to achieve on the air conditioning manufacturing side. Which other clusters do you believe have the potential to achieve that kind of scale very quickly?
No, automotive is a cluster, renewable energy, air conditioning, space, drones, electronics manufacturing, quantum, pharma, medical devices manufacturing.
Is there anything that's not?
22 sectors, so we're quite clear given, I mean, Andhra Pradesh is blessed with the second longest coastline, right? So there's a lot of focus we can do, and a lot of work that can come in. So that focus is enabling us to execute at a scale that other states are unable to.
You know, you talked about the coastline, and I know that shipbuilding was also something that the state is considering as a possibility. Any forward movement on that front?
Yeah, absolutely. We're talking to a few of the large ocean liners to look at one of our ports. So we've signed an MOU with Moyle Maersk in the past, and the conversation is coming to now. It's fructifying in terms of exactly which port, what are they going to do, and so on and so forth. We're also using a large coastline to attract investments in maritime defense. So Sagar Defense, which is a very popular startup in this ecosystem, they're setting up their facility after Pune in my state. So again, the maritime defense cluster is now coming about.
So, you know, what does it mean in terms of jobs? How many jobs have you been able to create on the back of prioritizing these 22 sectors? And what's the ambition, what's the aspiration from here? What do you believe that you can deliver on?
Well, we've done about 400,000 jobs already. Our aspiration is 2 million in 5 years. It's a promise we made in the election campaign. So we're really excited on delivering it.
Well, you know, the one thing that you intend to focus most on in 2026?
Sharpen our speed of doing business. If you look at it, Andhra Pradesh has been delivering on that promise. I think we really want to work with the government of India, look at decriminalization of various laws. We're looking at also labor reforms, so where we can sharpen this and have a unique competitive advantage compared to any other state in India.
So you believe Andhra Pradesh is back?
Absolutely. I mean, we've attracted 25.3% of investments that have come into India. And that's what makes Andhra Pradesh now very unique. We're back, we're ready to do business.
You're back and ready to do business. I'll close by asking you, what is the message that you're sending out to global investors and domestic investors here?
No, Andhra Pradesh is ready to do business. We are just one WhatsApp message away. And it's exciting times, and India is the place to be. And for all the global investors, you know, India is the future. So you should look at India and definitely give Andhra Pradesh a chance, and we won't let them down.
And WhatsApp Nar Lokesh to ensure that you get all the approvals that you need done and out of the way.
Absolutely, we'll have a WhatsApp group for them ready and ensure that we deliver on the promise.
Welcome back. Here's a look at the big stories that we're tracking for you today. Less than 24 hours before reaching Davos with the largest ever American delegation, President Donald Trump has ramped up the pressure on European leaders over Greenland and the Gaza Peace Board, where a permanent seat costs $1 billion. Speaking to reporters in Florida, Trump reiterated that the U.S. must have Greenland, adding that Denmark can't protect it. He also claimed that NATO allies would not push back too much on his claim over the island. Trump doubled down on his Greenland bid on social media too. The US president shared AI-generated images of him putting an American flag on Greenland soil alongside Vice President J.D. Vance and U.S. Secretary of State Marco Rubio. He also posted edited images depicting American flags on Greenland. While clarifying that there would be no going back on Greenland, Trump said on social media that he will be meeting various parties to discuss USA's bid for Greenland in the alpine town of Davos. However, he did not clarify who he will meet. He added, and I quote, "Everyone agrees there is no going back on Greenland." He also claimed to have had a very good telephone call with the NATO Secretary General Mark Rutte. Trump also posted screenshots of Rutte's messages telling Trump he is committed to finding a way forward on Greenland. He also posted a screenshot of messages he received from French President Emmanuel Macron, who urged him to participate in G7 meeting after Davos. Trump threatened to impose 200% tariffs on French wines after President Macron refused to join the proposed Gaza Board of Peace. Trump wants European allies to sign up for the Gaza Board at Davos, but EU leaders remain wary after Trump invited President Putin to be a part of the Gaza Board. Kremlin said it is reviewing the invite.
Give your thoughts to President Macron. Thank you. Will not join the Board of Peace.
Oh, did he say that? Well, nobody wants it because he's going to be out of office very soon. So, you know, that's all right. What I'll do is if they feel like Costa, I'll put a 200% tariff on his wines and champagnes, and he'll join. But he doesn't have to join. If he said that, you're probably giving it to me a little bit differently. But if he actually did say that, but as you know, he's going to be out of office in a few months.
Trump also took aim at the United Kingdom in a bid to defend his annexation plans. He called UK's decision to hand over its sovereignty of the Chagos Islands to Mauritius an act of great stupidity. The UK handed over the Chagos Islands to Mauritius in May last year, but retained military bases in the territory. U.S. Secretary of State Rubio called it a monumental achievement at the time. Remember, leaders of 8 European nations slammed President Trump's tariff threat over Greenland. Speaking at Davos today, Ursula von der Leyen, President of the European Commission, cited a landmark free trade agreement with a bloc of Latin American countries. She said it was a sign that Europe was choosing partnership over isolation.
This agreement sends a powerful message to the world that we are choosing fair trade over tariffs, partnership over isolation, sustainability over exploitation, and that we are serious about de-risking our economies and diversifying our supply chains.
India and the European Union are likely to conclude talks for a free trade agreement by the 27th of January. Sources tell CNBC-TV18 that the proposed deal respects the red lines on agriculture and dairy. Both sides expect to sign and ratify the FTA by the end of the calendar year. Parikshit Luthra has all of those details on what the trade deal could entail. Parikshit?
EU Council President Antonio Costa and EU Commission President Ursula von der Leyen will be the chief guests at the Republic Day this year. The major highlight of this visit would be the India-EU FTA. Sources say EU-India are likely to announce the conclusion of FTA talks by January 27. But this doesn't mean that the FTA will come into effect immediately. The conclusion of talks will be followed by finalization of the legal text of the FTA. EU Commission will sign the FTA with India after being authorized by the EU Council. The agreement will be approved by the EU after consent from the European Parliament and the decision from the EU Council. Sources say the EU will work towards signing and completing this entire exercise and ratifying the FTA by 2026. CNBC-TV18 has learned that EU has been amenable to India's demand for greater market access for Indian labor-intensive exports, and both EU and India's red lines on agriculture and dairy have been completely respected in the FTA talks. Market access for European automobiles has always been a major issue. We learned that automobile exports from EU to India will be subject to a tariff reduction quota. The FTA to fix a tariff reduction quota for cars as per fuels and engine capacity, and tariffs on cars will come down in phases. However, discussions on tariff rates and quotas for automobiles is still on. When it comes to wines and spirits, the EU industry, we are told, is set to get better market access in India. We also learned from sources that EU will not compromise on the carbon border adjustment mechanism, but will support Indian companies in their decarbonization efforts. EU has to maintain a level playing field, according to sources, and the CBAM has actually encouraged countries to develop their own carbon credit systems. Now, this is a stand that has been taken by EU officials in talks. After the conclusion of FTA, the EU will begin a major outreach exercise to accelerate trade between the two regions. EU and India will also sign an MOU on facilitation of mobility of professionals during the high-level state visit.
Right after Davos, the next weekend, I will travel to India. There's still work to do, but we are on the cusp of a historic trade agreement. Indeed, some call it the mother of all deals. One that would create a market of 2 billion people, accounting for almost a quarter of global GDP. And crucially, that would provide a first-mover advantage for Europe, with one of the world's fastest growing and most dynamic continents.
And that's all the action from Davos. But back home, the Nifty hit a 3-month low after posting the biggest single-day fall in 10 months. 10 lakh crore rupees in investor wealth was wiped out in today's trading session. All sectoral indices closed in the red. Nigel D'Souza is here with all of those details. Nigel, it's red across the screen today.
Well, the weekly expiry day goes to the bears. The Nifty recorded its lowest close in the last 3 months. The Nifty Bank was putting up a bit of a fight, but that as well breached the 20 DMA, which is a crucial technical level on the downside. The market breadth, well, it was firmly in favor of the number of stocks declining. Close to 7 stocks declined for every 1 stock that advanced, which clearly indicates signs of capitulation in the broader markets. There were very, very few Nifty gainers that were up, 0.5% or thereabouts. Only Tata Consumer and HDFC Bank managed to end with some gain from the Nifty pack itself. The mood of the markets actually was showing, because even average earnings did get slammed into, and good news was ignored. Cases to point out could be UPL, where there was some good news. They will be unlocking some value. The stock ended down. Havells, the numbers weren't so bad, but the stock was down. And LTI Mindtree as well, similar as the case, numbers were pretty okay. The street was cited valuations, that it was expensive, and that's why all 3 of them did end lower in trade. The sector that's been getting pummeled and continued to do so even in today's trading session was the real estate stocks. Oberoi Realty was down, Lodha gave it company on the downside, and thrown there Godrej Properties as well as Prestige Estates. All those stocks did see intense selling pressure. There were a few standout winners. Hindustan Zinc delivered a good set of numbers. That's the only way to play silver. That stock ended higher in today's trading session. Dalmia Bharat as well, there are hopes that East India cement pricing as well as demand will recover. So that's why both those two were standout winners. The question is, where does the Nifty go from here? Well, one thought that we were sitting at fresh all-time highs, but very quickly we have corrected close to around 1,000 points. The next crucial level is just 100 points away from current levels, around the 200 DMA, where the Nifty has support at around 25,100. Can the bulls fight back from here? Well, we'll have to see. But for the time being, the structure on the Nifty itself is extremely weak. And the broader markets, immense selling is what we saw. And let's see whether or not, we could see a bit of recovery. But otherwise, things looking extremely weak. And the bears will go home with all the gains today.
Absolutely, Nigel. Nifty at a 3-month low and the mid-cap seeing big cuts. Thank you so much for those details. Now, more than 100 Indian CEOs are in Davos this year, underlining India's growing influence at the World Economic Forum. From Mahindra's plans to list its electric 3-wheeler business to Cognizant's potential India IPO and TCS's ambition to become the world's largest AI-led technology services company, business leaders outline their growth roadmaps in conversations with CNBC-TV18 Shireen Bhan. Take a look.
We will continue to see EV grow. EV today is about 7% or so of our sales. And We expect that to grow to 20%, then 30%. The key is going to be around infrastructure.
Many of your businesses have seen significant investments but are now targeting significant growth plans. So what can we expect realistically? Are we likely to see any listings from the Mahindra Group in 2026 or perhaps in the near term?
Not in 26, but in 27, we will look at listing our last mile mobility business, which is electric three-wheelers.
Okay.
A business also that has done phenomenally well.
Are looking at the possibility of a secondary listing or an IPO in India. Where have things progressed on that front? How close are we to an actual decision being taken?
So, Shireen, we are working with the regulators in India. The last time something like this happened was many, many years ago. Standard Chartered did this. Right now, we will be the first company who's attempting this, which means we have the burden of actually helping the regulator to work alongside us to get to the finishing line. So
with that, it is a wrap on this bulletin, but our Davos coverage continues on the other side. Stay tuned, don't go anywhere.
back. The conversations continue here at Davos 2026. Joining us now to take us through what the year ahead looks like is Renew Power Sumant Sinha. Sumant, many thanks for joining us here on CNBC-TV18. You've been here now about 48 hours, picking up on the conversations that people are having, not just about the global economy, but also about India. What are the key takeaways so far?
You know, this is a very interesting Davos, as you know, Shireen, because there's just so much going on globally.
Yes.
And everybody's walking around in a bit of a confused days right now as to what is likely to unfold over the next couple of days. And I think that will drive the agenda for the rest of the year for a lot of people. I don't think that we can overstate the importance of President Trump coming here, interacting with his European counterparts. And let's see what happens, what the outcome of that is. As far as India is concerned, India, I think, is in a good place because we are obviously doing very well domestically as an economy. Growth is good. And, we are not in the public's eye at this point in time. And that gives us the opportunity of doing our own thing, which I don't think is a bad thing in today's context, right? Yeah. So I think from that standpoint, and of course, there's a pretty heavy Indian delegation here. The agenda is mostly business and economic. It's not political, and I think that's a good thing.
Well, speaking about growth back home, and specifically as far as the renewable energy sector goes, we've also got the Minister Prahlad Joshi here at Davos. On course, on target, India and China continue to build on renewable energy capacity, driving that forward. Will 2026 be more of the same or anything different that you expect?
I think what's happening right now, Shireen, is that in the world now, there's a big division showing up, which is that there are those countries that are rich in fossil fuels, let's call them the petrostates, and those that actually don't have fossil fuels, like India or even China for that matter. These countries, and let's call them electrostates, are really going after the path of clean energy and electrification of their economies and decarbonizing that electrification, and therefore are doubling down on clean energy. And that's really therefore an opportunity for a country like India, because we, along with China, which has already taken a big lead, we can actually play catch up and become really the alternative big clean energy global player compared to anybody else in the world. The interesting stat is that last year, India added more solar capacity than the US did. So we're actually already the second largest solar market in the world after China. And I think we're at the vanguard of a lot of other interesting developments on clean energy, whether it's on green hydrogen, now the whole data center movement, which is also predicated on clean energy, all of that is taking off. So I think India is actually positioned very well, and there's lots of very interesting things going on.
Well, speaking of interesting developments, the US has been retreating from multilateral organizations. The Solar Alliance is one, organization that the US has decided to move out of. What are the implications of something like that?
Well, look, the reality is the US is the largest economy in the world, and in some ways is the largest cumulative emitter of carbon as well in the world. For them to withdraw from global climate change treaties is obviously a big setback for the world as a whole, right? But having said that, it was well telegraphed and well known to everybody that that's what they were going to do. So it wasn't a surprise. The good thing is that at COP30 in Belém in Brazil, all the other countries of the world got together and reaffirmed their commitment to climate change and dealing with it. And so I think that's really good that the rest of the world is going ahead. And so yes, I think the fact that the US is not going to do as much as they should have over the next few years' time is not great, but at least the rest of the world is going ahead, right? The US pulling out of all the other treaties like the ISA and so on and the UNFCCC, look, it can't be construed as being a good thing, obviously, because, apart from everything else, the US also has massive amounts of research and measurement and so on going on. All of that is now getting defunded. And that is obviously not going to be good for climate change efforts.
The year ahead for Renew Power, what are you going to be focusing on?
For us, it's very simple. We're going to carry on adding more capacity. We're going to, we're adding about 2.5 gigawatts a year of new solar and wind capacity. Now a lot of storage as well, so that will carry on. We also have a pretty big solar manufacturing business. We look to continue to monetize that business and add more capacity. And then, of course, we have also to look at this whole situation of whether we look at the delisting in some way or not. I thought I'll put that up before you ask about it. So we're going to look at that and see whether that makes sense, and if so, how does it make sense?
And you did preempt my question on a possible delisting from the US markets. Why do you feel the need to do that, and what will it take for you to be able to do that?
The reality is that ever since we got listed in the US on the NASDAQ 4.5 years ago, a lot of things have happened in the US market. The Fed has been increasing interest rates. Then, of course, Trump came in, and he was not a fan of clean energy either. And sustaining, money that is going into sustainability funds has started getting pulled out. So a lot of not good things have been happening in the US market as far as clean tech stocks in general are concerned. On top of that, we are an Indian company listed in the US. A lot of people in this kind of environment don't really want to invest in a company that they don't really understand much about in terms of the context of where we operate. And so we've not really had good sponsorship or good sort of research and investor support in the US market. So our sense is that it's probably better to just not be listed there. Whether that means that we stay private or whether we get listed at some point in some other market is something that we have to wait and see, of course. So in general, I would say getting delisted is not a bad thing. Whether we end up doing it or not, I can't say at this point because it depends on many factors. But the good news is that our business is sound and our business continues to go ahead. And that's really what I'm personally focused on.
So what will it take for you to be able to take that decision on A, whether you want to delist, and B, how complex is this process likely to be if you do decide to delist?
Well, it is a complex process because we are a UK domiciled company which is listed in the US. So we have to mind the regulatory regimes of both countries. And frankly, to take a decision to get delisted, it's not my decision as the CEO of the company. We obviously will have to set up a special committee of the board, which we have done. And really, it's going to be their decision that has, they'll have to drive the decision on this. And that group consists of all of our independent directors at the board level.
Okay, and then the regulatory approval, you'll require both the UK as well as the US?
Right. Yeah.
Okay.
Yeah.
Eventually, if it gets done, an India listing, is that something that you're, likely to work towards?
As I said, step one is let's think about whether the delisting makes sense and how to get it to work. It's a long and complicated process, and we've already had one bite of the apple that did not go off successfully. So I think we're going to be very mindful and careful about what we take up as the next step. Would an India listing be the next logical step? It certainly is one of the possibilities that we'll consider. But frankly, at this point, I think one step at a time, even being a listed company perhaps is a better outcome for us than being listed where we are.
Okay, so let me end by asking you, budget around the corner, from the sector's point of view, anything specific that you would like from the finance minister?
There's always a lot that one can ask for, but the government has, continues to do a lot of things in between the budgets as well. There's a new Electricity Act that is going to be introduced to Parliament in the budget session, which hopefully will then improve the overall DISCOM operating environment, which we are looking forward to. Of course, tax cuts are always welcome for any new investments that we are making. There was that tax benefit given to companies set up at a certain point in time. Perhaps things like that can be extended. And of course, I think anything on the green bond financing side, which is right now very limited to the extent that companies like ours can issue domestic bonds and avail of green bond financing rates, that itself would be quite good as well.
Well, we will find out on the 1st of Feb. Thanks very much, Sumant, for joining us here in Davos. Always a pleasure. Thanks for your time, and we hope that, we leave charged up at the end of this week. From all of us here for now, we'll take a quick break. The conversations will continue. Don't go anywhere. We're back in a minute on CNBC-TV18. Welcome back. You're watching our continuing coverage here from Davos 2026 to talk to us about IKEA's plans for the world. More importantly, IKEA's plans for India. Joining us now is the man who heads it. Yuvinsio, thanks very, very much for joining us here. And it's great to have you back with us in Davos. Thanks very much for your time. Outlook for 2026, despite all of the negativity in the headlines and the uncertainty, consumer spending has held up. What's the story that you're picking up on?
Good morning, Shireen.
Good morning.
Happy to be here. No, we are cautious and optimistic. We like to have a positive view of the future, and we are optimistic because more than ever, sustainability and affordability have to come together in the times we are in. And then, of course, it's turbulent times. That's why it's so important more than ever to secure low prices.
So on that effort of being able to secure low prices with tariffs and threats of more tariffs, how do you deliver on that promise of low prices?
You can panic on the short term, but then I always say that it's very important to zoom out and to see the long term. Because in the long term, the IKEA supply chain is designed to secure as much as possible low price. And in the here and now, companies have to navigate uncertainties. But I think it's important to keep the consistency in the long term while navigating the short term.
But in the here and now, what's the impact on the supply chain? How much are you being able to absorb? How much are you being able to pass on? What are you seeing?
We have made a big effort, IKEA in general, to try to secure low prices. And then IKEA tries always to take things step by step. And then we are very happy that more than a year ago we invested, from the retail point of view, more than 2 billion euros price reduction all over the world. Because our goal is not to maximize profit, but to maximize more homes with IKEA products. And this is the focus we are having.
Well, let's talk a little bit about India then. Yuvinsio, you have tried to accelerate your plans in India as well as speed up your store openings in India as well. But do you believe that you could speed things up even further? Because consumers certainly are hoping for that.
Yeah, I am. I always put a disclaimer when talking about India that I am emotionally biased. I am not objective. And India is deeply in our heart, my family and myself. We're happy that today, actually, we have opened online in Tamil Nadu, actually in some cities in Tamil Nadu. But over the last year, we have built a foundation. We have built a foundation to have a decent footprint, physical footprint, to start to operate online. The IKEA supply chain is also partnering with many suppliers in India to start to prepare the development. And now we want to go to the next phase. And we're the next phase where we can really create sustainable growth for the future.
And what kind of growth do you anticipate now in India that is going to be sustainable for you? What are you already starting to see on the ground? And what is the aspiration in terms of IKEA's own growth in India?
Yeah, knowing that the country is growing at 8% GDP, we have to, of course, grow more than the GDP, which is remarkable, by the way, this level of growth in India. I think it depends, because we are crushing the number of investment now, and it depends on the retail plans, but also on the ability that IKEA supply chain can partner with more suppliers. That's why, for me, for example, the QCO and all these standards, we welcome very much the intent to increase quality and increase standard. And then it's important to have a 2 years easy, smooth implementation. So suppliers, IKEA can work together with them, because the full intent is to plug in to the global supply chain. Do you know that India, when it comes to the global production of furniture, it's only 1% of the global production of furniture? Can we agree that India deserves more than that?
Yes.
Of course. That's why, for us, the easy implementation of the new standard, so then suppliers can plug into the global supply chain, is critical and important for the future.
So how much has the supply base grown in India, and how much has the export order book out of India grown for IKEA in the past 12 months?
So IKEA is exporting more than 400 million euros a year. Initially was only in textiles, but more and more there are other categories that are non-textile and are furniture-based. And this is a good signal. But this is just the beginning.
This is just the beginning. So what could that 400 million number look to grow to?
Depending, are we talk about next year or 100 years?
Next year. Who knows about 100 years in the world that we live in?
IKEA will still be there. Probably you and me will not, but IKEA will still be there. No, I think it depends on how can the suppliers in India can connect to the global supply chain. That's why I keep insisting a smooth implementation of the QCO to really help suppliers to upgrade. It's really, really important for the future.
Yes, quality control orders are something that you've been focused on, but let's also talk a little bit about what's happening online, because you have tried to speed up things online. You were slow off the mark, but you've tried to speed things up in the last few years. I know Delhi has been online, and you just spoke to us about some cities in Tamil Nadu going online as well. What's the experience been like growing online, and how many more cities do you intend to add?
Very good question. Online globally represents 30%, which is remarkable, and in some cities up to 50% in the world. And then in India we started only with the physical because we wanted to cement the experience from there, and then we are adding online. Online can grow significantly in India. For us, it's extremely important that online grows in a concentration way. So online grows as much as possible where we have the physical footprint, because it's important not only the sales part, but also of the efficiency part. All the delivery, the warehousing, the product, that has to come hand in hand.
So in terms of your offline presence, we're still waiting for Noida.
I am waiting to. And Gurugram.
And Gurugram.
They are big
Delhi has seen a small format store. So what has India also taught you in terms of experimenting with formats, and is that something that you are going to look at taking to the rest of the world as well?
Absolutely. I like to say that this is a marriage, and one side is IKEA can contribute to a better life at home for many people in India, and India is making IKEA better.
A love marriage or an arranged marriage?
I love marriage. I love marriage. And a long-term love marriage. But and this is important because we are learning from India. We are learning from India how to optimize footprint, how to optimize cost,